Okay, good afternoon to all of you. Let's start our first chapter for discussion in advanced accounting. So, what is the name of the chapter, sir? Preparation of financial statements of companies, or we can simply call it as financial statements of a company. This is a very important chapter, sir. I can say this is the base chapter. So the knowledge of this chapter will help you in so many other chapters. So definitely you have to focus on this chapter. You have to learn it. Not just from examination perspective, sir. Not just from examination perspective. Even practically also, this is one of the very important chapter. Okay, let's start. Sir, what we are going to learn in this chapter, preparation of financial statements of company. What are the things we are going to cover in this chapter? Let me first give you a brief idea about the contents what we are going to cover in this chapter. It's like a bird's eye view, so that when you are making a preparation, you know exactly what is there in this chapter, what you are going to prepare, and accordingly this order only I will discuss the topics. See, first I'm going to explain you some basic concepts relating to financial statements. What are the basic concepts we are going to cover? First, we are going to understand meaning of financial statements. Meaning of financial statements of companies we will cover, sir. Second, section 128 of Companies Act 2013, very important section we will cover, sir. Next, section 129 of Companies Act 2013 I will cover, sir. These are the basic concepts we are going to cover in this chapter. Of course, what I will do is I will link with one chapter called framework. Framework for preparation and presentation of financial statements. One chapter is there. That chapter is also released by our ICI. Actually, the main object of that chapter is to on what basis accounting standards are prepared, or whenever a ICI wants to develop any new accounting standard, what is the knowledge they should have. That was there in the framework chapter. So in the framework chapter, there are some concepts relating to financial statements, like what are the components of financial statements, what are the features of financial statements, who are the users of financial statements, like that some concepts are there. So I will link up with those concepts and I will cover them, so that in this chapter some parts of the framework also I will cover. Later on when I go to framework, I don't cover them. And see here I am covering now, therefore I don't cover there. Only remaining parts I will cover when I go to the framework chapter. Okay, next, once you understand these basic concepts, some theory points also like annual report, annual return, like that statutory registers and books company need to maintain, like that some other theory concepts also there, we will see them. But most importantly, in basics you need to understand what is financial statements and section 128 and section 129 of the Companies Act. Now once you understand the basic concepts, the second part we are going to cover is schedule 3 of Companies Act 2013. Very important. Schedule 3 will give you what? The format of financial statements of a company. And also it will give you the general instructions. Actually the name of schedule 3 is what? General instructions for preparation and presentation of financial statements. And after that one more concept is there, sir. That is dividend concept. See, in companies, one of the special concept is what? Dividend. So relating to dividend also, in this chapter we are going to cover. Especially suppose when a company wants to declare a dividend, especially from past profits, what are the conditions they need to comply? All these things we are going to cover it. So this is the overall chapter, sir. And in this, the most important aspect is this one, sir. You have to focus on this one. And mostly 14 marks question will come from this. Okay, 14 marks question. And by the way, what is the weightage of this chapter? The weightage of this chapter is 14 marks. Generally, a 14 marks question will come from this chapter. Sometimes another 4 marks can also be asked. If you see, dividend question also they are asking. So, for example, from this dividend concept, sir, a 4 marks question they are testing. Okay, so 14 plus 4, 18 marks may come from this chapter. One 14 marks question, one 4 marks question. Sometimes what he will do, he won't ask 14 marks question. He will ask 2 4 marks questions, like that he will ask. So therefore, the best possible case is 14 marks question will come from this. And another 4 marks question is also a possibility. Relating to schedule 3, some practical questions are there. They may test those practical questions also. They are testing practical questions. In our study material, some practical questions are there. Generally, those practical questions only they are testing in the examinations. Okay, this is the overall view of this chapter. And you know, the meaning of financial statement as per Companies Act, this question asked in law once. I think 2 times they asked this question. Meaning of financial statements. How confident he is about the students. Even student doesn't know the meaning of financial statements. True only. Because when I ask a student what is financial statements, he will tell balance sheet, P&L, next, that's it. Cash flow statement. If you directly write in examination balance sheet, P&L account, cash flow statement, they won't allot marks. You need to write like balance sheet as at the end of the year, P&L account for the financial year, cash flow statement for the year, statement showing changes in equity, notes to accounts, explanatory note forming part of the above. Like that you need to explain perfectly. That is the meaning. Okay. So these are the things we are going to cover in this chapter, sir. That is financial statements of a company. Now let us first start with the basic concepts. Okay. So what is the first concept we are going to cover in basics? Meaning of financial statements. Meaning of financial statements. Sir, if you see the Companies Act, sir, there is a section called section 2. Section 2 exclusively deals with the definitions. Section 2 clause 40 deals with the definition of financial statements of a company, which says financial statements include the following. First one, balance sheet as at the end of the year. Second, P&L account for the financial year end, for the financial year. And if you are a NPO, non-profit organization, in place of P&L you will prepare income and expenditure account. Third, cash flow statement for the year. Fourth, statement showing changes in equity if applicable, because this statement showing changes in equity is applicable only for listed companies. And the last one, any explanatory notes, any notes to accounts forming part of the above for P&L account, balance sheet, cash flow statement. Okay, statement showing changes in equity. Relating to them, if you prepare any extra, if you want to give any extra information, that is called notes to accounts, explanatory statement. That is also part of financial statements. So in financial statement there are 5 things will come. 5 things will come. What are the things covered in financial statements of company? First one, balance sheet, sir. Second one, see, financial statements includes balance sheet at year end, and then P&L account or income and expenditure account for non-profit activities, cash flow statement for the year, statement of equity changes if applicable, explanatory note incorporated in any above document. These are the 5 things we call it as financial statements. Now important things here, you know, in financial statements definition, what they have covered, sir? Tell me. Balance sheet, P&L account, cash flow statement, statement showing changes in equity, statement showing changes in equity. This is one. And what is the last one? Notes to accounts are also called as explanatory notes as statements. Explanatory statement or notes to accounts. So to put it simply, notes to accounts forming part of above. Notes to accounts forming part of above documents. These 5 things are called financial statements. Now listen, balance sheet P&L account, balance sheet P&L account, notes to accounts. These 3 things. In this chapter we are going to cover these 3 things. Cash flow statement covered in CFS chapter. Even though it is part of financial statements, we are going to cover in CFS chapter, not here. And what about this statement showing changes in equity, if applicable? Generally, statement showing changes in equity is applicable for listed companies. Listed company. And actually, in schedule 3 we have 3 divisions. Next I am going to explain it. Division 1, division 2, division 3. Division 2 is applicable for companies which are subject to Indian accounting standards. Now if you are a company, for you Indian accounting standards are applicable now, you need to prepare statements showing changes in equity. So generally for normal companies, unlisted companies, statement showing changes in equity is not applicable. So therefore I can say that this is not there in our syllabus. Okay, this we are not going to learn. Notes to accounts we are going to cover it. So therefore out of these financial statements, we cover balance sheet, we cover P&L, we cover CFS, we cover notes to accounts. The only thing which we don't cover is what? Statement showing changes in equity. Statement showing changes in equity we don't cover here. There are no questions relating to it. So therefore we don't cover it. And here one important point, sir. Sir, see, if you are a OPC company, if you are OPC, that is one person company, small company, dormant company. What is dormant company? Inactive company. In the Companies Act they defined what is dormant company. Dormant company and startup company, that is private company, startup private company. See, for these 4 categories or these 4 companies, cash flow statement is not applicable or cash flow statement is not required. Cash flow statement is not required, sir. Important, listen to me, understand carefully. Because generally CFS is mandatory only for big companies. Even accounting standard 3 also says the same thing. It is applicable only for level 1 listed companies. Level 1 listed companies. Level 2, level 3, level 4. We have 4 levels in non-corporates, which is given by ICA, which we are going to cover it in applicability chapter. So level 2, level 3, level 4, cash flow statement is generally not applicable. Only for level 1 it is applicable. In corporates, it is applicable only for non-SMCs. Non-SMC means other than small, medium-sized companies. If you are a small, medium-sized company, sir, then cash flow statement is not mandatory for you. Not mandatory, not required. If you want to prepare, you can. See, CFS is not mandatory. See, for them, CFS is not mandatory. But if they want to prepare, they can prepare. If they want to present it, who stops them? Nobody. They can prepare, but they need to comply with accounting standard 3. They need to comply with accounting standard 3, because for CFS there is a separate chapter, separate standard, so they will follow this. Okay, so meaning of financial statements are this. So that means we have completed the first topic, that is meaning of financial statements of a company. So as per section 2 clause 40 of the Companies Act, financial statement includes these companies. And the note point also I mentioned, OPC, small, dormant company, private company, startups may not need the cash flow statements. Okay, now next topic is what, sir? Section 128. Important section this is. Section 128 of Companies Act. Sir, what is Section 128 of Companies Act? See, 128 talks about maintenance of books of accounts. Maintenance of books of accounts. So maintenance of books of accounts, sir. Maintenance of books of accounts. Maintenance of books of accounts. Sir, tell me, if you want to prepare financial statements, what is required? Information, books of accounts required. Without having any data, information, how will you prepare balance sheet, P&L, cash flow statement? Not possible. Therefore, every company has to maintain proper books of accounts. That was prescribed in section 128. This is important section for a chartered accountant. Suppose you went for a audit, you went to a company. Okay, you asked them, submit books of accounts. I want to do the audit. They said, sir, we don't prepare any books of accounts. Okay, give me financial statements. You asked financial statements of a company. They said, sir, we don't prepare financial statements. Since you are the chartered accountant, you came for audit now. You prepare books of accounts. You do the audit. You prepare financial statements and you do the audit. You are the professional. You know how to prepare financial statements, books of accounts. We thought you should do all these things. You are like an accountant of the company. So please maintain all the books of accounts, you yourself, and prepare financial statements. Do the audit. It is like, for example, you write the exams and you correct your own answer sheet. Now company said like that. So what is your answer, sir? Tell me. What do you tell to the person who said this? You said to him that, hey, I am a chartered accountant. I came for audit. I am not an accountant of your company. My job is only to audit. Audit means what? Verification. Whether you have done correctly or not. That is only I will do. Remaining things you need to do. Books of accounts you need to maintain. Financial statements you need to prepare. Sir, where they said, sir, you are saying, no, section 128. You go and read section 128. Section 128 clearly says that every company, the section starts with what? Every company. So every company should prepare and keep at its registered office proper books of accounts, papers, documents, financial statements for every financial year. So therefore, for every financial year, you need to maintain proper books of accounts, papers, documents, and even financial statements you need to prepare for every financial year. And that too in accordance with what? In accordance with accrual basis, double entry system you follow. Accrual basis, double entry system. Sir, you said I will maintain books of accounts. I will take one diary. In the diary I will write. Like for example, you go to a small what do we call, small provisional store. What is that? Dabba shop, one small shop here where they will sell small things. Kirana, like small shop. Okay, what he will do? He will, in one book he will write everything, right? So small, I mean sales, purchases, all these things. Can company also maintain like that? No. Why? Because section 128 says nothing doing. You should follow accrual basis. That too double entry system. That means cash basis of accounting not permitted. Why? You tell them section 128. So once 128 is a awareness program. If client says I am not responsible, you tell him section 128. I don't maintain books of accounts, section 128. I don't follow accrual basis, section 128. I don't follow double entry system, section 128. 128 says you have to follow, boss, all these things, and you maintain books of accounts, because only if you do that you can prepare financial statements based on that. Even preparation of financial statements is also your responsibility. Your responsibility means who is responsible in the company? Employees, management. Management means board of directors. Board of directors are responsible, not the accountant, not the employee. For example, in your house, if something happens, only the head of the family will be asked, you are the responsible, like that. In a company, the responsible persons are whom? Board of directors. They need to absolutely make sure that company will comply with accounting standard. Company should comply with all the provisions of the Companies Act. So therefore, section 128, the key words of section 128 is every company, there is no exception whatsoever. Every company, what they need to do? Every company should prepare and keep at its RO, registered office, at its registered office. Registered office means principal place of business is called registered office. At its registered office, what should prepare and keep at its registered office? Proper books of accounts. Proper books of accounts, papers, documents and financial statements for every financial year. Proper books of accounts, papers, documents, financial statements for every financial year. It is your responsibility. You need to prepare and keep. So the important word is what here? Every company. The word every company. What every company need to do? Prepare and keep. What? Proper books of accounts. Proper word they used. Not according to your liking. Proper books of accounts. Papers, documents, financial statements in this for every financial year. In accordance with what? In accordance with accrual. In accordance with accrual basis and double entry system. So they need to maintain books of accounts on what basis? Accrual basis, double entry system. So from now onwards, in your mind, you should fix that for companies only accrual basis are applicable. Whenever you will get a doubt why cash basis are not applicable, you need to understand it is section 128 coming into the picture and says, hello, accrual basis only applicable. Cash flow statement, you go to hell. Income Tax Act, mostly if you observe now, Income Tax Act, they follow cash basis. For them only received, paid, relevant. But accounts, we don't follow cash basis. We always follow accrual basis. That too, which system? Double entry system. What is double entry system? For every debit, there is a credit. For every transaction, there should be two aspects should be there. That is double entry system. And, okay, sir, one more interesting point, sir. Okay, you said every year we need to prepare all these things. How many years we need to keep them? 8 years, 8 financial years. Why? Because meanwhile any scams came, anybody, income tax department, any department wants to verify your books, the book should be ready. Suppose you are a person who is doing a lot of frauds. What is your intention? Immediately after preparation, you try to destroy the records. For that purpose, they said nothing doing. Relating to any financial year, you need to keep the books of accounts for how many years? 8 years. So these books should be kept in good order. Books, etc. Books, etc. means all the books, documents, papers should kept in good order. Good order for how many years? 8 years. So you should keep them in good order for 8 years. You cannot say, sir, some books eaten by rats. Some books we have given to that person who is selling ice creams. Whenever we want to eat ice cream, we have given some books to him. He has given some ice creams. You cannot say like that. That's why they said good order. Good order means they should be properly documented, properly neatly aligned like that. Not like that. Suppose they will be thrown into one room, and whenever a person came, a department came, go and verify. In that room, all the documents is there. Like when you go to a government office, you see a lot of documents, right? They don't be properly. They are not in good order. It should not be like that. So books, etc., should be kept in good order for how many years? 8 years. That's it, pa. This is section 128. So 128 is giving you some good knowledge about the maintenance of books of accounts. Why section 128 is relevant for us? Because in order to prepare financial statements, first the company should maintain proper books of accounts. Then only financial statements preparation is possible. That's why. Hello, you understood? So section 128, this one. Section 128, maintenance of proper books of accounts. Every company should prepare and keep at its registered office books of accounts, other relevant books and papers, financial statements for every financial year. And what is the basis? Accrual, double entry system. How many years? 8 years. And where these books should be kept? Registered office. And of course, true and fair view must be given. Sir, we prepared all the books of accounts, financial statements, everything, but everything is wrong, sir. What is the use? Tell me. All these books of accounts, everything you are preparing, na, they should give what? True and fair view. Next, section 129, pa. Very, very important section. Section 129. Very, very important section for us being a professional. Two sections are very, very important being a CA. 128, 129. What 129 says? 129 talks about financial statements. Financial statements. The name of the provision itself is financial statements, sir. The name of the provision itself is what? Financial statements. Okay. Sir, what this section 129 says now? Whenever you are preparing financial statements, those financial statements must reflect true and fair view, and they will be prepared in accordance with schedule 3 by complying with accounting standards. So when you are preparing financial statements of company, you should follow section 129. What it says 129? The financial statement should give true and fair view. That means all the information in the financial statement should be true information, fair information only presented. Second, the financial statement should be prepared in accordance with the format which is prescribed in schedule 3. Third, accounting standards you need to comply when you are preparing financial statements. This is what section 129 says. Otherwise, what people will say, why I need to follow accounting standards? 129. Why I need to follow schedule 3? 129 says. See, if law said something, we need to comply, na? So therefore, that compliance, the source section is section 129. So therefore, this section says financial statements when you are preparing should reflect what? True and fair view. Should reflect true and fair view. Second, financial statements should be prepared in format of schedule 3. Whatever the format given in schedule 3, in that format only financial statement should be prepared. And the last one, comply with accounting standard. Comply with accounting standards. So we can call them as what now? Prerequisites, or what are the things you should keep in mind when you are preparing financial statements. So when you are preparing financial statements of a company, you should keep in mind these things. So the following should be kept in mind while preparing financial statements. While preparing financial statements. So what are the things we should keep in mind when we are preparing financial statements, sir? First thing you need to remember, sir, schedule 3, sir. Whenever we are preparing financial statements, schedule 3 requirements we need to keep in mind, and also accounting standards, whatever the accounting standards are there, you should keep in mind. And then third thing is other statutory provisions, whatever the provisions as per law applicable, you have to comply. For example, Companies Act provisions, if applicable, you need to follow. And also, sir, guidance note given by ICAI, guidance note given by ICAI, guidance note given by ICAI. So these are the things you should keep in mind. And apart from that, this standard says now financial statement should reflect true and fair view. This is the bottom line. Actually, you should not forget it. So financial statement should always consisting of true and fair information. So therefore, you see, when you are preparing financial statements, sir, you should first comply with what? Schedule 3, which is there in your syllabus. And when you are preparing financial statement, you should comply with accounting standard. All the standards are there in your syllabus. Other statutory provisions, Companies Act is there. Guidance note given by ICAI, it is not there in your syllabus. That's why I said, in your syllabus CA Inter, you are learning all the standards. And all the standards must be complied when you are preparing financial statements. That's why in the first day itself I told, only one chapter we are learning. What is that? Preparation of financial statements of company. All other chapters are supporting this. This is how. Because when you are preparing financial statements, you should comply with accounting standard, you should comply with schedule 3, you should comply with other statutory provisions. Of course, guidance note is also there given by ICAI. Our institute, whatever the guidance note given in so many areas, those guidance note also we need to follow. Actually, this guidance note is there in the old syllabus, but in the new syllabus they removed it. Guidance note is no more applicable to you. So therefore, these three things are there in the syllabus. But in this chapter, we are going to cover exclusively schedule 3. And the knowledge of accounting standard you are going to get when we learn accounting standard one by one. So therefore, you need to understand, unless and until you complete learning all the accounting standards, this chapter is not complete. Even though we say financial statements of company chapter over, but technically it is completed only when the entire syllabus is completed. Because whatever the provisions are there in the accounting standards, those provisions also we should apply in the preparation of financial statements. Especially in accounting standard, there is one segment called disclosures. What kind of disclosures we need to make in the financial statements? Those disclosures are prescribed in accounting standards only. That means until and unless you complete learning all the accounting standard, preparation of financial statement chapter is not yet completed. Only when you complete all the accounting standards, then we say preparation of financial statements of company chapter is completed. Okay. So therefore, section 129 is very, very important section, sir. Basically, this section will talk about, say this, section 129, financial statement should give what, sir? Always true and fair view. And they should comply with what? Accounting standards, which is prescribed in 133, section 133. And they should be in the format which is prescribed in schedule 3. Hello? And this point I told, inspired from section 129, this point is drafted. That is, what are the points we should keep in mind while preparing financial statements? When you are preparing financial statement, we should follow schedule 3, statutory requirements, accounting standards notified by MCA, statement and guidance note by ICAI. I want every one of you to confirm once again, when you are preparing financial statements of company, what are the things you should keep in mind? Schedule 3, that is what we are going to cover in this standard. In this chapter, first thing what we are going to cover, schedule 3. Next, accounting standards. Third, other statutory provisions. Last one, guidance note given by ICAI. Okay. So I think I have completed the most important part, that is the meaning of financial statements. Section 128, section 129. Okay. So once we complete these things, next I am going to start schedule 3, sir. First part is over, na, sir. Next we are going to start what? Schedule 3. Okay. And sir, one important point, sir, here I would like to tell you, sir, schedule 3 is what? The format for preparation and presentation of financial statements. But is this schedule 3 is applicable to all companies? Like for example, there is a banking company. Banks will also prepare financial statements, right? Shall they require to follow schedule 3? No, because see, they say if there is any specific act is applicable to your company, in that specific act, if there is a specific format prescribed for you, you follow that format, not schedule 3. For example, if you are a banking company, you have Banking Regulation Act. There they have a prescribed format. For example, if you are an insurance company, IRDA Act, IRDA regulations, Insurance Act is there. For you, there is separate format there. And suppose if you are an electricity company, Electricity Act is there. But Electricity Act does not prescribe any format. Therefore, again, they need to follow schedule 3. So, therefore, you need to understand schedule 3 is applicable for those companies for which there is no specific accounting, specific act, specific format is applicable. Only those are covered in schedule 3. If you are a banking company or if you are an insurance company, for you specific provisions or specific format which is prescribed in the respective act is applicable, not schedule 3 format. Hello? Important point this is. See this. Specific act applies to insurance, banking, electricity companies. For all other companies, schedule 3 is applicable. So you need to remember. But you write down here one important point. Electricity companies, here you write down, schedule 3 is applicable. Because for electricity companies, sir, there is no specific format prescribed. Therefore, obviously, they need to follow what? Schedule 3 they need to follow. See, one more important point I forgot, sir. Super point, say this. In companies, what happens? Say this. First, books of accounts ready. They will ready the books of accounts. Books of accounts, they will prepare and they will ready. Once the books of accounts are ready, next step is what? Once books of accounts is ready, what is the next thing? Preparation of financial statements. Preparation of financial statements. Once preparation is done, next, once preparation is done, financial statements prepared. Next, audit. Once audit is over, they will conduct one meeting called AGM, Annual General Meeting, AGM. In the AGM, these financial statements will be approved. Financial statements are approved. Actually, see, here the concept is, first books of accounts are ready, sir. Once books of accounts are ready, financial statements will be prepared. Once financial statements are prepared, sir, they will be approved by board of directors. They will approved by board of directors. Then go for audit. Once auditor's audit report is given along with the approved financial statements of board of directors, a meeting will be conducted, AGM, Annual General Meeting. In that AGM, financial statements will be approved by shareholders. AGM financial statements are approved. In AGM, who will approve the financial statements? Shareholders. So first board of directors will approve, then shareholders will approve. Shareholders are owners of the company, right? Definitely every year company will conduct one meeting, AGM. In that AGM, these financial statements will be laid down. And in the AGM, shareholders will approve it. Once the shareholders approve the financial statements, what happens next? Next, they will release annual report. Company will release annual report of that year. And one more thing, dividend concept will also come. What is that? Dividend concept. Okay. Now, see, why I am telling all these things now? Who is responsible to lay down the financial statements in the AGM? Board of directors. It is the responsibility of whom? Board of directors. So board of directors should lay down financial statements for approval in the AGM. So BOD is responsible for this. BOD is responsible. BOD is responsible for lay down of financial statements. Okay. Suppose if the financial statements are not laid down, then board of directors will be punished. It is their responsibility. They should make sure that financial statements will be laid down in AGM. This point is also there in section 129. See this. Section 129 also tells this point. See this. So under 129, BOD should lay financial statement before the company at the AGM. Okay. So that's it. Section 129 done. Now, sir, I told you, sir, every company at the end, they will release one written called annual, annual report. That is, they will release the annual report. Every company, once the AGM is over, they will submit annual return to ROC. Register of companies is there, to whom these are submitted. This is just a theory point, not important. Okay. And every company should maintain some statutory books. I told you company should maintain proper books of accounts, documents, papers. They will maintain all these registers, which will come in law. You come across all these things, like for example, register of investments, register of charges, register of members, register of debenture holders, security holders, register of minute books, register of contracts arrangement, register of directors, key management persons, register of loans and investments. These statistical books, these things they won't ask in exams, sir. Okay, these are all just theory points. You see them. Main important things I told you. Next. So first part we have successfully completed, sir. So shall I revise first part? What we have discussed so far? First, we understood what is financial statements of a company. As per section 2, class 40 of the Companies Act, financial statement includes balance sheet at the end, P&L account for the financial year. If you are NPO, see here, if you are a NPO, non-profit organization, NPO, we don't prepare P&L, we will prepare income and expenditure account. Why? Because if you are a NPO, your object is not to earn income. So you don't have any profit or loss. You have only surplus or deficit. That's why income and expenditure account. And CFS, which is covered in next chapter, CFS, statement showing changes in equity, and then notes to accounts forming part of above. And for one person company, small company, dormant company, private startup company, CFS is not mandatory. And section 128, which is says maintenance of books of accounts. Every company should prepare and keep at its register office proper books, documents, papers, financial statements for every financial year in accordance with approval basis, double entry system, and books should be kept in good order for 8 years. And 129 says when you are preparing financial statements, you should make sure that these financial statements are true, reflect true and fair view, and they are in the format of schedule 3 and they will comply with accounting standards. And it is the responsibility of the board of directors to lay down these financial statements before the shareholders in the annual general meeting. Now let us start the next part, which is schedule 3, the most important part. Okay, sir. Now let us start the most important part of this chapter, that is schedule 3. Schedule 3 of Companies Act, sir. Companies Act 2013. See, basically schedule 3 will provide what? Schedule 3 will provide general instructions for preparation and presentation of financial statements. For preparation and presentation of financial statements. Okay. See, in schedule 3 we have 3 divisions. In schedule 3, sir, we have 3 divisions. Division 1, division 2, division 3. Division 3. Division 1, division 2, division 3. Division 1 is applicable to those companies which are required to comply with accounting standards notified under section 133. Division 2 is applicable to companies who are required to comply with Ind AS. Division 3 is applicable to NBFCs, non-banking finance companies. Important this is. So division 1 is applicable to whom? Companies who are required to comply with accounting standards notified under section 133. So applicable, division 1 applicable to companies to whom AS applicable. AS means normal accounting standards applicable under section 133. Under 133, the government will notify the sections which is applicable to companies. For them, division 1. Division 2 applicable to companies to whom Ind AS applicable. Important, Ind AS applicable. So if you are a company, for you Ind AS applicable na, how you are going to prepare financial statements? By following schedule division 2 formats. Division 3 is applicable to whom? NBFCs. I told na. So this is exclusively applicable to NBFCs, non-banking finance companies, to whom Ind AS applicable. So if you are a non-banking finance company, for you Ind AS applicable now, for you division 3 is applicable. So like this, division 1, division 2, division 3, 3 divisions are there in schedule 3. Division 1 is applicable to companies to whom normal accounting standards are applicable. Division 2 is applicable to companies to whom Ind AS applicable. Division 3 is applicable to NBFCs to whom Ind AS applicable. Say this. So division applicable to division 1, companies required to apply AS notified under 133. Division 2, companies required to apply Ind AS. Division 3, NBFC is required to apply Ind AS. So therefore you need to understand, sir, okay, whether all divisions we need to learn in CA inter syllabus. Will we required to learn division 1, division 2, division 3? See, for us we are subject only to this one. In CA inter level we cover only this one. CA inter level we cover only this one. That is division 1. Division 1 only we cover. Division 2, companies who is required to follow Ind AS. In CA final they will be covered. So generally this is covered in CA final level. It will be covered in CA final level. But you know, in CMA inter syllabus, if you see na, for them division 2 is also there. But the problem is they have division 2, but there are no Ind AS. In the syllabus they have only 5 or 6 Ind AS, but in the financial statements of companies division 2 is also there. I am shocked by looking at the syllabus of CMA inter. In CMA inter level itself division 2 is there. But how can a student will understand division 2 without having knowledge on Indian accounting standard? He cannot, because division 2, I mean financial statements, if you are a company who is required to follow Ind AS, is little bit tough, little bit standard is high level. For that to understand, first you need to understand division 1 properly. So thank God ICI has done the right thing. They have given only division 1. First we learn division 1. Then CA final level you are going to cover division 2. Okay. Division 3 also, I mean division 2 means division 2 and 3 both are covered in CA final level. Only division 1 is applicable for us. That means only the companies which are required to comply with the normal accounting standards. I told na, in India normal accounting standards, Ind AS. Only the companies which is required to follow normal accounting standards, we need to learn how to prepare financial statements. Hello. Now, sir, okay. So we need to learn division 1. In division 1, sir, you know, in division 1, we have 2 parts. Division 1, we have 2 parts. Part 1, part 2. Sir, part 1 talks about what? BS, balance sheet. Part 2 talks about what? P&L account. That's it. So, division 1, part 1, balance sheet. Division 1, part 2, P&L account. So, first we are going to cover part 1. Then we are going to cover part 2. So, division 1, schedule 3, division 1, part 1. See this. Actually, if you see the heading properly here, schedule 3, part 1, balance sheet. Schedule 3 means which division? 1, division 1. I told now there are 3 divisions. In that division 1, the company who is required to follow normal accounting standards. In that part 1 talks about balance sheet format and instructions, how balance sheet will be prepared. Okay, pa. Now I am starting the balance sheet and P&L account. First I will finish balance sheet, then I will go to P&L account. Okay. Now, before I am going to explain the format of balance sheet, first let us understand the most important, the basic part. What are the elements of financial statements? Elements of financial statements. See, I told you, after listening to my class, you should not have any confusion or doubt. Everything will be covered in a detailed manner. So that much guarantee I can assure you. So even if you are a first time listener, you don't know anything, if you listen to me carefully, I will make sure that you learn everything. So next time, explaining the concept of elements of financial statements. What is elements of financial statements? Elements of financial statements. What balance sheet P&L account will consist? See, in an entire accounting, only 5 things. Assets, liabilities, incomes, expenses, capital, equity, nothing but. That's it. Only these 5 things. Na? In this assets, liabilities, equity, balance sheet, incomes, expenses, P&L. Agreed or not? Assets, liabilities, equity. These 3 comes in balance sheet. So elements of financial statements. Actually, these elements of financial statements, they have given in which chapter? Framework chapter. So that's why I said now I will connect with framework. So if you see the framework of preparation of financial statements, this said there are 5 elements. One is asset. Asset is the first element. Second, liability. Second element. Third, incomes. Fourth, expenses. And what is the last one? Equity. Nothing but capital. Okay. Sir, because in order to prepare the financial statements, you need to understand what generally will consist in financial statements. Na? In financial statements, balance sheet is there, P&L account is there. In balance sheet, what items will come? You need to know. In P&L, what items will come? You should know. That's why I'm explaining this. That's why I'm connecting with framework chapter. I'm connecting with framework chapter. If you open the framework chapter in your material 9th chapter, 9th, check once. Framework for preparation and presentation of financial statements, one chapter is there. 9th, go to that 9th chapter. In that, see the areas of framework. Have you been able to see this? Areas of framework. In areas of framework, first one we already completed, components of financial statements. Balance sheet, P&L, cash flow statement, notes to accounts, all these things we covered. Definition, sir. Now come to 5th one. See this, elements of financial statements. Have you seen it? What are the elements? Asset, liability, equity, incomes, expenses. Correct? Now I am explaining these 5 to you. Why I am explaining these 5? Because they are only form part of financial statements. So if you see carefully, sir, when you are preparing balance sheet of a company, in balance sheet what items will come? Assets, liabilities, equity. These three items will come. When you are preparing P&L account, sir, what items will come? Incomes, expenses. Now see, incomes includes gains also. Income includes gains also. Expenses includes losses also. Expenses includes losses also. We don't write separately. Incomes means gains also included. Losses means, expenses means losses also included. Okay. So in P&L account, incomes and expenses will come. In balance sheet, assets and liabilities, equity will come. Now let us discuss one by one, sir. First of all, what is asset? Can anybody tell me what is asset? Asset means what? First of all, is it necessary to learn what is asset? Is it necessary? We know what is asset. Building, asset. Plant and machinery, asset. Debtors, asset. Furniture, asset. Generally these are assets. But is that sufficient? No. Generally you are saying all these are assets. But in all circumstances, all situations, this will not work out. Sometimes you need to judge whether it is my asset or not. On what basis you will judge whether it is my asset or not? So you should learn the criteria. That criteria was there in the framework chapter. The framework says, listen, what is asset? Asset is a resource controlled by an entity from which we are expecting future economic benefits. Asset is basically what? Resource controlled by the entity. The word control is absolutely necessary. If you don't have control, that is not your asset. Control means what? For example, this building is there. Suppose, for example, I was appointed as a watchman. So what is the watchman job? He can restrict who can enter into the building. So that means I have control. Can watchman have control? Can we say he is the owner of the building? That means you need to control, means you need to see who is controlling the benefits of this asset. Who is controlling the future economic benefits of this asset? Now who can give this building for rent? And who will decide this building will be utilized for which purpose? That person we say he is having control. And this building will become asset to him. Even though he may not be legal owner. In accounts we don't see legal ownership. We see only substance over form. We will see the financial reality. The reality is who is controlling the future economic benefits of this property, he will become the owner. Even framework is also saying the same thing. Therefore, what is asset? Asset is basically a resource controlled by you and from which you are expecting some future economic benefit. You are expecting some future economic benefits out of it. It is not saying you should have a legal ownership. For example, best example is what? Hire purchase. When I purchase anything on hire purchase basis, the seller will give me possession. Immediately I will take the possession. I will use it. That means who is having risks and rewards? The buyer. Even though legal ownership is not there with me, but still I am the owner because I am controlling the property, the future economic benefit. For example, I purchased a car, sir, on hire purchase basis. That moment I purchased the car, the person will give the delivery. Now, whether this car, how it has to be utilized, whether I can give for rent, right? Whatever I want, I can do it with this asset. That means the risks and rewards of this asset is my hands, even though I am not legal owner. So in accounts, always see what is asset for you. Asset is basically a resource controlled by an entity from which we are expecting future economic benefits. So asset is basically what, sir? See this. Asset is basically a resource. The important word is the resource. Controlled by an enterprise. The word is control. And we are expecting to generate FEB, future economic benefits. So therefore 3 keywords, sir. What are the keywords? Resource. We should have control over it. And we are expecting what? FEB, future economic benefits. FEB, future economic benefits. Now, here control means what? Control means control over future economic benefits of the asset. Control over FEB, that person. Legal ownership not required. Legal ownership does not required. What we see? We see substance over form. What is substance over form? We will see the financial reality, not the legal formality. Substance over form actually, which is given in AS1, which says substance over form says give importance to financial reality over legal form, over legal formality. For example, sir, see this. There is a company A Limited, sir, which has purchased a building. When they purchased the building, 25th March 2025, they purchased a building. 25th March 2025, A Limited purchased a building. But see, this is the building purchase date. Purchase. But registration happened. Building registered. Registration will happen now. When registration happened? For example, 15th April 2025. Registration happened. Now you tell me, when you are preparing the balance sheet of A Limited, in the asset side, will you show this building or not? Will you show this building as an asset or not? Building. For example, the building they are purchasing is 100 lakhs. So suppose, tell me, when they purchased the building? 25th March. Purchased. Purchase means what? We paid the consideration, agreement entered, everything is done. Next, but officially registration when happened? 15th April. That means on 31st March, when the company is preparing this balance sheet, is this an asset for the company or not? Will they have to recognize it in books or not? The answer is yes, they have to recognize in the books. Because why? We need to see substance or form. Building is a resource for us. Control. Who is having control? A Limited. The moment I entered an agreement executed, I purchased the building. My control, my possession, my control. I am controlling it. Controlling the future economic benefits. And I am expecting some economic benefits out of this asset. In future, I can rent it or I can use it for production. Hello. Future economic benefits means what, sir? Either income should come or my cost will be saved. Suppose this building I purchased. In future, I can give it for rent. Income. Or suppose in this building I am started my business. That means rent I am saving now. So future economic benefit means either I should able to generate some income or I can able to save some cost. That is also FEB. FEB doesn't mean always income. Even savings and cost is also FEB. So if anything, any resource I have a control is saving my cost in future, that is also my asset. That is also my asset. So therefore in this case, sir, on 31st March 2025, they should recognize this as their asset in the books. They should recognize it. Because you need to see what? Substance over form. Whether they have control over or not. Yes. Registration is just what, sir? Legal security. Registration is just a legal security. For legal purpose, this has to be done. But you don't see the legality. You see the substance. That's what substance over form concept says. Substance over form means don't see the legal formality. See the substance over form. So asset definition, I hope I explained. So therefore tell me, when you are preparing the financial statements, asset, basically in order to recognize an asset, what are the three things you should have? First, it should be a resource. You should have what? Control over it. Control means what? Control over future economic benefits. Second one is you are expecting some future economic benefits. So control you should have, and you should be able to expect future economic benefits. Then it will become your asset. Okay. Next. Second one is what? Liability. Can you tell me what is liability? Liability. For example, we have taken a bank loan. Is it a liability? Goods purchased from suppliers. Is it a liability? Liability. Liability means what? Liability means the framework says liability is basically a present obligation arising from past events and the settlement of which involves outflow of resources. So to become a liability, first thing is there should be what? Present obligation. Present obligation should there. Present obligation means something you cannot avoid is called obligation. You have to do it. Present obligation means on the balance sheet date there is an obligation. Already obligation is there. There is a present obligation and this obligation arises from past events. Past event. For example, you taken a bank loan. It's a past event. That past event is now giving a present obligation. What is that obligation? You need to repay the loan amount. Present obligation from past events. And to settle this obligation, what I need to do? Settlement involves outflow of resources. Settlement involves outflow of resources. Some resources must go out to settle this. Then only it become a liability. Otherwise it is not a liability. For example, my friend is taking a bank loan and bank asked for guarantee. I have given the guarantee. Is it a liability or not? Tell me. My friend is taking bank loan here. I have given the guarantee. Guarantee means what? I am giving guarantee to the bank. If he doesn't pay, my friend doesn't pay, I will pay. That is a guarantee, right? Tell me, guarantee given, is it a liability? It is not a liability. Why? Apply this definition. Is there any present obligation? Why there is no present obligation? See, as long as my friend is paying, I am not liable. If only when my friend failed, I need to pay. That means the moment I signed the guarantee agreement, there is an obligation for me. But outflow of resources, as of now, it is not there. Settlement involves outflow of resources. So guarantee is an obligation, present obligation. But as of now, there is no outflow of resources. Therefore, it is not a liability. So therefore, to become a liability, it is not just present obligation. You need to see whether to settle this obligation, is there any outflow of resources? If there is just an obligation without outflow of resources, you cannot consider it as a liability. For example, provision for warranty. We sold goods on warranty basis. We have given 2 years warranty to the customer. What is the meaning of warranty? If within these 2 years anything happens, repairs, we will do free repairs, replacement we will do. That means there is a present obligation and this obligation requires settlement of resources, outflow of resources, because in order to replace the asset, in order to do the free repairs, company involves some cost. Therefore, company should treat it as a liability, create a provision. See, most of the students I know, they are not understanding what is liability. See, to become a liability, 2 things are required. First thing is present obligation. On balance sheet date, there is an obligation. Second thing is, this obligation settlement involves outflow of resources. Then it becomes a liability. Sir, if any one is missing, it is a contingent liability. Sir, there is no present obligation. Contingent liability. Sir, there is a present obligation, but there is no outflow of resources. Contingent liability. For example, there is a case pending in the court. Whether we liable or not, only decided by the court judgment. As of now, there is no present obligation. Therefore, it is a contingent liability. For example, my friend is taking a bank loan. I have given a guarantee. As of now, even though there is a present obligation, there is no probable outflow of resources to settle the obligation. Because as long as my friend is paying, bank will not ask me. That means I cannot consider guarantees given as a liability as of now. Because even though there is an obligation, there is no outflow of resources to settle the obligation. So therefore, company point of view, when something will become my liability, company should have a present obligation, and company is estimating, or company is more expecting that to settle this obligation, definitely what involves? Outflow of resources involves. Then only it becomes a liability. So you understand what is liability? Tell me, what is liability? Yes, liability is basically a present obligation that requires outflow of resources for settlement. Outflow of resources. So two things are very, very important. One is present obligation. Second one is outflow of resources. Present obligation is there, outflow is not there, not a liability. Outflow of resources is there, present obligation not there, not a liability. Okay, pa. So two things I explained, pa. Asset as well as liability. For example, bank loan taken, pa. Liability or not? Apply the definition. Present obligation there are. Yes, the moment you taken a loan, there is an obligation to repay. Okay, and is the repayment involves outflow of resources? Yes, you need to pay the amount. Outflow of resources means your asset will go out. Basically, asset is what? A resource. This resource outflow means asset will go out. When you want to settle a liability, there is a outflow of resources. Outflow of resources means outflow of assets. My intention is outflow of assets. Okay. So assets to liability is over. What is the next one? Equity. What is equity? Equity means residual interest in the company. Residual interest means the difference between assets and liabilities is called equity. So equity is very simple, sir. The difference between assets and liabilities is called equity. Assets and liabilities is called equity. So which is a residual interest. Residual means remaining, correct? So from the assets, if you reduce all the liabilities, what is the amount left out? That is called equity. Suppose, see, when I prepare a balance sheet of a company, sir, for your understanding I am preparing, sir. Actually, you should not prepare like horizontal format. According to schedule 3, you need to prepare financial statements on vertical basis, one after another. But here I am writing horizontal basis for your understanding. On one side assets, on the other hand liabilities, na sir. Hello? Suppose asset side you will write all the assets. For example, all of your assets are 100 rupees. All of your liabilities is 60 rupees. That means 100 minus 60, how much, sir? 40. This is called equity. Actually, what is this equity? It is nothing but share capital plus reserves and surplus is called equity. Share capital plus reserves and surplus is nothing but equity. We simply call this as what? Equity. Equity means shareholders funds. What comes in shareholders funds? Capital they contributed, and at the same time the reserves, the undistributed profits, they will come here. So therefore the difference between assets and liabilities is nothing but equity. So when you prepare a financial statements of a company, equity will come. What is the equity? This is the residual interest in assets after deducting liabilities. After deducting liabilities, how much amount still there in the assets? That is called equity. For example, just now I told my assets are 100 rupees, sir. My liabilities is 60. How much is the balance left, sir? 40. 40 is what, sir? This is the balance of assets. From this 100 only I am reducing the 60 na. That means this 40 is what? Balance of assets. This balance of assets belongs to whom? Shareholders. That is called equity. So therefore in my business 100 rupees is there in the form of assets. 60 rupees liabilities will go. Remaining 40 rupees only owner's amount. Can they take total 100 rupees? No, because that's why they are called owners na. Ultimately they have to bear the loss. At the end only they have to take. First they have to pay all the outside liabilities. Sir, suppose for example your family is there, sir. You taken a lot of borrowings. Okay. Suppose you decided to sell the building property and settle all the liabilities. Suppose you sell the building for 100 lakhs. 100 lakhs came. What do you do with that 100 lakhs? First you will take all 100 lakhs. Huh? What do you do? 100 lakhs first you will use to settle all the outside liabilities. Only balance left will be taken by you. Correct? It is not that first I will take, sir. 50 lakhs is required for my personal things, personal survival. Remaining 15 lakhs only I will pay. That should not happen, na? Because companies are incorporated as per Companies Act. They have regulations and rules. Okay. So equity is nothing but equity. How to calculate? Assets minus liabilities. Now that means here the one important point is whenever there is a change in assets and liabilities, your equity will be affected. Most of the students, they are unable to understand accounts. Why now? They don't know the interlinking. Because they are not understanding. Suppose assets increased, equity will also increase. Liability increase, equity will decrease, because the difference between assets and liabilities only equity na. So look at the interlinking, sir. Look at the interlink. That's why there is a concept called accounting equation. Accounting equation approach. What is accounting equation? Can anybody tell me? Accounting equation is nothing but equity is equal to, or else I will write like this. Assets is equal to liabilities plus equity. This is the equation, sir. Always remember this equation. Assets is equal to liabilities plus equity. Because the logic is very simple, sir. Balance sheet logic is very simple. Sir, can anybody tell me what is the logic of balance sheet? One side assets, another side equity and liabilities. What is the logic? Asset side is called what? Sources. Sources of funds. Liability, equity and liability side is called what? Sorry. Reverse. Asset side is called application. Application of funds. This side is called sources. Sources and applications are nothing but, on a particular day, your sources should equal to assets. For example, my father gave me 100 rupees. That is my source. Now with this 100 rupees, I purchased one book, for example. So book is my asset, 100 rupees, application. Cash given by my father is a source, 100. So therefore, see, say for example, capital brought by the owner, capital, share capital, 100. With this 100, company purchased one land, 100. So balance sheet tally it. For example, share capital 100. With this 100, land purchased 50. Remaining 50 is there in the cash and bank balance, 50. Balance sheet tally it. So therefore, always you need to understand, sir, your sources and application should be equal on a particular date. Sir, suppose in your pocket 100 rupees is there. Can you spend 120 rupees? No. In order to spend 120 rupees, the 20 rupees you need to get from somewhere. That means again source will be created. Similarly, company, from where they have brought the funds, sources, where they are putting the money, application. That sources and application, if you see now, it should tally on a particular day. What are the major source to the company? Capital, liabilities. They will bring capital. They will take borrowings. That is only sources now. What is application? Where they will spend the money? Assets. They will purchase assets. They will create assets. And they do business. They earn profits. And the profit earned is also there as a part of sources. That's why share capital plus reserves and surplus. Reserves and surplus includes the profit you earn. Hello? So therefore, you need to understand, sir. So equity, assets, liabilities, equities. Three things I explained, sir. What is the next one, sir? Sir, these three things come, where they will come? Balance sheet. So therefore, balance sheet will always consisting of which items? Come on, tell me. Balance sheet consisting of which items? Assets, liabilities, equities. Only these three items. Whenever you are preparing balance sheet, you should fix in your mind. These items will come. Next, income. Can anybody tell me what is income? Income. Income. Income means increase in economic benefit. Because of income, ultimately, what is the net effect? Can you tell me? Think and tell me. Suppose income came. What happens? So, increase in economic benefit. One thing. Next thing. Increase in financial resources. For example, company made sales, sir. Sales. Sales is an income. Because of sales, what happens? Tell me. Sales. Because of sales, if it is a cash sales, cash will come. If it is a credit sales, debtors will create. That means asset will be created. So always remember, income will create an asset or it will decrease the liability. That means it is ultimately affect the equity. See, look at the connection here. Equity means assets minus liabilities. Equities, assets minus liabilities. Income means it will either create an asset or it will decrease my liability. Liability, for example, expense. Expense means what? What expenses will do? Either it will create a liability or it will decrease my asset. ultimately equity will be affected. Therefore, see, you know, in business, any income came, any expenses incurred, ultimately is going to affect my balance sheet. Because if it is an income, it will affect my asset or liability. If it is affected my asset and liability, means it is going to affect my equity. And suppose expenses came. Because of expenses, either there is a decrease in asset, increase in liability. For example, salaries. Company paid salaries. Cash balance will reduce. That means because of expenses, your cash balance reduces, your asset decreases. If your asset decreases, what happens to equity? Equity will also come down, because the difference between equity, assets and liabilities is nothing but equity. So look at the interconnection. Based on that interconnection, you need to see when you are preparing financial statements in the question, suppose income given, you need to understand, okay, income given. Because of income, what is the effect? This income will come in P&L account. Okay. This income is also going to affect my asset, or it is going to impact my liability. You need to check and give a corresponding effect. If it is there in the adjustments, they will give trial balance. After that, adjustments they will give. Anything which is given in adjustment means the effect is not yet done. Hello. For example, in adjustments, they have given outstanding salaries. Outstanding salary means salary incurred but not paid. Salary incurred means it is an expense. So it will come in P&L account. At the same time, outstanding salary will impact my balance sheet. It will create a liability for me. So I need to impact my balance sheet also. So therefore, any item, if it is an income or expense, it will affect my P&L. At the same time, it will affect my balance sheet also. If it is already impacted, you don't do any other adjustment. If it is not impacted, if it is given in additional information, when you are preparing financial statements, you should give corresponding effect in balance sheet also. So income means what? Increase in economic benefit. Increase in economic benefit, which ultimately create an asset or decrease my liability. Hello? See this. What is income? Income increases economic benefits either by inflow of assets, decrease of liabilities, excluding owner's contributions. That means ultimately it is affecting my owner's contribution. That means equity. Other than, see, generally equity will be affected by owner's capital. Apart from owner's capital, for which reasons equity will be affected? Because of incomes and expenses. So income means what, sir? Can anybody tell me in simple manner what is income? Increase of my, yes, increase of economic benefits. Increase of economic benefits. What happens because of income? Simple. Assets will increase. Assets will increase. Or liabilities decrease. Liabilities decrease. And ultimately, because of the assets and liabilities, what will be impacted? Equity. If your assets increase, liabilities decrease, equity will also increase. So somebody asks you, you need to understand, you need to tell them. Income means what? Income means increase in economic benefit, which will come in P&L account. In P&L account, income side we will show. At the same time, because of the income, asset will create or liability will decrease. Ultimately, it will increase my equity. Best example, for example, sales, 10 lakh rupees. See this. When I make a sales, what is the entry? Cash. Suppose if it is a cash sale, cash or bank account debit to sales account. 10 lakhs, 10 lakhs. Look at this. This sales will go to P&L account because it is my income. What about this cash and bank balance? It is my asset created na. So this. So asset increased because of the income. So when the asset increases, obviously equity will also increases by 10 lakhs. Net effect I am saying, sir, because equity is nothing but assets minus liabilities. What about expenses, sir? Same, opposite. Expenses means decrease in economic benefits. Decrease. My benefits got decreased. Economic benefits. Ultimately, because of expenses, what happens? Either my assets will decrease. My assets will decrease or my liabilities will increase because of this. And ultimately what happens to equity? Equity will be decreased. My equity will decrease because of this. So for example, salaries. Company paid a salary of 10 lakh rupees. See this. What is the entry for salaries? Can you tell me? Salary to cash or bank? Hello? Salary to cash or bank. Or for example, salary is incurred but not paid. Salary to outstanding salary. Correct? 10 lakhs, 10 lakhs. This salary is what? Expenses. Which will come in P&L account as expenses. Correct? Now this outstanding salary is what? Liability. Which liability increased by 10 lakhs. Obviously it reduces my equity by 10 lakhs. So now you tell me the accounting equation approach. So therefore you tell me, is it interesting or not? You know this point. I think maybe you can revise it now. So in the business, if any expense came, any income came, so the effect should be in the P&L as well as in the balance sheet, especially if the information is given in adjustments. You understand the interlinking? This is called accounting equation approach. Actually based on this approach you can write accounting entries also. That's why in order to write the journal entries there are two approaches: double entry system, accounting equation approach. In foundation they will tell you this, but most of the student doesn't able to connect it. Now that's why I have connected here. See, if you want to write the entries, personal account, real account, no need. Just think like this: assets, liabilities, equity. Expenses came. What is the impact of the expenses? You see, expenses we pay or we incur, we don't pay. In either case, because of expenses, what happens? My outflow, my benefits will decrease. Either liability will create or asset will decrease. If I pay expenses, my assets will decrease. Or if I incur expenses not paid, my liability will increase. So therefore asset and liability will be impacted. Obviously equity will be impacted. So that means I have explained all the elements. Hello? So expenses, you understand, decrease in economic benefits either by outflow of assets. Outflow means decrease, or increase of liabilities, excluding owner's contribution. So without owner's contribution also equity will be affected because of what? Expenses and incomes. So you understand all the 5 elements. So tell me, what are the 5 elements of financial statements? Assets, liabilities, equity, income, expenses. Out of these 5, which 3 elements comes in balance sheet? Assets, liabilities, equity. Which 2 will come in P&L? Incomes, expenses. What is asset? Resource we should have control and we are expecting future economic benefits. Liability means present obligation from past events, and to settle this obligation, outflow of resources should be there. What is equity? Difference between assets and liability, residual interest in the company. Residual interest in the company. That means when your assets and liabilities are impacted, obviously equity will be impacted. Obviously equity will be impacted. Now what is income? Your benefits will increase. Ultimately because of that, either asset will increase or liability will come down. Obviously equity will increase. What about expense? Decrease in benefits. Because of this, either liability will increase or asset will come down. Ultimately my equity will come down because of the expenses. Okay. Now sir, one more important point sir. When you are preparing financial statements, sir, for whom you are preparing financial statements? Why we need to prepare financial statements? Because see, ultimately 2 things I want to know. What are those? Sir, every business owner wants to know 2 things, sir. Suppose you started a business, you want to know 2 things. What are those? Your performance, your position, correct? Which performance? Financial performance. Which position? Financial position. If I want to know the financial performance, I will prepare what? P&L account. If I want to know the position, I will prepare balance sheet. Okay. Now, apart from you, who else wants to see these things? in the company there are different category of people. Okay, so they are called as stakeholders or users of financial statements. So in the framework chapter I have given users of financial statements, they have given. See this, investors are there. Investors means shareholders. Hello, investors means shareholder. Equity preferential. What they want to know, shareholders? They want to know they want to assess the performance, profitability and financial position. Employees also want to know na. Sir, suppose you are working in a company, you want to know the performance of company or not. Why you are bothered? Why you want to know? Because whether you will get salary or not, whether you are going to get your retirement benefit or not. Suppose for example you don't know the profits, how much profits this company is earning, what is the financial position of this company. Suppose you don't want to know, means what? You are in very danger. Because suppose for example suddenly one fine day you came to know that this company is full of losses. What happens to your PF amount? What about to your gratuity amount? What about your salary? Nothing. 1 rupee also will not be recovered. That's why even employees also very much interested to know the financial position performance. They want to evaluate the stability, continuity and growth. Who wants to travel with your company, sir? Suppose if you are a loss making company, will anybody wants to travel with you? No, they want growth, stability, continuity. That's why they are also see your financial statements. Suppliers and creditors, those who give goods on credit basis, they will see credit worthiness now, whether you should be able to pay the amount or not. For example, today you went to one showroom and you purchased something, bill 50,000. You asked them, this 50,000 I will pay after 1 month. Will they agree? No, they will see your credit worthiness, right? Whether this person is able to make the payment or not. So for that they need to study the financial statements. Customers, even customers also want stability and profitability. For example, you want to purchase the shares of a company or you want to purchase a product of a company. Definitely you will check the financial statements. Of course, sir, we are going DMart, we are purchasing so many products. We don't know the which company product also that. You are saying even customers also. In general, I am saying here, I am talking about a customer who have financial knowledge, who wants to analyze these things. I am not talking about Aam Admi, normal customer. Sir, I will go to DMart, I will purchase bingo packet, I will eat. Snacks I will purchase, I will eat. Why I am bothered about ITC financial statements and all? I am not talking about those customers, only eating. These customers, they are very much wants to analyze the stability and profitability of the company. For even sometimes customers are also users. Government, sir, tell me, government is also one of the users, right? Why government bother about my performance, my company performance? Taxes, sir. Taxes, social contribution, how much you spend in CSR activities, corporate social responsibility. Government only will see. Lenders, lenders will also definitely they want to see your performance. For example, when you went to a bank loan, bank will first ask for your return. Where is your income tax return? Where is your balance sheet? They will ask. Where is your P&L account? They will ask. Now that person will come to us, CA, sir, please prepare balance sheet and P&L. These days now, so many people only they are preparing finance. They will come to chartered accountant only when they are going for loan. They don't have any other information. Only when the loan wants, they are coming and they are asking, sir, please prepare balance sheet and P&L. And we are preparing and signing it. And they are submitting for the loans. Next, public. Even public also want to know how many job opportunities you will create, how much companies will contribute. So these are all the people who are the users of financial statements. So you are preparing financial statements for all of these people, sir. So it is not just investors, sir. Employees, suppliers or creditors, customers, government, lenders, public, everybody interested in your financial statements. So look at the importance of these financial statements. Once in every year they are waiting for this. So that's why it is very important to understand and learn how to prepare the financial statements. And sir, what are the qualitative characteristics of financial statements? This is one of the very, very important things, sir. Sir, when you are preparing financial statements, this question they may ask in exam, sir. You need to remember only headings. 4 headings you need to remember, sir. Not 4, 4. What are the characteristics of financial statements? So we are learning how to prepare financial statements. These financial statements should have 4 characteristics. This was prescribed in framework by ICAI. They say first thing is understandability, second relevance, third reliability, fourth comparability. URRC, you remember like this, URRC, URC, understandability, relevance, reliability, comparability. Listen, first understandability. Sir, when I look at your company financial statements, it should be easily understandable to me. Sir, what are you talking, sir? Suppose one person is there, he is having a tea in a tea shop. Now I given him the financial statements of a company, Tata Steel. Will he understand anything? He don't understand anything. Then how can you say understandability? See, they are saying that understandability means people with accounting knowledge, they should able to understand. Not everyone. People with reasonable accounting knowledge. Reasonable accounting knowledge. When they look at your financial statement, they should understand. For example, one company financial statement, they give it to me. I have seen the financial statements. I am unable to understand. Being a chartered accountant, I am unable to understand means. Sir, what kind of a chartered accountant you are, sir? You don't understand balance sheet, P&L account. You qualified. Hey, I am a qualified chartered accountant. I understood the financial statements, but you prepared in such a manner, even people with reasonable knowledge also unable to understand. It should not be like that, they are saying. That means don't show your creativity. Suppose once you become chartered accountant, you go to companies, na? You guys shown all your creativity and you prepared some P&L account balance sheet. Nobody will understand that. You used whatever the words, headings you like, whatever the amounts you want to put, you put it, and you prepared financial statements. And people with knowledge, they see they are unable to understand. They said that's why understandable means information should be easily understandable by users who is having basic financial knowledge. They should able to understand. Not everybody. You should prepare in such a manner. Not like some Harappa, Mohenjo-daro language, Chinese language, Japanese language, some kind of, now I will become father of accounting. Louis Pacioli is become old. Now I will be the father of modern accounting. I will prepare in different manner. Don't show your creativity. Next, relevance. What is relevance, sir? Sir, financial information should contain all the relevant information. Relevant information means the information which influence the decisions of users of financial statements. So financial statement must include only information which influences the decisions. Sir, last 3 years, company not declared 1 rupee also dividend. But we will hide that information. We don't disclose it. If that information is disclosed, anybody who sees our financial statements will think like this. Hey, this company last 3 years, 1 rupee dividend also these guys does not give. I don't invest in this company. Correct? Suppose for example, you are having 10 lakh rupees here. You want to invest in a particular company. What is the first thing you see? Suppose you want to earn some reasonable income. You will see dividend. Whether this company is declaring proper dividend or not. But that information, those guys not disclosed in the financial statements. Intentionally they hide it. The framework chapter says no. Please include relevant information. The information which influence the decisions, intentionally you should not hide it. Third, reliability. Abba. Reliability means, sir, look at our financial statements. Look at the profit. When compared with last year, 4 times profit increased. Assets 5 times increased. Why? How it is possible to increase this? How means we increased it, sir? It is not actually increased. We increased. That means window dressing we have done. Should not do that. Reliability. It should free from material errors and bias. Your financial statement should be free from errors and bias. That means true and fair view. Last one, comparability. This is very, very important feature the financial statement should have. Comparability. Sir, they say financial statement should have the character of comparability. You should able to compare your financial statement with other company financial statements, and you should able to compare your financial statements of the current year with the last year financial statements. That is called comparability. That is called intraform. Intraform means with other company. Intraform means within the organization. Hey, this is important, pa. This is important. Listen to me carefully. Suppose I am Swiggy. Okay, for the year 25-26 we prepared what? P&L account, balance sheet. Now I want to compare with what? My competitor. Who is my competitor? Zomato. 25-26. I want to compare with my competitor P&L account and balance sheet. Now tell me, when comparison will be correct and give meaningful results? Only when there is uniformity. Suppose I prepared P&L account in one manner, Zomato will prepare in another manner. Whether comparison will be correct? Can you compare can you compare monkey and fish with their swimming ability? Swimming ability. Who is a good swimmer? Fish or monkey? Fish. Game over. But you want to compare. I want to compare monkey and fish. That means your comparison itself is wrong. Why it is not wrong? Because no set of skills. So therefore, when I want to compare with other companies, they should follow the same principles. I should follow the same principles. Therefore, I should prepare financial statements in such a manner the comparison is possible. So that's why they brought uniformity in accounting standards. Every company should follow the same principles. So your financial statement should provide that uniformity. It is not like I will prepare in my own manner. No, not possible. You should follow the accounting standard. You should follow the schedule 3. Your financial statement should be able to compare with others. Not only that, within your organization itself. Suppose 25-26 is the current year, 24-25 last year. You should be able to compare financial statements of the current year with last year. That is called comparability. So your financial statement should provide comparison. So therefore, these are the qualities the financial statement should have. Tell me, what are the qualities financial statement should have? URRC. U means understandability. Second, relevance. Third, reliability. Fourth, comparability. So these things you should keep in mind. So I think I have discussed all the basic elements of financial statements, sir. Now the conclusion is, now I am going to focus on the schedule 3. Now we are ready to understand schedule 3. Schedule 3 is basically what? Format of balance sheet and P&L. What items will come in balance sheet, how they will be presented, what items will come in P&L account, what items it will come. We need to understand. The basic things you understood, na sir? The elements, how many elements are there? 5. Asset, liability, equity will come in balance sheet. Incomes and expenses will come in P&L account. Now based on that we will understand these formats. Okay. Okay guys, let's continue our discussion. So now I am going to start schedule 3. First we are focusing on the balance sheet. Schedule 3 part 1 balance sheet. Please observe everybody how balance sheet of a company will be prepared. Exactly the same thing you need to apply when you are solving the questions. Okay. First, name of the company you need to mention. Then balance sheet as at or as on. Balance sheet as at or balance sheet as on. Because balance sheet is a point statement. On a particular day, on a particular point of time, what will be the position of assets and liabilities? That will be shown. That's why balance sheet as at or balance sheet as on we will write. For example, we are preparing balance sheet on 31st March 2025. So we'll write balance sheet as at 31st March 2025. Look at the format. Particulars, note number, figures of the current reporting period, figures of the previous reporting period. That means along with the current year we need to mention previous year data also. What is this comparison? I told you the financial statement, one of the qualities the financial statement should have is comparability. We should be able to compare the current year with the past years. This is called intra-firm comparison, intra-firm within the organization. For example, this is 31st March 2025. This is 31st March 2024. Always give current year, last year data. But in the question, they don't give. When they don't give, no need to present. But in practice, when you see the financial statements, they will consisting of current year figures as well as previous year figures. Okay. Now listen to me very carefully. Sir, in balance sheet, sir, as per schedule 3, balance sheet consists of two parts, sir. Balance sheet consists of two parts as per schedule 3. The first part of the balance sheet is equity and liabilities. Equity and liabilities is the first part, sir. Equity and liabilities is called sources of funds. These are sources of funds, sir. And then the second part is assets. This is called what? Application of funds. Application of funds. So on a particular day, your sources will be equal to your application. Now, according to schedule 3, sir, equity and liability side, we have 4 heads. We have 4 heads. The first one is shareholders funds. Shareholders funds. Second one is share application money pending allotment. Share application money pending allotment. Share application money pending allotment is the second head we will write in balance sheet. Equity and liabilities. Third one is non-current liabilities. Fourth one is current liabilities. Like this, on the sources of funds, we will get 4 heads. Shareholders funds, share application money pending allotment, non-current liabilities, current liabilities. Now when you see the application of funds, we have 2 heads. One is non-current assets, another one is current assets. Sir, I told you in elements of financial statements, the first element is what? Asset. Second element, liability. Now schedule 3 classifies the assets and liabilities into current, non-current. That's why you see asset side, current asset, non-current asset. Liability side you see current liabilities, non-current liabilities. Basically they are assets, basically they are liabilities, but they will be classified under current or non-current. Sir, how will you classify? Which one will become current, which one will become non-current? The criteria is also there in schedule 3, we'll see. So when a asset or when a liability will be classified as current, when it is a non-current, we will see it. But these are the major heads. These are the major heads. So see this. So on the equity and liability side, how many heads are there? 4. Asset side, 2. Now within this head, there are different categories, different items. Like for example, shareholders funds you take. Listen to me carefully. Shareholders funds, A, share capital, B, reserves and surplus, C, share application, money received against share warrant. In shareholders funds, A, share capital, B, reserves and surplus, C, money received against share warrants. Share application money pending allotment. There is no separate head in that. In shareholders funds, we will get 3 items. In share application money, no sub items, no nothing, directly. Next, non-current liabilities. In non-current liabilities, 4 items will come. 4 categories. In non-current liabilities, 4 categories you need to divide. One is long-term borrowings. Long-term borrowings. Deferred tax liabilities. Other long-term liabilities. And the last one, long-term provisions. Like that, 4 items will come. Long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Now come to current liabilities. In current liabilities, we have 5 items. 5. What are those? Short-term borrowings. Short-term borrowings, trade payables. Short-term borrowings, trade payables. And then other current liabilities. Short-term provisions. Only 4, sir, not 5, 4. 4 items will come in short current liabilities. Hello? So in current liabilities, how many items will come? 4. So total, how many sub items? 11. 11, sir. Now come to asset side. Non-current assets, current assets. See, you need to understand this format. What we are discussing now, you have to remember it as it is. The heading, the sub items. You have to remember. And only by repetition it will fit into your mind. So you need to repeat number of times, read number of times, and when solving the questions also you need to recollect the entire format. That's how you will remember, because this format you are learning, you will apply the same in amalgamation chapter, you apply the same in buyback chapter, you apply the same in other chapters, internal reconstruction, you apply the same in consolidation. So many places you will use this format. That's why I said this is the chapter which is helpful in so many other chapters also. So definitely this format should fit into your mind, and understand it is not fit at a time. You will understand this format only by repetition. Number of times you repeat, it will fit. So bar, again and again, again and again, again and again. You need to repeat it. While solving the question also, recollect the entire format. Then it will fit into your mind. So see this. Balance sheet divided into 2 parts. First, equity and liabilities. 1, shareholders funds. In that, A, share capital. B, reserves and surplus. C, money received against share warrant. Second, share application money pending allotment. Third, liabilities, non-current liability. Fourth, current liability. Non-current liabilities: A, long-term borrowings. B, deferred tax liabilities. C, other long-term liabilities. D, short-term, long-term provisions. Now current liabilities. In current liabilities, A, short-term borrowings. B, trade payables. C, other current liabilities. Last one, short-term provisions. Now come to asset side, non-current assets. In non-current assets, if you see, there are 5 items will be there here. In non-current assets are grouped into 5 categories. First one, first one is non-current assets. In non-current assets, the first one is PPE and intangible items. In that first PPE and intangible items, in that first PPE, then intangible item, then capital work in progress, then intangible assets under development. Within the first itself, there are 4 items will come. First head, 4 items. PPE and intangible items, there are 4 things you need to write. First PPE you need to write, then intangible items, then capital work in progress, the last one intangible assets under development stage. Second category is non-current investments. Third, deferred tax assets. Fourth, long-term loans and advances. Fifth, other non-current assets. Okay, so these are 5 items will come here. One is PPE and intangible items. Second, non-current investments. Third, deferred tax assets. Fourth, other non-current assets. Long-term loans and advances. After that, other non-current assets. Next, in current assets, we have 6 items. Short-term, current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. Current investments, first. Inventory, second. Trade receivables, 3. Cash and cash equivalents, 4. Short-term loans and advances, 5. Other current assets, 6. So total 11. Balance sheet tallied. So categories you see 11 will come. Equity and liabilities at 11. Categories, I am not saying headings. Main head in that breakup 11. So sir, see, forget about this format, sir. First of all, tell me common sense you use. Balance sheet generally consists of what? Assets, liabilities, equity. Correct? Assets. Which assets? What are the assets? Tell me some assets. Some assets names here. building, land, plant and machinery, furniture, debtors, investments, goodwill, copyrights, patents, trademarks, any loans and advances given, all this, stock, all these are what assets, sir? The same assets now properly organized. The format is nothing but they are properly organizing it. Like they divided the assets into two, current and non-current. In non-current they are saying that first PP and intangible assets, then investments, non-current investments, then deferred tax asset, then long-term loans and advances. You have given, asset means given. Others, every category you see there is others. Every category there is a others. You check non-current liabilities, non-current assets, current assets, there is others. Because how many items you can give separately? Only few. Remaining and all should come in others. Similarly, you go to current assets. What items are there in current assets? Short-term investments, in inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. Similarly, liabilities. Generally, what liabilities an organization will have? Bank loan, debentures, trade payables, any short-term loans, loans and advances taken from related parties, deposits accepted. These are all liabilities. They will be divided into two categories, non-current, current. In non-current, long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Current liabilities means short-term borrowings and trade payables, other current liabilities, short-term provisions. So like this, they have divided a classification. Properly they are organizing it. That's why we need to understand this format properly. We know balance sheet generally consisting of assets and liabilities only. But these assets and liabilities will be grouped under two categories, current, non-current. In current and non-current, what is the proper head under which they will be written? That also we need to understand. Now come back, see the format everybody. Yeah, see this. What is the first part, sir? Equity and liabilities. What is the first item? In that A, share capital. B, C, money received against share warrants. Next, what is the second head? Application money, pending allotment. What is the third item? Non-current liabilities. See these liabilities they have divided. Non-current. In non-current liabilities we have long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Now come to current liabilities. What is the first one? Short-term borrowings, trade payables. Again in trade payables there is a breakup. That total outstanding dues of micro and small. Total outstanding dues of creditors other than micro and small. Important, sir, this is. So when it comes to trade payables, sir, you need to give a breakup that how much amount you are outstanding for micro and small enterprises. Separately you need to write. Other than micro and small enterprises you need to write separately. Next, other current liabilities. Other current liabilities. Last one, short-term provisions. Total. So equity and liability side total done. Now come to asset side. You see non-current assets. In that, see property, plant, equipment, intangible assets, capital work in progress, intangible assets under development. Here you add, sir, like this. Actually, in balance sheet, non-current assets, right? A is nothing but PPE and intangible assets. Basically, in PP and intangible assets, PP will be written separately, intangible assets written separately, capital work in progress separately, intangible assets under development separately. What is PP means? These are nothing but tangible items, tangible assets. All tangible assets are considered as PP. Intangible assets means other than tangible. Like for example, tangible items means land and building, plant and machinery, furniture and equipment. These are all. Intangible means goodwill, patents, copyrights, trademark, franchises, brand. All these things, intangible items which does not have any physical substance. They are intangible. Capital work in progress means any physical assets under a development stage. For example, building under progress, construction, factory under construction, plant and machinery under construction, they are capital work in progress. They are also assets only, but under construction stage. Next, intangible assets under development. Through research and development, company will develop the intangible assets like any patent, copyright, trademark. In the research and development stage, they are called intangible assets under development stage. They will be shown separately. And then investments. Investment is basically what? Asset. Non-current investments, deferred tax assets, long-term loans and advances, other non-current assets. When it comes to current assets, you see, current investments, inventories, trade receivables, cash and cash equivalent, short-term loans and advances, other current assets. See, this is the format, sir. This is the format. And this format you need to repeat number of times. Then only you will understand. Okay. Sir, next, tell me, as per schedule 3, how liabilities are classified? Liabilities are classified into two categories. What are those? Current, non-current. Assets are classified into two. What are those? Current, non-current. Now, how they have made a classification? Let's check this. See, this classification criteria they have given. Important. Please listen to me carefully. There is a possibility of question from this. When we say a particular liability is a current liability, first I am going to discuss about current liability. What is that? Current liability. When we say a particular liability is a current liability. Sir, schedule 3 has given 4 criteria. 4. If any one is satisfied, that is current liability. If any one sufficient to say this liability is current liability. Basically, it is a liability. What is liability? Present obligation from past events, and the settlement of which involves outflow of resources. Today we discussed liability. So now we are going to discuss when we call this liability as a current liability. The schedule 3 says a liability is classified as current if it satisfies any of the following criteria. Any of the following criteria, if it satisfies, then we say the liability is a current liability. Now see this very, very carefully. First one, any liability expected to be settled in the company's normal operating cycle. Look at the wordings. Any liability, wording is what? Expected to be settled in the company's normal operating cycle. Is which liability? Current liability. What is normal operating cycle? They are saying that any liability which is expected to be settled within the normal operating cycle. Sir, what is normal operating cycle? How much time it is taken to convert the raw material into cash or cash equivalent? That time is called normal operating cycle. For example, raw material will become work in progress. Work in progress will become finished good. Finished good will become sales. We'll make a sales, na sir. It will become cash or cash equivalents. We make a sales. When we make a sales, either we make a cash sales or credit sales. If you make a cash sales, cash will be. If it is a credit sales, debtors. Debtors, again amount will be collected, so it will become a cash. Again this amount will be utilized for manufacturing raw material. So this is a cycle for any company, correct? For example, I am manufacturing this calculator, sir. To manufacture this calculator, first I will purchase raw material, right? Raw material holding period. This raw material is converted into work in progress, semi-finished, then finished, then sold. So therefore, see, to complete this circle, how much time it has taken. For example, you know, here raw material holding period 2 months. 2 months time, raw material holding period. Work in progress holding period 3 months. Finished goods holding period another 2 months. And after finished goods are produced, we need to do marketing, sell it. Suppose it will take another 2 months. Now tell me what is that cycle? 2 plus 3, 5, 5 plus 2, 7, 7 plus 2, 9 months is the NOC for this company. That means to this company, to convert raw material into cash, how much time it will take? 9 months it will take. This is called NOC. Now the schedule 3 says anything they are expecting to settle within this cycle. expecting to settle within the normal operating cycle. See, first of all, any liability, it must arising from operating activities and they are expected to settle within this normal operating cycle. That will be treated as what? Current liability. That will be treated as current liability. For example, within this cycle, for example, we are going to settle creditors, suppliers. We purchased goods from the suppliers. We are expecting to settle within this normal operating cycle. Suppose, for example, 9 months is a normal operating cycle. Creditors credit time is 6 months. That means we are expected to settle within the NOC, normal operating cycle. So obviously it will become what? Current liability. Current liability. So you see this first. Any liability expected to be settled within the normal operating cycle. Sir, suppose if normal operating cycle is not determined, unable to determine, then assume 12 months. If you are unable to determine normal operating cycle, assume 12 months. Because for some entities, it may not be possible to calculate this NOC. If it is not possible to calculate NOC, assume 12 months. That means any liability expected to be settled within the normal operating cycle of 12 months, it is which liability? Current liability. Suppose, sir, see, NOC came 15 months. Normal operating cycle, 15 months. Tell me. Suppose if it came 15 months, so if you want to settle it, a liability, 15 months, within the 15 months, is it a current liability? Yes. Yes. If it is an operating liability, if the normal operating cycle is 15 months, within that 15 months, if you want to sell, if you want to settle it, no matter what, it is a current liability only. No matter what, it is a current liability only. For example, creditor is there, supplier, creditor. Creditor is part of operating activities. Creditor is part of operating activities. We purchase raw material from him, right? So he is part of NOC. It is the liability arising from operating activities. And you are settling, suppose you are settling creditor within 15 months. Your NOC is also 15 months. Therefore, this creditor will be classified as what? Current liabilities. Generally, current liabilities only we will classify it. Hello. Suppose, for example, in this case, your NOC is only 12 months, but you are settling creditor within 15 months. Then, even though creditor is part of operating activity, operating liability, it is part of, but you are not settling within the NOC. Therefore, it will become non-current liability. It is not part of current liability. So, to become a current liability, in the first criteria, this one, according to this first criteria, first thing you need to remember is that liability should arise from the operations, our operating activity, main activity. What is operating activity? Relating to purchase of raw material, production, sales. Relating to this, if any liability arises, that is called operating liability. That liability you must settle within the normal operating cycle, then it becomes a current liability. Suppose the liability arises from operating activities, but you are not expecting to settle within the normal operating cycle, then it is not a current liability. According to this criteria, maybe it may become current liability as per any other criteria. Because see, there are 4 things here, right? I told any one, hello, I told any one of the following, any one is sufficient. But the first one, suppose if it is not satisfies, now you can check others also. Hello, you understand this? See this, everybody. For example, there is a trade payables for raw materials. We purchased materials, sir, from the supplier. What is the nature of liability? Operating. Relating to operations only, sir. It is payable during purchase, production, sale cycle, linked to day-to-day business. Correct? So it is definitely becomes which liability? Current liability. If it is payable within the normal operating cycle. Generally, trade payables for raw material is expected to pay within the normal operating cycle only. Similarly, bills payable accepted for goods purchased. Suppose I purchased goods from you. So I need to pay the amount. You draw a bill, I accepted. So bills payable is also what? It's an operating liability because it is related to purchases. settlement expected when sales are realized in the same operating cycle, say 15 months. For example, your operating cycle is 15 months. Creditor at least will expect the payment within the 15 months. Creditors knows that your operating cycle is 15 months. That means by what time your raw material is converted into cash? 15 months. So he will expect the payment within 15 months. That means this bills payable accepted for goods purchased is an operating liability, and generally which is expected to settle within operating cycle. Therefore, it becomes a current liability. Next to outstanding wages and salaries. See this, outstanding wages and salaries. Generally, it is also what? Operating. Suppose labor you employed in production process. So raw material, work in progress, finished goods. Raw material is converted into work in progress, finished goods. Labor has to be there. There are also operating activities, operating liability, and it is arising during production and paid within the operating cycle. So it is a current liability. Similarly, short-term working capital loan. For example, you taken a loan from the bank. That to short-term working capital to use in the production. So it's an operating liability, and it is used for financing the inventories and receivables, repaid from the operating cash flows. So basically, it is a which liability? Current liability. Like this. For example, you take an advance from customers. Advance from customers. It is an operating liability which is received against goods and services to be supplied during the same operating cycle. So it is also current liability. Like this, you need to understand, sir, GST payable or tax payable. For example, you need to pay GST now. Hello? Whenever you purchase material, you need to pay GST. Whenever you sell goods, you need to pay GST. So statutory dues arising out of trading transactions, they are operating, which is to be settled within the normal operating cycle. Then also they will become current liability. For example, you see one more thing, term loan for machinery. For example, you taken a term loan from banks, which is repayable after 15 months. Now, this term loan for machinery purchase, is it operating liability, non-operating liability? Non-operating, because it is no way connected with the raw material, work in progress, finished goods, production, no. So it's a non-operating. So basically, this is not operating, this is a finance liability. So therefore, it is not related to production cycle. So generally, it will comes in non-current liability category. Similarly, debentures. Suppose a company issued debentures. Which liability is this? Non-operating. They are not related to production. Debentures and all. So it's a long-term borrowings for financing unrelated to operations. So it is also non-current liability. Similarly, any lease liability for building. You taken a building for lease. 5 years lease. Is it anyway connected with goods production? Lease of building? No. So non-operating. So it's a finance liability over multiple periods. It's a non-current liability. Similarly, any provision for employees' gratuity which is payable after 2 years. It is also non-operating, not expected to settle within the current operating cycle. So it's a non-current liability. See, my point is very simple here. Here, most of the students are not able to understand. But understand the intention of Schedule 3. What Schedule 3 says is, when a liability is called current liability, that is what they are telling, right? First they are saying is, first criteria is, suppose there is a liability. You are expecting it to settle within the normal operating cycle. Normal operating cycle, you are expecting to settle it. So it is a current liability. But you need to understand here, suppose normal operating cycle in this case 15 months came. See here, normal operating cycle, for example, 15 months came. You cannot say all the liabilities I will settle within 15 months or current liabilities. No, that is not the intention here. First of all, that liability should arise from operating. Relating to this operating cycle, that liability is relating to your operations, not relating to other than operations. For example, trade payables, advance taken from customers, short-term loan taken for production, any outstanding wages relating to production, these are all related to this cycle, right? So that liability should arise from operating activities and which is expected to settle within this normal operating cycle. Then that liability will become a current liability. Hello? That's why, here, you see, come to current liabilities. In current liabilities, you see, current liabilities. You see this one, trade payables. Why they have taken trade payables here? Trade payables means supplier for goods. Generally, trade payables are operating liability, which we are expecting to settle within the normal operating cycle. That's why they have considered here. So you understand the first one, first criteria. When a liability is called current liability, expected actual settlement, expectation, expected to be settled when normal operating cycle. What is normal operating cycle? How much time it is taken to convert the raw material into cash and cash equivalents. That is NOC. This NOC can be more than 12 months also. No problem. If it is more than 12 months, then also it is current liability only. If that liability is part of operating activities and you are expecting to settle within the NOC. Here, it is not relating to 12 months. That NOC can be more than 12 also. NOC can be more than 12 also. If that liability is an operating liability and it is expected to settle within the normal operating cycle, it is classified as current liability. Even though it is more than 12 months. Doesn't matter here. Here 12 months criteria is not applicable. Here what is applicable? Whether you are expecting to settle within the normal operating cycle or not. Generally what items will come here? Trade payables. Trade payables, short-term working capital loans for use in the production, advance from customers, these things I told na. Bills payable, accepted, goods purchased, outstanding wages and salaries, short-term working capital, advance from customers, GST payable, these things will come. Because these are basically operations, operating, and they are expected to settle within the normal operating cycle. Okay. Sir, you understand this? Next, second criteria you see. Held primarily for trading. Sir, any liability held primarily for trading. Primarily for trading means trading of, trading operations, like for example, derivatives, futures, options, forward contracts. Company will enter na, sir. Those items will come here. Primarily for trading means sometimes some entities will do trading, purchase and sale of securities, like so forward contracts, so future contracts, so derivatives. From that any liability arises na, that is also classified as current liability. See this examples of liabilities held primarily for trading. For example, derivative liabilities like futures, options, forward contracts. Company will enter futures, forwards. So company may enter into currency or commodity contracts and their result in payable. Such liabilities are held for short-term trading generally. They will be classified as what? Here the important thing is what? They are held for primarily for what purpose? Trading purpose. That means trading purpose means short-term only. Similarly, any security short selling obligation, any brokerage payable by share broker, market to market margin payable, trade payables of dealer engaged in frequent buying and selling of goods, short term forward contract losses. These are examples. You write down these examples there. Futures, options, forward contracts. Generally derivative liabilities, these are called. Generally these are all comes under which category? Hello? Current liabilities. So futures, options, forward contracts, etc. So these items will come here. See here, options, futures, any derivatives, these items will come here. See, same point is there in current assets also. You see, current asset definition also telling the same thing here. You see here, held primarily for trading. Here assets, because of trading, sometimes assets will come, sometimes liabilities. If it is a liability, it is a current liability. If it is an asset, current asset. See, from trading, suppose for example from future contracts, option contracts, forward contracts, derivatives, disadvantage position comes, that means it's a liability. Advantage position is there, that is a asset. Hello? Next. See the next one. 2 criteria is completed, sir. What is the next one, sir? Which is due to be settled. Due to be settled within the due to be settled within 12 months after the reporting date. See this. Any liability due to be settled within 12 months after the reporting date. That is also current liability. Due to be settled within the normal, after the reporting date. For example, reporting date. Reporting date means balance sheet date, sir. Suppose 31st March 2025 is the balance sheet date. You are preparing financial statements. Now from here within the next 12 months, that means 31st March 2026. So from this day to the next year end, whatever the liabilities due to be settled, due, they are all considered as which liabilities? Current liabilities. These are all considered under which liabilities? Current liability. Suppose next 12 months you need to pay salaries outstanding, current liability. Next 12 months you need to pay rent, current liabilities. Next 12 months you need to pay any other expenses, any other liability. For example, bank loan you need to pay next 12 months, current liability. So they will come here, current liabilities. You understand? Next. So therefore, see, this is the most frequent and common we use, sir. This one, because in the question generally they don't give this one either. So therefore, only way we can say this liability is a current liability is what? If it is due to be settled within 12 months. For example, you see creditors given, creditors. Nothing mentioned means creditors are due to be settled within 12 months. So we will consider it as a current liability. That's why when you are preparing financial statement, most of the times we will use this only. Hello. Next, the last one you see, sir. No unconditional right to defer settlement of liability for at least 12 months after the reporting date. No unconditional right to defer the settlement of liability for at least how many months? 12 months. No unconditional right to defer settlement of liability for at least 12 months after the reporting date. If terms of the liability provide option to the holder to take shares for settlement of liability, it could not affect the classification of liability. Sir, what is this important point, sir? This one, once they have asked in exams also, no unconditional right, sir, to defer settlement. Defer means postponement. Postpone settlement of a what? Liability for at least how many months? 12 months. That means your company does not have an option to postpone a liability beyond 12 months. You don't have option to postpone a liability beyond 12 months. After the reporting date, suppose your reporting date is 31st March 2025. 31st March 2025 is the reporting date, sir. Now you cannot postpone a liability beyond 12 months. That means you have to settle it in the next 12 months. You don't have the unconditional right to defer the settlement of liability for at least 12 months. What is unconditional right? Unconditional right means on my own if I can take any decision. That is called unconditional right. But I don't have that right. That means I can't postpone the liability settlement beyond 12 months. Therefore, that kind of a liability will also be classified as what liability? Current liability. And even sometimes to settle that liability, we have given a holder the option to take what? Shares. Sometimes liabilities may settle by issue of what? Shares. That could not affect the classification of liability. Whether you go cash or shares or doesn't matter. Classification will not change. So therefore, the best example is, for example, loan repayable on demand. Loan repayable on demand. For example, we have given a loan, sir. Hello? We have taken a loan, for example. That loan is demand loan. That means whenever the bank calls, other party calls, we need to pay. That means can you tell me, suppose you taken a loan of 10 lakhs, sir. 10 lakhs from the bank. Time period is what? Demand loan. Demand loan means whenever bank calls, you need to pay. Bank will give you notice. Within 1 month you pay. That means you have to pay it. That is called demand loan. Now you tell me, on 31st March 2025, you have taken a loan repayable on demand of 10 lakhs. Will you classify it as current liability or not? You check it. Whether this 10 lakhs, can you defer the payment beyond 12 months? No, you can't defer the liability settlement beyond 12 months from the reporting date. That means whenever the bank calls, I need to pay. I can't defer it over the period of 12 months. Therefore, I have to classify this as what? Current liability. And suppose, another best example I could take, sir. For example, convertible debentures. Company issued convertible debentures, sir. Convertible debentures. 10% debentures company issued. Convertible debentures. Now it is the due date of this debentures is next year, 31st March 2026. Now I am on 31st March 2025. That means it is due in the next 12 months. Now can I postpone the settlement of this liability on my own? No. Suppose I am a company, I can postpone, I can say to the debenture holder that I am not paying this amount in the next 12 months. No, on my own I does not have the unconditional right to defer the settlement. Next 12 months it will falls due, how to settle it? Suppose for example, I am expecting that debenture holders will exercise shares. These are convertible debentures rights. Conversion option is there. That means instead of cash, what they can take? Shares. Whether, suppose if the board of directors are expecting that they will take shares, whether it will affect the classification? No. Sir, as a board of director, you may expect that shareholders may exercise the option and take shares or may not take the shares. Shares will taken or not taken or doesn't affect the classification of liability. This is still which liability? Current liability. So to become a current liability, any one of these four things satisfied, then that liability is a current liability. So basically understand what is current liability, sir. A liability which satisfies any one of the four. What are those, sir? Any liability which is expected to be settled within the company's normal operating cycle. What is normal operating cycle? How much time it will take to convert the raw material into cash or cash equivalents. Within this cycle, what liabilities you are expecting to settle? So basically that liability must arise from operations and you are expecting to settle within this cycle. Therefore, it will be current liability. Second, any liability primarily for trading purpose. When you enter any derivative contracts, future contracts, forward contract, because of that any liabilities arises, that is also current liability. And next one, any liability due to be settled within 12 months after the reporting date. After the reporting date, if you want to settle within 12 months, that is also current liability. And last one, no unconditional right to defer the settlement of liability for at least 12 months after the reporting date. Even if the holder of the liability, if we have an option to take what? Shares, it does not affect the classification. Whether a liability is settled by cash or shares doesn't matter. Still it is which liability? Current liability. Even though the holder will take what? Shares. Everybody, you understand this? Now that's why you see here, if any liability is there, if it is not satisfying any of the above, any liabilities that do not meet the above criteria is what? Non-current liability. Now come and check, sir. Non-current liabilities, you check what items are there in non-current liability. Can you tell me? Long-term borrowings. Long-term borrowings, why they are not fit into current liabilities? Tell me. Apply 4 criteria. For example, a bank loan. First, bank loan. We have taken a bank loan for 5 years. Okay, 10 lakh rupees. Whether it is current or non-current? Non-current. Why non-current? Apply. Current liability definition apply. What is the first criteria? Expected to settle within the normal operating cycle. Whether bank loan is expected to settle within the normal operating cycle, is it arising from operating activities like raw material, work in progress, financial goods, so sale, cost of sales? No. So first criteria not satisfied. Next, second, is it held primarily for trading? Is it future contract options, so forward? No. Next, third, it is due to be settled within 12 months after the reporting date? No, because we are how much is the period? 5 years. 5 years. Sir, here interesting point is, in this loan, next 12 months, whatever the portion is due, that will be current liability. For example, in this 10 lakhs, sir, next 12 months I need to pay 1 lakh rupee, one installment, for example. This 1 lakh will be current liability. Remaining 9 lakhs, non-current liability, long-term borrowings. So basically you need to understand, bank loan, first criteria failed, second criteria failed, third criteria, is it expected to settle within next 12 months? In this 10 lakh, maybe 1 lakh. So it is a current liability. Remaining 9 lakhs, no. Therefore it's non-current. Next, last criteria. Do I have the unconditional right to defer the settlement of liability beyond 12 months? No. When this amount becomes due, I need to pay na. Hello. So therefore it is not a current liability. Therefore, it will come in non-current liability. Like this, every current liability, every liability you check it. Every liability you check. For example, short-term loan from bank. You taken a loan from bank for 6 months. Short-term loan for use in production. Now tell me, whether this short-term loan is a current or non-current, apply. What is the first criteria? Expected to settle within the normal operating cycle. Is it expected to settle within the normal operating cycle? Short-term working capital loan? Yes. Because this working capital loan you taken a 6 months for use in production. Inventory manufacturing. That means it is part of operating activities. Suppose if the operating cycle is also more than 6 months or 6 months, definitely it is going to settle within the normal operating cycle. Therefore, it is which liability? Current liability. In current liability, where will you show? Short-term borrowings. Short-term borrowings. Short-term borrowings. For example, advance taken from customer or trade payables, amount payable to supplier for purchase of goods. Now apply. First, expected to settle within the normal operating cycle? Yes. Generally, any supplier amount is expected to settle within the normal operating cycle. Because we purchase the goods on credit basis, definitely supplier will give a credit period. That credit period is within the normal operating cycle. Sir, if it is within the normal operating cycle, then only you take. General assumption that is. If it is not part of the, if it is not expected to settle within the normal operating cycle, even though it's an operating liability, then it will not come under current liability. Then it will go to non-current liability. In non-current liability, where it will come? Others it will come. Hello. Suppose there is a trade payable. There is a supplier. Okay. Supplier is basically arising from operations. Suppose our operating cycle is 12 months. Operating cycle is 12 months. But we are supplier has given a credit period of 15 months. That means when we are going to settle? 15 months. Not within 12 months. Even though it is arising from operating activities. But we are settling. Are you settling within the NOC? No. Hello. And remaining 3 criteria, anyone it is satisfied? No. Therefore, it will come in non-current. In non-current, other long-term liabilities. Like that you need to classify. Like, I will show you interesting also. That's why you see in other long-term liabilities, if you check the breakup, I will show you. See this. Other long-term liabilities, you have what? See. Trade payables. You will be interested, sir. Trade payables, it is there in current liabilities. In current liabilities, you check second item. Trade payables is there. Na? Then again, why it is coming in other long-term liabilities? Trade payables already there in current liabilities. Na? Then here also they are showing trade payables. What is this trade payable? That means the trade payables not fit into current liability definition. If it is not fit into any of the 4 criteria, then obviously it is non-current. Na? In non-current, where will you show? Others. These are nothing but long-term trade payables. That means basically, suppose in the question trade payables given here, tell me where will you show? Current liabilities. General assumption is that current liability. It is expected to settle within the normal operating cycle or expected to settle within 12 months after the reporting date. Suppose if you categorically said in the question that your NOC is 12 months. NOC is 12 months. Supplier given 15 months time. Where will you show? Current liabilities, non-current liabilities. Non-current liability. Non-current liabilities, other long-term liabilities. But of course, see, you need to check other criteria also. That third criteria is also there. Na? Anything expected to settle within 12 months. That is also you need to check. Sometimes one failed, maybe 3 come. That's why any one satisfies to become current liability. It is sufficient. Hello. Are you understanding this? You apply yourself. See. Okay. Deferred tax liability, other long-term liabilities, long-term provisions. Here short-term borrowings come. Current liabilities. Trade payable. Because see, the intention is, the moment I said short-term borrowing comes under current liabilities, my intention is it is satisfying any one of these 4. That's why it is coming. Any one of these 4, it should satisfy. That's why it comes in current category. Otherwise, it comes in non-current category. Okay. Now come to current assets, sir. Like current liabilities, we will see current assets. Same manner. You check here. An asset is classified as current if it satisfies any one of the following. Any one. Any. See this. Any of the following. The word is any of the following conditions. First one, expected to be realized or consumed in the company's normal operating cycle. Sir, anything expected to be realized or consumed in the normal operating cycle is a current asset. Asset, we are talking about what? Assets. Anything expected to be realized. For example, see this, raw material is the best example for what? Current asset. Because raw material is consumed in the production cycle. Correct? Sir, raw material is consumed, sir. What is the cycle? I already drafted the cycle. This is the cycle. Raw material will become work in progress. That means raw material is consumption within the cycle. Anything you consume within the cycle is which asset? Current asset. So raw material is always current asset because it is consumed. Similarly, work in progress is also consumed. Hello? Similarly, you see work in progress converted into finished goods during operating cycle. Current asset. Finished goods. Because what is the operating cycle formula is what here? How much time it is taken to convert raw material into cash? In this, what are all involved? Raw material involved, work in progress involved, finished goods involved. So anything you consume within the normal operating cycle, or anything you realize within the normal operating cycle is which asset? Current asset. Next, finished goods are converted into cash, so it is a part of normal operating cycle. Similarly, trade receivables, debtors, amount collected from debtors is also part of that cycle. Expected to be realized within the normal operating cycle. It's a current asset. Any advance given to supplier expected to be paid within the normal operating cycle. Current asset. Any prepaid expenses related to operating activities. Current assets. Contract assets in case of service companies. Current assets. See, my point is, first of all, to become a current asset, that asset must be relating to our operations. Either it is realized or consumed. Raw material, work in progress, consumed in the production process. Finished goods are sold, converted into cash. So trade receivables is part of operating cycle. They will be converted into cash or cash equivalents. So that's why they say all these are which assets, sir? Current assets. What is expected to be realized within the normal operating cycle? Amount will be realized from debtors, from finished goods. What is consumed in the operating cycle? Work in progress, raw material. That's why you see in the current assets category, what is the second category? Inventories. Inventories includes what? Raw material, work in progress, finished goods. Always which assets? Current assets. Why they are always current assets? Because they are part of that cycle. Operating cycle. Within that part, they are there, na? Raw material, work in progress, finished goods. And also you see trade receivables, debtors. Debtors is always current asset. Debtors is always current asset. Provided they are part of this operating cycle, if amount is realized from them within the normal operating. Sir, when you calculate this NOC, even collection from debtors is also there, na? Because what is the definition of NOC? How much time it is taken to convert raw material into cash. So therefore, from this to this, what are all involved? Raw material converted into work in progress to finished goods are sold on credit basis, debtors will come, debtors cash will come. So therefore, converting of debtors into cash is also part of NOC. Correct? So that's why trade receivables. Suppose if the amount is not collected within NOC, then they are not part of current assets. They will be part of non-current assets. In non-current assets, there is other non-current assets. Say, I will show you. In other non-current assets, if you see, asset side, other non-current assets. You see, other non-current assets. What is that? Long-term trade receivables. Trade receivables basically comes in current assets. But if it is not part of this, if it is not expected to realize it within the normal operating cycle, then it comes in non-current assets. Like similar to current liabilities, trade payables. Trade payables basically comes in current liabilities. But if it is not expected to be paid within the normal operating cycle, where it will come? Non-current liabilities, other long-term liabilities. I told you, I show you also, same here. Okay. Next, see the next one. What is the next one, sir? Held primarily for trading. Any current asset held primarily for because of trading. What is this? Futures, options, derivatives. I told na, because of those contract, if any asset came, that is current asset. If liability came, current liability. Similarly, anything expected to be realized within 12 months after the reporting date. From this balance sheet date to the next 12 balance sheet date, anything expected to be realized, any amount receivable, comes under current asset. Comes under current asset. For example, insurance claim receivable. I see insurance claim receivable. Insurance claim receivable we are expecting in the next 12 months. It will comes under current assets. Where will you show in current assets? Other current asset. For example, rent receivable we are expecting to collect it in next 12 months. Current assets. Where? Other current assets. Like that. Anything receivable, commission receivable, next 12 months we are expecting to realize. Basically it is a current asset. Other current. Next, last one, cash and cash equivalent. Sir, always cash and cash equivalent which asset? Current asset. That's why you see in cash and cash equivalents always they have considered here. Hello? Unless restricted from being used for at least 12 months after the reporting date. Suppose if there are any restrictions that this cash and bank balance will not be utilized for next 12 months, then you should not consider it as what? Current asset. For example, there is a court case pending. Court freezed our bank account. That means in that bank account, whatever the balance is there, we cannot utilize in next 12 months. There is a restriction. Then in such situation, the bank balance cannot be classified as current asset. It has to be shown under non-current asset. In non-current asset, other non-current assets will show. Because it is not available in the next 12 months, this cash balance. You understanding? In the company bank account balance, 10 lakhs is there. But this 10 lakhs, can you use it next 12 months? No. If there is any restriction, don't consider it under current asset. And any asset which do not meet the above, then it is a non-current asset. So if you observe non-current assets, sir, for example, see here, property, plant, equipment, tangible. For example, this building. Building is which asset? Current or non-current? Why? Why it is non-current? Apply the criteria. First criteria. It is expected to be realized or consumed within the normal operating cycle. Whether this building is expected to be realized, are you going to get any amount in the next NOC? For example, NOC is 12 months. In the next 12 months, are you going to get any cash from this? Sir, I am going to get rent, sir. Not rent. This asset should be realized in the form of cash. Is it going to realize anything? No. It's a fixed asset generally. Next, is it held primarily for trading? No. And are you expected to realize anything from this asset in the next 12 months? No. Sir, I am selling it, sir. Selling is different. Without selling, can this asset, anything amount will be realized? No. Is it cash and cash equivalent? No. Therefore, it is not a current asset. Plant and machinery, similarly. Plant and machinery, is it expected to realize within the normal operating cycle? No. It is held primarily for trading? No. Are you expected to receive anything in the next 12 months? No. Is it a cash and cash equivalent? No. So it's a non-current asset. Similarly, you make any investment, long-term investment. You purchased shares of a company, investment. Is it expected to be realized in the next, within the normal operating cycle? No. Is it held primarily for trading? No. Are you expected to realize in the next 12 months from the reporting date? No. It is a cash and cash equivalent? No. Therefore, if there is an asset, apply the criteria. If it is not fit into any of them, take it to non-current asset. In non-current asset, choose the right one, write it. Hello, that's it. So therefore, you understand the classification, sir. So can you give me the final conclusion? What we are discussing? We are discussing schedule 3. In schedule 3, assets and liabilities are classified as Current, non-current. Tell me first liabilities. Liabilities are classified as current, non-current. When we say liabilities are non-current, current, 4 criteria is there. If any one met, current. What are those? Expected to be settled within the normal operating. If you are expecting to settle any liability within the normal operating cycle, only those liabilities which should arise from operations and they are expected to settle within the NOC, they will comes under that. Second, held for trading. Third, anything which is due to be settled within next 12 months from the reporting date. Last one, no unconditional right to defer the settlement of liability for at least 12 months. Whether a liability is settled by issue of equity shares, is it make any difference in classification? No. Even though the liability is settled in shares, it does not make any effect on classification. And next, tell me when an asset is called current asset, which is expected to be consumed or realized within the operating cycle. Next, held for trading. See, that means within the expected NOC means, suppose NOC is 15 months. Within 15 months, whatever the raw material, finished goods, debtors, if I am going to realize or consume, that is also current asset, irrespective of the 12 months criteria. Every criteria is different, please understand. NOC can be more than 12 also. NOC can be more than 12 months. If NOC is more than 12, then the corresponding operating assets and corresponding operating liabilities, even though they are expected to be realized, expected to be settled beyond 12 months, but within the normal operating cycle, they will be classified as what? Current assets, current liabilities only. Okay. Next, held primarily for the purpose of trading. Next, any amount realized within 12 months from the reporting date. Last one, cash and cash equivalent. Unless the balance is restricted, then that liability, that asset is called what? Current asset. Any other assets are non-current assets. Hello, you understand what is the operating cycle? So relating to this current liabilities, non-current liabilities classification, there is no question available from CA intermaterial, sir. That's why I'm taking CMA intermaterial. In CMA inter, one beautiful question is there relating to this classification. Let us try to solve this question, sir. Okay. See this question, everybody. Illustration number 2. First, don't rush. Try to apply the concept. While preparing the balance sheet as on 31st March 2023, the accountant of ABC Limited is confused regarding classification of following trade payables into current and non-current. So he is confused on 31st March 2023. You need to tell him this is current, this is non-current. See the amount, first amount due, and it is due from and due to be settled. 3 dates given. Like that, everything amount due, which is due from, which is due to be settled. Like this, how many cases given? 6 cases they have given. And they are saying that the normal operating cycle of the company is how much? 15 months. Advise the accountant on classification with reason. So take your time, think. Online students also, you pause and see, tell me the answers. So here the normal operating cycle is how much? 15 months. Now each you are preparing financial statements at the end of 31st March 2023. Now you need to tell me out of these 6 which one is current liability, which one is non-current liability, and you need to apply the current liability definition. What is the current liability definition? First, expected to be settled within the normal operating cycle, held primarily for trading, due to be settled within 12 months. I think A and C will affect here. A and C. A means expected to be settled within the normal operating cycle and due to be settled within 12 months after the reporting date. So check and tell me which one will become current, which will become non-current. Come on, try. So okay. So your answers are first one current, second non-current, third non-current, fourth. Okay, some people are saying current, some people are saying non-current. Let's take non-current. Last one current liability. Correct? This is the answers you have given. Now let's check it one by one. So see the answers. So classification of trade payables as current and non-current liabilities. Current, non-current, 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 current. See one by one, sir. First amount due is 3 lakhs 10,000. What is the date of settlement? 18/5/2023, correct? To be settled on 8/5/2023. Settlement date given, sir. When it is due from actually 1/4/2022. Due from 1/4/2022. What is the cutoff period based on operating cycle? Sir, operating cycle 15 months. Anything due to be settled within 15 months is a current liability. So if it is start from 1/4/2022, sir, from here to 15 months means 1/7/2023, correct? From 1/4/2022 to 15 months, sir, 1/7/2023. Cutoff period based on operating cycle. 15 months time. Agreed or not? Calculate here 1/4/2022 to 31st March 2023, 12 months. After that April, May, June. So 15 months. That means whether due within the cutoff date or not. Are you settling within this? Yes, it is actually due from, and date of settlement when you are doing 18/5. So therefore it is due and settled within the normal operating cycle only. So definitely it is which liability? Current liability. To become a current liability, it must settle within the normal operating cycle. Or at least it is due 12 months from the balance sheet date. But here in this case, if you observe, it is due and settled within the normal operating cycle only, much before the normal operating cycle only. So it's basically it's a which liability? Current liability. Now come to the second case. What is the amount, sir? 1,80,000. What is the date of settlement? 15/9/2024. Given due from 1/6/2022. 1/6/2022. See this. See from here the operating cycle is how much? 15 months. Calculate 15 months. It is due from 1/6, sir. It is just to be settled within 15 months. 15 months from here to here. 1/6/2022. It will become 1/9/2023. So when you are settling it 15th 9, that means it is settled after the normal operating cycle. After the normal operating cycle. So if it is a normal operating cycle, if you are not settling within the normal operating cycle and you are preparing financial statements on 31st March 2023. So generally based on this, it will be considered as what? Normal, non-current liability only, na? Hello? Non-current liability. Now same manner, 40,000. Date of settlement 15/7/2024. Due from 1st August 2022. What is the cutoff period? 1/11/2023. That means after operating cycle. So therefore it will also become which liability? Non-current liability. Same this one. You see everyone after non-current liability. After non-current liability. Last one you see 1,08,000. What is the date of settlement? 31st December 2023. Due from 15/3/2023. Cutoff period 15/6/2024. So it is due settled within the before the normal operating cycle only. So this will be generally considered as what? Current liability. Hello? Anything to be settled within the normal operating cycle is which liability, sir? Current. Here the answer is given purely based on the first criteria. Suppose, sir, for example, here, even though it is not to be settled within the normal operating cycle, but if it is due to be settled in the next 12 months, if that criteria is considered, sir, then they may become which liabilities? Current liabilities. Some of them may become which liabilities? Current liabilities. Everybody, suppose you are preparing balance sheet on 31st March 2023, right? This is the date you are preparing. If this is the date you considered, from here to next to 31st March 2024, next to 12 months, whatever you are going to due to settle, that is also become which liability? Current liability. Everybody. That criteria also not met. Not met, I think, correct? For example, you see the first one we'll see. First one you check. We are preparing on 31st March 2023, right? Next to 12 months means 31st March 2024. First one you take and tell me what is the cutoff date? 1/7/2023. So that means when we are settling it, 18/5. That means within the normal operating cycle only we are settling it. Hello? So obviously it will comes under which category? 1 minute, sir. See here, first one we are settling within the normal operating cycle only. NOC within the normal operating cycle. So obviously it will comes under which liability? Current liability. No need to check the other. Because if any one satisfies, that is sufficient, na? If any one satisfy. Now you see the second one, sir. What is the second one, sir? 1,80,000, yeah? 1,80,000. What is the date of settlement? 15/9/2024. And when you are settling it, what is it cutoff date? 1/9/2023, correct? You see, you are preparing on 31st March 2023. So here, is it settled within the NOC? No, not settled within the NOC. Now check the second one. Is it due to be settled within the next 12 months? Hello? When you are settling it? 15/9/2024. 15/9/2024 you are settling, sir. Which is false after 12 months. That means this criteria is also failed. 12 months criteria also failed. That's why it is which liability? Non-current liability. It is not due to be settled within 12 months, not fall due in within next 12 months also. Are you understanding? Similarly, next one also I will for your purpose. First, next one is when you are settling it 15/7/2024. Is it settled within the normal operating cycle? No. NOC failed. Third case. Sir, 31st March 2023 you are preparing, sir. 31st March 2024. Third liability, is it settled within the normal operating cycle? No. NOC criteria failed, na? Next you will check what? Next to 12 months. Next to 12 months means it has to be settled within 31st March 2024. But when you are settling it? 15/7/2024. Everybody, you are settling on 15/7/2024 means after 31st March 2024. Correct? So 12 months criteria also failed. Therefore, definitely which liability? Non-current. So therefore, you need to check, sir, whether it is settled within the NOC. If it is settled within the NOC, current liability. Suppose if it is not settled, then you need to check next 12 months from the reporting date. If that is also not satisfied, non-current liability. Everybody, you can check the other next item also. This one. This one, 15,000. When you are settling, sir? 34/2024. Correct? Is it settled within the normal operating cycle? No. So therefore, next one also you check 31st March 2023, 31st March 2024. So NOC criteria failed. Next I need to check next 12 months. But when I am settling it? 34/2024. 34/2024. That means it is not due within the next 12 months. So that is also non-current liability. Are you understanding? And see the last one, sir. Last one you check it. When you are settling it? 31st December 2023. That means you are settling within the normal operating cycle. Within the normal operating cycle. Because here cut-off date of a normal operating cycle is 15/6/2024. So therefore due and settled within the normal. So obviously it will become which liability? Current liability. So therefore now I think you got the clarity. So therefore when a liability is called current liability, either it has to be settled within the normal operating cycle, due and settled within the normal operating cycle, or 12 months from the reporting date. If that failed, you have to check this. If this is also failed, then it's a non-current liability. You got the clarity now? Yes, that's it. Okay, sir. Let us continue our discussion relating to Schedule 3. So in Schedule 3, we have understood we have seen the format, and then we have seen when an asset, when a liability is called current, non-current. Now next what, sir? Next is in schedule 3, relating to each item, what information we need to present and how we need to present. That is also there, that we need to see one by one. Because if you see the financial statements definition, in that notes to accounts is also part of financial statements, right? So in the notes to accounts, what information we need to disclose relating to each and every item, it is given in schedule 3, sir. So can you tell me what is the first part of the balance sheet? Equity and liabilities. In that first head, shareholders funds. After shareholders funds, first one, share capital. Now come to share capital. Relating to share capital, what items we need to disclose? That was there in the schedule 3. Relating to share capital. Now these disclosures are very, very important, sir. When you are preparing financial statements, they should be complied with. They should be complied with. See this. First, relating to share capital, what I need to present in the notes to accounts. Total 11 points are there, sir. 11 points. First, always remember, authorized capital will be presented. Authorized capital. And when you are presenting authorized capital, the number, the value, both are to be presented. Number and value. For example, how many shares are your authorized shares? For example, 1 lakh equity shares of rupees 10 each, 10 lakhs. Next, once authorized presented, na sir, next capital is issued capital, subscribed capital, fully paid up capital. Sometimes subscribed but not fully paid. Sometimes public will subscribe but total amount is not yet called or paid. So first authorized capital, then issued, subscribed, paid up. And nominal value per share, always you need to mention, sir. Nominal value. Some students, how they are writing share capital, sir, in the notes accounts, SC. SC means share capital. 1 lakh shares, they write 1 lakh into 10 lakhs. Schedule 3 crying. What they are saying, when you are presenting share capital, you need to present number, you need to present face value also. Okay, so clearly you should mention the par value per share. 1 lakh equity shares of 10 each, like that. And also you see shares outstanding at the beginning and end of the period. You need to give a summary of shares outstanding at the beginning and at the end. For example, how many shares are there at the beginning? How many shares are there at the end? What happened during the year? Shares, fresh issue shares happened. Buyback of shares, because of buyback shares will reduce. ESOPs, shares issued. Shares will be issued for different reasons, right? So you give one statement showing the outstanding shares at the beginning and at the end. And also, sir, relating to each class of shares, you need to mention what are the rights they will get, what are the preferences they will get, what are the restrictions they have. For example, dividend limitations, capital repayment restrictions, equity shares, preference shares. Preference shareholders will get preference in 2 matters. One is dividend, one is capital repayment. Equity shareholders, within the equity shareholders, we know equity shares with the differential voting rights, equity shares, normal equity shares. Now, if you purchase equity shares with the differential voting rights, what rights you will get? Is there any restriction in payment of dividend? All these details you need to mention. And also, any shares held by holding company. Holding company means parent company. Ultimate holding company, parent company, and their subsidiaries or associates. See, in our company, how many shares are held by parent company? Or else, how many shares are held by their subsidiaries, parents' subsidiaries or associates? All these things we need to mention. See, there are 3 concepts: holding, subsidiary, associate, which will come in consolidation chapter. And this is important point, sir. 7th point, mark it as important. 7th point, sir, you need to mention the details of shareholders owning more than 5% shares with their shareholding numbers. Sir, in the notes to accounts, company should clearly mention Shareholders who is having more than 5% shares in the company, their details will be given. Name, number of shares, percentage of shares, like that they should give details. And also, any shares reserved for issue under options, contracts, other commitments, including terms and amounts. Suppose if any shares are reserved, company sometimes will reserve some shares for issue under options. Options means ESOP, employee stock options, contracts or other commitments. Suppose sometimes company will issue shares for consideration other than cash. For example, company purchased an asset. Instead of paying cash, company issued shares. That means shares are issued under contract or commitment. Any shares company reserved for issue under any options, contracts, commitments, they need to clearly mention, including the terms and amounts. How much amount we need to pay, what are the terms, how many shares we are issuing. Sir, sometimes we will issue shares, na sir, for other than cash. Generally shares are issued for cash. Sometimes we will issue shares other than cash under any contract, commitment. Those details we need to mention. Ninth point is important point, sir. Mark it as important. This can come in examinations. See, ninth point saying there are three situations, sir. What are the three situations? In case company has allotted fully paid up, any shares issued without payment being received in cash. Sometimes shares are issued without payment being received in cash. Second, shares allotted as fully paid bonus shares. Sometimes company will issue shares in the form of bonus. Next, shares bought back. Shares bought back. Three situations. When shares are issued without payment being received in cash, when shares issued as fully paid bonus shares, third one, buyback. See, the schedule 3 says if any one of these three things happened, you need to mention two things. What are those? Aggregate number, class of shares. Aggregate number, class of shares. Aggregate number, class of shares. You need to mention. Where you need to mention all these details? Notes to accounts. Notes to accounts. How many years you need to disclose? 5 years. See this. For the period of 5 years, immediately preceding the date at which the balance sheet is prepared. Immediately preceding the date at which the balance sheet is prepared. Balance sheet date is prepared. Okay. For example, sir, three situations, sir. Important, sir. What are the three situations, sir? When shares are issued for consideration other than cash. Second, fully paid bonus shares. Third, buyback. In these three situations, we need to mention two details. What are those? Aggregate number, class of shares. Where we need to mention? Notes to accounts. How many years? 5 years we need to mention these details. 5 years we need to mention the details. For example, see here. Suppose 24-25, right? 24-25 financial year. That is 31st March 2025 is the balance sheet preparation date. So from here to 5 years, preceding 5 years. That means 24-24, 24-25 means 23-24, 22-23, 21-22 and 20-21. You see, from 31st March 2025 to 5 years preceding, from here to 1, 2, 3, 4, 5. So within the 5 years, see this, within the 5 years, if any one of these three things happen, we need to disclose. Suppose for example, for next year, 25-26, 5 years means it will be up from 21-22 to here. So therefore, suppose if any buyback shares issued for consideration other than cash bought back happened in 2021, you need not require to disclose. Only preceding 5 years, immediately preceding 5 years. If any one of these three things happen, you need to disclose. For example, 21-22 it is happened. We will disclose in 2021, 21-22, 22-23, 23-24, 24-25, 25-26. That's it. Are you understanding? Suppose if it is happened in 2021, we will disclose this year, next, 3, 4, 5. That's it. Next onwards, no need to require to disclose. That means If any one of these three things happen, sir, in the preceding 5 years, we need to disclose in the notes to accounts. What we need to disclose? Aggregate number, class of shares. Aggregate number, class of shares we need to disclose. Aggregate number, class of shares. Aggregate number, class of shares. Aggregate number, class of shares. Suppose company issued bonus shares. They need to disclose what? How many shares? What is the class of shares? They need to disclose. And also next one, you see, unpaid calls on shares showing amount unpaid by directors and officers. Any unpaid calls are there. For example, companies sometimes call the amount, but calls in arrears. Some directors, officers or some shareholders may not pay the amount. So you need to mention them, including the amount unpaid by directors and officers, if any there, we need to mention. And also any original amount paid on forfeited shares. If any shares are forfeited, sir, in respect of the forfeited shares, amount already paid by the shareholder, that amount also we need to disclose. You know, sometimes we will forfeit the shares. Why we will forfeit? Because of unpaid amount. Now whatever the amount till now they paid, that is called amount originally paid, that we need to disclose. So 11 points like this they have to disclose, sir. So therefore please, this one first, sir, this is second, this is third, and also shareholders holding more than 5%, this one. So these 5 points put a star mark, sir. At least try to remember these 5. At least try to remember these 5. So therefore whenever you are presenting share capital, these are the details you need to present, sir. So clearly you need to first mention the authorized capital, number shares, face value. Next, issued, subscribed, paid up, you need to mention. Each time number of shares, face value, both will be mentioned. And if in your company more than 5% shares, if anybody having their details, we need to mention. Main points I am telling. And if in any one of these three things happened in the preceding 5 financial years, you need to mention the details, the aggregate number as well as class of shares. So this is the first one. So in shareholders funds, what is the first one? Share capital. We completed share capital. Now come to second one. What is the second one? Reserves and surplus. Basically, what is reserves and surplus? Any profits earned by the company, any profits set aside, those are called reserves and surplus. Every year company will do business, earn some profits. Those profits will go to P&L account, and from these profits some amount will be transferred to some other reserves. All the reserves and surplus is nothing but the undistributed profits of the company or profits of the company. Here they will be shown. Look at how the classification should be given, sir. First one, capital reserve. Next, CRR, capital redemption reserve. Securities premium. Sometimes company will issue shares above the face value. That securities premium will also be part of reserves and surplus. Next, DRR, debenture redemption reserve. Next, revaluation reserve. Next, share option outstanding account. Sir, put a star mark, share option outstanding account. Share option outstanding account or ESOP outstanding account, employee stock option outstanding account. See, the moment some students they see outstanding account, they think it is current liability, but it is wrong. Here they are talking about share options. Share options means employee stock options. When company wants to give any shares to employees, in that situation we will create one reserve called share option outstanding account. That is part of reserves and surplus, not part of current liabilities. Please be careful. And any other reserves. Okay. And reserves represented by investments. A reserve shown by earmarked investments is called fund. What is this reserve shown by earmarked investments? For example, sir, in the books we create one reserve, sir. The reserve is DRR, debenture redemption reserve. Now relating to this debenture redemption reserve, if the amount is made invested, any investment we made, sir, then this is not called reserve, this is called fund. So what is the difference between a reserve and fund? Reserve means some profits we set aside. When we call that reserve as fund, when an equivalent amount was invested. For example, in balance sheet there is a reserve DRR. This will comes in balance sheet liability side, reserves and surplus. Now whatever the amount you set aside in the form of DRR, relating to this fund, this reserve, some amount we will invest in outside securities. Then this is called what? Fund, not reserve. Because this reserve, whatever the amount we set aside, that is utilized to investments. We invest. The moment we utilize this for investment, this will become what? Fund. We call it as fund. That point is also there in the this one. So the reserve shown by what? Earmarked investment. What is earmarked investment? Earmarked means investment which is specifically made from the fund amount. Investment specifically made. So specific investment, sir. Specific investment. Specific investment from this fund is called earmarked investment. So when if reserve will have any specific investment, that is called fund. You understand this point? Next, surplus and negative balances. Sir, what is surplus? Actually, sir, schedule 3, we call P&L account as what? Surplus. We call P&L account as what? Surplus. Surplus means P&L account, sir. Sir, P&L account is also what, sir? Reserves and surplus. P&L account is also reserves and surplus. No, but here P&L account can have a debit balance, can have a credit balance. For example, surplus, P&L account have a debit balance. That means negative. Where will you show? Reserves and surplus only we will show. But with a negative symbol. Brackets will put. And because of this negative balance, the entire reserves and surplus may become negative. No problem. Still negative symbol only. We will put it on the reserves and surplus. Brackets. Suppose P&L account will have a credit balance. Positive balance. Reserves and surplus only. So therefore sometimes, actually before schedule 3 sir, there was schedule 6. In schedule 6 what they have done now, whenever P&L account debit balance is there, they have not shown it on the reserves and surplus side. They will show it on the asset side, which is wrong, which is violation of schedule 3. How can debit balance of P&L account will be asset, sir? Wrong. Your weakness cannot be your strength. Correct? So it is a kind of misleading the users. That's why now schedule 3 came and specifically saying that even though your P&L account is having a debit balance, don't show it on the asset side. You keep it on the liability side only with a brackets, within the brackets. So that point only they have covered here, sir. If there is a debit balance in the P&L account, it will be shown as a negative figure under surplus. Important. Negative figure under surplus. And if the total reserves and surplus after adjusting negative surplus may show a negative balance, no problem. We will put it in the brackets. We will put it in the brackets. So therefore 2 things we completed, sir. What are the 2 things we completed? We are discussing shareholders funds. In that first one, share capital. Second one, reserves and surplus. So 2 things we covered, sir. Now relating to these 2, sir, some practical questions are there. They have given in the study material. I will show them. Yeah. Come to page number 15, sir. Practical questions relating to schedule 3. So this is what I am talking about, sir. In examination, they will give like this. They may give 4 marks, 5 marks questions relating to schedule 3. Okay. See this. First question I am important, sir. In the financial statements for the financial year 21-22, Alpha Limited has mentioned in the notes to accounts that during the financial year, 24,000 equity shares of 10 each were issued as fully paid bonus shares. However, the source from which the bonus was issued has not been disclosed. Is such non-disclosure a violation of Schedule 3 to the Companies Act? Comment. Tell me, is it a violation? First of all, this point, what they are talking, have you understood the question reasonably? First, understand the question. Some student doesn't understand the question also. There is a company, Alpha Limited, sir. This company has given a bonus shares, fully paid bonus shares. How many bonus shares they have given? 24,000 bonus shares. They mentioned it in the notes to accounts. But what they have not mentioned? Source. From which source bonus is given? Not mentioned. Is it violation of Schedule 3? No. Why? Yeah, Schedule 3 says, just now we discussed, whenever there is a fully paid bonus shares, only 2 things we need to disclose. What are those? Aggregate number, class of shares. Source, nowhere mentioned, na? And that too how many years? 5 years. 5 years. I told that point. So therefore, this question they will ask for 5 marks. What students will do? Students will answer by emotions. The moment they say source not mentioned or wrong. So wrong, they say. First they will write first summary, like analysis they will write. What they will do? In the given case, Alpha Limited in the year 21-22, they have given bonus shares 24,000 fully paid, but they have not given. Like that, they will write one big paragraph first. Second line, they will conclude, but they need to mention the source, but they have not mentioned, which is absolute violation of Schedule 3. Like that, they will write. Final conclusion, since company violated, all the board of directors must be imprisoned. They will be taken to the central jail. And in spite writing this all bullshit, what the student will tell, na, sir, I written everything correctly. Why ICA is blaming me? Why ICA is not passing me? Why they are reducing marks? Why they are taking grudge on me? Am I not eligible to become a chartered accountant? Like this, bari dialogues he will use. Because so many students, this happened. They come to me and they will give complaints that on ICA. Okay, that ICA is not intentionally they are making me fail like that. I ask them, okay, you get your answer sheet. The moment they get answer sheet, they will send me that answer sheet to me. And if they check their answer sheet, I will be surprised. So many mistakes are there. But what they will tell, see, if this mistake is there in your answer sheet, they will tell, sir, for this mistake, this many marks. First he will say, there is no mistake in my answer. Next he will say, small mistake only, no, sir. This mistake only half mark should reduce. Why they reduce 3 marks? First you accept that there is a mistake. Accept yourself. There is a mistake, first thing. Second thing, how many marks will be deducted decided by ICA, the person who is correcting, not you. Because there is a stepwise marking here. There is a stepwise marking. For you, this step is only 1 mark. But in the original answer key sheet, that step may be allotted 3 marks. So you will reduce accordingly. Don't correct your paper in your imagination. This is a small mistake only. Who said it's a small mistake? You yourself believing it's a small mistake. ICA intentionally. Who the hell you are? ICA will every time will fail you. If that is the case, every one of should not become CA. Na? See, some students, not I am talking about all the students, some students, of course there may be some errors in correction, but majority of the cases, students should understand that their answers are lacking quality. If your answers are lacking quality, don't expect marks. Don't expect marks. Sir, I have written everything perfectly, sir, but in spite of that I am getting, that's very genuine, 2 or 3% will be there. I'm very much, worried about those cases, but majority of the cases, students have to understand that the answers are lacking quality. So this is the classic example. This question, the answer should be very simple. It is not a violation of Schedule 3 because non-disclosure of the source from which bonus have been disclosed does not violate Schedule 3 because Schedule 3 does not require a company to disclose the source from which bonus have been issued. But you written answer by your emotion, not by law, and you are expecting full marks. Okay, suppose they have given 0 marks. Next he will say, sir, first paragraph I analyzed. What you analyzed? Whatever is there in the question, that only you write. 1 mark, sir, 1 mark, 1 mark. Why 1 mark? Your conclusion is wrong. Your entire thinking is wrong. And for writing that first 5 lines based on the question, you are expecting 1 mark. This type of expectation worries me. Because student somehow wants the marks, but he doesn't want to write the correct answers. That should not happen, sir. Okay. Next, come to question number 3, sir. Again, there is a company Futura Limited, sir, which had the following items under the head reserves and surplus in the balance sheet as on 31st March 2011. So in the reserves and surplus, they had securities premium, capital reserve, general reserve. 80 plus 60, 150, 80 plus 140, 140 plus 90, 230, sir. Next, the company had an accumulated loss of how much? 250. That means P&L account debit balance on the same date, which it has disclosed under the statement of P&L as asset in the balance sheet. Comment on accuracy of this treatment in line with Schedule 3. Tell me. P&L account debit balance, they shown it on the asset side. Is it violation of Schedule 3 or not? Absolute violation. Because Schedule 3 says even though you have a negative balance, you should show under the head reserves and surplus only within the brackets. Within the brackets. And because of that, the total reserves may become negative. Not a problem. You should still show it under the reserves and surplus with brackets only. Thus, the presentation by the company is not correct. In this case, the debit balance of P&L 250 lakhs exceeds the total reserves 230. Therefore, balance of reserves and surplus after adjusting debit balance of P&L is negative by 20. We should be disclosed on the face of the balance sheet only. So, therefore, this is not a violation of, this is a complete violation of Schedule 3, sir. Sir, are you understanding, sir? Next, see question number 4, sir. Question number 4. This question they have asked in the recent examinations, MCQ, sir. MCQ. Sumedha Limited took a loan from bank for 10 lakhs to be settled in 5 years in 10 equal half-yearly installments with interest. First installment is due on 30th September 2011 of 1 lakh. Determine how loan will be classified in the preparation of financial statements of Sumedha Limited for year ending 31st March 2011 according to Schedule 3. So see this, sir. Sir, when they are preparing financial statements? 31st March 2011. Correct? Hello? 31st March 2011. They taken a bank loan. How much is the loan? 10 lakhs. This loan they will pay in 10 half-yearly installments. Correct? That means every 6 months one installment. That means from here to next 12 months. Next 12 months, how many installments fall due? 2. 2 installments fall due. So I told you that any amount due to be settled in the next 12 months from the reporting date is which liability? Current liability. Therefore, in this 10 lakhs, sir, 2 installments, 2 into 1 lakh, that is 2 lakhs will be what, sir? Current liabilities. In current liability, where will you show? Short-term borrowings. And remaining 8 installments, obviously non-current liability. In non-current liabilities, long-term borrowings you will show. Long-term borrowings you will show. Simple. Next year, sir, next year simple. Next year 2 installments, 2 lakhs will be again current liability, short-term borrowings. Remaining 6 installments, long-term borrowings. Because this year 2 installments already paid. So this is how you need to classify, sir, in this case. So therefore answer you see, sir. Therefore, in the balance sheet on 31st March 2011, 8 lakhs will be shown under the heading long-term borrowings. And 2 lakhs will be shown under the head short-term borrowings as a current liabilities. Hello. Next. Now come back, sir. So we have seen some practical questions relating to this. So in the balance sheet, what are the things we completed? Share capital, reserves and surplus. What is the third one? Money received against share warrant. Look at the shareholders funds. What is the next one, sir? Money received against. Sir, what is this money received against share warrant? Basically, sir, share warrant is a document. This document representing the ownership of some number of shares. Suppose if you purchase this share warrant, you will not be treated as a member of the company. You will not be treated as member of the company. For example, I purchased 10,000 shares. Company has not allotted shares to me, but has given one warrant, share warrant. That means my name is not entered in the register of members, but company received the money. So this share warrant, what I can do? Either I can surrender it to the company and in my name shares will be allotted, or this warrant I can transfer to somebody else. Easily I can transfer the share warrant. In the transfer, finally whoever wants to become member of the company, he will surrender the share warrant to the company and company will allot shares to him. Then the share warrant money will become share capital. Till that point of time in the balance sheet you need to show money received against share warrant. Don't include it as a part of share capital. That's why in shareholders fund, first one is what? share capital. Second, reserves and surplus. Third, money received against share warrant. So basically what is share warrant, sir? Share warrant is a document representing ownership of certain number of shares. See this. It is basically a financial instrument, sir, that gives the holder the right but not the obligation to purchase shares of the company in future at a specific price or within a specific time period. In future, if share warrant holder exercise the option, this amount will be created to share capital. So it is like but see, today's world share warrant is not relevant, sir, but understand it is like this. Generally there are two ways. First, suppose I purchased shares in a company. The moment I purchased shares in a company, I will become member. My money, whatever the money I paid, that will be transferred to share capital. Correct? But I can request the company that give me share warrant. The moment I applied for share warrant, what company will do is they will remove my name from the register of members and they will give one document, one financial instrument to me representing that this is the value of the shares you had. What I can do with this financial instrument, I can easily transfer it. It is like a negotiable instrument. For example, I want to sell my shares, sir, to Mr. X. Mr. X wants to sell it to Mr. Y. So therefore, what I can do is I can apply for share warrant. My name will be removed from the register of members and share warrant will be issued in my name. I can give this to X. Transfer over. X will give to Y. Y will give to A. Now A wants to become a member. What A will do? He comes with that share warrant to the company and surrender it. The moment share warrant surrendered, company will again allot shares in his name, Mr. A name. Obviously, this money received against share warrant will go to share capital. Till that point of time, it is to be shown separately in the shareholders funds only, but not part of share capital. Money received against share warrant. You understand this? So basically, what is financial instrument? What is share warrant? First of all, it's an instrument here. Instrument means anything which creates a right is called instrument. It represents value of certain number of shares. What I can do with the share warrant? I can easily transfer the ownership. And finally, whoever wants to become a member, he will surrender it. Till that point of time, whatever the money received by the company relating to this, what they will do? They will show separately, not include in the part of share capital. The moment the surrendered allotment will happen, then it will go to share capital. Everybody? So three things. No, it is not like that. I think these provisions are applicable only for public companies. Now they are not relevant practically. This share warrants concept. No time limit like that. But I don't know whether any time limit now they have updated or not. I don't know. But as of now, you understand. Treatment point of view on 31st March, just any share warrant money received, but it is in the form of warrant, you should not include as a part of share capital. You should show separately in shareholders fund. Okay. Now share, next second. So first heading we completed, sir. What is the second head, sir? Share application money pending allotment. What is the share application money pending allotment? See, we received application money, but allotment not yet done. So, no. Application money received pending allotment. You remember, I think in foundation it will come. First, whenever company issued shares, public issue, company went for public issue, public will apply for shares, application. When public made an application for shares, what company will do next? Company will accept the application and allot. Till allotment is not done, whatever the money you received by the company, till the allotment is not done, then it should not be included as a part of shareholders funds. That's why it is to be shown separately. So on 31st March, application money received, but allotment not yet done. Allotment not yet done. Without allotment, company cannot consider this money as share capital. Only when allotment is done, this application money will go to share capital. Till that point of time, it is to be shown separately. It should not be included. Next allotment done, then this amount will go to share capital. Till that point of time on 31st March, it will be. Now see, here some students will confuse. Sir, here you need to understand, sir, this is share application money pending allotment. For example, allotment done, but your money is your application is rejected. That means whatever the application money received, company need to refund. If that money is there na, then that will be a liability. Where it will come? It will come in current liabilities, other current liabilities. Application money pending due for refund. There is a difference between application money pending due for refund, application money pending allotment. Without allotment, if application money is received na, that cannot be a liability. That will be shown separately. Because next when I do the allotment, it will go to share capital. Second one is what? Application money received due for refund. Why it is due for refund? Because your application is rejected. That means your shares are not allotted to you. Allotment already done, but your shares are not allotted. Like in case of pro rata allotment, some portion shares will not be allotted na money. So that money company has to refund. If any refund amount is there on 31st March, where will you show? Current liabilities, other current liabilities. I will show you also. You go and put a star mark there. Go to other current liabilities. In other current liabilities, you see this one. Page number 7. Other current liabilities, this one, you check it. Yeah. Application money received for allotment of securities and due for refund. And interest accrued thereon. Suppose if you don't refund the money within the time, you need to pay interest also. So any interest due at the end of the year relating to this application money due for refund, that is also comes under other current liabilities. Sir, you understand the difference? Tell me what is the second head we completed? Share application money, pending allotment. Pending allotment means, is it amount due for refund? No, allotment not yet done, but amount received. It is like income received in advance, sir. When you receive anything in advance, it is a liability to you. But see, don't include it as a part of liability. The interesting point is, they are not including it as a part of liability, and they are not including as a part of shareholders fund. In between. When it will go to share capital? When allotment done. Suppose if allotment not done, it will go to refund, other current liabilities. Understood? So we have to be very careful when solving the question. Is it application money pending allotment or is it application money pending, refund? If it is due for refund, liability. If it is pending allotment, show shareholders fund below. Separate you need to show. Next, what is the third head? Non-current liabilities. Important pa. We are moving into the important zone. What is that? Non-current liabilities. In non-current liability, what is the first one? Long-term borrowings. See this. Come to long-term borrowings. Tell me, generally borrowings means what? Loans, debentures, any loans and advances taken from related parties, any deposits taken from public, all these will come here, right? Bonds, debentures. These are all basically borrowings of the company. Now see how borrowings are classified. Bonds and debentures first. Always remember, bonds and debentures is what? Long-term borrowings. Because these are generally issued for long-term purpose. No company will issue bonds or debentures for 6 months or 7 months. Only long-term finance they will issue. Bonds and debentures. Next, term loans. What is term loan, sir? Generally 3 years. Any loan is taken, minimum duration is 3, above that. So term loans, 3 years, 5 years, 10 years, like that. From banks, from other parties. Next, deferred payment liabilities. Important, sir. Sir, what is deferred payment liability? Any liability which is to be paid over a period of time. The liability payment is deferred over a period of time. Deferred payment liability. Payment liability, sir. Let us discuss about it. So what is deferred payment liability? Deferred payment liability. See this deferred payment liability, everybody. A deferred payment liability arises when an asset or service is purchased on credit or deferred terms. That is, the payment is postponed to future period instead of being paid immediately. So if I purchase any asset but I don't make the payment immediately. I will make the payment over a period of time. That is called deferred payment liability. Or I will take any service from you, but I don't make payment immediately. I will make the payment over a period of time. In other words, in simple words, the company has already received the benefit, but it will pay later, generally in installments after a certain period. So it represents a liability, the amount still payable in future. For example, sir, a company purchases a machinery worth 10 lakhs, payable in 3 equal installments. The unpaid balance after year 1 is deferred payment liability. Suppose building purchased with 20% down payment, sir, and balance after 2 years. So 80% unpaid amount is treated as what, sir? Deferred payment liability. Suppose a land acquired on deferred payment terms from government. Suppose government has sold one land to us. The land cost is 100 crores. We requested the government that, sir, please give installments option. We don't pay 100 crores at a time. Now government said, okay, we will give 10 years time. Every year you pay 10 crores like that. So therefore that is deferred payment liabilities. Everybody. Or for example, a computer systems bought under buy now pay later for 18 months. So these are all what? Deferred payment liabilities. So deferred payment liability is anything, any asset purchased or any liability which is to be, the payment has been deferred over a period of time. It is not paid immediately. It is to be paid over a period of time, more than 1 year, over a period of time. Then it is considered under deferred payment liability. I will tell you one more best example also. For example, sir, there is a company, sir. For example, there is a company, see this. There is a company XYZ Limited, sir. There is a GST department. Now, this company is not paying GST because they are thinking that GST is not applicable on their products or services. They are not paying. One fine day department send the notice saying that you need to pay 50 crores. Your products are applicable. Your GST is applicable to you. Now your liability is how much? 50. So you accepted 50. But you requested the department that, sir, please give us time. We don't pay. We are unable to pay 50 crores at a time. So department given 10 years time. That means 50 crores will be paid over a period of 10 years. So therefore obviously this will become which liability? Deferred payment liability. Where will you show? Deferred payment liability. Sir, simple sir. Is it a borrowing? GST liability, is it a bond? Debentures? Term loan from banks? Then where it will suit, sir? See, out of all these, where it will suit? Deferred payment liability. So the word defer means postponement. Everybody. Similarly, for example, you are a company X Limited. From Mr. Z you purchased a plant and machinery. Cost is 25 lakhs. This 25 lakhs will be paid over a period of 5 years. Every year 5 lakhs you are going to pay. That is the agreement between you and that person. Now these kind of liabilities are called what? Deferred payment liabilities. And any deposits. Deposits. What is deposits here? Deposits taken from public. And also loans and advances from related parties. Related parties means for company who are the relatives? For you who are the relatives? Mother, father, brother, sisters. They are relatives. For you, individual, humans. But for company, parent company, subsidiary company, associate company, they are related parties. Directors. So from them if any loans and advances taken, it's a liability. And next one, long-term maturities of which obligation? Finance lease obligation. Put a star mark here. Long-term maturities of finance lease obligation. What is this long-term maturities of finance lease obligation? When any asset is taken on lease basis. When any asset is taken on lease basis. That to which lease? Finance lease. Now according to that lease agreement, what is the amount we are required to pay to the lessor? Lessor means the owner of the asset. I am lessee. I am taking the asset on lease basis. I am lessee. See, there are two parties in lease agreement. Lessor, lessee. Lessor will give the asset on lease basis. Lessee will take the asset on lease basis. So when I take asset on lease basis, I need to pay lease rent every year. So there is a liability for me. That liability is generally long term. Because lease is taken for 1 year, no, not 6 months, 1 year. Lease is taken for generally 5 years, 10 years, 15 years like that. So whatever the liability I am going to pay, to the lesser long-term maturities, long-term, beyond 12 months, whatever the amount I need to pay, that will also comes under long-term borrowings, and other loans and advances. Okay. Now, sir, along with this classification, sir, the schedule 3 says the borrowings you need to classify into 2 categories, sir. Whatever the borrowings made by the company divided into 2, secured, unsecured, sir. Important, sir. Secured, unsecured. Sir, when you want to borrow something, the other party will definitely ask for security. If you give any security, those are secured borrowings. If you don't give any security, unsecured borrowings. For example, you take a bank loan, bank asked for security, you given building. So therefore, that is secured category. So like this, the borrowings will be classified as secured, unsecured. And the most important thing is, if it is a secured borrowings, sir, you need to clearly mention what is the nature of security. That means which asset you have given as a security. Is it a pledge, hypothecation? You need to clearly mention. And loans guaranteed by directors or others. Sir, sometimes the company loans taken, those loans are guaranteed by directors or any other person. Then we need to mention the amount for each head must be disclosed. Okay. In the notes to accounts, we need to clearly mention how much amount company has taken, which is guaranteed by directors. And also bonds and debenture details company need to mention, sir. If any company issued bonds or debentures, they need to mention what is the interest we are paying on those bonds and debentures. Generally, on borrowings, we need to pay interest, right? When company issued debentures, bonds, we need to pay interest. Those interest details, redemption or conversion details, when we are going to redeem those details, list by latest date first. So while redemption, first which debentures will be redeemed, the latest date we need to present. If paid in installment, use the first payment date as the maturity date. Suppose sometimes we will pay the debentures and bonds in installments. What is the first date onwards you are going to pay? All these details will be mentioned in notes to accounts. Term loans and others. Suppose if company has taken any term loan from bank or others, they need to clearly mention what are the terms of the loan and other loans. Like in the notes to accounts, company need to mention how much amount we has taken a loan, how many years, what is the rate of interest, when we are going to repay, if you don't repay, how you are going to pay. All these terms and conditions we need to mention. That means if you want to know anything about company's borrowings, where will you check? Simply take the balance sheet, notes to accounts, you go. In this notes to accounts, you find all these things. That's why if you understand the financial statements chapter correctly, auditing will be very easy. How, for example, loans, how will you audit? In audit chapter, they will ask one question. How will you verify the loans of a company? You need to write the points now. There you can write, I will check the notes to accounts. In that notes to accounts, company will mention clearly the terms of term loan. In the terms, they will clearly mention. See, that means as an auditor, how effectively I audit depends upon how much clarity I had on schedule 3. Because what schedule 3 says to present in the financial statements. If I know, in my mind, obviously I can connect this point is already there in schedule 3 notes to accounts. So I will get the notes to accounts and I will check it. Are you understanding what I am saying? So your auditing job will be easy. So auditing subject linked with financial statements of company, sir. If you understand the financial statements of company perfectly, auditing will be very easy. You can easily judge whether the company properly prepared the financial statements or not, whether they are complying with schedule 3 or not. All these things. And also, sir, this point important, sir, actually. Loan default details. Suppose there is a company. You want to know that company, if they are making any default in payment. Suppose tell me one company name where you are very interested to know. Satyam, when you are gone Satyam. Now it has become Tech Mahindra. For example, you want to know about Paytm. Paytm company is there. Regularly you are using, na? One day you got a doubt. What is this Paytm company? How much they are earning? I want to check whether they are paying loans or not. What will you do? Take the financial statement, goes to notes to accounts. In the notes to accounts, under the borrowings, they will have loan default details. Also, they need to mention. So in that, clearly they should mention the period, and the amount of continuing default as on the balance sheet date for both loans and interest. How much loan they have taken till now, how much period it is outstanding, so how much amount they are making default, including interest. All these details will be known. That means schedule 3 is kind of an internal control. Entire your jatakam, entire your life will be in front of public. That's why companies worried about schedule 3, because through schedule 3 government is asking companies to disclose all these things. See, you know, the biggest internal control in the world is what? Disclose. For example, your father asked you that what you are doing in a day, you have to disclose me. You have to disclose everything. Whatever you are doing, tell me, are you going to really disclose what are all the activities you do? If you tell to your father what are all the activities you are doing, he will practice karate, kung fu, boxing, everything he will do. So the biggest internal control is disclosure. Now see, companies don't have any other option. They have to follow Companies Act. Schedule 3 is part of Companies Act. Therefore, through Schedule 3, they are asking the companies disclose these details also. Suppose if there is a company, if they are making any default in payment of loan interest, any other bank or financial institution will come and give loans. No. So that's how this point will help. This point will make sure that company will not get any loans in future. That's why Schedule 3 will give all history, all your loopholes, all your weaknesses will be covered in the form of notes to accounts. That is the most important part here. Of course, see, for examination purpose, they may not test all these things, but you need to remember. Are you understanding long-term borrowings, sir? So basically, what items will come in long-term borrowings? Bonds or debentures? Term loans, not normal loans, term loans. You see the word term. Next, deferred payment liabilities. What is deferred payment liability? I told you. The payment is deferred for a future or a period of time. Deposits taken from public, nothing but. Loans and advances from related parties, and last one, long-term maturities of finance lease obligation. And all these points, secured, unsecured, if they are secured, nature of security, if any loans and advances guaranteed by directors, how much amount they have given a guarantee, details of debentures and bonds, all these bit. And see, once you completed long-term borrowings, sir, immediately go to short-term borrowings. It is exactly same, sir. Therefore, we need not require to spend any much time. Go to short-term borrowings. Short-term borrowings, where it will come? Current liabilities. Now, relating to short-term borrowings, what is there? See this, loans repayable on demand from banks, from other parties. See, important, loans repayable on demand means, I told you, whenever they demand, we need to pay. Obviously, they are current liabilities. I told now in current liabilities one criteria, where company does not have unconditional right to defer the settlement of liability for at least 12 months after the balance sheet date. I told the best example is loans repayable on demand. Whenever the other party demands, we need to pay. So loans repayable on demand is what? Basically current liability. Current liabilities, where will you show? Short-term borrowings. Short-term borrowings. You can take from bank, from other parties. You know, you observe here bonds, debentures, they are not there. Bonds, debentures, term loans, they are not there here. See this. That means bonds, debentures, term loans obviously will comes in long-term borrowings. But deposits is there. See this, deposits, loans and advances from related parties. That means when you accept a deposit from public, if you accept deposits for period beyond 12 months, obviously long term. If it is to be paid within next 12 months, short term borrowings. And loans and advances from related parties, others. Now same, borrowings are classified into secured, unsecured. If they are secured, you need to mention nature of security. And if any loans and guaranteed by directors, we need to clearly mention how much amount is guaranteed by directors. And same, loan default details. Specify the amount and amount of period and amount of default as on the balance sheet date, both loan and interest. If company has taken any short-term loans, borrowings, not paid, default is there, they need to clearly mention the period and amount of default. And the most important point, put a star mark, the last one, the current maturities of long-term borrowings will also comes under short-term borrowings. Current maturities of long-term borrowing, that means basically that liability is which borrowing? Long-term. But in that long-term borrowing, what is the amount due in the next 12 months? then it will be treated as current maturities of long-term borrowings, and that will be disclosed under the head short-term borrowings and current liabilities. For example, loan is there, term loan is basically long-term borrowing. Just now we have seen term loan, where it will come, long-term borrowing. But in this term loan, next 12 months, how much amount falls due? It will be short-term borrowings as current maturities of long-term borrowings. Just now we solved one question as Sumedha Limited sum. In that Sumedha Limited sum, they have taken a loan. It is paid in 10 installments. Next 12 months, how many installments? 2 installments. 2 installments is classified as short-term borrowings, I told now. This is the reason. Current maturities of long-term borrowings. Important. Basically, that is a long-term liability. But in that long-term liability, how much amount falls due in the next 12 months? Where will you show? Short-term borrowings in current liabilities. In old textbooks, in old things, before amendment, where it will be shown? Current liabilities, other current liabilities. Current liabilities, other current liabilities. Which is wrong now. You should not show as other current liability. You need to show it as short-term borrowings. If somebody is still telling you other current liabilities, they have not updated. So any current maturities of long-term borrowings will be classified as other current liability. For example, debentures is there. Debentures. Basically, debentures is a long-term borrowing. Suppose it is due to be settled in the next 12 months. That means current maturities of long-term borrowings. Where it will come then? Short-term borrowings. Because it is current maturities of long-term borrowings, it is due to be settled within the next 12 months. Hello. So we are discussing schedule 3. In schedule 3, can you tell me what are the things we completed so far? Shareholders funds completed. Then money, share application, money pending allotment. Yes. In non-current liabilities, we completed long-term borrowings. In current liabilities, we completed short-term borrowings. Now, next one more point I will cover and I will close. The next one is deferred tax liabilities. See this? Deferred tax liabilities. DTL. And if you see the non-current assets, we have DTA. See this? DTA. So, DTA, DTL. These two arise from AS 22. There is a standard called Accounting Standard 22. Please give reference here. When we discuss AS 22, I will again connect you. AS 22. There is a standard called AS 22 which talks about what? Deferred tax concept. Deferred tax can be deferred tax asset, deferred tax liability, sir. If it is a deferred tax asset, non-current assets. If it is a deferred tax liability, non-current liability. No question of current liability. Deferred tax is always long term. That's it. No question of short term, because schedule 3 exclusively said deferred taxes will be classified under non-current category 1. If it is an asset, non-current asset. If it is a liability, non-current liability. So don't ask much about deferred tax now. Even if I explain now, you don't understand. Because what is deferred tax? Deferred tax is the tax effect of timing difference between accounting income and taxable income. Then what is accounting income? What is taxable income? What is the tax effect on timing differences between accounting income and taxable income? This we will understand only when we discuss AS 22. So wait till AS 22 discussion will come. There I will connect you. As of now, if you see any deferred tax asset or liability, you classify accordingly. Okay, va? So that's it, pa. Okay. Good evening to all of you. So let's start our discussion. What we are discussing, sir? We are discussing balance sheet format as per schedule 3. So far, what are the items we have covered? Equity and liabilities, shareholders funds, in that share capital, reserves and surplus, money received against share warrants, share application money pending allotment. What is the third head? Non-current liabilities. In non-current liabilities, long-term borrowings. I think we completed long-term borrowings. And deferred tax liabilities also we completed. Next, in non-current liabilities, we had other long-term liabilities as well as long-term provisions. In current liabilities, we have completed short-term borrowings, and trade payables, there is nothing to discuss. Next, other current liabilities we need to discuss, and short-term provisions we need to discuss. So let us start our discussion. First, in long-term borrowings, see other long-term liabilities. What items will come in other long-term liabilities? Already I think we know one item in other long-term liabilities. Yeah, trade payables. See this one I told you already. Trade payables. So trade payables basically will be part of current liabilities. But when it will be classified under non-current liabilities, if it is not satisfying the criteria of current liabilities, we have discussed now. If it is not satisfying any criteria of the current liabilities, obviously it has to be classified in non-current liabilities. In non-current liabilities, where will you show? Is it long-term borrowings or is it deferred tax liability? No, it is definitely other long-term liabilities. So trade payables and any other liability like this, we need to show others. Any other liability which is not current liability, it will come in non-current liability. You see, in non-current liability, is it a long-term borrowings? No. Is it deferred tax liability? No. Is it long-term provision? No. Obviously, it has to be classified as other long-term liabilities. Okay. Now, next, long-term provisions. Let us discuss about provisions. Long-term provisions. Sir, what is basically a provision? Provision is a liability which the amount we cannot, I mean, the amount we are going to make an estimation. We don't know the exact amount. We will make some estimation. So provision is a liability, okay, and the amount we are going to estimate. We don't know the exact amount, how much this liability is. So that will become a provision. So please understand, sir, when you are preparing balance sheet of a company, any provision you create against liabilities, that will come in liability side. If you create any provision against asset, that will be shown by way of deduction from the particular asset. Like for example, provision for doubtful debts, it won't be shown on the liability side. It will be deducted from the particular debtors. Similarly, if you create any provision for depreciation, it will be deducted from the PPE. It will not be shown on the liability side. So this long-term provisions we will show on the liability side of the balance sheet. Okay. So basically, what is provision? See, there is one standard called AS 29 which talks about provisions. We are going to discuss it. What it says is, provision is a liability measured only by substantial degree of estimation. So first there should be a liability, but that liability should be estimated. Then you create a provision. And you know what is liability? Already we discussed. What is liability? Liability is a present obligation arising from past event, and the settlement of which involves outflow of resources. See this. This is what we have discussed in the previous session, right? So liability with estimation will become a provision. Like for example, provision for warranty. Company is selling goods, right? When company sold goods, it gives warranty for 2 years. That means within the next 2 years, out of the product we sold, some of the products may be come for repairs, replacement. Whatever the cost company is going to incur, so that will be liability to the company. It's a present obligation arising from past event, and company has to settle it by way of outflow of resources. And we don't know exactly how much amount we are going to incur for this warranty services, warranty we have given. So that's why we will make estimation. Based on the past experience, we will make an estimation. Like provision for tax, for example, provision for tax. But basically, sir, this provision for tax will come in short-term provisions, not in long-term provisions. Because tax we are going to pay every year, right? Within 12 months we will pay. Generally this year tax will be paid in the next 12 months only. You cannot say tax provision as a long-term provision. So it's basically a short-term provision. Any provision for gratuity, for employee benefits. Suppose employees are going to retire in future. you need to pay PF, gratuity, pension. For that you created a provision. So that is basically a long-term provision. So you need to see whether provision created is a long-term or short-term. That depends upon when we are going to meet the obligation. Depending upon that, if it is going to meet in the next 12 months, it's a short-term provision. Otherwise, it's a long-term provision. But remember, guys, if you see any provision for doubtful debts, provision for depreciation, provision for diminution in the value of investments, these are all provisions created against assets. So they will be shown as a deduction from the concerned asset, not on the liabilities side. For example, one student, what he has done is, suppose there are debtors, see this, 10 lakhs. On these debtors, we created a provision for doubtful debts. Suppose we created a provision for doubtful debts on 10 lakhs, sir. So suppose 2% provision we created on 10 lakhs. So can you tell me how much? 20,000, correct? 20,000 provision. So deduct it. 9.8 lakhs. You will show it on what side? Asset side. This is the presentation. Asset side, current assets. In that current assets, debtors, trade receivables. This is how you need to present. See, these are all you need to do in notes to accounts. In the original balance sheet, directly you write 9.8 lakhs. In the notes to accounts, you will give this analysis. Suppose one student is there. What he is doing is liabilities, assets, balance sheet. Asset side, current assets. In that current asset, trade receivables, he will show 10 lakhs. Liability side, there is current liabilities or non-current liabilities, whatever, current liabilities or non-current liabilities. Short-term provision. In that he want to show provision for doubtful debts, 20,000. He want to show whether this presentation is correct. Is this presentation right? Can I show provision created against debtors on the liability side? Now why? Because it is basically this 20,000 is not a liability. Will you pay this 20,000 to anybody? No. So in order to understand what is provision here, provision first of all should be a liability. Provision should be liability. Here they are saying that provision is a liability which is measured by substantial degree of estimation. Sir, then why you are calling this is also a provision? Provision for doubtful debts. See, here provision is created for the loss in value of an asset, not for meeting any liability. So therefore, when you are preparing balance sheet, only provision created to meet the liabilities will come on the liability side, either short-term provision or long-term provision. If you create any provision against asset, you need to show by way of deduction of that provision from the concerned asset. That's why when you prepare balance sheet, debtors minus provision for doubtful debts, building minus accumulated provision for depreciation, investment minus provision for diminution in the value of investments will deduct, because these are all provision created against loss in value of asset, not a provision created to meet any liability. Hello, you understood? So therefore you understood what is provision. Can anybody tell me what is provision? Liability with estimation is provision. Suppose if there is no liability, there is no provision. So any provision created against asset, can I show it on the liability side? No. What I need to do? Deduct it from the concerned asset. Fit into your mind. Only provision created against asset will be reflected. Either it can be long-term provision or short-term provision. Depends. So when you are going to meet this obligation, depending upon that, you need to segregate. Here you see long-term provisions they are writing. Provision for employee benefits, others. Employee benefits means gratuity, pension, PF. You can add here provision for warranty. Provision for warranty. Warranty provision. Like this, so many types of provisions a company create to meet the liabilities. Hello. Next, any other provision. Now you see short-term provisions. See this. There also provision for employee benefits. That means the provision for employee benefits can be a short term, can be a long term, depending upon when you are going to meet the obligation. Suppose if you are going to meet the obligation in the next 12 months, short term provision. If it is going to be meet 12 months after the reporting date, obviously long term provision. You can add here provision for tax. Provision for tax. Sir, always remember provision for tax is which provision? Short term provisions. Any other provision. Okay. So provisions also done, sir. I think in non-current liabilities everything is done. Hello? In non-current liabilities, long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. In current liabilities, short-term borrowings, trade payables. Trade payables divided into two categories. Amount due to micro and small enterprises, other than micro and small enterprises. And then short-term provisions also I completed. Now you understand the difference between provision created against liability, provision created against asset? Yes. Now, only one thing is left, sir. What is it? In current liabilities, we had one other current liabilities. I think this is the important one, sir. Other current liabilities. Now, come to other current liabilities. What items will come in other current liabilities? See this. Very interesting this is. Please focus. See the first one. Current maturities of finance lease obligations. Sir, you go and check long-term borrowings. Long-term borrowings. In long-term borrowings, one item called long-term maturities of finance lease obligation. Correct? There I told you, if you take any asset on finance lease basis, in respect of that lease, what is the amount you are going to pay? That liability will comes under long-term borrowings. Now, in respect of that long-term borrowing, how much we need to pay in the next 12 months? Current maturities of finance lease obligation. That will comes in other current liabilities. You know, the interesting part is in short-term borrowings. Look at short-term borrowings. Yesterday, last class I told one point. Current maturities of long-term borrowings will comes under short-term borrowings. That means I told, suppose debentures, basically. Debentures, where it will come? Long-term borrowings. But if it is going to paid in the next 12 months, it is going to due in the next 12 months, then it is short-term borrowings. But here they have not included this lease obligation, finance lease obligation. They are saying that long-term maturities of finance lease obligation will be there in long-term borrowings. Long-term borrowings. In that finance lease obligation, how much is due in the next 12 months? That is current maturities of finance lease obligation. That will be shown under which head? Other current liabilities. I think they are they might have forgotten to include this as a part of borrowings. Maybe their intention is even this also they need to include it as a part of short-term borrowings. But unfortunately they kept it in other current liabilities only. So still it is in other current liabilities only. So you need to understand current maturities of finance lease obligation will be there in other current liabilities. Everybody. Next, see the second one. Interest accrued but not due on borrowings. See this, interest accrued but not due on borrowings. Similarly, interest accrued and due on borrowings. What is interest accrued but not due? 31st March already interest accrued but due date not came. That will be your other current liability. Already 31st March interest accrued and due also. That is also other current liabilities. Hello? For example, sir, there is a company, sir. Say this, there is a company which has issued debentures, sir. 12% debentures, 10 lakh rupees. The company will pay interest in 2 times in a year, 30th June, 31st December. Financial statements we are preparing for the year 24-25, sir. So when your year end, sir, 31st March 2025. So by the time you are closing the books of accounts, last time interest was paid on 31st December. That means January, February, March. 3 months interest already accrued, but not due. Because due date is 30th June, 31st December. You are closing books on 31st March 2025. By the time you are closing books of account on 31st March 2025, from 31st December 2024, 3 months interest accrued, na sir. So therefore, interest accrued for 3 months is 10 lakhs into 12%. Suppose the rate of interest, 12% is the rate of interest. How many months? 3 months. See this, 10 lakhs into 12% into 3 months, that is 30,000 came. This 30,000 where I will show? Other current liability, because this is interest accrued but not due. Interest accrued but not due. Similarly, interest accrued and due also. Due means not yet paid. Accrued and due, that is also comes under other current liabilities. So both interest accrued but not due, interest accrued and due will also comes under other current liabilities. Important, mark it as importance. Next, income received in advance. Sir, any income received in advance will be shown under other current liability. For example, customer paid advance for supply of goods. Customer given advance for supply of goods. We have not supplied the goods, but customer given the advance. We received the advance. Now you tell me, you received the advance without still supply need to make. That means at the end of the year, this is not your revenue, but income received in advance. So it is received but not your income. Therefore, what is the entry you will write? What is the entry you will write, sir? Bank account debit to income received in advance. So advance is like liability. So where will you show? Other current liabilities. Other current liabilities. Next, unpaid dividends. Important. What is this unpaid dividend? Company not paid the dividend declared. So when company not paid the dividend, it's a other current liability. Why company not paid the dividend? So many reasons. So many reasons could be there. For example, we are unable to find out the recipient. So we have not paid it. So any unpaid dividend is there from company point of view, that will classified under other current liabilities. And this one we already know. What is that? Application money received pending due for refund and interest accrued thereon. By 31st March already application money received, allotment done, your share application was rejected. Therefore your money should be refunded. So whatever the money refundable at the end of the year, including interest thereon, where it will come? Other current liability. I think last class we have discussed this point. Now next one you see, unpaid matured deposits and interest accrued. Unpaid matured deposit, debentures and interest accrued. See this, unpaid matured deposits and interest accrued. Unpaid matured debentures and interest accrued. Can anybody tell me what are these two? First one you take, unpaid mature deposits and interest accrued. What is this? Yes, very good. Sir, suppose you know, you go and check long-term borrowings. Long-term borrowings, you check long-term borrowings. In long-term borrowings, we have public deposits. Correct? Public deposits. Or look at short-term borrowings. In short-term borrowings also, public deposits is there. Right? Now suppose this public deposits due date came, maturity date came, but you have not paid it. So you need to show in OCL, other current liability. So look at the journey. Suppose for example, I have taken deposits from the public for 5 years. So basically it is long-term borrowings. Deposits taken from public for 5 years. Suppose 10 lakh rupees. Hello? Suppose we have taken deposits here, public deposits we have taken. How much deposits we have taken? 10 lakhs. For how many years? 5 years. So tell me, where will you show in balance sheet? Generally, if this is the case. Non-current liabilities. In non-current liabilities, long-term borrowings. Correct? In long-term borrowings, public deposits I will show. How much? 10 lakhs. This is at the end of first year. Okay. Now, suppose at the end of the 4th year, this entire 10 lakhs is due in next 12 months. So therefore it will be converted into current maturities of long term borrowings, correct? So there, then where it will come? Short term borrowings. In short term borrowings, public deposits. How much? 10 lakhs. So initially it was long term, but now it has become current maturities. Current maturities of public deposits, long term borrowings. Now you see, suppose due date came, company not paid. That means already due date came, maturity came, but you have not paid it. Therefore, it is no more a borrowings. No more it is a borrowings. They want us to show it in OCL, other current liability. This is unpaid matured deposits. Unpaid mature deposits, if any is there, that will be shown in OCL, other current liabilities. Similarly, any interest accrued thereon. Suppose on these deposits, suppose 2 lakhs interest is there. That interest will also be shown in OCL. So unpaid matured deposits. The word is matured, sir, here. That means already the due date came, but you have not paid it. Similarly, debentures, you see debentures. Due date came, but you have not paid. So unpaid mature deposits and any interest accrued thereon will be part of OCL, other current liabilities. You understand the journey? Basically, it can be a long-term borrowings. Then if it is current maturities of long-term borrowings will come in short-term borrowings. Then once due date came, but you have not paid. Unpaid mature deposits, unpaid mature debentures and interest accrued thereon will comes in other current liabilities. So last one, any others. So therefore important things here. Tell me what items will come in other current liabilities. First, current maturities of finance lease obligation. Long term maturities of finance lease obligation. Long term borrowings. Long term borrowings. Current maturities of finance lease obligation. Next, interest accrued but not due on borrowings. Next one, interest accrued and due on borrowings. Fourth, income received in advance. Next, unpaid dividend. Unpaid dividend. Next, application money received for allotment and due for refund. Refund including interest accrued thereon. So therefore, at the end of the year, any interest accrued but not paid basically will come in other current liability. What is the last two? Unpaid mature deposits and interest accrued thereon. Unpaid matured debentures and interest accrued thereon. Okay. So that will be shown in other current liabilities. I think we have completed liability side, sir. Correct? Entire liability side, I think we have finished. So short-term provision. So entire liabilities we finished. So can you recollect what are the items in liability side? First we'll start part 1, equity and liabilities. First head, shareholders funds. In that A, share capital. B, reserves and surplus. C, money received against share warrants. Second, share application money pending allotment. Next, third, non-current liabilities. In non-current liabilities, A, long-term borrowings. B, deferred tax liabilities. C, other long-term liabilities. Other long-term liabilities. Last one, long-term provisions. Now come to current liabilities. First one, short-term borrowings. Next, trade payables. Next, other current liabilities. And then short-term provisions. These are the items on the liability side. We have discussed each one. Okay. Now let us discuss the asset side. Let us discuss the asset side. Okay, sir. Now see the asset side. So I told you, as per schedule 3, assets are divided into 2. Non-current, current. First see the non-current assets. In non-current assets, total 5 heads will come. 5. What is the first one? PPE and intangible assets. I told PPE and intangible assets. PPE means? Okay, abbreviation, okay. Basically, it's a tangible fixed assets. Tangible fixed assets is called PPE. Property, plant, equipment. See here. First one, property, plant, equipment. It is tangible fixed assets. Next, intangible assets. So let us look at the breakup, sir. Come to tangible PPE, sir. How presentation will be made in respect of PPE? Say this. You need to show in notes to account, sir. PPE classification. like land, buildings. Sir, land and buildings, actually land is a separate asset, building is a separate asset. Why, sir? Because land is non-depreciable. If I include it as a part of building, I am depreciating land also, which is not correct. That's why practically when you present, land will be presented separately, building will be presented separately. But in the question, suppose if they have given land and buildings together and they have not given any other information, don't try to become a hero there. In this land building both are combined, land is non-depreciable asset, so your question is wrong, allot full marks. Don't write like that. If land and building together they given, you provide depreciation on the total value. Okay. Next, plant and equipment, like plant and machinery, furniture and fixtures, vehicles, office equipment, others. Like this, whatever the assets you had, tangible fixed assets, you made a classification. Now the important point is assets under lease, sir. Assets under lease. Sir, if any asset is acquired under lease, that will be shown separately. Lease asset should be separately disclosed. I told you, sir, substance or form concept. You may get a doubt, sir, how can a leased asset will be our asset? Yes, it can be, because last session we have seen asset definition. Asset is a resource controlled by an entity from which we are expecting future economic benefits. So this building, suppose the company has taken this building for lease basis for 20 years. Now for next 20 years, this building, who is controlling? Company. Who is controlling the future economic benefits? Company. Therefore company point of view, this is the company asset. So they will show in the balance sheet in non-current assets as PPE. So that's why they said any asset acquired under lease should be shown separately. And also, sir, the important thing is, in respect of this PPE, sir, at the end of the year in the notes to accounts, we need to prepare one reconciliation statement, reconciliation of asset values. What is this reconciliation? Simple. Opening, what is the asset? For each class of asset we need to do this. For example, buildings. What is the opening gross value of the building? What is the opening net book value of the building? How much is the opening provision for depreciation? How much is the closing provision for depreciation? What will be the closing gross value, closing net book value? And also during the year, any additions happened, any sale happened, any depreciation, all these things we need to adjust. That we need to prepare in the form of a statement. That we need to prepare, sir. See this, you need to provide a reconciliation of gross and a net carrying amounts. Gross, net carrying amount of each class. See this, each asset class, detailing the additions. What are the additions happened during the year? Disposals, any sales made during the year. Business combination acquisition. What is business combination acquisition? Actually, amalgamation is called business combination as per Ind AS. We call it as amalgamation, sir. Amalgamation is called business combination in as per Ind AS. So if you acquire any asset through business combination, that details also we need to provide. For example, we purchased a company. From that company we received a plant and machinery. So additions, this is an addition in the plant and machinery value. Any revaluation changes, for example, company will do revaluation, right? As per accounting standard 10, some assets may be valued at fair values. They will be revalued. So if there is any revaluation happened, because of that either there will be under revaluation, over revaluation. Asset value may increase or decrease. If 10% or more of the net carrying value is there because of this revaluation, then we need to disclose that also, and any other adjustments required. Like showed related depreciation, impairment losses, reversals separately. So any depreciation, any impairment losses, reversals separately. What is impairment loss? Any loss in value of asset due to reasons other than depreciation. Remember, any tangible, intangible asset, first loss is depreciation. For example, if it is PPE, depreciation. If it is intangible asset, amortization. Apart from depreciation and amortization, is there any reason why an asset may lose its value? Yes, that is called impairment loss. These impairment losses are discussed in separate standard AS 28, and depreciation is discussed in separate standard called AS 10. So there you will understand this impairment losses and reversals. So because of impairment also, sometimes an asset may loses its value. So that adjustment also you need to do. So at the end of the year, sir, in respect of each class of PPE, company need to prepare one reconciliation statement. So this reconciliation statement should consist all these details. See, this is practically relevant. Actually, if you see the notes to, if you see the financial statements of any company, notes to accounts, you will find this. But when you're solving the questions, sir, we don't apply all these things. Why? Because that much information is not available in the question. At the most, what is the information available? Cost minus depreciation. That's it. So therefore, from the cost, we will reduce depreciation and we will show. So this reconciliation statement and all not required to be prepared. But practically it is there. Practically it is there. Okay. Now come to intangible assets, sir. Sir, like PP is tangible asset, we have intangible assets also. Like for example, goodwill. Goodwill is an intangible asset. So you give the breakup of intangible assets like goodwill, brand, trademarks. Your brand, trademarks, computer software is also intangible asset. Mastheads. What is mastheads? Publishing titles. What is masthead? Masthead means the title of the paper, newspaper. For example, there is a newspaper. So we have here Sakshi, Eenadu, one newspaper is there. That Eenadu name is there, sir, that is called masthead. That itself is an intangible asset for them. For example, when you go to any shop to purchase a newspaper, you ask, give me newspaper, or you will ask a particular name only, you will ask. Na? That particular name you are asking means that is the brand of the company. So that's an intangible asset for them. So masthead is the title of the paper. So publishing titles, some books, for example, publishing titles will be there. Na? Though they are also intangible assets. Mining rights, if you got any mining rights, copyrights, patents, other intellectual property rights. So all kinds of intellectual property rights which does not have any physical substance, they will come under intangible assets. Any recipes, formula, models, designs, prototypes. What is prototype? Anything developed initially, first time, that model is called prototype. Initial model, like initial model. Yeah, prototype, that is called. Recipes, formulas, models, designs, prototypes, licenses, franchises. These are all intangible assets. So if you have any intangible asset, give a breakup like this. And same, like for each class of PPE, we have prepared a reconciliation statement. Na? Similarly, for each class of intangible asset, you prepare a reconciliation statement. That reconciliation must show the gross, the net carrying amount for each class, detailing the additions, disposals, business combination acquisitions, revaluation changes, other adjustments, related depreciation and impairment losses. Here you don't call this as depreciation, you call this as what? Amortization. So any amortization, all these things you disclose. Next, so in non-current assets, PPE and intangible assets. In PPE and intangible assets, first PPE we completed. Second, intangible assets completed. Third, capital work in progress. Relating to capital work in progress, there is no breakup. Capital work in progress means what? Any physical assets in development stage. Next one, intangible assets under development. That is also, for that also there is no breakup. Intangible assets under development means in R&D stage, research and development stage. If any intangible asset is there, that will be shown there. Correct? Now once you complete that, what is the next one? Non-current investments. Non-current investment. You see the investments? Non-current investment is there. Yes. Now important, come back. Sir, non-current investments, see basically investments are two types. If you see, there is a separate standard for investments, accounting standard 13, which deals with investments. Which says investments are basically two types. Investments are two types. What are those? Current investments. No, long-term investments. These are the exact words used by standard. Current investments, long-term investments. But if you look at schedule 3, they are calling it as non-current investments. They are not calling it as long-term investments. So when you are preparing balance sheet, don't write long-term investment. If you write long-term investment, you are not presenting as per schedule 3. If you look at schedule 3, they said only non-current liability. Basically, non-current liabilities is what? Long-term investment only. Long-term investment. But the wording should be as per schedule 3. Okay. Sir, you said as per AS 13, investments are two types, current, long-term. What is current investment? If investments are made with an intention to sell them in next 12 months, within near future 12 months, those are current. No, I don't want to, I want to hold them for more than 12 months, long term. Similarly, a company has to make a classification of its investments. So if they want to make any investments for a period exceeding 12 months, then they need to present under non-current investments. Now look at non-current investments. What investments are they have classified? First, trade investments and other investments. See this, trade investments, other investments. See, within the investments there is two classification: trade investments, other investments. What is trade investment? Trade investments, other investments. Trade investment means the investment which is made with an intention of trading. So maybe 1 minute. Okay, so trade investment, other investments, sir. What is basically trade investment? Trade investment is an investment which is made by the enterprise to protect its business, to promote its business, like investment in subsidiaries, investment in associates, okay, investment in joint ventures. These are trade investments. So in trade investments, investments made by a company to promote or protect its business interest, they will make those investments. Those are called trade investments, which is relating to our business, for protecting or promoting our business. Other investments means the investments which is made by the enterprise for earning income, rental income, dividend income, interest income. Those are called other investments. So when companies making investments, with what intention they are making? Whether these investments made by the company is it increasing the business interest? For example, I am a parent, I am A Limited. I invested in B Limited shares more than 50%. That means B Limited is what? My subsidiary. So therefore your business is expanded, your business interest is protected, right? So there, why I will invest more than 50% in a company? Maybe I am exercising control. I want to exercise the control of that company. Maybe I want to include that business as a part of my business. So in order to promote my business, in order to protect my business, increase my business, I make investments. Those are trade investments generally. Investment in subsidiaries, joint venture, all these entities. For example, there is a supplier who is supplying raw material for me, right? I invested in a supplier company shares. Why I invested in supplier company? Because for protecting my business interest. He is the supplier of material for me. So if I invest means I can control his company to a certain extent. Therefore, here investment is made with an intention to protect my business interest. That is trade investment. Other investments generally made, investments made for earning income, not directly linked to the main business operations. For example, I am Infosys company. I invested in TCS company. Why? Just for earning income. Just for earning income. You understand trade investments and other investments? Important. Now, okay. You need to classify like this. Non-current investments are like this. See this. What is the classification? Investment property. First one, investment property. What is investment property? Investment property means investment in land or building, not for the purpose of business usage and not for the purpose of earning income, but for the purpose of using in business. Okay. So investment property, sir. What is investment property? I told investment in land or building, not with an intention to use in business, but for the purpose of earning income or capital appreciation. Maybe I, okay. So investment property means investment in land or buildings, sir. Understand this. This is investment in land or buildings for earning income or capital appreciation, right? Capital appreciation. but not for use in business. For example, I purchased this building. Why I purchased this building? To earn income, rental income, or for capital appreciation, not to use this in the business. For example, I want to use this building as a factory, or I want to use this building as an office. I don't have that intention. Then it will be called as what? Investment property. Investment property. So investment property means an investment in land or buildings that are not intended to be occupied substantially for use by or in the operations of the investing enterprise. So in simple terms, it is land and building held to earn rental or capital appreciation, not for business use. Then that will be classified as what? Investments. Suppose, for example, sir, a company purchased a building for use in business. Then where it will come? PP. Very good. Property, plant, equipment, tangible fixed asset. So therefore, with what intention you are investing? That is very, very important. If I just purchased a building, company purchased a building for earning rental income, not for use in the business, then it is investment. Where non-current investments. Suppose if a company purchased a building not with an intention of earning income but for use in the business, then that building will be PP. PP. Hello. But now I have one doubt. You have to clarify. Suppose a company purchased a, this is only out of curiosity I am asking. Suppose a company purchased a building for earning rent income, earning rental income. So company purchased a building for earning rental income. It will be treated as what? Is it treated as PP or investment property? Investment property as per AS 13. Correct? Now, will you provide depreciation on this building or not? Will you provide depreciation on this building or not? Because depreciation concept is prescribed in AS 10. So will you provide depreciation on a building which is purchased for the purpose of earning rental income? That is, it is investment property. Will you provide depreciation? Yes, we need to provide depreciation. Why? Because AS 10 is also applicable. The provisions which is not covered in AS 13, automatically AS 10 is applicable. If you look at open AS 10, sir, in AS 10 scope it is there. This point is there. Investment property is valued at cost. Like that one point is there. So understand, sir. See, this is the subject you need to understand. You cannot blindly say a building purchased. Sir, at the end of the day, building is a tangible asset. We need to provide depreciation. Whether you will treat it as investment property, whether you are treated as PP, it is a physical asset. It will have a limited life, right? You need to provide what? Depreciation. So you cannot say, sir, I am considering this as investment property as per AS 13. It is not PPE as per AS 10. AS 10 is covering depreciation concept. AS 13 there is no depreciation concept. I won't provide depreciation on that. That's a wrong thing. You see the nature of the asset. The nature of the asset is what? Physical asset. It will have a limited life. Therefore, AS 13 it is investment property. At the same time, whatever the aspects which is not there in 13, AS 10 is automatically applicable. In AS 10 there is a depreciation concept is there, na? That is applicable for investment property as per AS 13. You enjoyed this point? Very good point actually this is. Okay. Practically, why they will follow? See, here the problem is they purchased a building. They, with what intention they will purchase? Management doesn't know this. But big companies, they know. For example, they purchase the building means whether we purchase this building for business user other than business user. I mean just for rental income. If you purchase the building for rental income or capital appreciation, definitely they have to classify it as non-current investment. Otherwise, why as an auditor we need to make a qualification remark, na? As an auditor, we need to verify whether company's really intention is what. If it is for business use, then you can treat PP. If it is not for business use but for earning income, definitely we have to treat as investment, non-current investment. And you need to apply AS 10 also for depreciation purposes. Okay. That is obvious. It will change according to the nature of the business. That is obvious. I can't say it. You need to understand, depending upon the nature of the business, it will change. For example, if I am a real estate company, I will purchase a building. For me, it is a stock in trade. Correct? So the question of will not arise. Here, depending upon the nature, it will change. But generally, we are making a discussion. for all companies. If your nature company will differ, obviously your assumptions, your way of classification will also change. Now next, what items will come in investments, sir? Equity, that means you are investing in other company equity shares, preference shares, government securities, trust securities, debentures, bonds of other companies, mutual funds, partnership firms, other non-current investments. Like this, whatever the investments you made of long-term nature, you make a classification. But remember guys, this one, investment property will always comes under non-current investments. Now the important points, sir. Everybody please focus here. See, Schedule 3 asking regarding investments, you need to clearly mention the name of the company or entity where you are investing, and also relationship type, whether that company is your subsidiary, associate, joint venture, you need to mention, and also what is the nature of the investment and the amount of investment also you should mention, and also separate details of partly paid investments. Any investments only part of the amount is invested, partly paid investment, that we need to disclose separately. So these are the details. In respect of company, corporate body, for example, if your company invested in any other company, any other corporate body, these are the details: name of the company, what is the type of relationship you had with that company, how much amount you invested. So all these details you need to mention. And also suppose if you invest in partnership firms, see this here in investments, partnership firms is also there, na sir? Sir, can a company invest in partnership firm? Yes. Can a partnership firm invest in company? Can a partnership firm purchase the shares of the company? I don't think so. It is not allowed. Partnership firm cannot purchase shares of a company. I think that point it is to be discussed in law, not in accounts. But a company certainly can invest in partnership firms. But when a company invested in partnership firm, in Schedule 3, notes to accounts, we need to clearly disclose what is the name of the firm, and who are the partners of the firm, name of all the partners, and the total capital of that firm, and also each partner's share in the capital also need to be mentioned. Why they are asking all these details? This is the biggest internal control. Where company is investing, suppose investing in a partnership firm, why you are investing in that partnership, what is the name, how much amount you are investing, who are the names of the partners of that partnership firm. That means if any funds of the company are misappropriated, wrongly invested, then shareholders will started asking. For example, MD, managing director son-in-law is there, he is having one partnership firm. Suppose the company is investing in that partnership firm, now everyone knows those details now, because in the notes to accounts we are mentioning the name of all the partners, in that son-in-law name will also be there. Then shareholders will question now next, why you are investing in a partnership firm, what is the benefit to the company. So therefore Schedule 3 main intention is they want us to disclose everything, so that if you done anything with a wrong intention, or maybe you have not done with a wrong intention, but there is a chance that a fraud might happen at that case, in that case. So they want every company to disclose all this information, so that users will read and start questioning the company. Next, and also suppose if you investment, investment carried at other than cost. Suppose sometimes investments are valued other than at cost, then what is the basis for such valuation, you need to mention in the notes to accounts. Generally AS 13 says current investments are valued at cost or fair value, whichever is lower. Long term investments are always valued at cost. If you are making investments valuation other than cost, what is the basis for such valuation, you need to mention in the notes to accounts. And also additional disclosures you need to make, that is aggregate quoted investments, market value. What is quoted investment? Listed company securities. Quoted investment means listed company securities. So if you purchase shares of a listed company, you need to clearly mention how much amount you invested and what is the market value. And also quote aggregate unquoted investment. Unquoted investment means unlisted company. Unlisted company shares if you purchase, you need to clearly mention what is the aggregate number. And also any provision you created for diminution in the value of investments. Diminution means reduction. For fall in value of investment, if you create any provision, how much provision you created, that details also you need to mention. So very good sections or segments that this is. So whenever in the question you see investments, you see whether that investment is long term or short term. When current or long term. If it is current, it will go to current assets, short term investments. Current investments, sorry, not short term, current investments as per Schedule 3. If it is long term, then it will comes under non current assets, non-current investments. So investments are classified like this. These are the details we need to mention. Now immediately see current investments, sir. Same points are there. See this. Come to current investments. Same points. But one thing is missing. What is that? Investment property. You see, investment property is there only in long term. I mean non-current. So therefore here you see equity, preference, government, bonds, mutual funds, partnership firm, other investments. If you invest in a company, name of the company, type of relationship, nature, amount, separate details of partly paid investments, what is the basis of valuation, if it is other than cost, quoted investments, what is the amount and market value, unquoted investment, what is the total amount you invested, any provision for diminution you created, and if you invest in partnership firm, what is the name of the firm, who are the partners, what is the total capital, and each partner share in the capital. So these are all internal check to the company, sir, where company is investing the money, whether company is investing in places which is beneficial to the company or not, or just company funds are misutilized, investing in different places, partnership firms, businesses where company does not have any benefit. Then with this information everybody will know, sir. Now they will start asking the board of directors policies. So therefore through schedule 3 we know a lot of information relating to the company, what company is doing. Hello. So that means we have completed what? So non-current assets. If you come to non-current assets, sir, so this one done now. Property, plant, equipment, intangible assets, capital work in progress, intangible assets under development, and non-current investments. In current assets we completed current investments. Now you see in non-current assets we have deferred tax assets. This is also I explained, because I told you AS22 deferred tax, either it can be an asset or it can be a liability. Now next one you see, sir, long-term loans and advances. Sir, any long-term loans and advances given by the company will comes under non-current assets. So regarding loans and advances, see what is the classification they have given, sir. First, capital advances. Capital advances, sir, what is capital advances? Any advance given by the company to acquire any tangible or intangible fixed asset, that is called capital advances. So capital advances given by the company will be shown separately, sir. For example, you see advance given for acquisition of a capital assets like fixed assets. For example, a company wants to purchase a plant and machinery, sir. Now for this purchase of plant and machinery we have paid advance 10 lakh rupees. So what is the entry we write, sir? Capital advance account debit to bank account. Now this capital advance will be shown in long-term loans and advances in non-current assets. Now when actually we purchased the asset, we paid advance first, then actually when the asset is received, plant and machinery account debit. Suppose the asset cost is 25 lakhs. In that already advance we paid 10. This advance will be adjusted. Remaining balance we will pay 15 lakhs. So plant and machinery account debit 25 lakhs, capital advances 10 lakhs to bank 15 lakhs. So where these capital advances will come, sir? Long-term loans and advances. See this, in long-term loans and advances, first we need to classify capital advances, and also any loans and advances given to related parties like our subsidiary company, joint venture, parent company, any loans and advances given, if it is of long-term nature, that will be shown under other long-term loans and advances, and like any other loans and advances. Hello. And similarly you see short-term loans and advances, sir. Short-term loans and advances, you see short-term loans and advances to related parties, others. You need to specify the nature. Now listen to me very carefully, sir. Sir, we are discussing assets or liabilities, sir? Assets. In that assets what we are discussing? Loans and advances. Loans and advances can be either short-term, long-term. Okay. Now whenever you are presenting short-term, long-term loans and advances, they are saying that you need to make additional classification in the notes to accounts. What is that classification, sir? See this. When you are making loans and advances, these loans and advances will be classified in 3 categories. One is secured considered good. This is one category. Secured, considered good. This is one combination. Second, unsecured but considered good. Second combination. Third, doubtful combination. Doubtful combination. You need to remember this because this subclassification is applicable for assets. Which assets this subclassification is applicable? Actually, if you see the entire schedule 3, in 4 places this subclassification is applicable. What are the 4 places? Long-term loans and advances, short-term loans and advances, other non-current assets, trade receivables. You know, for all these 4, same subclassification is applicable. What is the same subclassification, sir? 3 combinations you need to do. Secured but good. Next, unsecured but considered good. What is the last one? Doubtful. What is secured considered good? Secured means, suppose you give a loan, you take an asset on security, and we are expecting that that person will make the payment perfectly. So that is secured as well as good. That means we don't have any, feeling, expectation that that fellow will not pay. We are confident that that person will make the payment. For example, I given a loan to you. At the time of loan, I have taken asset on security basis, and your previous track record is so clean. You are making the payment. Therefore, it will comes under secured good category. Next, unsecured but considered good. For example, I given a loan to you, okay, or any amount is receivable from you. There is no asset I have taken, unsecured, but I am expecting payment from you. So therefore, unsecured considered good. And doubtful, that means any amount is receivable from you, any loans and advances I given to you, it is receivable from you. Doubtful means I am expecting that you are not going to pay. Then we need to classify it as what? Doubtful. Like this, I need to classify the loans and advances. In the total loans and advances, for example, the company total loans and advances 100 lakhs. In this 100 lakhs, how much is secured considered good? For example, 50 lakhs. How much is unsecured but considered good? 20 lakhs. How much is doubtful? Suppose 30 lakhs. Like this, company has to classify. Same thing is applicable for short-term loans and advances also. You see, short-term loans and advances also subclassification. Secured considered good, unsecured considered good, doubtful. Okay. Next. And also, sir, whenever you have given any loans and advances, you know, any bad and doubtful loans, allowance for bad and doubtful loans, any doubt is there, any amount of loans and advances you have given may not be recovered, doubt, bad debts. So you create a provision. How much provision you created, allowance for bad and doubtful loans and advances, it should be disclosed separately. And also sometimes, sir, any loans and advances given to directors' offices, company given a loans and advances to directors or offices. Now, how much loans and advances given to directors? We need to present in the notes to accounts. And also, what is the amount due from the firms? Suppose if you given any loans and advances to partnership firms, how much amount is due from the partnership firm? And also any private companies, any loans and advances given by the company to any private company, in which director is a partner or a director or a member, should also be shown separately. For example, there is a company, private company. Our company has given a loan to that private company. In that private company, one of our director is a member or maybe a director. Suppose there is a partnership firm. Now our company has given a loan to that partnership firm. Now one of our director is a partner in that partnership firm. Now we need to clearly mention in the notes to accounts the list of those firms and the private companies, how much loan is due from those. See, these are all internal controls. You will understand these points only when you get qualification. When you go to audit, now you will understand the depth of schedule 3. Then you started appreciating it. Actually, students are not reading schedule 3 properly. They're thinking schedule 3 is only examination perspective. Of course, correct. But at the same time, if you read schedule 3 correctly, so much knowledge you will get. Your auditing, excellently you can do. You need not require to depend upon anybody. Lot of information is available. Now tell me, in schedule 3, according to schedule 3, if a company has given a loan to any partnership firm, in that partnership firm, one of our director is a partner. That details also we need to mention. Now shareholders will question, why loan is given to that partnership firm? Since because you are the partner, you have given. Like that they will ask the question, na? What is the benefit to the company, they will ask, na? They will see interest rate, all these things, na? Then shareholders will be caught, right? Especially if you are a listed company. Listed company means the funds is given by public, right? You cannot utilize the funds in whatever manner you like. It is not your family business. But these days everybody is what? They are growing themselves only. So schedule 3, all these details should be mentioned. But guys, remember, it is only, they mentioned here what? Private companies. Hello? Same points are applicable for short-term loans and advances also, sir. Same, see this. Any bad and doubtful, we need to create a, how much allowance we created, provision we created for bad and doubtful. And also any loans and advances given to directors, officers, we need to mention. And also any amount loans and advances due from private firms, private companies, where a director is a partner, director or a member, we need to clearly mention all these details. Hello? So that means non-current assets. Can you tell me what is the first non-current asset? PPE and intangible assets. We completed that. What is the second one? Non-current investments. Completed that. Correct? Next, deferred tax assets. Completed that. Right? What is the next one? Long-term loans and advances. What is the subclassification of long-term loans and advances? Subclassification. Secured, considered good. Unsecured, considered good. Doubtful. Same subclassification is applicable for short-term loans and advances also. And also other non-current assets also. And also trade receivables. Trade receivables also. Next, last one in non-current assets. See, we have completed this also. What is the last one in other non-current assets, sir? Others. Other non-current assets. So look at other non-current assets, sir. What items will come in other non-current assets? We know already. Trade receivables. Trade receivables basically will come in current assets. When it will come in non-current assets, if does not satisfy the criteria, then it will non-current assets. In non-current assets, other non-current assets. So you see other non-current assets, actually you will find it. Other non-current assets. See here. Long-term trade receivables. Security deposits. Put a star mark here. Important. In other non-current assets, security deposits will also come. Any security deposits given by the company. So those security deposits which is made by the company to enter into any contract or for any purpose, those security deposits will be shown as other non-current assets. And then same subclassifications: secured, considered good, unsecured, considered good, doubtful. Relating to these other non-current assets, how much is secured, considered good, how much is unsecured, considered good, how much is doubtful, and any bad and doubtful debts is there, provision you need to present separately, that in respect of this amount, this is the amount bad and doubtful. And see, any amount due from the directors and officers, same, how much amount is due, we need to present. And also any amount owed by firms, private companies, in which a director is a partner, director or member, should also be shown separately. Sir, that means for loans and advances, either long term, short term, or other non-current assets. Other non-current assets. Right now we are discussing trade receivables. For all these four, sir, for all these four, subclassification is same. Remaining points also same. What are the remaining points? Allowance for bad and doubtful debts. Any amount due from the directors and officers should be shown separately. Any amount due from the firms or private companies in which one of our director is a partner, director, member. So same points, you see, repetition. Hello? Same points are repeating. So that means we have completed other non-current assets. Okay. So in the asset side, I think non-current assets, everything is done. Now come to current assets, sir. What are the pending things? Inventories, trade receivables, cash and cash equivalent. Last one, other current assets. Correct? There is nothing in other current assets, sir. No breakup, nothing they have given. So literally we need to discuss three things here. What are those? Inventories, trade receivables, cash and cash equivalents. Very interesting points. Inventories. Come to inventory, sir. Inventory means here what? Closing stock, right? The schedule 3 asks relating to inventory in the notes to accounts, you need to give classification like this: raw material, okay, work in progress, finished goods, stock in trade for goods acquired for trading. If you are a trader who acquired, see, any goods acquired for trading will not be called as finished goods, they will be called as stock in trade. Stores and spare parts, loose tools, if they satisfy the definition of inventory. Suppose loose tools, if they don't satisfy the definition of AS2, then they will go to AS10. AS10 PP. Others specify the nature. And now goods in transit, sir. See, at the end of the year, any goods in transit is there, you need to disclose them separately. Any goods in transit, you need to disclose them separately. And also mode of valuation. What is the method of valuation you are following for a valuation of inventory? That is also be disclosed in the notes to accounts. State the valuation method for inventories. Actually, in CMA Inter, not in CA Inter, CMA Inter, they are asking questions like this. What are the questions now? Explain disclosure requirements of inventories as per schedule 3. 4 marks. Like that they are asking. Explain disclosure requirements of inventories as per schedule 3. So if you learn this much now, if you're writing CMA paper, it will be very easy for you. You know the disclosure requirements. What is that? Raw material, work in progress, finished goods, stock in trade, spare parts, loose tools, and you need to mention goods in transit separately. And then what is the method of valuation of inventory? That's it. If you write these 3 points, 4 marks will come. Okay. So inventory is done. Next, trade receivables. Put a star mark, pa. This is very, very important. Trade receivables. See, trade receivables means what? Basically, debtors. Debtors for goods is called trade receivables. Now, sir, schedule 3 asks, in respect of debtors, you need to prepare aging schedule. You need to prepare aging schedule. What is this aging schedule? How much period the debtors are outstanding? We need to prepare in the form of a table. Look at this table, sir, this table. You need to prepare this table. See this. Particulars and outstanding for following periods from due date of payment. Less than 6 months. 6 months to 1 year. 1 to 2, 2 to 3, more than 3 years total. Like this you need to classify. From due date to how much period they are outstanding. Suppose due date already over, next 6 months. Less than 6 months outstanding on the balance sheet date, show separately. 6 months less than 1 year, show separately. 1 to 2 years separately. 2 to 3 separately, more than 3. Like that, whatever the amount outstanding in respect of debtors, that has to be classified like this. And you know how it will be classified? See this. Undisputed trade receivables considered good. Undisputed trade receivables doubtful. Disputed trade receivables considered good. Disputed trade receivables. That means when you are preparing aging schedule, this is what you need to follow. And of course, there is a sub-classification also. Like, what is the sub-classification for trade receivables? Secured considered good, unsecured considered good, doubtful. That is also applicable in notes to accounts. Along with that, you need to prepare this aging schedule also. When you are preparing aging schedule, sir, you need to divide the debtors into 4 categories. First, undisputed category. Undisputed. That means there is no dispute with the debtors. In that, good, undisputed good, and undisputed doubtful. Next, doubtful category, disputed category. Whether, there is a dispute, how much amount to be received from the debtors, there is a dispute between the company and debtors. Disputed. In disputed, we need to see good or doubtful. And you need to divide this into period wise. Outstanding for a period less than 6 months, 6 months to 1 year, 1 to 2, 2 to 3, more than 3 years. Now here I would like to tell you one important thing. When you are solving the questions, sir, debtors outstanding for a period exceeding 6 months. Debtors outstanding for a period exceeding 6 months, we need to show separately. Because of this schedule, see this 6 to 1 year, we are showing separately or not? So in the question, one of the question they will ask you, they will give you that debtors outstanding for a period exceeding 6 months, like this one amount they will give. What you need to do? You need to show separately. You need to show that amount separately. For example, your trade receivables is 10 lakh rupees. In this 10 lakh rupees, debtors outstanding for a period exceeding 6 months is 8 lakhs. So separately, this 8 lakhs in the notes to accounts. Remaining 2 lakhs is normal amount of debtors. We need to show others, like others. So like this, we need to prepare a aging schedule. So I think this question is also there in the practical questions also, sir. One of the practical questions of schedule 3, this question is there. I will show you. One of the practical questions, I think, as per schedule 3, some practical questions we have solved yesterday. In the study material, one question is there. Yeah. See this, I think, sixth question, you see. What is the question they're asking? Anik Limited is a company that is required to present its financial statement as per division 1 of schedule 3. The company has trade receivables, debtors, at the balance sheet date. What are the disclosures that are applicable with respect to trade receivables in the financial statements? With respect to trade receivables, what are the disclosures applicable? Same points you need to write. Like loans and advances, what are the points? Subclassification. First, trade receivables are subclassified as this: secured considered good, unsecured considered good, doubtful. And also any allowance for bad and doubtful we need to present separately. And also any amount due from the directors, officers, we need to show separately. And also any amount due from the firms in which our director is a partner. And also any amount due from a private company in which one of our director is a member or a director. Same points, sir. Please understand, sir. For trade receivables also, same points which is applicable for loans and advances will be applicable. And you need to prepare a schedule. This schedule you need to prepare. Okay. This aging schedule you need to prepare in respect of the debtors. So that means trade receivables done na? Yes. Last one pending. What is that? Cash and cash equivalents. Now come to cash and cash equivalents. Generally, you know, in cash and cash equivalents, what items will come? Cash in hand, cash at bank, all these things. See, balance with banks, checks, drafts on hand, cash on hand, others. Now, earmarked balances with banks. What is this earmarked balances with banks? Earmarked balances. Suppose, sir, if there is any specific bank balance, you open any specific bank account for any particular purpose, that is called earmarked bank balance. That has to be shown separately in the notes to accounts. For example, unpaid dividend. See, as per the Companies Act, sir, whenever company declared a dividend but it is not paid the amount, that amount should be transferred to a separate bank account. They need to open one bank account. In that bank account, they need to keep this amount. That is called earmarked balance, right? So when you are presenting cash and bank balance in the notes to accounts, you need to show this amount separately. For example, 10 lakhs. 10 lakhs is deposited in the bank. This is the earmarked balance for payment of dividend. Like that. Any balance held as margin money or security. See, sometimes, sir, with the banks, we will keep some money as a security. Okay, or as a margin money, we call it as margin money or security. If any kind of amount is there with the bank, our money only with there in the bank, with the bank as a security deposit, as a margin money. For example, bank is providing borrowings to us, right? For providing borrowing loan, banks sometimes they ask us to deposit some amount. So if you deposit any amount as a margin money or security, that has to be shown separately. See this separate disclosure for balances held as margin money or security deposit. And also repatriation restriction. Sir, what is repatriation restriction? For example, sir, your company is in India, you have a bank account in USA. In that bank account, $1 lakh is there. $1 lakh. That is also cash in hand, right? Cash at bank, sorry. But that $1 lakh has to convert into Indian rupees. Correct? But suppose if there are any repatriation restrictions, what is repatriation means? Bringing funds to India is called repatriation. Repatriation means bringing the funds from abroad. The funds are there in abroad. If I want to brought them to India, if there are any restrictions are there, exchange fluctuation, exchange restrictions, political restrictions, so like that, that country may put some restrictions, right? So if there is any restrictions like that, please disclose them in the notes to accounts. And also any bank deposits with 12 months maturity, greater than 12 months maturity. Separate disclosure for bank deposits with maturity greater than 12 months. We need to show separately, sir. Any bank deposits with a maturity greater than 12 months. So you need to give disclosure that we have a bank deposits. In that bank deposits we have this much cash, the maturity period is more than 12 months, like that we need to disclose. Okay, kind of deposits only with a maturity period of greater than 12 months. Here deposits with bank means with what intention the company is making those deposits. Is it just for security purpose? Sometimes some companies, what they will do, they will make investments for the purpose of security, like whenever suddenly funds are not there, this deposit amount they will use for business. So if for security purpose, if they deposit any amount, it is kind of a savings only. So those kind of deposits with greater than 12 months maturity we have to show separately. For example, if the company intention is to, we will make this fixed deposit for 5 years, 10 years, and our intention is to earn income, then it can be treated as what? Investment, because their intention is what? Earning interest. But sometimes we will make a deposit with the bank not with an intention of earning income, but with an intention of savings, or with an intention of meeting any sudden expenditure, suddenly if there is any shortage of funds. Or suppose for example, if company has any surplus funds, what they will do, they will load it in the bank account, surplus funds. So there, just to save the surplus funds we have done it, not with an intention of earning any income. That's it. So that's it, pa. I think entire balance sheet done na. Every item I discussed, pa. Every item, each and every item I discussed. This is called entire schedule 3 explanation. What most of them, what they are doing is, schedule 3 means only their format they are studying and they are solving the questions without understanding what is there in the schedule 3. Now I think you understand how much depth the schedule 3 is, how many new points you learned. Previously you don't know all these points, now you know so many new points you have learned, and you understood the scope of schedule 3 also. See, this is what exactly the subject is. Schedule 3 is not just format, it is giving you a lot of insightful information which definitely will help you. And even when you are solving the problems now, after learning entire schedules, if you are solving the balance sheet now, the different feel will come. You will see this, you will see, because you will be very confident, you know what point relating to each item, what information we need to disclose, you know this. So therefore exactly all those things we will implement, I will show you also. Okay, so shall we have completed entire balance sheet, right? Balance sheet done na? Yes, so entire balance sheet is done. Now one more important point is there, this is not part of balance sheet, but that point also important, sir, that I will show you. What is that? Contingent liabilities and commitments. There is one concept called contingent liabilities and commitments. See, put a star mark, important this is. Contingent liabilities and commitments, to the extent not provided for. A small concept, we'll discuss it. First, contingent liability. What is contingent liability? Actually, sir, I told you liability definition, right? What is liability? Present obligation from past events which requires the settlement of which requires outflow of resources. Correct? For example, it is not a present obligation, it's a possible obligation. So it will become contingent liability. It becomes a contingent liability. Suppose there is a present obligation but there is no probable outflow of resources, that is also contingent liability. Actually, I told you that point also. For example, your friend is taking a loan, you given a guarantee. Even though there is a present obligation, but there is no probable outflow of resources, because as long as your friend is paying, you are not required to pay. But when your friend fails, you need to pay. Correct? That means guarantee is given is what? Contingent liability. Hello. So therefore you see, contingent liability, if at all company had any contingent liabilities will not be disclosed in balance sheet, schedule 3, but they will be disclosed in notes to accounts. In fact, if you read AS 29 says contingent liabilities will be disclosed in notes to accounts. But in one exception, even contingent liabilities are not required to disclose in notes to accounts also. If the probability of outflow of resources is remote to settle this contingent liabilities, then they are not required to disclose in notes to accounts also. Okay, wait. So therefore, contingent liabilities, if you had, you need to disclose in the notes to accounts. As of now, you understand like that. What are the classification they given? First, claims against the company not acknowledged as a debt. There is a claim against the company, but company not accepted the debt. For example, we have a factory here. Because of our factory, entire environment damaged. Now that means, suppose surrounding one family is there. Surrounding one family is there. This family filed a case against the company in the court that because of this company pollution, our health got affected. So give us a compensation of 10 crores. That means this is what claim against the company, but company said, no, we are not accepting it. See, the family filed a case against the company in the court for how much amount? 10 crores. But as company accepted, no. That means it's a contingent liability. Like that, any kind of claims against the company but company not accepted is there, disclose them. And also any guarantees given. See this, important, guarantees given. Suppose I am a parent company, my subsidiary is taking a loan, I have given a guarantee. So parent company point of view, guarantee given is what? Contingent liability. When it will become actual liability? When my subsidiary fails. As of now, there is no probable outflow of resources to settle the obligation. Next, other money for which company is contingently liable. Any other liability for which company is contingently liable. Contingently means which liability may come, may not come. Now, this is contingent liabilities. Next, there is a concept called commitments. Important part. What is commitment? Commitment means if company committed something for future, those details also company need to mention. What are the things company will commit for future, sir? For example, company want to expand the business, company want to invest in any capital project, or company invested in any company, remaining amount, company will make the payment. For example, a company purchased bonds worth of 10 crores. Till now 5 crores paid. Remaining 5 crores, commitment. When the other party calls, company will make the payment. That is called commitment. Commitment is not an asset. Please understand. This is the future action company will do. So any kind of commitments company have, those details also we need to mention in the notes to accounts. Like for example, you see, estimated amount of contracts on capital account remaining to be executed and not provided for. So for example, any contracts company entered, in respect of those contracts, what is the remaining part company need to execute? For example, there is a contract company entered, the contract cost is 50 crores. Till now 50% of the project is completed. Remaining 50% project we need to complete it, right? For that company need to spend 250 crores. That is called commitment. That company need to mention 250 crores is our commitment in respect of a capital account. Contract on capital account remaining to be executed. And this one most important, put it as star mark. What is that? Uncalled liability on partly paid up shares, for shares and other investments partly paid up. Here most of the students are confusing, sir. What they are thinking is, the moment they see uncalled liability on partly paid up shares, for shares and other investments partly paid up, what they are thinking is this is calls in arrears. No, read properly. What is that? Read. What is that? Uncalled liability. Uncalled liability on partly paid up shares. Correct? Uncalled liability means, suppose company issued shares, 10 rupees each share. Company will call the amount, right? For example, till now 5 rupees called. Remaining 5 rupees uncalled. So uncalled liability on partly paid up shares for shares. So you think from the investor point of view. For example, you purchased in a company shares. 10 rupees share you purchased. Till now company called 5 rupees. Remaining 5 rupees company not yet called. In future company will call. When call, you need to make the investment. So therefore, from your point of view, it is what? Uncalled liability on partly paid up shares are, and also other investments partly paid up. So you made these investments. In regarding your investments, what is the amount? When the other party calls, you pay. That is your commitment. Please understand. That is your commitment. Sir, when you invest in any company, whatever the amount in respect of those securities, you need to pay when they call, na sir. Suppose at the end of the year, you only part of the amount called, part of the amount you paid. From your point of view, that is investment. But that company point of view, that may be a share capital. That may be a debentures. Whatever the remaining amount you are going to make, that is your commitment, right? Commitment. When you purchase the securities, you have given a commitment. So that's it. Next, any other commitments like that, you need to disclose. Hello? You understand uncalled liability on partly paid up shares? What is this uncalled liability? Is it you are seeing from company as an investor or company as a issuer of shares? Company as a investor. Company as a investor. We are seeing this point, company as a investor. Investor point of view, think. As an investor, whatever the amount I have not yet paid because they have not called, that is my commitment. It is not an asset. When it will become an asset? When the other party calls, I made the payment, then it's part of my investment. Till then we need to show it as what? Commitment. In the balance sheet we need to show the commitment. So that means entire balance sheet we have completed as per schedule 3. Now we have what? P&L account. Okay, sir. In schedule 3 we have completed balance sheet, right? Schedule 3 division 1, in that part 1 talks about balance sheet. We have seen entire balance sheet, the format and also the disclosure requirements, right? Now next P&L account. Let's see P&L account format and the disclosure requirements. So part 2 P&L account, sir. Name of the company, P&L account for the year ending. So particulars, note number, current year figures, previous year figures. You know, P&L account is prepared for the period. Balance sheet as on a particular date. P&L account main object is what? To ascertain the financial performance. Now I already told you P&L account will consisting of what? Incomes and expenses. Income includes gains, expenses includes losses. So all incomes and expenses will come. Now look at the presentation as per schedule 3, sir. First, revenue from operations we need to show. Revenue from operations. What is revenue from operations? Revenue from operations means your major operating activity, major principal activity. From that activity, whatever the revenue you got, that is revenue from operations. Then other income, any other income. For example, if you are a non-finance company, suppose like Reliance company for example, what is the revenue from operations? Oil, textile, telecom, whatever the activities they are doing, retail business, all this is revenue from operations. Apart from that, they will make investments. From the investments they will receive interest income, dividend income, rental income. All these are what? Other incomes. Okay, then you will get total income. So if you see the breakup here, general revenue from operations, if you are a non-finance company, sale of product to sale of services, grants or donations, if you are a section 8 company, other operating revenue less excise duty. Excise duty means any tax paid on manufactured goods. Excise duty, I think now it is not there. Only on some products excise duty is there. Previously, before GST, there is excise duty is there, because these excise duty directly related to the products we manufacture, right? That's why it is directly reduced. And that too, if you are which company? Non-finance. Non-finance means your main business is not financing business. For example, there are some companies whose main business is financing, like for example banks, NBFCs. What they will do? They will give loans, take loans. They will make investments, like that, sale and purchase of investments. They are called financing companies. If you are a finance company, then what is your main revenue? Revenue from operations, interest income. See, for example, if you take a bank, what is the revenue from operations to bank? Interest income, discount on bills, discounted, commission. These are all revenue to the bank. So you need to see the nature of the company, and accordingly you need to judge the revenue from operations. So suppose for example, if you are a finance company, interest income or any other financial services, like bank will provide financial services and charge commission. So commission is revenue from operations for bank. But suppose if you are non-finance company, if you receive any commission, it is not revenue from operations, it is other income for you. So you need to see what is the nature of operations, and accordingly you need to decide. If you are a non-finance company, sale of products or sale of services is your revenue from operations. If you are a finance company, interest income, dividend income, discount income, For example, if you're a bank, discount on bills, interest earned, commission earned, these are all what? Revenue from operations. So you need to see the nature. What is the nature of the operations? Accordingly, you need to say whether it is revenue from operations or not. Revenue from operations means principal activity. The object why that business is formed, that activity. Whatever the revenue generated from that activity, it is revenue from operations. Hello? Next. Okay. So revenue from operations, you need to see whether you are a finance company or non-financing company. Accordingly, you need to classify. What is other income, sir? Other income, like interest income for companies other than finance company. If you are a finance company, interest is revenue from operations, not other income. Dividend income. Generally, I am talking about non-finance companies. If I am a non-finance company, any interest income, dividend income, any net gain or loss on sale of investments, these are all what, sir? Other incomes. And other non-operating income, any other thing will comes under other incomes. So when you are presenting P&L, first you need to show revenue from operations, then other income, then you will get total. Now look at the expenses. Most important part is expenses, sir. Most important part is expenses. Everybody please focus. Expenses side. See, if you look at P&L account format, sir, P&L account expenses, first 4 are related to what? First 3, not 4, 3. 3 items relating to what? First 3 are relating to stock, inventory items. Correct? What is the first one? Cost of materials consumed. Second one, purchase of stock in trade. Third, change in inventories of finished goods, work in progress, stock in trade. Let us discuss this. Important. Listen to me very carefully. So raw material, work in progress, finished goods. I told you, if you are a manufacturer, these are the stock items to you. If you are a trader, you don't have raw material, work in progress, finished goods. It is called stock in trade. Okay. Sometimes a manufacturer can be both manufacturer as well as trader. Then he will have raw material, work in progress, finished goods as well as stock in trade. Now see, listen to me carefully. First you take raw material, sir. Raw material, opening stock available. Raw material opening stock will be there. Yes, definitely. Opening balance will be there. And during the year we make purchases. Raw material will be purchased. Purchases will be there. And there will be closing stock will be there. Raw material. I am talking about only raw material. Opening stock, purchases, closing stock. See this. Opening stock plus purchases minus closing stock. Opening plus purchases minus closing. You will get what? Yes, consumption you will get. How much raw material consumed? You will get raw material consumption, sir. Raw material consumption. This is the first item in expenses. See this. First item in expenses is what? Cost of materials consumed. That means they are talking about raw material. How much worth of raw material you consumed during there? That will be your expenses. For example, opening raw material will be there. 100 lakhs. During there you purchased 50 lakhs. So 150. Closing it is only 20 lakhs. So 150 minus 20. 130. So that is the raw material consumption. This will come in P&L account as a expenses. Okay. In respect of raw material, what will show? Consumption. Suppose for example, if this is not the case, generally we prepare trading account, right? Trading account. When we prepare trading account, opening, purchases, closing. Opening plus purchase minus closing. That means we are showing consumption only. But there T-shape account. Here we are not preparing in T-shape, na? Statement wise we are preparing. Directly we will take the net amount. That's why opening plus purchases minus closing. If you prepare trading account also, we will take the same thing. Trading account, if you prepare, you will show first opening stock of raw material, then purchases you will take, then you will write this side closing stock. Automatically what you are considering? Consumption only. Here also consumption, but presentation is little bit different. Now come to work in progress. Tell me, relating to work in progress, opening balance will be there? Yes. Purchases will be there? Work in progress, no purchases. We will do manufacturing, right? So no purchases. Closing balance will be there? Yes. So that means you need to understand, sir, relating to work in progress and finished goods, we don't have purchases because these are manufactured. So in respect of work in progress and finished goods, what we need to show? We need to show changes in work in progress, changes in finished goods we need to show. That means the difference between opening and closing stock. Generally, suppose normal trading account, how will you do? Opening stock you will show debit side, closing stock you will show credit side. Here directly the difference will be shown. Correct? Because we are not preparing P&L account in T-shape manner, na sir. Directly we are presenting in the form of statement. The directly difference we will show. That difference is this. See this. Change in inventories of finished goods, work in progress. So the difference between opening and closing. Opening and closing. For example, opening stock balance 10 lakhs. Closing stock balance 20 lakhs. So can you tell me how much is the change? Minus 10 lakhs. Minus 10 lakhs. Opening minus closing. So it is minus 10 lakhs. So in P&L account you will write how much? Minus 10 lakhs you will write. Indirectly what you are doing? Revenue minus expenses. Minus plus. That means this 10 lakhs is added to income. That means it is automatically added to profit. Why? Because closing stock is more than opening stock. Closing stock is more than opening stock. Sir, when closing stock is more than opening stock, whatever the excess is there, that will increase my profits. That is what I am doing. So therefore you need to understand here what is opening, what is closing. Opening minus closing. What most of the students doing mistake here is opening 10, closing 20. They write 10 lakhs in the P&L account. They write 10. Instead of minus 10, they will write just positive 10. So because of that, they will get a wrong answer. So you should, as it is mathematically, you follow like this. Opening minus closing. Same finished goods also same. Opening minus closing. That is also called what? Change. This change we will show in the P&L account. So in the P&L account, relating to raw material consumption we will show. Relating to change in inventories of finished goods. Relating to finished goods we will show change. Relating to work in progress we will show change. That's it. Manufacture is over. So can you give conclusion? If you are a manufacturer, when you are preparing P&L account, relating to stock, what items you will present? First, raw material. What you present? Consumption. Consumption means how much you consume during the year in production. That will be your expenses. That will be debited to P&L account. How to find out consumption? Opening plus purchases minus closing. Second, relating to work in progress finished goods, what will you present? Change. Change means opening minus closing. Opening minus closing. If closing is more than opening, negative symbol you need to put. Revenue minus expenses. Minus plus. It automatically added to income. Thereby profits. If you are a manufacturer, you have raw material, work in progress, finished goods. Tell me relating to raw material what you present. Relating to raw material, what you present in P&L account. Consumption. Consumption. What is consumption? Opening plus purchases minus closing. Relating to work in progress and finished goods, change you need to present. Now come, if you are a trader. Trader means he is having what? Stock in trade. Correct? Hello? Now tell me, relating to stock in trade, opening will be there. Opening balance? Definitely opening stock in trade will be there. Opening stock in trade will be there. During their purchases will be there. Yes, purchases, because you are not manufacturing, you are purchasing the goods and selling. Those are called stock in trade. And you will have closing. Stock in trade. Simple. What they are telling is, in respect of stock in trade, purchases you show separately. See here. Purchase of stock in trade. Show separately. And what is left now? Opening and closing. The difference between opening and closing. See, this will be shown separately in P&L. Hello? And the difference between opening and closing will be shown as change. Separately in P&L. That's it, pa. So relating to stock in trade, you see change in inventories of stock in trade is also there. You see. So tell me, relating to stock, totally how many items? 5. If I frankly speak, 5 items will come. What are those? Consumption of raw materials, purchase of stock in trade, change in inventories, 3 things. What are those? Work in progress, finished goods, stock in trade. Stock in trade. So therefore you need to understand, relating to work in progress, relating to finished goods, relating to stock in trade, change will come in P&L. And relating to raw material, consumption will come, change will not come, direct consumption will come. And relating to stock in trade, purchases will come separately. Purchases will come, change will come separately. So this is the expenses side stock. So now onwards there should not be any confusion relating to stock. Now do you have any confusion? No, that's it. Now see the next 4th one. Employee benefit expenses. All kind of employee benefit expenses like salaries, wages, PF, gratuity, pension, staff welfare expenses, anything relating to employees will be shown here. Employee benefit expenses. Employee benefit expenses. Okay. All kind of employee payments, salaries, wages will write in the employee benefit category. Next, finance cost. Finance cost means interest. Interest expenses. Not only interest, any cost we incurred at the time of borrowing of funds. Any cost we incurred at the time of borrowing of funds. Like for example, commitment fees. Actually there is a standard called A16 which talks about borrowing cost. So generally you remember here, finance cost means what? Interest. See this. Finance cost means interest, other borrowing cost, any net gain or loss on foreign currency transaction. So when you enter any foreign currency transaction, because of that any gain or loss came, either exchange gain or loss because of the foreign exchange rates fluctuation. We are going to discuss this in AS11 actually. That will also comes under finance cost. So finance cost means basically interest, sir. Apart from interest, any other borrowing cost will also come here. When you are going for borrowing, some cost you are going to incur. For example, application fees, processing fees, commitment fees. Like this, there are some fees you are going to incur. They are called borrowing costs. Those borrowing cost also comes under finance cost only. Next, depreciation and amortization expenses. Depreciation is the most common expenses, loss. Show it. And all other expenses are others. So tell me expenses, how many specific heads are there? 6. Tell me what are those? Cost of materials consumed. Next, purchase of stock in trade. Third, change in inventories of finished goods, work in progress, stock in trade. Fourth, employee benefit expenses. Fifth, finance cost. Sixth, depreciation and amortization. Remaining on all other expenses like admin expenses, factory expenses, manufacturing expenses, selling and distribution expenses, advertising expenses. Any expenses which is not part of these 6 categories will comes under others. Now see, if you want to show other, or else if you want to give detailed breakup also, you can give. Then you will get what? Total expenses. So total revenue, total income minus total expenses. You will get what? Profit before exceptional and extraordinary items and tax. Profit you will get. Profit before what? Exceptional, extraordinary, tax. Exceptional items AS5. AS5. Extraordinary items discussed in AS5. So any exceptional item are there, adjust. Any extraordinary items are there, adjust. Then you will get what? Profit before tax, important part. Profit before tax. From that reduce tax expenses. Tax expenses are 2 types, current tax, deferred tax. Both are discussed in AS22. Both are discussed in AS22. AS22. Then finally you will get profit or loss for the period from continuing operations. Any profit or loss from discontinuing operations is there, that has to be shown separately. Tax expenses of discontinuing operations shown separately. Then profit or loss from discontinuing operations after tax we need to show separately. Actually, you know, there is one standard called AS24 which talks about discontinuing operations. Whenever any business discontinued any of its operations, sir, relating to discontinuing operations, the profits will be disclosed separately. That's why here see, this profit what we got is profit from which operations? Continuing operations. See this. This is and then discontinuing operations we are showing separately, and both will be added. Then you will get what? Profit for the period. And finally what they are presenting, look at it, EPS. And EPS we have both basic and diluted EPS. And this EPS is discussed in AS20. Sir, I am giving reference so that you need to understand these items will be discussed in the respective accounting standard. So understand the significance of P&L account. If you look at the P&L account, what items are there? These are all the items are there. Correct? Hello? So EPS is also part of P&L account. And sir, you come to additional information, sir. In that additional information, in the notes to accounts of the P&L account, some additional information we need to disclose, sir. In that, the first point, very, very important, sir. See this point, put a star mark. Any significant income and expenses item, sir. Any item exceeding how much, sir? 1% of revenue or 1 lakh should be disclosed separately. This is what they say, sir. Any item exceeding 1% of revenue or 1 lakh, exceeding this limit, we need to disclose separately. 1% of revenue. For example, our revenue is 10 lakhs, sir. In that 1%, 1 lakh. No, 10,000. Correct? 10,000 or 1 lakh. Whichever is higher. So, not whichever is higher. Any expense or income exceeding this limit. This limit means 1 lakh. For example, company incurred fuel cost which is 1,50,000. That means which is exceeding this limit. Therefore, they need to disclose that expenses separately in the notes to accounts. And any payment made to auditors, like chartered accountants to us, we are the auditors. They need to give breakup of all the payments they made to us, like for taxation matters, for company law matters, for statutory audit, internal audit, what is the fees they are paying. And also CSR expenditure. You know CSR, corporate social responsibility. How much amount companies spend on these activities they need to mention in notes to accounts. And also any exceptional extraordinary items they need to disclose. These exceptional extraordinary items will be discussed in AS5. Any prior period items. Like that means prior period items means past years expenses or incomes. Suppose if you forgot them in the past year, or if you have wrongly considered them, now you need to consider in the current year. That is called prior period item. For example, last year salary expenses you forgot it. Now this year you find out. You need to record it under the name prior period item. And any inventory and purchases, detailed breakdown of manufacturing, trading, service companies, work in progress, give a breakup, major expenditure items. For example, stores, power, fuel, rent, repairs, insurance, rates, taxes and miscellaneous expenses. subsidiary companies, any dividend received and provision for losses from subsidiary companies, and cryptocurrency or virtual currency. For companies trading or investing in cryptocurrency or virtual currency, what is the profit or loss from cryptocurrency, amount of cryptocurrency, deposits or advance received, all these things we need to disclose. These are not that much important, but you need to first point is important. First point, any income or expenditure exceeding 1% of revenue or 1 lakh, whichever is, I mean, this, any income or expenses exceeding this limit we need to disclose separately, because they thought it is material. See here you write down, this is called material item as per schedule 3. That's why they put this limit, right? So that's it, sir. We have completed P&L account. So can you tell me the P&L account format once? First, revenue from operations. Second, other income. Then total income. Next, expenses. Tell me first one. Cost of material consumed. Second, purchase of stock in trade. Third, change in inventories of finished goods, work in progress, stock in trade. Fourth, employee benefit expenses. Fifth, finance cost. Sixth, depreciation and amount. Other expenses. Then total revenue minus total expenses. You will get profit or loss before exceptional items, extraordinary items and tax. Exceptional items, extraordinary items will adjust. Then tax expenses. Tax expenses are current tax, deferred tax. Then you will get profit or loss for the period from continuing operation. Then discontinuing operations. Then you will get total profit. Last we need to disclose EPS, earning per share. Okay. So this is the P&L account format, sir. Sir, I will show you examiner's favorite question, sir. I don't know why this question examiner's favorite. He is asking, keep on asking this question. See this question, sir. Question number 2, practical questions of schedule 3. Question number 2, mark it as important. They are testing this in the examination. Yeah, see this question, everybody. Management of Loyal Limited contends that work in process is not valued since it is difficult to ascertain the same in view of the multiple processes involved. That means they are talking about what? Stock. Work in process means stock. They opine that the value of the opening and closing work in process would be more or less the same. So according to their opinion, the opening and closing work in progress should be more or less same. Accordingly, the management had not separately disclosed work in progress in its financial statement. Comment in line with schedule 3. Tell me. First, you understood the question. Huh? Majority of the students, they don't understand question. What is the question here? That first of all, they are talking about what? Work in progress. See, regarding work in progress, what schedule 3 says? Tell me. Think. Just now we completed. What we need to show? Only change. Change we need to show. It is not required to show opening, closing separately. Just change is sufficient, right? That is what they are saying. They are saying is, here the opening and closing work in progress is same. When it is same, what is the reason why we need to disclose? That's why they have not disclosed it separately in the financial statements. Correct only. When schedule 3 is asking disclose only when there is a change in inventories of work in progress. If the difference between opening and closing is there is no difference. I mean, the opening and closing is more or less same. That is what they are saying now. Opening and closing work in progress is more or less same. When it is more or less same, there is no change. When there is no change, why it is required to be disclosed separately? Not required to be disclosed separately. So therefore, what management has done is correct only. Hello? See this. Schedule 3 to the Companies Act does not require that amounts of work in progress at the beginning and at the end of the accounting period to be disclosed in the statement of P&L. Only changes in the inventory of work in progress need to be disclosed in the P&L. Non-disclosure of such a change in the statement of P&L by the company may not amount to violation of schedule 3 if the difference between opening and closing work in progress is not material. Suppose if the difference is there but management not disclosed, then we say there is a violation of schedule 3. Without having any difference, so they said we need to disclose separately. So that is not correct now. So that's why management treatment is correct only. They have not disclosed it separately because there is no difference between opening and closing. Hello, you understand that question, sir? Yes. Sir, in the practical questions, one question is there. Question number 5. Please come to question number 5, sir. What is the question, sir? Question number 5. Prince Limited presents its provisions for contingencies under reserves and surplus in notes to accounts in the financial statements. Whether this presentation is correct? Sir, Prince Limited presents its provision for contingencies where? Under reserves and surplus in notes to accounts. Is it correct? No. Where they need to be presented? Any provision for contingencies. Contingencies means future liabilities. They may come, may not come. We don't know. So basically they will be presented as a part of contingent liabilities. So but they want to present it as a part of reserves and surplus, which is not correct. See this. The ICI glossary of terms used in financial statement defines the term reserve as the portion of earnings, receipts, other surplus of the enterprise, apportioned, appropriated by management for general or specific purpose other than provision for depreciation, diminution in the value of assets, or for a known liability. Reserve should be distinguished from provisions. For this purpose, reference may be made to the definition of expression provision. I told you what is provision. Provision is basically a liability with estimation. As per AS 29, provision is a liability which can be measured only by substantial degree of estimation. Liability is a present obligation arising from past events and which results in outflow of resources. Now present obligation means an obligation is present if based on the evidence available its existence on the balance sheet date is considered more likely than not. So therefore you need to understand, sir, they cannot present provision for contingencies under the head reserves and surplus. Reserves and surplus basically consisting of what? Profits. Either earned profits or appropriated profits. They should not contain any provision for liabilities. Hello? That's it. Required, we will disclose it generally. I think we have completed all the practical questions also. How many questions are there? 6. 6 completed. Correct? Now see, relating to balance sheet schedule 3, we have completed everything, sir. Now we need to solve the questions relating to balance sheet to understand it. So balance sheet format, P&L account format. Now we are available with both the formats. So now we need to apply it in solving the questions. Now if you remember in this chapter, in the beginning I told you. So what are the things are there? I think basic concepts we completed. Schedule 3 discussion is over. Now the thing left is what? Dividend. Only dividend concept is there. So before going to dividend concept, I am going to solve the questions relating to schedule 3. Okay. Okay. So relating to financial statements of companies, we have seen the format of balance sheet as well as P&L account. We have discussed. We have completed the discussion of balance sheet and P&L account relating to schedule 3. Right. Now let us solve some questions, problems. So in the question bank, first illustration number 2, sir. This is examiner's favorite illustration, sir. If you observe the past examination questions, so many times this question has been asked either as it is or with some additional points. Same question they have asked. Okay. Let us see illustration number 2, sir. How we are going to approach these type of questions, balance sheet and P&L account preparation questions, I will tell you. And we are going to solve the complete question. We are going to solve it completely. Because most of the students, what they are doing is, they are not solving the questions. They are doing auditing, watching. There is a difference between solving the entire question and just watching the question. Most of the students, what they are doing, they are not solving at least once. At least every chapter you should solve 4 or 5 questions completely from the beginning to the end. That will give you the areas to identify where you are lacking, and also that will give you the practice. Writing practice is also very, very important. Just verifying solution, auditing solution. In examination, you won't solve because you don't have the proper practice. Unless and until you solve the entire question, you don't know where you are lacking. So practice is very, very important, especially when you are solving questions relating to balance sheet and P&L account. Okay? Because here, even a small mistake will give wrong answers. That's why. So I'm reading the question. See this question, sir. Illustration number 2. They have given a trial balancer of a company Omega Limited as on 31st March 2012. Figures is in thousands, sir. Debit items, credit items given. Can you tell me? In trial balance, debit items represents what? Assets, expenses. Debit represents. Credit represents liabilities, incomes. Correct? So you should, first of all, you should need to, keep in mind these things. Debit balance basically indicates assets and expenses. Credit balance indicates liabilities and incomes. Okay, now see the debit balances one by one, sir. Land at cost 220. So where will you show land at cost? PPE, correct? PPE. Plant and machinery at cost, PPE. Trade receivables, current assets, nothing but current assets, trade receivables. Inventories 31st March 2012, closing stock. Current assets, inventories. Current assets, we have one head called inventories. There we will show. Bank, cash and cash equivalents, current assets, correct? Adjusted purchases, P&L account, purchases, P&L account, we have purchases, right? There we will show. So P&L account, purchases. Factory expenses, P&L account, expenses, other expenses. There is no specific head for factory expenses. So these factory expenses, admin expenses, selling expenses, these three will come in other expenses in P&L account. Debenture interest, expenses, finance cost, correct? Finance cost. Interim dividend paid, interim dividend paid. Interim dividend paid, will it come in P&L? No, it is, because it is not an expenses. Dividend is not an expense. Dividend is appropriation from profits. So it's an appropriation from profits. So whenever a company gives any dividend, sir, our profits should be reduced. First point. Second point, this dividend already paid. They said paid. That means it is not a liability. It is not a liability. So therefore, what we need to do, this interim dividend paid, we need to deduct from the P&L account balance. From P&L, we need to reduce this 18. Because dividend paid means our profits have been deducted. So what is the entry for dividend generally? P&L account debit to dividend, dividend to bank. That is the entry. Here paid means already bank balance adjusted. No need to adjust again. Only thing that has to be adjusted is what? P&L account. So in reserves and surplus, we will show all the reserves, right? So P&L account, opening balance, current year profits, from that dividend paid will be adjusted. So dividend paid is basically appropriation from profits. One more thing, sir. This is which dividend? Interim dividend or final dividend? Interim dividend. Interim dividend means any dividend which is declared during the year. Generally, once the year is completed, for that completed year, company will give dividend. That is called final dividend. This is not final dividend. This is interim dividend. This is interim dividend. Generally, final dividend, when it will be declared after 31st March, it is not considered as liability. See, there was accounting standard 4 which talks about events occurring after balance sheet date, which says any dividend declared after 31st March is a non-adjusting event. Therefore, it should not be considered as a liability. I will come to that point. So interim dividend paid will reduces my profits. It is an appropriation from profits, so it will be deducted from P&L account. It is already paid means it is not a liability to us. So these are the debit items. Now look at the credit items, sir. Share capital, equity capital, shareholders funds, share capital, debentures, long-term borrowings, general reserve, reserves and surplus, P&L account, reserves and surplus, securities premium, reserves and surplus, sales, P&L account, revenue from operations in P&L account, trade payables, current liabilities, trade payables, provision for depreciation deducted from the cost of the asset. You know, in this question, if you observe, land, plant and machinery, land is non-depreciable asset, plant and machinery given at cost. See this, asset is maintained at cost. That means depreciation we are transferring to a separate account called provision for depreciation. There are two ways a depreciation can be maintained, asset can be maintained. One is depreciation is directly reduced from the asset, or else depreciation will be transferred to separate account called provision for depreciation account, and asset will be shown in the books at cost. So here asset is shown at what value? Cost. But when you present in balance sheet, na sir, cost of the asset minus provision for depreciation we will write. Provision for depreciation indicates total depreciation till now. Hello? So provision for depreciation 172 is there, and cost of the asset is 770 is there. That means 770 minus 172 subject to current year adjustment. This 172 is not yet adjusted with the additional information. So this 172 maybe current year depreciation is not there in this 172, that is to be adjusted. And also suppose any plant and machinery sold during the year, the sold portion provision for depreciation we will cancel it. So those adjustments we need to do. Important adjustment in this question. Why again and again he is asking na? Because of these 2 points he is asking again and again, this one and this one. Okay, so here plant and machinery is given at cost to, provision for depreciation given. Now look at the next one. What is it? Suspense account. Suspense account, how much is there? 4. So let's see additional information what is there, because we don't know suspense account having credit balance, what it is we don't know. Next, look at the additional information everybody. The authorized share capital of the company is 40,000 shares of 10 each. So what is the impact of this point? I told you notes to accounts relating to share capital. First we need to present authorized capital, number of shares, face value, all these things we need to disclose, right? Next, the company on the advice of the independent valuer wished to revalue the land at 3,60,000. Revaluation of land. Land original cost how much, sir? 220. Correct? Now they want to revalue it to 360 rupees in 1000, 360. So that means how much increase? 140. That is called revaluation profit. That will be transferred to revaluation reserve. When the asset was increased, here upward revaluation, asset value increased. So land account debited to revaluation reserve account. So this revaluation reserve will go to reserves and surplus. Correct? Next, third point, important point. See this point. Declared final dividend at 10% on 2nd April 2012. Sir, this is final dividend. Once the year is completed, for completed year company declared a dividend. Any dividend declared after 31st March is not considered as a liability on 31st March because it's a non-adjusting event. Why? We see, for example, first of all, once year is completed, na sir, board of directors will propose the dividend. Once board of directors proposes the dividend, AGM will be conducted. In AGM, dividend will be approved. So on 31st March, just proposal happened, declaration happened, approval not yet done. Therefore, it cannot be considered as a liability. So therefore, this we will not consider. It's a non-adjusting event. Therefore, any dividend, final dividend after 31st March cannot be treated as liability to the company. For example, sir, in this case, dividend is declared on 31st March itself. Then here they have given, see this, 2nd April. That means after 31st March they have given. Instead, suppose they have given 31st March. Then that means dividend declared at the end of the year. So we assume that it is also approved by the shareholders. We assume it is already approved by the shareholders. Then we will consider that as what? A liability. If you consider that as a liability, then you need to show where? Other current liabilities. Other current liability. But see the question. When dividend declared after 31st March, simply ignore it. No need to make any kind of disclosure. If required, we will disclose in notes to accounts that board of directors has declared or proposed this much dividend. Next, 4th point, you see, suspense account they are talking. 4,000 represents, sir, suspense account 4,000 is there, no sir? That 4,000 represents what? Cash received for sale of some of the machinery on 1/4/2011. See, they sold some of the machinery, sir. So that 4,000 is what? Sale value. And the cost of the machinery is how much? 10,000. Accumulated depreciation thereon being 8,000. That means, see, 10,000 cost, accumulated depreciation 8,000. That means what is the WDV? 2,000. Sold for 4,000. So profit on sale 2,000. That profit on sale will come in P&L account. P&L account. Other income, profit on sale of machinery, we will show. And also see here, some part of the plant and machinery is sold. Whenever we are selling any part of the plant and machinery, the corresponding accumulated depreciation will also be cancelled. How much is the accumulated depreciation on the part of the plant and machinery sold? 8,000. So this 172, from this 172 we need to reduce this 8 also. Because this 172 is what? Accumulated depreciation. In this depreciation, even depreciation included on this 10,000 cost of the machinery which is sold is also there. See, whenever a machinery is sold, na sir, the corresponding accumulated depreciation will also be cancelled. Sir, generally tell me, when you sell the asset, asset is de-recognized from the books. Now relating to the asset, that asset there is a accumulated depreciation. That account will also be closed. Okay. Now 5th point. Depreciation is to be provided on plant and machinery. How much? 10% on cost. What is the cost of plant and machinery? 770. But in this 770, at the beginning, how much we sold? 10,000. That means 10. Look at the 4th point. The cost of the machinery we sold, how much? 10,000. When we sold? At the beginning of the year, 1/4/2011. That means 770 minus 10. 760 is the cost of the machinery. On 760, 10%. How much? 76. This is current year depreciation, which will go to P&L account. In P&L account, we will show depreciation. And the 76 will be added to the accumulated depreciation, provision for depreciation. So therefore, provision for depreciation closing balance is 172 plus 76 minus 8. 172 originally given, sir, plus current year depreciation 76 minus depreciation of the plant and machinery sold 8. 172 plus 76 minus 8. What is the closing? 240. 240. That is the closing provision for depreciation. That will be deducted from the plant and machinery cost. Original cost 770 minus sold 10. So it is 760. From 760, this provision for depreciation of the, at the end we need to deduct. Then we will get the WDV to be shown in the balance sheet of the company. Sir, this is an important point, sir, in the question. I will write entries also. Now see what they are asking here. You are required to prepare Omega Limited balance sheet as on 31st March 2012 and also statement of P&L with notes to accounts for the year ending 31st March 2012 as per schedule 3. Ignore previous year figures and taxation. Sir, this is the information they have given. How you are going to approach to solve this question in examination? How you are going to approach this question in examination is simple. First, in the question paper, when you are reading the question, first take the pencil. With that pencil, you try to identify the items. You write it. Which item will come where? Like this. I have written. You write it. Then read the additional information. In your mind frame, what items will come? Then first you need to write down the format. Once format is completed, try to prepare the notes to accounts for each item required. See, we'll solve this question, sir. I will show you how you are going to approach it. You need to practice this. In order to get that completeness, you need to solve along with me. Those students who are watching recorded classes, you also need to solve along with me. Only you should have question. Don't see the answer. Only with the question you need to solve. Come on. Let us solve question. What is the number illustration? 2, sir. Omega Limited balance sheet as on 31st March 2012. Particulars, note number, amount. Here amount rupees in thousands, right? Rupees in thousands. First, recollect the format. The first part of the balance sheet is what? Equity and liabilities. Equity and liabilities. In equity and liabilities, first one, shareholders funds. See, here I am writing shortcuts, but in examination, please don't use shortcuts. Shareholders funds. In shareholders funds, what is the first one? Share capital. See, this is where you need to recollect the format again and again. This is where it will be remembered for a long period of time. You need to remember shareholders funds. In that, the first one is what? Share capital. Second, reserves and surplus. Note number 2. Generally, for share capital, reserves and surplus, note will be prepared. Next, tell me what is the third item? Money received against share warrant. There are? Not there. Next, what is the second head? Share application money pending allotment. Not there. Next, non-current liabilities. In non-current liabilities, first one, long-term borrowings. There are? Long-term borrowings. There are? You need to see the question. See, I will tell you trick. Liabilities. Whenever you want to see the liabilities, see the credit side items. Correct? Because the liabilities and incomes will have credit balances. So, here you need to write like this, non-current liabilities. In non-current liabilities, long-term borrowings. Long-term borrowings, I think debentures is there. So, for that put note number 3. Next, sir, in non-current liabilities, deferred tax liabilities, not there. Next, other long-term liabilities, not there. Next, long-term provisions, there are? No. I think in non-current liabilities, only one item is there, long-term borrowings. Next, sir, current liabilities. Current liabilities, what is the first one? Short-term borrowings, there are? No. Next, trade payables, there are? Yes. Trade payables, mostly it will be there. Can you tell me how much is the trade payables? 52. So I am taking directly because relating to this there is no breakup, nothing to additional information to be presented. So I am writing 52 directly. Next, other current liabilities there in the question. Other current liability. Sir, in examination you need to check like this each and every item. Other current liabilities is there. That's why when you are reading the question itself you need to identify. OCL is there? No, na, yes, sir. No, OCL nowhere it is there. So OCL not there. Next, short-term provisions is there? No, mostly it is provision for tax, not there. That's it. Make a total. So one side is over. Now come to the second side, that is assets. In assets, what is the first one? Non-current assets. Non-current assets, first one PP. There PP there, land is there, plant and machinery is there. Intangible assets, not there. Non-current investments, not there. Deferred tax assets, not there. Long-term loans and advances, not there. Other non-current assets, not there. Only one item PP is there. For this, prepare note number 4. Now next come to current assets. Can you recollect current assets? What is the first one? Current investments, not there. Next, inventories. There are? Yes. Current assets inventories is there. Inventories. How much is there in inventories? Look at the asset side. Debit balances, inventories, closing stock, 86. So take 86 here. Next, trade receivables. There. How much? 96. Trade receivables, you need to see breakup required or not required. Not required. Sometimes in the question he will give you trade receivables outstanding for a period exceeding 6 months. Then you need to prepare note, and in that you need to write separately. Because schedule 3 says debtors aging more than debtors outstanding more than 6 months should be presented separately. That's why. Here directly given, no additional information is there. So 96. Next, cash and cash equivalents. There are? Yes, cash and cash equivalents. I think bank balance is there. How much? How much, sir? 20. If you want, you can give a breakup, sir, or else directly you can write. Generally, if you have cash or bank separately, prepare a note. Sir, when I need to prepare note, that's your choice, sir. Generally, if there is any additional information we need to present, if there is any breakup of items, then we generally prepare note. There is no hard and fast rule, only for this we need to prepare note like that. If amount is directly written, there is no breakup, no additional information, directly we can write. Okay, cash and cash equivalents is also done. Like last one, short-term loans and advances. There are? No. Other current assets? No. Sir, in the name of format, I am recollecting the entire format I recollected. If you recollect like this, then only you will remember. Okay, total. That's it, pa. Some students, some faculties, what they are doing now, they are writing entire format. It is absolutely waste of time. Don't do that. Even if you write all the items, they won't allot any marks. For example, money received against share warrant, not there. Why we need to write? For example, non-current liabilities, long-term borrowings is there. Deferred tax liability there. Don't write. If you are writing entire format, means unnecessarily you are wasting time and you won't get any extra mark. Only the items which will come as for the information you write down first. Hello? Once balance sheet is completed, next P&L account. Sir, first I need to present balance sheet or P&L? No, first always balance sheet, then P&L. P&L will follows balance sheet. That's why note number also you see up to what note we presented in balance sheet 4. 5th onwards will start in P&L account. And one more thing, sir. When it comes to presentation, first balance sheet, then P&L. When it comes to completing, first we need to close P&L, because only when you know the current year profit you can finish the reserves and surplus. So next time preparing P&L account, sir. So Omega Limited P&L account for the year ended 31st March 2012. Recollect the P&L account format, everybody. Particulars, note number, amount rupees. In P&L, what is the first one, sir? Revenue from operations. So revenue from operations. Revenue from operations means what? Sales. Sale of goods, sale of services, all those items will come. Look at the question. If you want incomes, you need to see the credit side. We have sales. 700 is there, sales. Correct? Sales, revenue from operations, 700 is there, na? Apart from that, any other item is there? No. So revenue from operations, sales we have taken 700. Now what is the next one? Other income, right? Other income, what items we have? Profit on sale of machinery. Hello? Profit on sale of machinery is there now. See, we sold for 4,000. The WDV of the asset is 2,000. So profit is 2,000. So other income profit on sale of asset, note number 5 I will present. Two, nothing but. In that note I will mention profit on sale of asset, machinery, nothing but. Any other income? No. Total revenue. How much is the total revenue? 702. Next, fourth is expenses, right? Expenses, first one, cost of material consumed, not there. Next, purchases, there. Yes, purchases is there. Look at purchases. Tell me how much? 320. Take it. Next, change in inventories of finished goods, work in progress, like that, anything given? No. Closing stock, opening stock, nothing given. Next, employee benefit expenses, not there. Next, finance cost. Yes, debenture interest is there, na? Finance cost. Note number 6, debenture interest, how much? 20. Next, sir, depreciation is there. Current year depreciation, very, very important. Sir, how much is the current year depreciation, sir? See this fifth point you read, 10% on cost we need to provide depreciation. Most of the students here cost means they are taking 770. But you need to understand, in the beginning itself we sold machinery cost of 10,000. Therefore first from that 770 this 10 will be reduced. So the cost is only 760 remaining on that 10% depreciation. So 76 is the current year depreciation. 76 is the current year depreciation. Next, sir, other expenses. Other expenses. Other expenses, note number 7. What items are there in other expenses? Factory expenses, admin expenses, selling expenses. Add these three, 60, 30, 30. 120. 120. So, next to total. What is the total expenses? Total expenses. 536. Now, find out profit for the period. Here tax is also not there. Profit for the period is total revenue minus total expenses. So total revenue 702. So 702 minus 536, sir. How much, sir? 166. This is the profit for the period. Sir, this profit where it will go? It will go to balance sheet. Balance sheet. In balance sheet we will show reserves and surplus, na? This is 176 is the current year profit. In the question, any opening P&L balance given, na? Yes, P&L account, how much balance given? 72. You look at this, 72 already there. That is opening carry forward balance. So 72 plus current year profit 166. Minus from current year profits whatever the appropriations will do. Like interim dividend given, any appropriation to general reserve, all these things will adjust. Then we will get the closing balance. Okay. Understand how things will done. So therefore see. Now I need to prepare how many notes? 7 notes to accounts I need to prepare. So start notes to accounts here. Notes to accounts. Below the balance sheet and P&L, start notes to accounts. In notes to accounts, what is the first one? Share capital. How we need to present share capital? Important, sir. First always authorized share capital. Before that, sir, first always whether your share capital equity or preference, you write down first. Here equity share capital. There is no preference share capital in the question. So first equity share capital, right? Write down. Next in that authorized you write down. Authorized share capital. How much is the authorized share capital, sir? Look at the additional information, first point. 40,000 shares of 10 each. You need to write down 40,000 equity shares of rupees 10 each. 10 each. How much, sir? 4 lakhs. 4 lakhs. In 1000 it is 400. Hello? Rupees in thousands, na? 400. This is only for presentation purpose. Don't consider it for total purpose. Now, once authorized capital is presented, next issued, subscribed, and paid up share capital. Suppose if there is a difference between called up and paid up, then you write issued, subscribed, called up first. From that you reduce calls in arrears if it is there. Then you will get paid up. But here in this question there is no difference between called up and paid up. No calls in arrears is there. So directly I have written issued, subscribed, and paid up share capital. Now you look at the question. In the trial balance, we have equity shares 300 is there. That means 3 lakhs divided by 10. That means 30,000 equity shares of 10 each. Fully paid. Correct? So 30,000 equity shares of rupees 10 each, fully paid up. Fully paid up. How much, sir? 300. 300. Everybody? So total we need to consider 300. Don't add 400 plus 300. Some students I know they are adding. The moment they see two figures they will add. Here authorized capital is only for presentation purpose. We should not consider it. For balance sheet we will consider only paid up share capital. So our paid up share capital is how much here? 300. Consider this 300 in balance sheet. You write down here. Say this. 300 update in balance sheet. Next, see, this is how you need to present the things here. Now you compare your previous presentation, how you are doing. Now, this is how we should do according to schedule 3. Look at the difference between your previous learning and this. Most of the students, they are not following schedule 3. So they are writing SC, ASC, ISP. What is the shortcuts? They don't write 30,000 equity shares of 10 each fully paid. They will directly attack. Marks will also come directly. Attack. They will attack you. They will not increase. Second one is very, very important. What is it? Reserves and surplus. Reserves and surplus, sir. In the question, check what are the reserves and surplus we had, sir. Credit side, credit balance you see. We have general reserve, we have P&L, we have securities premium. Correct? First general reserve you take. General reserve. How much is balance is there in general reserve? 130. Any change during there relating to general reserve? Nothing. Sometimes what happens, there is a transfer from current year profits. Then we need to add. So here there is no change. So 130. Next you take securities premium. Securities premium, how much is there? 40. Any change? No change. Next, land was revalued. Land was revalued. We got revaluation profit, right? So that is transferred to revaluation reserve. So land was revalued. Land was revalued to 360. Correct? What is the land original cost? 220. So 360 minus 220. How much? 140. Consider it also in reserves and surplus. Next, P&L account, sir. The most important is what, sir? P&L account balance. P&L balance. Now see, P&L account balance already opening how much given, sir? Opening balance 72. Already there, opening 72 is there, correct? 72. For that we need to add profit for the period. What is the profit for the period? Profit for the period 160. This you need to take from P&L account. In P&L account 166. See this 166. Total 72 plus 166. 238. Less Interim dividend paid, appropriations, nothing but, correct? They are called appropriations. Appropriations, interim dividend. Sir, please understand, sir, learn it. Dividend, either final dividend, interim dividend. Suppose if company gives any bonus, okay, any provision for tax, these are all appropriations from profits. They are not expenses. They will not be debited to P&L. Once you got the profit, from that profit, these things will be deducted, appropriated. That's why they are called appropriations, allocations. How much is the interim dividend, sir? 18. So 238 minus 18. 220. Now add everything. You will get total reserves and surplus. 130 plus 40, 170, 170 plus 140 plus 220. How much, sir? 530. So write this in balance sheet, 530. Sir, this is very, very important, sir. Mark it as important. I know where students are doing mistake. This is where reserves and surplus, especially P&L account balance, how we got it. Next, once P&L is over, reserves and surplus is over. What is the third note? Long-term borrowings. LTBs, long-term borrowings, we have debentures. 10% debentures is there. Look at the question. How much is there? 10% debentures? 200. That's it. Take it. I think this is the only item. Hello? There is no other item. Debentures. Interest? Not required. Not required. Interest. Because interest already recognized na, in the book sheet is there. Finance cost, like that. Nothing is outstanding. If it is outstanding, it will be shown on credit side. Na? Credit balance it is there. Interest accrued but not paid. But it is not there. Only debit balance we had, finance cost. That means it is expenses. Expenses incurred and paid. That's why nothing, no interest is there on the credit side. See, if it is outstanding, it will be there on the credit side, credit balances. But credit balances, we don't have any interest. That means what? Interest incurred and paid during the year. Paid means it will not come in balance sheet. Sir, when an item will come in balance sheet, either it should be an asset or it should be liability. If you pay already, it is not a liability. Then it will not come. But in P&L account, expenses, incomes will come. Expenses, incomes will come. Okay. How much, sir? Debentures? 200. I think we have completed equity and liability side, sir. Total, can you tell me? 300 plus 530 plus 252. 1082. So one side is done. 1082. Now come to asset side, sir. PPE. PPE, I think there are two assets. One is land. Land original cost, how much given? 220. Correct? And add revaluation profit. We have done the revaluation. So revaluation profit. What is revaluation profit, sir? 140. So what is the closing balance of land? 360. This you need to present like this. Next, plant and machinery. Important. What is the cost of plant and machinery, sir? 770. Now important, see this. From this 770, first we disposed 10,000. That means 10 in thousands. Hello? We sold. That means how much remaining? 760. This is the cost of plant and machinery. From this I need to reduce what? No. Accumulated depreciation. Total depreciation till now. Accumulated depreciation. Total is how much given? Accumulated depreciation in the trial balance, how much? 172. Accumulated depreciation or provision for depreciation, both are same only. 172 is the depreciation. For this we need to add current year depreciation 76 minus accumulated depreciation in respect of the machinery sold 8008. So 172 plus 76 minus 8. So what is the total provision for depreciation at the end? 240 minus it. So 760 minus 240. 760 minus 240. How much, sir? 5. That's it. 520. So therefore, what is the total PPE value? 880. 880. Sir, here students should not get confusion. Here they are maintaining asset at cost. That's why provision for depreciation, there is a separate account called provision for depreciation is there. Here see how entries will be recorded. First they sold the asset now. Whenever there is a sale, what is the entry, sir, here? Simple. Bank account debit. What is the sale value? 4,000. Correct? Sale value 4,000. What is the worth of plant and machinery they sold? 10,000. Cost of plant and machinery sold. Because we are maintaining asset at cost. Depreciation we are writing to separate account called provision for depreciation account. When you sell the asset, the corresponding depreciation will also be cancelled. Generally, provision for depreciation will have a credit balance, right? Now it will be debited. How much? 8,000. So therefore, what is the balance? That will go to P&L account. What is this? Profit. Balancing figure. This profit where we will show? P&L account. That's why in P&L account other income we showed 2,000. Hello? So therefore you need to understand. And see, whenever we are maintaining separate account for depreciation, what is the entry for, generally what is the entry for depreciation? Depreciation to asset. But here we don't credit directly to asset. We will credit to provision for depreciation. Where we are maintaining a separate account. So therefore here for current year depreciation, the entry is depreciation account debit to provision for depreciation account or accumulated depreciation account. How much is the current year depreciation? 76. That means if you in the trial balance total 172 is their provision for depreciation. And when we sold a plant and machinery, in respect of that 8,000 was cancelled. So that's why minus 8. Plus current year depreciation was transferred. That's why you add 76. So therefore total we got 240. This is the closing provision for depreciation. Again and again I won't teach. These are basics. Asset is maintained in two ways. One is asset will be represented at cost. Depreciation is transferred to a separate account called provision for depreciation account. Or else another way is depreciation is directly adjusted from the cost of the asset. In this question, if you observe, trial balance debit side, plant and machinery at cost given. Provision for depreciation separately given on the credit side. That means depreciation they will not deduct directly from the asset. They will transfer to a separate account called provision for depreciation account. Entry is also explained, but presentation in the balance sheet it will be like this. 770 is the cost, 10 cost we sold, 760 we got, accumulated depreciation 240, so it is 520. Hello? Sir, this will help you in cash flow statement chapter also. In cash flow statement, they will ask you to find out cash flows from cash flow statement you need to prepare. In order to prepare cash flow statement, assets related adjustments, cash inflows and outflows will come in investing activity. There sometimes you need to prepare the asset account separately. For that, these things will help you. Are you understanding? That means here, sir, in this case, what happens is plant and machinery will be maintained. This is the ledger account of plant and machinery. This ledger account will be at cost only. And we will open a separate account for depreciation. That is provision for depreciation account we will open separately. Provision for depreciation we will open separately. That means plant and machinery original cost how much? 770. Correct? In this 770 how much we sold? 10. So how much balance is there? 760. That means asset is maintained at cost only. But provision for depreciation, already how much is there in provision for depreciation? 172. How much we will add in the current year depreciation? 76 credited to provision. How much cancelled? 8. So therefore what is the balance? 240. This is the closing balance of depreciation. This 240 is nothing but the total depreciation till now. Cost of the asset total 760. That's why 760 at cost minus total depreciation till now on the 760 is 240. So therefore we need to show in the balance sheet how much? 520. The presentation is like this. Presentation is like this. Asset is maintained at cost, provision for depreciation is maintained separately. In cash flow statement chapter, sir, sometimes we don't know current year depreciation. How to find out current year depreciation? This 76 is current year depreciation. Na? So therefore, by preparing provision for depreciation account, this 76 can be ascertained as what? Balancing figure. Because in cash flow statement, there is indirect method. In indirect method, all non-cash items we should add. One depreciation is one of the non-cash item. But they won't give in the question. Then by using this provision for depreciation account, you need to find out it. If you know the subject, you can play with it. But if you don't know the subject, that will be a dangerous thing. Why I am going in, actually this question is already over, I solved it, but I am going in depth because I know next chapter cash flow statement is there. So this knowledge will help there. That's why I am spending this much time. Don't make a wrong impression about me, because I know next what is coming, what is going to come. So therefore, in this question, what is the unique thing you learn? Tell me. What are the ways an asset can be maintained? Two ways. What are the two ways? Asset maintained at cost, depreciation, separate account. In the balance sheet, cost minus accumulated depreciation. There is another way. What is that? Depreciation directly deducted from asset. WDV method. There, depreciation to asset we will write. Here, whenever depreciation is there, depreciation to provision for depreciation we will write. That means asset will be presented at cost only. There in WDV method, asset will be presented at WDV value. Okay. Entries also I have written. Hope you understand this. Yeah. So what is the total? 880. Yeah? So I will update this here 880. 880. Tell me now. Total 1082. Tell it. That's it. 1082. This is the question, sir. This is illustration number 2, sir. 2. Illustration number 2. In our question bank, sir, there is one question number 5 in previous exam questions. This question came in September 2024, sir. September 2024 attempt, one question is there. This question is same as illustration number 2. You see, illustration number 2 just now we solved, right? See this question. Same, land given at cost, plant and machinery also at cost, provision for depreciation given, suspense account given, but interim dividend not there. In that question, interim dividend is there. Here not given. See the debit side. Adjusted purchase also given. Additional information, bonus shares given, 1 extra point. Next, authorized capital there. Land was revalued, this point is there. Dividend declared on 5th April and transferred a profit of 10% to general reserve. This is 1 extra point they have given. Suspense account point given, same. And then depreciation is to be provided 10% on cost, same. Provision for income tax is there, 30%. So they are asking P&L account as well as balance sheet. So understand the examination question, sir. Whatever the question is there in the study material, for that some extra points they have added. Here what are the extra points they have added, sir? Bonus point is 1, and then transfer to general reserve 1 point, provision for tax. These are the 3 points they have added. Except that everything is same only. Illustration 2 is all same question they have asked. Only 3 extra points they have given. Okay, like that. See, my intention is to show you that in examination also the same type of questions with extra 2 or 3 points they are adding. Of course, we come back to this question later. But in this illustration, sir, one point I would like to tell you is dividend point. What is the question we have solved, sir? Illustration 2, right? In that illustration number 2, you know, there is a note point relating to dividend. Yeah, see this illustration, they have given a note point here. Finally, the final dividend will not be recognized as a liability in the balance sheet. even if it is declared after reporting date but before approval of the financial statement as per accounting standard. Hence, it has not been recognized in the financial statement for the year ending 31st March 2012. Such dividend will be disclosed in notes to accounts only. See, the final dividend will not be recognized as liability at the balance sheet date. If it is, because it is declared after reporting date but before approval of the financial statements by the board of directors. That means they are talking about events occurring after balance sheet date as per AS4. So any dividend declared after 31st March shall not be considered as a liability on balance sheet date. Remember that. Because basically it is not a liability on 31st March. That's why. Okay. So relating to illustration number 2, I think notes to accounts we have prepared up to 4, right? For 5, 6, 7 also you need to prepare notes to accounts, sir. What is the 5th note account, sir? So 5th other income, right? Yeah, other income. What is there in other income? Profit on sale of machinery. How much we got? 2002. How we got it? Sale value 4000, WDV 2000. So this is 1, sir. And also what is the 6th note, sir? Finance cost. Hello? Finance cost we have what? Debenture interest. How much is there in debenture interest? 20. Take it. And also what is the 7th one? Other expenses. Very simple. What items are there in other expenses? Admin expenses, factory expenses, selling expenses. Correct? Tell me, admin expenses how much? 30? 30, huh? 30. Factory, selling, total 120. That's it. Very simple. Nothing great. So that's it, sir. This is illustration number 2. So illustration number 4, sir, next. Very good question. Important question, examination point of view. Please see this question carefully. You are required to prepare statement of P&L and balance sheet from the following trial balance extracted from the books of International Hotels Limited. Underline the company name because sometimes the nature of the business will also impact. So this is hotel, sir, hotel. As on 31st March 2012. Okay. The trial balance given debit, credit. Debit balances, trial balance indicates what? Either assets or expenses. Credit balance indicates what? Liabilities, incomes. Always remember that. Now see one by one. First, authorized capital they given, sir. Divided into 5,000 6% preference shares of 100 each, 10,000 equity shares of 100 each. So in this question, preference shares is also there. Next, subscribed capital is there. Authorized, subscribed by public. 5,000 6% preference shares of 100 each. 5 lakhs is there. Equity capital 8 lakh 5,000 is there. Subscribed. Okay. Next. Purchases is there, sir. Purchases is there. Wines, cigarettes, cigars. And then foodstuff. You know, think from hotel point of view, sir. Hotel point of view, hotel will sell what? Food. To prepare food, they want food ingredients. That is called food stuff. So food stuff is what? Raw material for them. In order to make the food, food stuff, ingredients required, na? Rice, dal, cashews, all these things. Those are called food stuff. They purchase raw material. And also tell me, wines, cigarettes, cigars means it is stock in trade for them because they are not manufacturing but they are buying and selling it in the hotel. Suppose I went to a hotel, I ordered wine. Hotel is making wine, no, they are purchasing the manufactured wine. So hotel point of view, these wines, cigarettes, cigars is what? Stock in trade. I told you na, stock in trade means what? Purchasing and selling. Whatever the items I will purchase for the purpose of sale is called stock in trade. Therefore, in this case, hotel is both a manufacturer as well as trader. Because they are manufacturing what? Food. For manufacturing of food, what they require? Food stuff, raw material. But see, like any other manufacturer, hotel does not have finished goods, semi-finished goods. So therefore, closing stock in the form of finished goods to semi-finished goods will not be there in the hotel. Biryanis on 31st March. Polkas on 31st March. Rotis on 31st March will be there? No. Understand? Hello? So therefore, for a hotel, food stuff means the ingredients is raw material, like a. And wines, cigarettes, cigars is a stock in trade. They are buying and selling it to the customers. Now tell me now, relating to raw material, what we need to present in P&L? I already told you. Consumption. Consumption. How to find out consumption? Opening plus purchases minus closing. So during the year, find out, take the calculator and tell me, foodstuff, what is the opening balance given? 5260. Take calculator, 5260. Plus purchases you add 36,200 minus closing foodstuff 16,400, last 16,400. Tell me how much is the consumption of foodstuffs? 20, 25, 060. Where it will come? P&L account expenses. First item, cost of materials consumed, foodstuff consumed, 2560 we need to show. Because in respect of raw material, we need to show consumption in P&L account. Hello? And foodstuffs closing balance, closing stock value will come in balance sheet, current assets, inventories. Closing stock value will come in balance sheet, current assets. During the year, how much you consumed will come in P&L account. How to find out consumption? Opening, purchases minus closing. Relating to stock in trade, what we need to present? Tell me in P&L. I told you. Purchases we need to show. Change we need to show. Two things. Purchase of stock in trade we need to show. Change in inventories of work in progress we need to show. You recollect, you go to schedule 3 and check. Already explained. Hello. Now tell me what is the purchase of stock in trade? 45,800. This will come in P&L account. And what is the change in stock in trade? Change in stock in trade means the difference between opening and closing. Opening wines, cigarettes, cigars 12,800. Closing wines, cigarettes, cigars 22,500. How much is the difference? Minus, this will come in P&L account. Minus 9,700. Look at the interlinking. What we discussed in schedule 3, the same thing we applied. That means this problem is done. Majority of the students struggling here only. Look at how easily we cracked it, because we have discussed it schedule 3 elaborately. And we know this is the nature of the business, hotels. So for a hotel, foodstuff is raw material. Wines, cigarettes, cigars is stock in trade. Relating to raw material, we need to show consumption in P&L. Closing stock will show in balance sheet. Relating to wines, cigarettes, cigars, in P&L we will show purchases separately, change separately. Closing value of stock in trade we will show as usual in balance sheet, current assets, inventories. Okay. Next to wages and salaries. Employee benefits in P&L account. Hello? Rent, rates, taxes, other expenses, laundry, other expenses, sales, revenue from operations, sale of wine, cigarettes, cigars, or food, both will come in revenue from operations. Coal and firewood, other expenses, sir. Carriage and coolage, other expenses. Sundry expenses, other expenses. Advertising, other expenses. Repairs, other expenses. Rent of rooms, incomes, rent of rooms. Rent of rooms means not other income, it is revenue from operations. For a hotel, what is the main revenue? Sale of food, at the same time sale of services. Sale of services means giving rent, Hotel rooms will be given on rent. That is the main revenue for them. So this is revenue from operations. Revenue from operations. Rent received. Next, billiard. Billiard game, sir. Billiards, you know, in table there are balls. 8 ball, 12 ball pool. Like that game. Tell me, rent, billiards, some income is coming. 5,700. Income. Where will you show? Other income or revenue from operations? It is revenue from operations. It is also main revenue here. Why it is other income? Is it not part of services? It is part of services in a hotel industry. Generally people, big hotels, if you enter a 5-star hotel, they will have a drink. In meanwhile, they will play. Not some small restaurants. Small restaurants only eating, no playing. But in big restaurants and all, 5-star hotel means there should be some facilities like this. Some standards should be there. Billiards game, it is very natural. It will be there. They will play. Next, miscellaneous receipts. I think it is other income. Revenue for other incomes will show. Dividend, discount received, other income. Transfer fees, other income. What is transfer fees? For example, any facilities arranged to the transport customers for transporting them to airports, pickups, all these things, that is transfer fees. Any fees collected for that, it's a other income for the hotel. Customer services, sir, negligible. Next, freehold land and property, freehold land and building, PPE, furniture and fittings, inventory on hand, opening, wine, cigarette, cigars, foodstuff, okay, we'll adjust it. Cash in hand, cash with bank, cash and cash equivalents, current assets, cash and cash equivalents, correct? Preliminary and formation expenses, other expenses, we will write off this to other expenses. Debentures, long-term borrowings, P&L account, reserves and surplus, trade payables in current liabilities, trade receivables, investments, sir, where will you show investments? Current investments or non-current investments? You can take a choice, because in the question nowhere they have mentioned about where they will take these investments. They have not mentioned whether they are current or non-current. So therefore, I assume non-current. If you want, you can assume current also. Non-current investments. Goodwill, intangible asset, general reserve, reserves and surplus. Trial balance is over. Below the trial balance, some additional information is there. Wages and salaries outstanding. Sir, outstanding wages and salaries, what we do? Add it to the corresponding expenses and show this as a liability, other current liability. What is outstanding salaries? Outstanding expenses means expenses incurred but not paid. But not paid means it's a liability. And expenses incurred means it should be part of current year salaries and wages. So therefore this 1,280 will be added to the corresponding expenses, and this unpaid amount will be shown in the balance sheet as a part of other current liability. Inventory closing stock given, we will adjust this. So this is the entire trial balance. Depreciation also given, sir. Furniture and fixtures 5%, land and buildings 2%. Now you see, this is the trial balance given when, sir? On which date this trial balance is available? 31st March 2012, correct? 31st March 2012, this is the trial balance. Now look at this. The equity capital on 1st April 2011, that means at the beginning of the year, the equity capital stood at how much? 7,20,000. That is 6,000 shares fully paid, 2,000 shares 60 paid. The directors made a call of 40 per share on 1st October 2011. A shareholder could not pay the call on 100 shares, and his shares were then forfeited and reissued at 90 per share as fully paid. Sir, very, very important, sir. You know, in the beginning of the year, what is the total capital? 7,20,000. This is illustration 4. Sir, 7,20,000 is the capital. 6,000 shares fully paid. Correct? 6,000 shares fully paid. 2,000 shares 60 paid. Correct? remaining 40 rupees called. But a shareholder holding 100 shares could not pay the call on 100 shares. Now you see, 100 shares, they have not paid the call amount. So company, what they have done, they have cancelled their shares, forfeited. These forfeited shares are again reissued. If you don't pay the call amount, your shares will be forfeited. Forfeited means your name will be removed. 100 shares. Now these forfeited shares now will become the property of the company, shares of the company. Company can reissue them. Company reissued it. At what price they reissued? 90 rupees. So 100 into 90. How much company collected? 9,000. Now, important sir. You might have learned in CA Foundation. See this, in respect of these 100 shares, how much originally paid by the shareholder? 60 rupees already paid, right? How much it is? 6,000. So 6,000 already paid. Now 9,000 came. Total 15,000 collected on 100 shares. So 100 into 100, it will be total 10,000 only share capital should be created, face value. But you collected how much? Therefore, whatever the 5,000 is there, this is what? Profit on reissue of forfeited shares. Profit on reissue of forfeited shares. This profit should go to capital reserve account. Any profit on reissue of forfeited shares will be transferred to capital reserve. But in this question, what they have done, this 5,000 also they included as a part of share capital. You look at the trial balance, tell me equity share capital, how much they have given? 8 lakhs 5,000 given. That means that 5,000 is this profit on reissue of forfeited shares. So that is a mistake they have done. Our actual paid up share capital should be only how much? 8 lakhs. Why? Because 6,000 shares fully paid, 2,000 shares if they are fully paid, only 2 lakhs. So 8,000 into 100, it should be 8 lakhs. Total share capital should be created with 8 lakhs paid up share capital. But how much given? 8 lakh 5,000 given. That means this 5,000 excess, what we collected by reissue of forfeited shares, we have included as a part of share capital, but we should not include it. It should be transferred to capital reserve. That is a mistake they have done. We need to rectify it. This 5,000 we will show in reserves and surplus. We will reduce from the share capital. Sir, this is the CA foundation concept, sir. Whenever shares are forfeited, in respect of the forfeited shares, how much already collected? 60. Plus reissued at what price? 90. 60 plus 90, 150 is the amount we collected. But what is the face value? 100. So excess collected above face value 50. That 50 will be transferred to capital reserve. Because it's a capital profit. This profit you earned on shares. It is not a revenue profit. So therefore this 50, 50, 5 rupees. 5,000. And each share how much we collected? 50 rupees only, na? 50 into 100 shares. 5,000. Excess amount we collected on each share is 50 rupees. Like that for 100 shares. That will be transferred to capital reserve. That is one important adjustment. You understand this? Next, the directors declared a dividend at 8% on equity shares. When, sir? 2nd April, after 31st March. So it should not be considered as liability. Any dividend declared after 31st March is not a liability. Transferring any amount that may be required from general reserve. Ignore taxation. So this is the question, sir. Now you tell me, sir, in this question what items will come? Come on. First we will start balance sheet. Equity and liabilities. First, shareholders funds. Share capital. 1. Note 1. Next, reserves and surplus. Note 2. Money received against share warrant. Not there. Share application money pending allotment. Not there. Next, non-current liabilities. Long-term borrowings is there. Debentures is there. Yes. Next, any deferred tax liabilities? No. Next, other long-term liabilities? No. Long-term provisions? No. Next, current liabilities. Short-term borrowings? No. Trade payables? Yes. Next, other current liabilities? What is there in other current liability? Outstanding wages and salaries is there. Very good. OCL is there. Next, short-term provisions? No. Provision for taxation not there. Not there. That's it. Now asset side, non-current assets. First PP is there. Yes. Intangible assets, yes. Next, any non-current investments, yes, investments are assumed as non-current. Next, deferred tax assets, not there. Next, short long-term loans and advances, not there. Next, other non-current assets, not there. Now come to current assets. First one, current investments, not there. Next, inventories, there. Next, trade receivables, there. Next, cash and cash equivalents, there. Short-term loans and advances, not there. Next, other current assets, not there. Next, P&L account, revenue from operations, yeah, there. Other income, there, total. Then expenses, first, cost of material consumed, there. What is foodstuff? Foodstuff. Next, change in purchase of stock in trade is there. Wines, cigarettes, cigars purchases. Next, change in inventories of stock in trade. Wines, cigarettes, cigars. Correct? Next, employee benefits, yes. Finance cost, yes. Debenture interest, hello. Next, depreciation is there. We need to provide depreciation. 5% on land and building, 2%. Next, other expenses. Other expenses is also there. Change in food stuff. Change in food. Where? What is that here? What they given? That is sale of food, pa. That will come in revenue from operations. Hotel will sell food item. You went to hotel, you eat biryani. Biryani is what food only, na. Sale of food is revenue from operations to hotel. That already covered. That's it. That's it. These are the items will come. Hello. So say this. Important question, sir. This is illustration 4. So what is the name of the company? Yes, International Hotels Limited. International Hotels Limited. Please practice this. Those who are watching recorded classes, also you please practice them immediately. Start writing. No need to write everything, just scribble it, because in examination you should complete the sum. Only when you practice you will be able to solve. So balance sheet as on 31st March 2022. Hello? 2012. Hello? 2022 2022. 2012. First particulars, then note number, then amount. Rupees normal or rupees in lakhs, like that given? Normal, no, crores. Normal. You do crores, no problem. You welcome. You can do crores, but we will do normal figures only, because our brain is only small brain. So first, equity and liabilities. First, always focus on writing the format. In that, first, shareholders funds. Shareholders funds, first one, share capital, note 1. Reserves and surplus, note number 2. Next, money received against share warrants, not there. Share application money pending allotment, not there. Recollect the format like this. Next to non-current liabilities. In non-current liabilities, long-term borrowings, there are, yes, 3. Give 3. Next, any deferred tax liabilities, not there. Other long-term liabilities, not there. Long-term provisions also, not there. I think non-current liabilities over. Next, current liabilities. In current liabilities, short-term borrowings there are? No. Next, trade payables, yes. Tell me trade payables closing balance, directly we can write. 42,000 trade payables we can write directly. It is there. Trade payables is there, directly there in the question. Trade payables, if you want, you can check it also. Yeah, trade payables 42. I am taking directly, because there is nothing, no additional information is required for this. Next, other current liabilities there. What is there in other current liability? Outstanding salaries and wages is there. For this, give note number 4. Next, short term provisions not there. Total. So equity and liability side total done na. Next, second part, assets. In asset side, first one, non-current assets. In non-current assets, the first one, PP and intangible assets. In that, the first one is PP. For this, give note number 5, PP. What is the second one? Intangible asset is there. Intangible asset, we have what? Goodwill. Correct? If you want, you can give a breakup, or else you can directly write. I am writing goodwill separately, directly here. Or else, if you want to give, you can give a note also. Nothing wrong. How much goodwill? 5 lakhs. So take 5 lakhs here. Any capital work in progress? Nothing. Any intangible assets under development? Nothing. Next, sir, non-current investments is there, na? Investments. Investments are assumed as non-current. How much? Investments 272, 300. There, 272, 300 investments. Take it. Next, any deferred tax assets? Nothing. Long-term loans and advances? Nothing. Any other non-current assets? Nothing. Okay. Next, current assets. In current assets, what is the first one? Current investments, not there. Inventories, there are? Yes, inventories is there. Inventories closing, I think we have 2 types of inventory. Foodstuff, wines, cigarettes, cigars. Non-current? Non-current investments you want to write note, Why? What will you write if you write a note for that? Investments only you will write, because no other breakup is available. Now, in investment, for example, shares, debentures, if it is there, then you can give a note. Directly it is investments readily available. So directly I am writing. See, note when required, please understand, if you want to give a breakup or if you want to present any extra information, give a note. Otherwise, unnecessarily not required note. In one textbook they have taken a note means I have to take like that. It is not the intention. Note intention is to explain something. If any item is having a breakup, give a note. If it is directly available, directly you can write. Nothing wrong. For example, here intangible asset is there. For this you can give a note. Intangible asset, goodwill you can write, because in intangible asset there is a goodwill aspect is there that I want to present it. You can give a note. But non-current investment, directly investments are available. Investments are I assumed as non-current. No need to give a breakup. When breakup is necessary, for example, this non-current investment, shares, debentures, government securities, like that is there, and then you can give a note. Okay? You understand my intention? Inventories, why I am giving note? Because in inventories we have foodstuff, wines, cigarettes, cigars. 2 things are there. That's why. Hello? Next, trade receivables. Trade receivables, any breakup available? No. Directly I can write? Yes. Trade receivables how much? 19,260. 19,260. Please, whenever I am telling something, you yourself find out that amount and write. Don't just copy paste. If you do that, there is no use. You yourself find out where that item is. Trade receivables. Next, other current assets is there. Cash and cash equivalents is there. Yes. Cash and cash equivalents. I think we have cash in hand, cash at bank. 2 things are said. Note 7 I will present. Next, any other current assets? That's it. Total? Next, P&L account, sir. So, International Hotels Limited. P&L account for the year ended. March 31st, 2012. Particulars, note, amount. First, revenue from operations. Revenue from operations, note number, continuation to the balance sheet, sir. 8. Revenue from operations, what items will be there? Revenue from operations, sir. Revenue from operations, see this. They are given, see this. Sales, wines, cigarettes, cigars, 68, 400, plus food, 57, 600, plus rent of rooms, 48,000, plus billiards. Total 1,79,700. 179,700. Because I want to close the P&L account. That's why while I writing the item itself, I am closing it. I am finding the total. Next is second, other income, right? Other income, note number 9. What items are there in other income? Other income, we have this one, discount, miscellaneous receipts, 2,800. And then dividend received 3,300. Transfer fees 700. Total 6,800. You take here 6800. Then find out total revenue. Total revenue. How much is the total revenue? 86,500. Then expenses, sir. Expenses. First one in expenses is what, sir? Cost of materials consumed. Here cost of foodstuff consumed. Materials is foodstuff consumed. For this you can prepare 9. Cost of foodstuff consumed. Foodstuff means what? Cost of material also you can write, nothing wrong. But here in order to identify that in this problem we have foodstuff is the material. That's why I have given that name only. Cost of foodstuff consumed. Okay. Foodstuff consumption, how much can you tell me? Opening plus purchases minus closing. 25,060. Already we have done. We have now find it. 25,060. So take 2560. Next. Next change in. No, purchase of. Yes, purchase of wines, cigar and cigarettes. Correct? Purchase of wine, cigarette, cigars directly available. How much is the purchase of wine, cigarette, cigars, sir? Purchases given. See this, 45,800 directly you can take. And then change in inventories of wines, cigarettes and cigars. Correct? Change in inventories means the difference between opening and closing of wine, cigarette, cigars. Find out the opening, closing, 9,700, sir. Correct? Wines, cigarette, cigars, opening, closing. Already we find out 9,700 minus 9,700. Opening minus closing minus 9,700. Correct? So this is raw material consumption part. This is stock in trade. For your understanding, I am writing this. Okay. Next, employee benefits. Employee benefits, note 12. What is there in employee benefits? Salaries. How much is there in salaries? 28,300 plus outstanding we need to add. Salaries and wages 28,300 plus outstanding at the end 1,280. Add 29,580. Note number 12 we will do. Next, finance cost. What is that? Finance cost. Finance cost, what is there? Finance cost, debenture interest. Debenture interest. We'll take debenture interest, sir. Hello? Finance cost, sir. Debenture interest. Can you tell me how much is the debentures? 2 lakhs. On 2 lakhs apply 6%. 12,000. See, now you hear important points here. This 12,000 finance cost, debenture interest, right? Interest accrued but not paid. So therefore this 12,000 I will consider them as a part of OCL also. OCL. That means my assumption is here debenture interest is not recognized by the company. That's why it is not there in trial balance. Anywhere in trial balance it is available? Huh? No. That means they have not recognized. So this finance cost is accrued, incurred but not paid. Therefore first I need to consider it as a normal expenses in P&L. At the same time, since it is not paid, we will consider it as a part of OCL. In the last problem we solved, illustration 2. In that illustration 2, in the trial balance, finance cost is there. That means they recognized it. Recognized, but on the credit side liabilities, finance cost is not there. That means it is already paid. Therefore, we considered only as a expenses, not as a liability. Very simple, pa. First expenses incurred. When you incur, you need to take it to P&L. If that incurred expense is not paid, then only it will become liability. In this question, trial balance itself, finance cost is not there. Not there means what? They have not recognized. Now I assumed, now I recognized it in the books. If you recognize, what is the entry? Debenture interest is an expenses. So P&L account debited to finance cost you will write na. You will debit to P&L account. At the same time, this 12,000 not yet paid. Therefore, I will consider it as a part of OCL, other current liabilities. Then my question is, why you have not considered in illustration 2? Already paid, because it is not there on the credit side liabilities. Incurred, already paid. Incurred but not paid, then only it will come in liabilities. That's the difference. Hope you understand my intention. Linking. Finance cost is done. Next, depreciation is there. Calculate depreciation. Note number 14. Depreciation, you see, furniture and fitting 5%, sir. Furniture and fittings. How much is there in furniture and fixtures? I think it is there in the question. See this, furniture and fixtures balance how much? Furniture and fixtures balance given, how much? On that 5% you apply. 4315. Okay. Then you need to consider on land and building also. What is the land and building value? On that to 2%. Total 21,315. 21,315 depreciation, correct? Hello? Depreciation on both furniture and fittings and land and buildings. And other expenses, remaining all other expenses. Note number 15. What items will come in other expenses? See this, in other expenses, rent, rates, taxes 8,900. Hello? Take it. Other expenses 8,900. Laundry 750. Coal and firewood 3,290. Carriage and coolage 8,100. Sundry expenses 5,840. Advertisement 8,360. Repairs 4,250. That's it, I think. Preliminary and formation expenses 8,000. All these are other expenses only. You add everything. Or add all these items and tell me how much it is. $8,900, 750, 3,290, 810, 5,840, 8,360, 4,250, and then 8,000. So total 40,200. 40,200, sir. 40,200 is other expenses. Then make a total, sir. Total expenses. Be careful when you are finding the total because there is a minus symbol also. How much? 1 lakh 250, correct? 255. Is this right? 164 255. So total revenue minus total expenses. So you will get what? Profit for the period, right? Profit for the period. What will be the profit? 22,245. Any provision for tax we need to create on this? Nothing. 22,245, sir. I think we got P&L account and also balance sheet. Now I need to prepare what, sir? Notes to accounts. 15 notes to accounts we need to prepare, sir. See, in examination, notes to accounts. First notes to accounts, share capital. Now in this question, both equity preference both are there. Correct? Authorized given? Authorized share capital given? Yes, first point itself authorized given. So when it is given, you need to present that. So authorized share capital, in that first equity. $10,000 equity shares of 100 each. Correct? 10,000 equity shares of rupees 100 each. How much? 10,000 into 100. 10 lakhs. And then preference share capital. 5,000. 6% preference shares of rupees 100 each. How much? 5 lakhs. So total 15 lakhs. So this is the authorized capital we need to present just for presentation purpose. Then next, issued, subscribed and paid up share capital. Issued, subscribed and paid up share capital. In that first equity share capital, sir, actually, you know, equity share capital how much given? 8 lakhs 5,000. You see 8 lakh 5,000 given. Each share 100 rupees, sir. Actually, in the additional information, they clearly said that till now how many equity shares are issued by the company? 8,000. Correct? So 8,000 equity shares of rupees 100 each. Correct? How much? Actually 8,000 equity shares of rupees 100 each. 8 lakh 5,000 they given. Given. From this how much I need to reduce? Capital reserve. Hello. How much, sir? 5,000 I need to reduce. So what will be the balance I will take? 8 lakhs I will take. Because this one is what, sir? This 5,000 is what? Profit on reissue of forfeited shares. Correct? We have reissued forfeited shares. On that we got a profit of 5,000. That is actually transferred to capital, but it should be transferred to capital reserve. That's why we deducted it. See, actually in the given question, what they have given? Equity shares, 8,000 equity shares of 100 each, 8 lakh 5,000. From that I reduce capital reserve. When you are presenting, sir, you can write like 8,000 equity shares of 100 each. Okay, here you can present like this: 8,000 equity shares of 100 each fully paid, like that 8 lakhs you write. This capital reserve no need to deduct like this. This is only for internal purpose. Okay. Yeah, you can present like this: 8,000 equity shares of 100 each fully paid up. Okay. 8 lakhs I will present here directly. Okay. 8 lakhs. Next, preference share capital. Preference share capital is also there, na? How much? 5,000, 6% preference shares of rupees 100 each, fully paid up. Fully paid up. How much? 5 lakhs. 5 lakhs is the total. So therefore, what is the total paid up share capital, sir? Total paid up share capital is 8 plus 5, 13 lakhs. So this you take it as A, this you take it as B. So A plus B is the total paid up share capital, 13 lakhs. So this 13 lakhs you need to take it in balance sheet, sir. 13 lakhs you take here. Next, reserves and surplus, sir. Note number 2. Reserves and surplus. What items we have in reserves and surplus, sir? Reserves and surplus is there. P&L account is there. Reserves and surplus, right? General reserve is also there. General reserve is also there, right? Reserves and surplus lo manaki em unnai, sir? What are the items we had in reserves and surplus? We have general reserve, right? How much is there in general reserve? 2 lakhs. Any adjustments to general reserve? Anything we need to transfer to general reserve? Nothing. Next, we have capital reserve. Na? Just now we, any profit on reissue of forfeited shares. How much? 5,000. Sir, 100 shares, sir. 100 shares. We reissued at 90 minus, to make it fully paid, only 40 rupees required. Because 100 rupees share, 60 originally paid, 40 not paid. So we forfeited and reissued at 90. 90 minus 40, 50 rupees extra we collected. That is profit on forfeiture. That will go to capital reserve. And next one, sir, P&L account. P&L account balance we want. Tell me any opening balance given in the question. Yes, how much given? 41,500. Opening 41,500. For that you need to add current year profit. What is the current year profit? 245. Total. Total 2,68,745. Correct? That's it. This is reserves and surplus. So reserves and surplus, opening current year profit. Current year profit 22,245 taken from P&L account. This one. Opening already given. So this one. So 268,745. 268,745, sir. Now come to long-term borrowings, sir. Next one. Long-term borrowings, what is their debentures, right? How much percentage? 6% debentures, huh? 6% debentures, how much? 2 lakhs. So take it, only one item is there. 6% debentures, 2 lakhs. Update this in balance sheet. Next, I want OCL, other current liabilities. In OCL, I think I have outstanding wages and salaries. What is the outstanding wages and salaries at the end, sir? 1280. And also interest, debenture interest. I assumed that debenture interest incurred but not paid. So 12,000. So total 13,280. 13,280 I will consider. 13,280 I will consider. I think equity and liabilities we done. Can you tell me total here? $18 lakhs. That's it. 18, 24, 25. Okay. Now come to asset side. What is the first one? PPE. Note number 5. PPE, write down, sir. So in PP, what are the items we had, sir? Furniture and fittings. Furniture and fittings, what is the balance? Given in the question, furniture and fittings. From that, reduce depreciation. 86,300 is the cost less depreciation for current year. I think depreciation is 5%, right? 415 minus it. So 86,300 minus 4615. 81,685, correct? Hello. Next, land and buildings. What is the cost of land and buildings? 8 lakhs 50. From that you reduce depreciation. Depreciation, I think depreciation is 2%, sir. How much? 8,50,000 into 2%, sir. 17,000. So it will be 8,20,33,000, right? This is 86,300 into 5%, 4,315, correct only, na? 86,300 minus 4,315. How much? 81,985. Okay. 985. Correct? Add these two. How much we got? 9 lakhs 14,985. 914,985. So 9 lakh 14,985. Next I want sixth. Sixth is what, sir? Inventories. So can you tell me, sir, inventories closing balance? I think two inventories. One is foodstuff. Foodstuff closing balance, can you tell me? 16,400. And also wines, cigarettes, cigars. Total, I think it is 39,100. Done? Hello? No. 38,900. Yes, 38,900. 38,900. Update this in balance sheet, sir. Last one, I want cash and cash equivalents. Cash and cash equivalents, tell me. First, cash in hand. Cash in hand, how much? Cash in hand, 2,200. Cash at bank, 76,380. Total, 78,580. That's it. So 78,580. Check it. Check the asset side total. Tallying or not? Tallied, how much came? 18 lakhs 24,025. Tallied. Check it, everybody. Now, P&L account, sir. P&L account, what is note number 8, sir? Revenue from operations. In revenue from operations, I think we have sale of food. And then sale of wine, cigarettes, cigars. Next is sale of room. Next, billiards. Correct? Room rent, nothing but sale of room means room rent only. Sale of food, how much? 50. What is sale of food, sir? 57,600. Wine, cigarette, cigars? 68,400. Next, room rent? 48,000. Next, billiards? I think you add all these things, you will get revenue from operations. How much? 1. That's it. Next, 8th, 9th. What is the 9th one, sir? Other income. In other income, miscellaneous receipts 1. and think discount received, another one, and next transfer fees. 3 items are there. So tell me miscellaneous receipts 2800, discount 3300, transfer fees 700, total that's it 6800. Already we have written totals here. This one, yeah. Next 10th note. What is 10th note, sir? Cost of foodstuff consumed, correct? How to find out cost of foodstuff consumed, sir? Opening you take first, add purchases minus closing you do. Automatically you will get consumption. Can you tell me foodstuff opening balance? 36,200. Purchases during the year? Foodstuff purchases during the year? Purchases 36,200. Opening 5,260. So this 32,600 is purchases, sir. Next 5,000 is opening. Closing 16,400. How much we got? Consumption 25,060. Next after consumption, sir? Purchases, purchases already we have, no need to prepare note, I think. Next change in inventories. So change in inventories of wines, cigarettes, cigars. The difference between opening and closing, sir. What is the opening balance? 800 minus closing balance. Closing balance of wine, cigarette, cigars. Closing balance how much? 22,500. So what is the difference? 9,700. Negative. Next 12th, sir. 12th note. Employee benefits. Employee benefits, I think salaries and wages, sir. How much is salaries and wages, sir, given in trial balance? 28,300. For this you need to add outstanding. Outstanding on 31st March 2012. How much is outstanding? 1,280. Total 580. Next 13. Finance cost. Hello? Finance cost, I think we have debenture interest. I think debenture interest is 2 lakhs into 6%. Right? How much, sir? 12,000. Hello? Next 14. Other expenses. No, 14. What is the note number 14? Depreciation. Depreciation. First, depreciation on furniture and fittings. Furniture and fittings, what is the depreciation, sir? 4,315. Next, depreciation on land and buildings. Total 21,315. Correct? Next, 15th note, other expenses. You write down all the other expenses, sir. What are the other expenses, sir? Laundry, coal and firewood, yes, carriage and coolage, sundry expenses, advertising expenses, what is that? Repairs. Okay, next. Preliminary expenses. Correct? Preliminary expenses. Any other item missed? Rent, rates and taxes. Yes, rent, rates and taxes. Tell me one by one. Laundry, coal and firewood, carriage and coolage, 810. Sundry expenses, 8. Advertisement 8,360. Repairs 50. Preliminary expenses, rent rates. That's it. Any other item missed? Total 40,200. 40,200. Hello? That's it. 40,200, sir. 40,200, sir. Sir, this is how we need to prepare the sum. Sir, why you are solving everything here? Because there is a difference between solving the entire question on your own and just watching or auditing the solution. Just watching or auditing the solution doesn't mean that you have solved it. In examination, there will be blockage. Even small points will stop you in examination. If that should not happen, means you should completely solve at least 3 or 4 questions completely in balance sheet. You yourself have to do completely solve balance sheet and P&L and tally the balance sheet. Including notes to accounts, you scribble it just. I am not saying you need to write everything. At least you scribble. In the rough paper, you need to solve everything, entire sum. Then only you can solve in the examination. Otherwise, there will be blockages. That's why in order to give you that practice, I am solving in the classroom, sir. It is very easy for me to take the format and explain you. But that is not at all useful to you. You will not get proper answers. So 2 questions I solved completely. Now you got the idea how to solve balance sheet and P&L account on your own. So this is how we need to solve. This is the way. Okay. This is a very good question, sir. Mark this as a very good question. And practice this question again and again. In this question, the important points are what? That capital reserve point, profit on resale of forfeited shares point, 5,000, that point. And also dividend declared after 31st March is not a liability, that point. And then since this is a hotel, foodstuff is a raw material for them. In respect of raw material, what I need to do, in respect of stock in trade, what I need to do present, that idea should come to you. Then only this will be very easy sum. So finally, they have given a note also. Any dividend declared after 31st March should not be considered as a liability. Hence, dividend was not considered. That's it, sir. I think. And one more important thing, sir. Interest on debentures is assumed, incurred but not paid. That's why here they have considered as a part of finance cost, as well as in other current liabilities also. This debenture interest they have considered, sir. If you want, you can check also. In other current liabilities, you see wages and salaries, interest on debentures, both are there. Sir, suppose if you don't assume, if you don't consider interest, then also balance sheet will tally. 12,000 will not come in P&L, 12,000 will not be shown as a other current liabilities. Suppose if we don't make an assumption that interest accrued but not paid on debentures, 12,000 will not come in P&L, finance cost, 12,000 will not be shown in balance sheet as a other current liability. Then also it will tally. That's it. This is how presentation will be done, sir. And in the question they have taken 17 notes to accounts. We considered only 15. Because for some notes to accounts we have written directly, they have given a breakup. That's the difference. It is not that they have taken 17 means we also do 17 in the examination. No, not required. For investments, what they have given for investments? Where they have given for investments? Not there, na? Given, relating to investments, no note, I think. No. Okay. Whatever. Purchase of investment, they have taken directly. They have given a note, but we have taken directly. That is one thing. Except that everything we also taken. Okay. Not a problem. If you want to present, you can present notes to accounts also, but notes to accounts will be presented only if there is additional information breakup like that. If it is available, you present. That's it. This is illustration 4, sir. Okay, sir. Next term, in financial statements of companies, scenario based questions Question number 8, we are going to solve it, sir. Question number 8. Very good question. Especially the minute details of schedule 3 will help in this question. I will tell you where students will do mistakes in this question. See this. From the following particulars furnished by Alpha Limited, prepare balance sheet as on 31st March 2011 as required by Part 1, Schedule 3 to the Companies Act 2013. So they are asking only balance sheet, sir. No need to prepare P&L. Only balance sheet they are asking. Now look at the details. They have given debit, credit. Equity share capital 50 lakhs given, sir. Face value 100. Calls in arrears given 5000. Tell me what you are going to do with calls in arrears. Reduce from the called up capital so that you will get paid up capital. Land and billings PP, and this is reduced from called up capital. Next, plant and machinery PP, furniture PP, general reserve, reserves and surplus. Loan from State Financial Corporation, long-term borrowings, long-term borrowings. Inventory, raw materials, finished goods, current assets, inventories. Next, provision for taxation, short-term provisions in current liabilities. Trade receivables, current assets, trade receivables. Short-term advances. See, these advances are having debit balance. Debit balance means advances asset, not a liability. Credit balance means a liability, advance taken. But this is advance given. Debit balance. So advances given is a current asset. Current asset or non-current asset. See, in I think loans and advances we have in non-current assets as well as current assets. In non-current assets we have long-term loans and advances. In current assets we have short-term loans and advances. So these are short-term. So consider them in short-term loans and advances in current assets. Next, P&L account, reserves and surplus. Cash in hand, cash at bank, cash and cash equivalents in current assets. Unsecured loan, long-term borrowings. Long-term borrowings. Trade payables, current liabilities, trade payables. Loans and advances from related parties. Loans and advances from related parties given. No information is given. Actually, you see, unsecured loan, loan from State Financial Corporation, these are unless otherwise provided always long term. But loans and advances from related parties, you know, if you recollect schedule 3 we have discussed, these loans and advances from related party, it is there in long term borrowings as well as short term borrowings. So therefore no information is available. So I am considering it as what? Short term. So you consider it as a short term borrowings, or else if you want you can take it in long term borrowings also. That's your wish. If you want you can consider in short term borrowings or you can consider it in long term borrowings. Assumption here I am taking it as a short term borrowings. Hello. So this is the trial balance of Alpha Limited, sir, on 31st March 2013. 31st March 2011, sir, this is trial balance given. Now look at the additional information, very important. 10,000 equity shares are issued for consideration other than cash. Tell me what is the impact of this point. 10,000 shares are issued for consideration other than cash. You know, as per schedule 3, when shares are issued for consideration other than cash, we need to mention aggregate number class of shares. You remember that point? 3 situations. What are those 3 situations? Fully paid bonus shares, buyback, and shares issued for consideration other than cash. In all these 3 situations, schedule 3 says we need to disclose aggregate number class of shares. So this is, we need to disclose in notes to accounts this point, that 10,000 shares are issued for consideration other than cash. Now those students who doesn't know schedule 3, they think that why they have given this information in additional information. They don't know. Here, since we have covered schedule 3, we know that whenever a company issued any shares for consideration other than cash, we need to mention the details of that in the notes to accounts. This is as per schedule 3. This point is relevant. Hello. Next, second point you see, trade receivables of 2,60,000 are due for more than 6 months. Debtors outstanding for a period of exceeding 6 months also we need to make a separate disclosure. So this is also separate disclosure is required as per schedule 3. Next, cost of the assets given, sir, building, plant and machinery, furniture. Sir, additional information they have given cost. In trial balance they have given what? WDV. For example, land and buildings you see. What is the land and building value? 30 lakhs is the cost they have given. WDV how much given? 27,50,000. That means what is the current year depreciation? 2,50,000. Of course, we are not preparing P&L account here, but when you present in balance sheet, buildings 30 lakhs minus depreciation 2,50,000, 27,50,000 you will show. Like that. So that's why reading is very, very important, sir. They have given cost here, cost, building, plant and machinery, furniture. And in the trial balance they have given WDV. The difference is nothing but depreciation. Now next one you see, the balance of 7,50,000 in the loan account with State Financial Corporation is inclusive of 37,500 for interest accrued but not due. Interest accrued but not due, where it will come? Other current liabilities. Very good. Interest accrued but not due. Interest accrued and due, interest accrued but not due. Both will come in other current liabilities. So here, but what they have done, this 7,50,000 which is loan from State Financial Corporation, in this 7,50,000 this 37,500 is also included, which is not correct, na? So this 37,500 where we need to show? OCL, other current liabilities. Only long-term borrowings we need to show 7,12,500. And the loan is secured by hypothecation of plant and machinery. Can anybody tell me what is the relevance of this point? Very good. I told you borrowings are basically divided into two types. Secured, unsecured. If they are secured, we need to mention the nature of security also as per schedule 3. Here, hypothecation. This point is also as per schedule 3 we need to present. Hello? Okay? Sir, look at this. In the additional information, the first point, the second point, fourth point. In all these 3 points, schedule 3 is impacting the disclosures. Okay. Next to see fourth point. Balance at bank includes 10,000 with Omega Bank Limited, which is not a scheduled bank. That means generally bank balance will come in cash and cash equivalents. But here in our bank balance, 10,000 is there with one non-scheduled bank. This is also we need to give a breakup. In the bank balance, 10,000 is there with non-scheduled bank, remaining is there with scheduled bank. Like that. Transfer of 20,000 to general reserve is proposed by board of directors. So board of directors proposing 20,000 will be transferred to general reserve. This 20,000 will be transferred from P&L account to general reserve. So from P&L account we need to reduce this, add to general reserve. Okay. This 20,000 is an appropriation from P&L account. Once you got the profit, from that profit 20,000 will be transferred to general reserve. So when you are preparing reserves and surplus from P&L account balance, we need to reduce this 20,000 and general reserve we need to add. One reserve increasing, another reserve decreasing. And board of directors declared a dividend of how much? 5% on the paid up capital. When? 2nd April 2011. That means any dividend declared after 31st March is what? Not a liability. So don't consider it as a liability. So the same question is there as MTP September 24 service. Okay. So this is a very good question, sir. Similar type of questions they tested in examination. Now you tell me, sir, in this question what items will come when you present first balance sheet? Shareholders funds, share capital, reserves and surplus. Next, money received against share warrants? No. Share application money pending allotment? No. Next, non-current liabilities. Long-term borrowings? Yes. What are there in long-term borrowings? 2. Loan from State Financial Corporation, unsecured loan. Next, deferred tax liabilities? Not there. Other long-term liabilities? Not there. Long-term provisions? Not there. Next, current liabilities. In current liabilities, short-term borrowings. There are, yes, loans and advances from related parties. We assumed it as short-term. Next, trade payables. Yes. Next, other current liabilities. Yes. Interest accrued but not due. Other current liability. Then short-term provisions. Yes. Provision for tax. Now asset side, non-current assets. PP is there. Yes. Intangible assets not there. Next, non-current investments. Any investments there? No. Next, deferred tax assets not there. Loans, long-term loans and advances not there. Next, other non-current assets not there. Then current assets. Current assets, first one, current investments not there. Second, inventories there. Trade receivables there. Short-term loans and advances there. Other current assets not there. That's it. Cash and cash equivalents there. So these are the items will come. So let us solve this question, sir. Very, very important sum. What is the number? Question number? Illustration? Not illustration, sir. This is SBQ. Scenario based question. 8. Hello? Alpha Limited, right? Alpha Limited. Only balance sheet, sir. Balance sheet as on 31st March 2011. So first, those who are watching recorded classes, first you solve along with me. Particulars, note number, amount. Rupees normal or in thousands or crores? Normal. Now first, equity and liabilities. In equity and liabilities, shareholders funds. In shareholders funds, share capital. Note 1. Reserves and surplus. Note number 2. Next, money received against share warrants not there. Share application money pending allotment not there. Then non-current liabilities is there. In non-current liabilities, long-term borrowings there. Note number 3. Next, deferred tax liabilities not there. Other long-term liabilities are not there. Long-term provisions also not there. Next, current liabilities. In current liabilities, short-term borrowings is there. Yes. Loans and advances from related parties. Next, trade payables is there. Can you tell me trade payables amount? Trade payables 8 lakhs. 8 lakhs. Directly I am taking. Short-term borrowings I will write note number 4. Next, other current liabilities is there. Yes. Interest accrued but not due. Next, short-term provisions is there. Yes, short-term provisions. Provision for tax. I think this is the total for all equity and liabilities. Now come to asset side, sir. In the asset side, first one, non-current assets. Non-current assets, in that property, plant, equipment, right? PP. Note number 7. Intangible assets not there. Next, non-current investments not there. Deferred tax assets not there. Short-term, long-term loans and advances not there. Other non-current assets also not there. Now we have what? Current assets. In current assets, current investments not there. Inventories is there. Yes, inventories. Inventories, I think we have raw material as well as finished goods. So note number 8. Next, sir, trade receivables. Trade receivables outstanding for a period exceeding 6 months, sir, we need to present. So therefore I am preparing a note for it. So note number 9. Next, cash and cash equivalents. Also note is required because amount of balance with non-scheduled bank, scheduled bank, like that. Additional information on point is there. Next, short-term loans and advances. Short-term loans and advances is there. They have given. How much is the short-term loans and advances? 2,13,500 directly you can take. 213,500 given. Next, any other non-current asset? Not there. Total. Correct? That's it. So total 10 notes to accounts I need to prepare, sir. 10 notes to accounts I can prepare. So let's start with the notes to accounts. notes to accounts. So in notes to accounts, the first one is what, sir? Share capital. So look at the question. What is the share capital available with the company? Only equity share capital. Correct? Any authorized capital given? Not given. So therefore directly we can write what? Issued, subscribed and paid up share capital. But we should not write paid up here, because in this question there is calls in arrears. So we will write issued, subscribed and called up capital. Called up capital. Because from this I need to reduce what? Calls in arrears. So issued, subscribed, called up capital. How much, sir? Actually 50 lakhs is there of rupees 100 each. That means 50,000 shares. Correct? 50 lakhs divided by 100. 50,000 shares. Correct? So look at how I am presenting. 50,000 equity shares of rupees 100 each. This is what we called, sir. Okay, 50,000 equity shares of 100 each. How much, sir? 50 lakhs. 50 lakhs. Now here comes the most important thing, sir. We need to write a note. Out of the above, how many shares are issued for consideration other than cash? 10,000, you see. Out of the above, 10,000 equity shares were issued for consideration other than cash. For consideration other than cash. For consideration other than cash. Aggregate number, class of shares. So schedule 3 says whenever any shares are issued for consideration other than cash, we should provide a note. Aggregate number, class of shares. So we provided note. Most of the students, frankly tell me, have you ever written this note? No, but you have to, because it is requirement as per schedule 3. Requirement as per schedule 3. And then from this you reduce calls in arrears. You called 50, but how much amount still in arrears, sir? 5,000. Deduct it. Then you will get 49,000, 95,000. So this will be the paid up amount. 49 lakhs 95,000. 50 lakhs we called, sir, but 5,000 not yet received. But this note is very, very important, sir. This is as per schedule 3. 49 lakhs 95,000. That means if the users are reading the financial statements, they will understand that, oh, this company issued 50,000 shares. In that 10,000 shares are issued for consideration other than cash. To give more information to the users, schedule 3 is trying. So 49 lakhs 95,000 update in the balance sheet. 49 lakhs 95,000. Okay. Now second note, sir. Reserves and surplus. So reserves and surplus, what we had? Reserves and surplus, we have general reserve. Now P&L account. 2 reserves are there, correct? So general reserve. Actually general reserve how much given, sir? 10 lakh 50. And during there was appropriation. Additional information they clearly said. Current year transfer. How much board of directors decided to transfer to general reserve? Additional information, I think point number 6, 20,000 they will transfer. So general reserve balance will become 10 lakhs 70,000 in the balance sheet. Now come to P&L account, sir. P&L account balance. So in the P&L account, how much given, sir? P&L account balance how much given? 4,33,500. 433,500, sir. 4,33,500. Sir, current year profit already adjusted in this, because P&L account we are not preparing separately. So 433,500. From this, how much we transferred to general reserve? 20. Deduct 20,000. These are called appropriations. Any provision for tax we create, any transfer to general reserve, all these things. 20,000 you transfer. So 433,500 minus 20,000. How much, sir? It is 4,13,500. 500. 413, 500. Hello. So can you tell me the total? 14,83,500. 1483,500 will be reserves and surplus. Update this in balance sheet, sir. 1483,500. Next, long-term borrowings, sir. Note number 3, long-term borrowings. Sir, long-term borrowings, we have two things, sir. What are those? Loan from State Financial Corporation, which is secured, sir, which is secured. So therefore, secured, unsecured. You know, according to schedule 3, borrowings will be classified into secured, unsecured. Now here, secured. Secured is what? Loan from State Financial Corporation. How much is the loan from State Financial Corporation, sir? 7,50,000. But in this 7,50,000, sir, I think how much? 37,500 is the interest accrued but not due. This will not part of long-term borrowing. It should be considered as what? Other current liabilities. So from here you deduct it. 7,50,000 minus 37,500. How much? 7,12,500 only will be considered as a part of long-term borrowings. And that too, here the most important point is, they clearly said in the question that, you know, here, see this point, fourth point. The loan is secured by hypothecation of plant and machinery. So schedule 3 says, secured by hypothecation of plant and machinery. Now, how many of the students writing this? Nobody, because they don't know schedule 3. Schedule 3 clearly says the nature of security also we need to mention. Here the loan from SFC is secured by hypothecation of plant and machinery. So therefore we have provided a note as per schedule 3. Okay, so learning schedule 3, applying them in solving is very, very important. And then we have unsecured, sir. Unsecured loan is also there, no, sir? Hello? Unsecured loan. How much is unsecured loan? Unsecured loan, how much? 6 lakhs? 5,000. So I think you add both, you will get long-term borrowings. How much? 13 lakhs? 17,500. 13, 17, 500. Correct? Update this in balance sheet. 13 lakhs, 17,500. Then note number 4, short-term borrowings. STBs, short-term borrowings. I think loans and advances from related parties. Loans and advances from related parties. How much, sir? 2 lakhs. That's it. I think this is the only item we had here. So consider 2 lakhs, sir, in the balance sheet. Loans and advances from related parties, 2 lakhs. Next to OCL, note number 5. OCL, other current liabilities. What is other current liability? Interest accrued but not due. Interest accrued but not due. How much? 37,500. Correct? 37,500. Interest accrued but not due. So consider it. 37,500 interest accrued but not due. Here 37,500. Next is short-term provisions. Note number 6. Correct? In short-term provisions, what will take? Provision for tax. How much is the provision for tax given? 6 lakhs. 6 lakhs, 6 lakhs 40,000 is the provision for tax. So consider it 6 lakhs 40,000. So short-term provisions 6 lakhs 40. So make a total of all these things. Can you tell me how much it is? 94,73,500. Correct? Now next PPE, sir. Note number 7. 7 is PPE. We have first, I think, building, plant and machinery. So building, building less depreciation. Look at how I am presenting. Next to plant and machinery. Plant and machinery less depreciation. And then furniture. Furniture less depreciation. First buildings, you see original cost given in additional information 30 lakhs. And how much is given in the trial balance? 27 lakhs 50,000. 27 lakh 50. So 27 lakh 50,000. And this one, plant and machinery 26 lakhs 25,000. And furniture 2 lakh 50,000. Original cost, if you see additional information, plant and machinery 35 lakhs. Furniture original cost 3 lakhs 12,500. The difference is nothing but what, sir? Depreciation. So here the balancing figure is depreciation, sir. So 30 lakhs minus 27 lakh 50. So 2 lakh 50,000 is the depreciation on building. Now next, 35 minus 26 lakhs 25,000. 8 lakhs 75,000 plant and machinery. And this one 62 lakhs 500. So these are all balancing figure. Now I want every one of you to observe how I am presenting PP in balance sheet. This is how you need to present cost minus depreciation, cost minus depreciation. So PP total, can you tell me? Add all these things. So 56 lakhs 25,000. Update this in balance sheet. 56 lakhs 25,000. Now come to inventories. Note number 8. In inventories, we had I think 2 inventories, raw material as well as finished goods. Raw material, how much given? Raw material is given for 2 lakh 50. Finished goods is given for 10 lakhs. So total it was 12 lakhs 50,000. So this 12 lakh 50,000 you update here. 12 lakh 50. Next, trade receivables. Note number 9. Trade receivables important, sir. See, trade receivables clearly given, sir. Outstanding for a period exceeding 6 months you need to present separately. Outstanding for a period exceeding 6 months. Outstanding for a period exceeding 6 months, how much given, sir? Additional information you see 2,60,000. We need to write separately. And others we need to write separately. This is the balancing figure for others. How much is the others, sir? Actually total trade receivables is how much? 10 lakhs. Everybody? 10 lakhs, sir. Actually total trade receivables 10. In this 10, 2,60,000 is outstanding for a period exceeding 6 months. So therefore 7,40,000 is other debtors. Presentation important, sir. Total 10 lakhs only, but how I am presenting based on the information given is important. So in balance sheet we will update 10 lakhs. And then last one, cash and cash equivalents. Note number 10. So note 10, cash and cash equivalents, sir. In cash and cash equivalents, we have cash in hand first. Cash in hand given, sir. How much? 1,50,000, sir. Now cash at bank, sir. So cash at bank, we need to give a breakup, sir. Because in the additional information they said cash at bank with scheduled banks, with non-scheduled banks. So total cash and bank balance, cash at bank given 12,35,000. In this 12,35,000, how much cash balance is with non-scheduled bank? Point number 5. Balance at bank includes 10,000 with Omega Bank Limited, which is not scheduled bank. So 10,000 with non-scheduled bank. That means 12,25,000 is with scheduled bank. So look at the presentation, how I present it. Total 12,35,000 only. In that 12,35,000, 10,000 is there with non-SBs, non-scheduled banks. Obviously 12,25,000 is there with what? Scheduled banks. So this is how you need to present based on the information given. Total it will be 13,85,000, right? 13,85,000 is the total. So present this 13,85,000 in the balance sheet. Check the total asset side. How much came? 94,73,500 came. That means we have done perfectly right. I want every one of you to observe this question carefully. How many points we have written as per schedule 3? See this point, I put a star mark. And in loans secured by hypothecation of point, all these points we have presented. And debtors exceeding 6 months we need to present separately. This is also as per schedule 3. Okay, that's it, sir. This is how a question will be solved, sir. This is scenario based question number 8. You understand this question, sir? Yes. Now, sir, similar to scenario based question 8, just now we solved scenario based question 8, right? Similar to scenario based question 8, illustration 5, sir. So you please write down here, similar to SBQ 8. If you want, you can check, sir. Same question. There is no difference at all. Only amounts changed. They have given the they are asking us to prepare balance sheet, sir. Same in scenario based question 8 also they are asking what? Balance sheet. You know, capital given, calls in arrears given, land, building, plant and machinery, loan from state financial corporation, everything. You see, same question. Advances. But one important extra point what they have given is, see, even in additional information also you see, 2,000 equity shares are issued for consideration other than cash. Trade receivables 52,000 due for more than 6 months. Cost of the assets given. Balance of 1,50,000 in loan account with SFC is inclusive of 7,500 for interest accrued but not due. This loan is secured by hypothecation of machinery. Bank balance includes 2,000 with Perfect Bank Limited, which is not a scheduled bank. See, the 6th point is an extra point, sir. 6th point is not there in scenario based question 7. This point is there here. See this. The company had contract for erection of machinery at 1,50,000, which is still incomplete. This is the only extra point. Remaining everything is same, sir. Remaining everything same only. And also one more extra point in the trial balance, if you see, they have given dividend payable. See this 60,000 is there. Payable, dividend payable is there. You check. This point is not there in SBQ. Hello? Dividend payable means outstanding, right? So it will come in other current liabilities. You check other current liabilities. See this. In other current liabilities, interest accrued but not due, and also dividend payable taken. Apart from that, everything is. And what about, see, dividend payable 60,000 is there now. This 60,000 will you reduce from profits? Will you reduce from profits? No, because this dividend is not declared in the current year. It is already declared last year. In that dividend, some amount is still not payable. So therefore, it might have been already appropriated from the last year profits. So no need to deduct now. Just show it on other current liabilities. If it is a dividend declared in the current year, then we might have adjusted from the current year profits. And this point, sir, what about this point? Can anybody tell me? The company had a contract for erection of machinery 1,50,000, which is still incomplete. How to deal with this? The company had a contract for erection of machinery at 1,50,000, which is still incomplete. That means here this company entered into a contract. So this is estimated amount of contract remaining to be executed on capital account and not provided for 1,50,000. It has been assumed that the company had given this contract for purchase of machinery. See, the company has given a contract for purchase of a machinery. So in respect of that machinery, whatever the contract is there, na sir, we need to fulfill that contract. So it is considered as what? Commitment. You know, we discussed when we are discussing schedule 3, contingent liabilities and commitment. What is commitment? Commitment means in future company has to spend some amount. Similarly here, company had given a contract for purchase of machinery. Now in respect of that purchase of machinery, what is the estimated amount of contract remaining to be executed on capital account? but it is not yet provided. 1,50,000. So this 1,50,000 is a commitment, sir. Company had contract for erection of machinery at 1,50,000, which is still incomplete. That means we given a contract for purchase of machinery. The other party, when they made, we will pay. So in future, this will become an asset for us. As of now, it is just a commitment. So we will not recognize it as what? Asset. That's why nowhere this 1,50,000 will be recognized. Only it is what? Commitment. Remaining everything is same, sir. Same as SBQ 8, sir. So same as SBQ 8. Only 2 extra points came. I explained those 2 extra points. So you solve this question on your own. Hello. This question you solve on your own. It is similar to scenario based question 8. Only 2 extra points. Dividend payable scheme. It comes in other current liability. 6th point, it is nothing but what? Commitment. It won't come in balance sheet. Financial statements, it won't be recognized. That's it, sir. This is illustration number 5. Now come to illustration 6, sir. Delta Limited question. This question. Following is the trial balance of Delta Limited as on 31st March 2012, rupees in 1000. Sir, if you see the additional information of this question, sir, I think total 8 points are there. If you observe all these 8 points, na sir, these are very familiar adjustments. Like this question is, I can say, is a combination of 2 questions. What are those? Illustration 2. Just now we solved one illustration. Illustration 5. Illustration 5 again exactly same as SBQ 8. Either illustration 5 or SBQ 8. So these 2 questions combination only they have given in illustration 6. If you want, you can check also. See, well, see this debit balance, credit balance they have given, sir. Look at the debit balance, landed cost, PP, calls in arrears, deducted from the called up capital, cash in hand, cash and cash equivalents, plant and machinery at cost, PP, trade receivables, current assets, inventories, 31st March 2012 closing stock, current assets, cash at bank, cash and cash equivalents, current asset, adjusted purchases, P&L account, purchases, factory expenses, other expenses, admin expenses, others, selling expenses, others, debenture interest, finance cost, P&L account. Now credit balances, equity share capital 500, shareholders funds, share capital, debentures, long-term borrowings, general reserve, reserves and surplus, P&L account balance on 1/4/2011, opening P&L balance, reserves and surplus, securities premium, reserves and surplus, sales, revenue from operations, P&L account, trade payables, current liabilities, provision for depreciation, deducted from the cost of the asset. You know, here they have given plant and machinery at cost. This is the total depreciation. Same as illustration number 2. Suspense account is there. See, even in illustration number 2 you find suspense account. Their suspense account is 4,000. Here also rupees are given in thousands only. Look at the additional information, sir. Authorized capital of the company 80,000 shares of 10 each. What is the relevance of this point? In notes to accounts, we will present authorized capital first. Company revalued the land at 9,60,000. So land value originally 800. We revalued to 960. That means 1,60,000 will go to revaluation reserve in reserves and surplus. Next, equity share capital includes shares of 50,000 rupees issued for consideration other than cash. Sir, I told you when shares are issued for consideration other than cash, we need to mention aggregate number, class of shares in the notes to accounts. And also suspense account 10,000 represents cash received from sale of some of the machinery on 1/4/2011. The cost of the machinery 24 and accumulated depreciation 20. So cost 24, sir. Accumulated depreciation 20. That means WDV is 4,000. We sold it for 10,000. So profit on sale 6,000 will go to other income in P&L account. And the balance of the plant and machinery given in trial balance is before adjustment of sale of machinery. Even if he has not prescribed, we will take before adjustment only. Hello. Depreciation is to be provided on plant and machinery at 10% on cost. What is the cost of plant and machinery? 824. But in this 824, at the beginning, how much cost of plant and machinery we sold? 24,000. That means 24 in thousands. So 824 minus 24, 800. 800 into 10%. 80 is the depreciation of the current year. This current year depreciation is added to provision for depreciation. Minus whatever the cost of the plant and machinery we are selling, in respect of that, whatever the accumulated depreciation is there, that will be cancelled. So that will be deducted. So we will get the closing provision for depreciation. Just now illustration number 2 we solved na. Next, balance at bank includes 5,000 with ABC, which is not a scheduled bank. So we need to make a disclosure. Balance at bank with the scheduled bank, with non-scheduled bank. Make a provision for income tax at 30%. Sir, here provision amount not given. We need to find out. How to find out? You prepare P&L account. You will get profit before tax. On that apply 30%. You will get tax provision. Tax provision, what is the entry? I mean, where will you show? Short-term provisions. Short-term provisions. Trade receivables 50,000 are due for more than 6 months. So give a breakup in notes to accounts. You are required to prepare Delta Limited balance sheet and statement of P&L with notes to accounts for the year ending as per schedule 3. Ignore previous year figures and taxation. Sir, this question is actually for practice, sir. We already solved illustration 2 and illustration 5, SBQ 8. The combination is this question. So this question we'll try to explain first. Okay. So tell me, first we need to write the formats. Balance sheet first, then P&L. How will you start? Balance sheet as on 31st March 2012. What items will come? Equity and liabilities. First, shareholders funds. A, share capital, note 1. Reserves and surplus, note 2. Money received against share warrants, not there. Share application money pending allotment, not there. Next, non-current liabilities. In that, long-term borrowings is there? Yes, 10% debentures is there. Next, deferred tax liabilities, not there. Other long-term liabilities, not there. Long-term provisions, not there. Now come to current liabilities. Short-term borrowings, not there. Trade payables, there. Next, other current liabilities, not there. Other current liabilities, not there. Short-term provisions, there. Provision for tax. That's it. Balance sheet, done. Now P&L account. Revenue from operations, there. Sales. Asset side, sorry, non-current assets, first one, PP, there yes, land, plant and machinery. Next, intangible assets, not there. Next, non-current investments, not there. Next, non-current investments, deferred tax assets, short-term loans and advances, other non-current assets, not there. Next, current assets, current investments, not there. Next, inventories, there. Trade receivables, there. We need to prepare a note also. Next, short-term loans and advances, not there. Other current assets, cash and cash equivalents, there. Other current assets, not there. So this is the entire structure. And first you need to finish what? P&L account. P&L account we need to finish. So presentation wise, you see, first they have presented balance sheet. So what items will come? Same. Shareholders fund, share capital, reserves and surplus, non-current liabilities, long-term borrowings, current liabilities, trade payables, short-term provisions. Asset side, non-current assets, PP is there. Current assets, inventory, trade receivables, cash and cash equivalent. Note given. Next to P&L account. Revenue from operations, sales is there. How much is there? Take it. 1200. Hello. So sales. Next. Other income means profit on sale of machinery. We got a profit. How much? 6. 6,000 is the profit. Correct? Because sale value is 10. Cost of the machinery sold is 24. WDV 20. That means the accumulated depreciation 20. So therefore WDV of the asset sold 4. But we sold it for 10. So 6,000 is what? Profit. That is other income. For that, note number 8. Then expenses. First one, purchases. Adjusted purchase, how much given? 400. Take it. Next, cost of metal consumed there, not there. Change in inventory is also not there. Closing stock, opening stock differences. Finance cost is there. Debenture interest. How much, sir? Finance cost? 30. Then depreciation. Depreciation 10% on the cost. 824 minus 24 we sold. 800. 800 into 10%. 80. See this. 80. Current year depreciation. Remaining all other expenses. What items will come in other expenses? Factory expenses, admin expenses, selling expenses. Add these three. 80 plus 45. 125. 125 plus 25. 150. So 150 is other expenses. Very simple. So total revenue minus expenses. You will get profit or loss for the period. 546. And they said we need to create a provision for tax. So create a provision for tax on profits. See, provision for tax is also appropriation from profits. Just like dividend. Just like transfer to general reserve. These are all appropriations. Once you got the profit, from that profit these things will be given. So that's why tax expenses. 30% of 546. 546 into 30%, it will be 163.80. So your profit is 382.2. This will go to reserves and surplus. This 163.8 will go to short term provisions, provision for tax. Hello. Now P&L account is done, sir. Now balance sheet you come, sir. First share capital. Share capital you check what item. Share capital how much is there? 500. In the question how much is there? 500. How much is calls and errors is there? 5. So 500 minus 5, 495. And also question authorized capital given. Hello. And also in the question they clearly said that how many shares are issued for consideration other than cash? 50,000 worth of shares. Each share face value 10 rupees. That means 5,000 shares are issued for consideration other than cash. So when you present share capital, I told you first we need to present authorized share capital. See this. Share capital, equity share capital, authorized. 80,000 shares of 10 each. Then issued, subscribed and called up. And 50,000 shares of 10 each. This is what we called up. Look at the note clearly given. As per schedule 3, out of the above 5,000 shares have been issued for consideration other than cash. You add here out of the above 5,000 equity shares have been issued for consideration other than cash. Because schedule 3 says whenever shares are issued for consideration other than cash, we need to give a note, aggregate number, class of shares. Less calls in arrears. So 495. So in total, how much we will consider in the balance sheet, sir? 495. Sir, you understand share capital presentation? Nothing new. Whatever we know, we have presented. Share capital, equity share capital, first authorized share capital, then issued, subscribed, called up capital. So till now, how many shares we have called? 50,000 shares of 10 each. From that, we need to reduce calls in arrears. Next, reserves and surplus, sir. When it comes to reserves and surplus, sir, what items are there in the general reserve? 150 is there. Securities premium 40 is there. P&L account balance 75 is there, opening balance. Now, and land was revalued, right? There is a revaluation reserve also. Hello? So, you know, if I make an adjustment, say this reserves and surplus. Securities premium 40 there. Revaluation reserve 160 is there. Now, general reserve 150 is there. General reserve, sir. Then P&L account, you see opening balance how much is there? 75. Add current year profit 382.2. So it will be 457.2. So total 807.20. So 807.20 I will take here. Next, long term borrowings I have what? Debentures. How much is the debentures, sir? So 3 lakhs debentures is there. Take it. So debentures note number 3, 300. Next, trade payables directly you can take. Short term provisions, you will get provision for tax. We have got provision for tax now. 163.8. Now come to asset, make a total. The total is 1796. To asset side, you see property, plant, equipment. I think this is one of the important things, sir. Note 5. What is note 5, sir? PPE. Now tell me PPE how much you will show? See PPE, what is the opening balance? 824. Correct? From that, how much we sold? 24 cost. So what is the remaining cost? Minus closing provision for depreciation, right? What is the closing provision for depreciation? What is the provision for depreciation given? 150. 150 plus current year depreciation. How much? Current year depreciation 80. Minus depreciation of the plant and machinery we sold 20. So this is the closing depreciation, provision for depreciation. 150 plus 80 minus 20. How much, sir? 210. So 800 minus 210. 590 is the value at which PP will be shown in the balance sheet. See this. This is only plant and machinery. Land also we need to take, right? Land how much? Revalued figure you tell me. 960 revalued figure. So both will be added. 590 plus 960. 1550. You check now. 1550. Correct? See this 1550. Now see, breakup also they given. See this land, this will be presented like this. Opening balance, you add revaluation adjustment. You will get closing balance. Plant and machinery important pa. Opening 824. Dispose 24. Depreciation is this. This is not depreciation. This is provision for depreciation. You write here. Provision for depreciation. 150 minus 20 plus 80. What are the entries also I told? Can you tell me what is the entries here? Entries for sale of plant and machinery here. What is the entry I told? We sold. So bank account debit. What is the sale value? Sale value. 10,000 is the sale value. See this 10,000. And from your books, plant and machinery will go. How much cost? 24. Because we are maintaining the asset at cost. Accumulated depreciation separately. And see, when you sell the asset, sir, the corresponding depreciation will also be cancelled. So provision for depreciation also will be cancelled. How much will be cancelled? On the asset we are selling, how much depreciation accumulated so far? 20. And obviously what will be the profit here? This will go to P&L account, 6,000. That's why in P&L account other income we have shown 6,000. And what is the entry here for current year depreciation? Depreciation to provision for depreciation. Depreciation to provision for depreciation. Okay. So next property, plant, equipment over. Next inventories 96. I think inventories closing stock value they have given, na? 96. Take it directly. Next to trade receivables. Trade receivables you need to give a breakup. Outstanding for a period exceeding 6 months show separately. Outstanding for a period exceeding 6 months 50. Other debts 70. This is the balancing figure. Show separately 120. Next to cash and cash equivalents. Prepare note number 7. In cash and cash equivalents, cash at bank with scheduled banks, with others. I mean with the non-scheduled banks. Non-scheduled banks. Cash in hand. So this is the how we need to present the things. Okay. And P&L account related notes to account other income. What is other income first? Profit on sale of machinery. Sale value minus book value of the machinery. If you want profit, you need to compare sale value with the carrying amount or book value. Sir, whether you call it as carrying amount or book value, they are same, sir. So this is the cost, this is the accumulated depreciation. This is called WDV or book value. Sale value 10. So profit is 6. Finance cost we need to consider debenture interest. Other expenses, factory expenses, selling and administration expenses. 150. So tell me, is there any point it is difficult? No, it is exactly same as illustration 2 and illustration 5. It's a combination question both. Now other incomes will show on the negative. No, negative balance will show generally. That's what. Generally they will present like that. Or else, so if loss came on sale of machinery, generally it will be can be shown in other expenses as a loss. Okay. So this is illustration number 6, sir. We have completed. See, in financial statements of company chapter, sir, after schedule 3, we have one concept called dividend concept, sir. Dividend. Sir, first of all, you tell me what is dividend? Dividend is nothing but the return which is given to the shareholders for their investment in the company. See, generally when I use my resources, when I invest in any place, any securities or any organization, I will expect something in return. Similarly, shareholders, if they invest something, they purchased shares of a company, what they expect? They expect some kind of return. That return is nothing but dividend. See, by using my money, company is doing business. It is the shareholders' money, the company is doing the business. Now, whatever the profits earned by the business, definitely out of that profit, some amount will be distributed to the shareholders. That is basically called dividend. But here, there are some rules, sir. Dividend is not like whatever board of directors decided, how much amount they want to pay, they can give it. No, they have some rules and regulations in the Companies Act relating to dividend, and there are some rules also. Okay. See, whenever a company wants to give dividend, that means a share in the profits to the existing shareholders, what are the conditions they need to follow? First of all, dividend can be given from which profits? Whenever a company wants to give any dividend to shareholders, what are the sources company can use? Company can use current year profits. If company earned any profits in the current year, they can use it. Or company can use what? Past profits. Past profits. These are called what? Accumulated reserves. Accumulated reserves, we call it as. In reserves and surplus, we are seeing the reserves na. In that reserves, free reserves like general reserve, revenue reserve, P&L account, these are all what? Accumulated reserves, past profits. Company can use past profits also. And any combination also okay. That means current year profits plus past profits, both can be utilized. Part of the current year profits, part of the past profit. Sometimes government will give you the funds. Central government, state governments will give any funds to the company. By using that funds also, they can give what? Dividend. But that is not relevant for us. What is the most important thing relevant for us? This one. When the company wants to give dividend from their profits, what are the rules they need to follow? Okay. Now, important. In this, the most important topic is when company earning profits giving dividend, it's okay. No problem. But suppose, sir, company is suffering losses. Company suffering losses. Or earning profits but they are not adequate. But still company wants to give dividend to the shareholders. First of all, when a company earning profits, I mean, first of all, when a company current year they are suffering losses, can they give dividend? Yes, they can if they have past profits, accumulated reserves. If they have, they can give. But there are certain rules relating to it. So whenever a company wants to give dividend from the past profits, because of the current year no profits or inadequate profits, then there are certain rules they need to follow. There are certain rules they need to follow. Sir, what are the rules they need to follow? Those rules we need to learn. So whenever a company gives dividend from past profits, so certain rules are there. By following these rules, company can give dividend from what? Past profits. Sir, what are those rules, sir? Important, sir. First rule number 1, sir, the rate of dividend cannot exceed average rate of the preceding 3 financial years. Average of the last 3 years. So you find out the rate. The dividend rate, the dividend you want to declare cannot exceed that rate. That is the first rule you need to follow. The rate of dividend. The rate of dividend cannot exceed what? Cannot exceed average of the last 3 years, financial years. For example, sir, 24-25 is the current year. 23-24, 22-23, 21-22. Suppose 21-22, 7% dividend company given. 22-23, 12% given. 23-24, they have given 10%. You see. Now current year they want to give dividend 24-25 from the past profits. They want to give dividend from past profits. In the year 24-25, they want to give dividend from the past profits. The rule says it cannot exceed average of the last three. So find out the average. 7 plus 12 plus 10 divided by 3. 29 divided by 3. 29 divided by 3 means 9.7. Or okay, 9.7 approximately. So this is the rate they can give. They cannot exceed more than that. This is the first rule. So the rate of dividend cannot exceed average of the last 3 years dividend. Second rule, sir. The amount to be drawn, the amount to be withdrawn from past profits cannot exceed how much? 1/10 of paid up share capital plus free reserves as per latest audited financial statements. Latest audited financial statements. So take latest audited financial statements, sir. Take share capital, paid up share capital of the company. Take reserves and surplus, free reserves. Combine on that 1/10, 10% you can withdraw from past profits. That is the maximum amount you can withdraw. Okay, this is the important thing. For example, sir, in the company latest audited financial statements, the paid up share capital, equity share capital 100 lakhs is there. Preference share capital 50 lakhs is there. Paid up. Free reserves, general reserve 150 lakhs is there. So total you take 350 lakhs into 10%. 350 lakhs into 10% means 300, sorry. This was 300. So 300 into 10% means 30 lakhs. So this is the maximum amount company can use from the past profits. Suppose here the past profit is what? General reserve. How much is there in general reserve? 150. But I can use maximum how much? 30 lakhs. Sir, these rules are applicable when, sir? When company wants to pay dividend from the past profits. Because current year profits are inadequate or losses. Now, from the past profits, how much amount maximum they can withdraw? The amount to be withdrawn from past profits cannot exceed how much? 1/10 of the paid up share capital plus free reserves as per latest audited financial statements. Next, third rules, what they're saying is the balance in reserves shall not fall below 15% of paid up share capital after such withdrawal. Correct? The balance in reserves shall not fall below 15% of paid up share capital after such withdrawal. Sir, these rules you need to remember, sir. What is this rule? The balance in reserves shall not fall below how much? 15% of the paid up share capital after such withdrawal. That means, for example, you see, your paid up share capital 100 lakhs, sir. On that 15% you apply, how much it will come? 15 lakhs. 15 lakhs coming, sir. That means your balance in reserves, past profit, general reserve, after withdrawing should be at least 15 lakhs. For example, your general reserve balance is 100 lakhs. On this, for example, 30 lakhs you are withdrawing. So what is the balance? 70, which is more than 15 lakhs. So therefore allowed. For example, you see, your general reserve is only 20 lakhs. Suppose if you are withdrawing 10 lakhs from it, how much is the balance left? 10 lakhs. But the 15% of paid up share capital is how much? 15 lakhs. That means the after withdrawing the balance in general reserve is below 15% of paid up share capital, which is not allowed. Therefore, whenever you want to give dividend from the past profits, you need to see how much amount maximum I can withdraw. 1/10 of paid up capital plus free reserves. Next, after withdrawal, minimum the balance should be 15% of paid up capital. All conditions I need to satisfy. It is not that only one condition I will satisfy. All conditions I need to make sure. Hello? My balance in reserves after such withdrawal shall not fall below 15% of the paid up capital. Here they are using the word what, sir? Paid up share capital, not just equity share capital. Paid up share capital means equity plus preference. These are the three main rules, sir. Whenever a company wants to give dividend from past profits, these are the three main rules. First rule, the rate of dividend cannot exceed average of the last 3 years. Second, the balance to be withdrawn from past profits cannot exceed 1/10 of the paid up capital plus free reserves. Third, the balance in reserves after such withdrawal shall not fall below 15% of the paid up share capital as per latest audited financial statements. These three are practical conditions. Apart from these three, there are another two conditions. Next condition is the amount withdrawn shall first utilize it to set off the current year losses, if any. So if there are any current year losses is there, first we need to utilize this amount you want to withdraw from the past profits to set off the current year losses. Then only balance will be utilized for payment of dividend. This is one rule. Now apart from this, there is one more rule, sir. That is, first when you want to give dividend from the past profits, whatever the any carry forward of losses or unabsorbed depreciation is there, first it will be adjusted against the current year profit before declaring the dividend. Suppose past year losses, past year unabsorbed depreciation is there. So in this, whichever is lower, take. First you need to adjust that from the current year profits. Only the balance, if there is a chance there is a profit left out, then you can go for dividend. Otherwise you cannot allow to go for dividend. So see this, whenever a company wants to declare dividend from the past profits, see this, dividend can be declared from accumulated profits from previous years if there are inadequate or no profits in the current year. If there are inadequate profits or no profits in the current year, but still company wants to give a dividend from the past profits, so they can give subject to fulfillment of the following conditions as per company's declaration and payment of dividend rules 2014. What are the rules? First, dividend rate cannot exceed average of the last 3 years rate. Second, the total amount to be drawn from accumulated profits, that means past profits which is eligible for payment of dividend, cannot exceed 1/10 of the paid up capital plus free reserves. Next, the balance of reserves after such withdrawal must not fall below 15% of the paid up share capital, should not fall below 15% of the paid up share capital. And the amount so drawn should first be utilized to set off the losses, if any, in the current year before equity dividends are declared. And the last one, the company must set off the lower of the past losses or unprovided depreciation. Unprovided depreciation means unabsorbed depreciation against the current year profit before declaring a dividend. So that means if company had any past losses, past year losses or unabsorbed depreciation, whichever is lower, first set off against the current year profits, if any, before declaring the dividend to the shareholders. Sir, you need to understand here, you want to give dividend to the shareholders when if current year profits are there but they are not sufficient, adequate. You are understanding this too. Using past profits will come in two situations: when current year completely lost, but still you want to give dividend. Obviously, you need to depend upon past profits, accumulated profits. Second, current year you earned profit, but it is not sufficient. Then also you have to use the past profits. So these rules will applicable in these two cases. Whenever you are utilizing past profits because of the inadequacy of profits or because of the losses of the current year, you are depending upon the past profits. These rules you need to follow. And my suggestion is these three rules you need to remember. Remaining two very easy na. Current year, if there is a losses, first we need to set off. Past losses or unabsorbed depreciation is there, first we need to set off against the current year profits, then only declaration of dividend will be done. That is what they are saying. Okay. But when you are solving the questions, these three you need to apply. Major rules. Hello. Now relating to this, there is a question, sir. I will show you. Come to illustration 1, sir. Illustration 1. You see this question, everybody? Illustration 1. Illustration 1. Due to, I am reading this question, important question, please concentrate. Due to inadequacy of profits. Inadequacy of profits. Inadequacy of profits means company does not earn sufficient profits. For the year ending 31st March 2012, XYZ Limited proposes to declare how much dividend? 10% dividend out of general reserve. See, they want to use general reserve for payment of dividend, 10%. See, 10% dividend. 10% dividend means 10% on the capital, paid up share capital, not 10% on general reserve. Dividend is always calculated on what? Paid up share capital, not on general reserve. We are using general reserve as a source. To pay dividend, we need profits, right? From the following particulars, ascertain the amount that can be utilized from general reserve according to the company's declaration of dividend out of reserve rules 2014. So we need to find out how much amount we can use from general reserve. See the information given. 17,500, 9% preference shares of 100 each fully paid. This company is having what? Preference share 17,50,000. 8 lakhs equity shares of 10 each fully paid 80 lakhs. General reserve as on 1/4/2011 25 lakhs. Opening general reserve. Capital reserve on 1/4/2011 3 lakhs. Revaluation reserve 1/4/2011 3 lakh 50. That means, sir, general reserve is free reserve, sir. Capital reserve is not a free reserve. Revaluation reserve is also not a free reserve. We cannot use it for payment of dividend. What is the net profit for the year ending 31st March 2012? 3 lakhs. The average rate of dividend during the last 3 years has been how much? 12%. See, the average rate is 12%, sir, but company wants to give how much? 10%. That means first rule also satisfied. Okay. Now, first of all, you need to understand what is the amount to, what is the requirement of the question. We need to ascertain the amount that can be utilized from general reserve. How much amount you are going to utilize from general reserve? That is the question. Simple. First of all, what is the equity dividend you want to give? How much is the equity dividend you want to give? 10%. Correct? See this. Logically you understand. Common sense. No need to do anything. So, I want to give 10% equity dividend. Right? 10% of equity dividend, how much you tell me? My equity share capital how much? 80 lakhs. On that 10%. How much? 8 lakhs. Correct? That means to pay equity dividend, I want 8 lakhs. But how much profit is available with me? How much profit available with me? Current year profit is 3 lakhs. Current year profit is 3 lakhs. First I will depend on the current year profit. So my current year profit how much, sir? 3 lakhs. But can I use this 3 lakhs for equity dividend? No, because in the question there is preference dividend. Preference shareholders are there. See, whenever there are preference shareholders, They will get preference over equity shareholders. First, preference shareholders will be paid dividend. Any profits remaining, that will be used to pay the equity shareholders dividend. Here in this question, you see, there is a preference share capital. How much? 17 lakhs 50,000. On that, how much is the preference dividend? 9%. See, this 9% is the dividend. So 17 lakh 50,000 into 9%. 157,500 is the preference dividend. That means from the current year profit, first I will pay preference dividend. 157,500 you pay. How much is the balance remaining? 142,500. That means this is the profit available for payment of equity dividend. So equity dividend I am paying is how much? 8 lakhs. This 8 lakhs first I will meet from the current year profit 142,500. Therefore, how much is the balance I required? 6,57,500 is the balance I required now. This I will use from what? Past profits. Past profit means general reserve. So therefore, the amount to be withdrawn, amount required is 657,500. First you understand this. First of all, equity dividend, how much they want to give? 8. And what is the current year profit available? 3. You cannot use entire 3 lakhs for equity dividend. First you need to give preference dividend because there is a preference share capital. After that 142,500 left. That means my equity dividend 8 lakhs, 142,500 I will met with current year profit. Remaining I will depend upon the past profits. Now from the past profit, how much amount I can withdraw? How much amount I want to withdraw? 657,500. But is this allowed or not? We need to check. In that 5 rules I told. Rule number 1 is what? Rate of dividend. That is already satisfied. Now come to rule number 2. What is rule number 2? The amount I can withdraw from the past profits, in this case general reserve, cannot exceed 1/10 of paid up share capital plus free reserves. Check the paid up share capital of the company. What is the paid up share capital? Preference 17 lakh 50, equity 80 lakhs. So total 97 lakh 50,000 is paid up share capital plus free reserves. Check free reserves. Only general reserve is the free reserve. Capital reserve, revaluation reserve is not free reserves. How much? 25 lakhs. 25 lakhs. Sir, you cannot take P&L account, sir. Some students, what they are doing now, free reserves means general reserve and also P&L account, 3 lakhs. No. Why no? Because current year profits already exhausted. Here we are finding how much amount we withdraw from the past profits. That's why when it comes to free reserves, consider only the existing free reserves apart from the current year profits. So therefore, on this 1/10 you apply. How much you got? 12 lakhs? 25,000. Sir, this much I can withdraw, sir. But I am withdrawing how much, sir? 657,500. So 12,25,000 I can withdraw, sir. But I am withdrawing only 6,57,500. Therefore, rule 2 is also satisfied. Because as per law, I am eligible to withdraw 1/10 of the paid up capital plus free reserves. But here I am withdrawing only 657,500. Now, next rule. Rule number 3. What rule number 3 says? The balance and reserves after such withdrawal shall not fall below 15% of the paid up capital. What is the general reserve balance, sir? 25. From this, if I withdraw 657,500, what is the balance? 1842,500 is there. Take paid up share capital. Paid up share capital means 97 lakh 50. Both equity plus preference. Correct? 97 lakh 50,000. On that 15% apply. 1462,500 minimum should be there in general reserve after such withdrawal. But after withdrawal, how much is there? 1842,500. So my general reserve 25. I am withdrawing this much. Therefore, the balance is 1842,500, which is more than 15% of the paid up share capital. Therefore, rule 3 is also satisfied. Therefore, company is eligible to withdraw 6,57,500. 6,57,500 company can withdraw. This is the answer. So look at the answer, everybody. First, they have ascertained how much amount they can withdraw from reserves for 10% dividend. So first equity dividend 8 lakhs. Current year profit 3. Give preference dividend first. Remaining balance you use for equity dividend. So still we require 657,500. Whether this is allowed or not, check. Condition number 1. Since 10% we want to give, we lower than the average rate of dividend 12%, 10% dividend can be declared. Rule number 1 satisfied. Condition number 2. The maximum amount that can be drawn from the accumulated profits and reserves should not exceed 10% of the paid up capital plus free reserves, which is nothing but 12,25,000. And we are withdrawing only 657,500. So therefore, rule number 2 is also satisfied. Rule number 3. The balance of reserves after withdrawal is how much? 18,42,500, which shall not fall below 15% of the paid up capital, which is only 14,62,500. That means balance in reserves is much more than 15% of paid up share capital. So since all the 3 conditions are satisfied, the company can withdraw 6,57,500 from accumulated reserves. So this is the answer, sir. So these type of questions they are asking in the examinations are very simple. So you understand the concept? Hello? So therefore, whenever a company wants to give dividend from the past profits, what are the rules they need to satisfy? 3 rules. Practical rules are 3. So by following those rules, how much amount we can withdraw? We can withdraw. Next, sir, illustration number 3 in study material. See this illustration, everybody. Very simple one. You are required to prepare balance sheet and P&L account from the following trial balance of Haria Chemicals Limited for the year ending 31st March 2011. So trial balance given, sir, on 31st March 2011. So debit side totals, debit side items, credit side items given. Okay. Now look at inventory given 6,80,000. See in the additional information, closing inventory given 8,23,000. Closing inventory will come in balance sheet. Current assets inventories. This inventory is which inventory? Opening. Furniture, PPE. Hello? Discount debit balance means discount received or discount given? Given. Loss. Discount allowed. Nothing but. Which will go to P&L account, other expenses. Loan to directors. Loans and advances given either long term or short term. Advertisement, other expenses. Bad debts, other expenses. Commission, other expenses. Metal consumed, cost of metal consumed, P&L account. Correct? Plant and machinery, rentals, other expenses. Current account, cash and cash equivalents, nothing but. Business people will have current account, cash and cash equivalents. Interest on bank loans, finance cost. Hello? Finance cost, sir, P&L account, expenses. Preliminary expenses, other expenses. Fixtures, PP. Wages, employee benefit expenses, P&L. Employee benefit expenses. Consumables, inventories 84,000 consumables. Inventories, materials, supplies, consumables can be considered as what? Inventory. Freehold land, PP. Tools and equipment, PB. Goodwill, intangible asset. Trade receivables, current assets. Dealer aid, to our dealers we will provide any, so aids. Aid means help, kind of some. Dealer aid, transit insurance, trade expenses, these are all distribution freight, these are all what, sir? Other expenses. Correct? Debenture interest, finance cost. Now come to credit side, equity share capital, shareholders fund share capital. Debentures, long term borrowings. Bank loan, long term borrowings. Trade payables, current liabilities, trade payables. Sales, revenue from operations. Rent received, other income. Transfer fees, other income. P&L account, reserves and surplus. Depreciation provision deducted from the machinery value. Correct? Provision depreciation. Now look at the first balance sheet we will present. So what items will come in balance sheet? Shareholders funds, share capital, reserves and surplus. Any money received against share warrant? Not there. Next, non-current money, share application money pending allotment, not there. Next, non-current liabilities. In non-current liabilities, long-term borrowings is there? Yes. Next, deferred tax liabilities, other long-term liabilities, long-term provisions, not there. Next, current liabilities, short-term borrowings, not there. Then trade payables, there. Other current liabilities, not there. Short-term provisions, not there. Asset side, PP is there, intangible assets is there. Current assets, we have inventories, trade receivables, cash and bank balances, short-term loans and advances. Short-term loans and advances is there. Loan to directors. So look at, come to P&L account, sir. Revenue from operations is there, na? Revenue from operations, sales is there. How much? 42 lakhs 68,000. See this. 4268 you take revenue from operations. Next, other income, we have two other incomes. What are those? Rent, transfer fees. Correct? Rent received, transfer fees. 46 to 10. 56,000. Correct? Now expenses side, you see, materials consumed is there, na? Consumption given. How much is the consumption in materials? 19,000. See this, 19,000 consumption is there. Next, change in inventories of finished goods. That is difference between opening and closing. Closing inventory, how much, sir? 8,23,000. Opening inventory, 6,80,000. What is the difference? 1,43,000. See this, 1,43,000. Minus 1,43,000. Opening minus closing. Closing is more than opening, I told you. Opening minus closing means minus 1,43,000. So minus minus plus. That means it will increases my profits. Next, employee benefit expenses. I told now employee benefit expenses, I think wages is there. How much is their wages? 9 lakh rupees is there. Any other item? Not it. Only one. 9 lakhs. Finance cost. Two finance costs, sir. One is interest on bank loans, 1,16,000. Debenture interest, 55. Add both, 1,71,000. See this, interest on bank loans, interest on debenture interest. Both will come under finance cost. Okay. Next, remaining all other expenses. What items will come in other expenses? Dealer aids, transit insurance, trade expenses, distribution, freight. Add these four. Consumables, 84,000. Preliminary expenses, discount, advertisement, bad debts, commission, all these items. So other expenses, you see what items is there. Other expenses, consumables 84,000, preliminary expenses 10,000, bad debts 35, discount 40, rentals 25, commission 1,20,000, advertisement 20,000, dealer side 21, transit insurance, trade expenses, distribution freight. Sir, here consumables they have considered as a part of other expenses, sir. But as per accounting standard 2, any materials, supplies, consumables can be considered as inventory also. Can be considered as inventory also. So here maybe their assumption is that this is not inventory. This is not inventory. Because as per AS2, what is inventory? Inventories are assets held for sale in the ordinary course of the business, in the process of production for such sale, or in the process of production for such sale, any materials, consumables, supplies to be consumed in production or supplying of those goods and services. That is also covered. That means raw material. So generally these any consumables we will consume in the production process, they can be qualified as inventories also. But maybe they have not considered it as a part of inventory. That's why they have considered in other expenses. Okay. Next, sir. Other expenses. Then you will get 6 lakhs 1,000. Any provision for tax given? Nothing. So this is P&L. Next, come to balance sheet, sir. First one is what? Share capital, right? Share capital. Any authorized capital given? No. 25 lakhs is there. Any calls in arrears? Nothing. Face value 10. So 2,50,000 equity shares of 10 each. Issued, subscribed, called up capital. Equity shares of 10 each. They have taken authorized also, because they assumed that whatever the shares issued, that is only authorized. But no need to write, sir. No need to write. In this problem they have written. They assumed that whatever the shares issued, that is only authorized. Issued and subscribed, equity shares of 10 each. Please add fully paid up. Fully paid up. And that too, here when you are pressing issued, subscribed and paid up share capital, you write paid up share capital. Okay. Next, reserves and surplus, sir. What is the opening balance? How much given? 1 lakh 39. Current year profit 6 lakhs 1. Total 7 lakh 40. Long term borrowings, we have debentures, bank loans. Hello? Debentures is there. How much is there? Debentures 5 lakhs. And this bank loan is also there now. 6 lakhs 45. That is also assumed as long term borrowings. Now PP, you see, PP. What items are there in PP? In PPE, we have freehold property, freehold land, tools and equipment, and then fixtures is there. Furniture is also there. So these are the items. And there is a accumulated depreciation against machinery. So all these items will come in PP. See this. Freehold land, 5 lakh, 15 lakh 46,000. Correct? Furniture, 2 lakhs. Fixtures, 3 lakhs. Plant and machinery, how much given? 8 lakhs 60. Minus accumulated tools, 2 lakh 45. Sir, plant and machinery 8 lakh 60 minus accumulated depreciation, we need to do. Accumulated depreciation how much? 1 lakh? Here some presentation mistake is there. Plant and machinery 8 lakh 60, sir. From this less provision for depreciation 1 lakh 46. Deduct it, sir. How much you got? 7 lakh 40. That's what they have taken. Okay. Next to lose tools and equipment 2 lakh 45. Depreciation is there only for machinery. That is only considered. Next, cash and cash equivalents. Current account balance cash. Other bank balance is nil. Short term, so loans to directors they have considered as what? Short term loans and advance. You can consider them as a long term also. Here the assumption, that's it. Other income, rent to transfer fees. Change in inventories, opening stock, closing stock difference. Employee welfare, employee benefit expenses, wages. So there is nothing great in this question, sir. Very simple question. Share capital, reserves and surplus, long term borrowings, trade payables directly they have taken. PPE, intangibles, goodwill is there directly. Inventories directly we can take. Inventory 8 lakhs 23,000. Yes, closing 8 lakhs 23,000. Trade receivables also 4 lakh 40 directly available. Trade receivables 4 lakh 40. Take it. Cash and bank balance 53. Short term loans and advances to directors 80,000. What is there? What is the difficult point in this question? Nothing. Everything is simple only. No adjustments also. But you need to remember in the additional information closing stock given. So obviously this will be opening stock. So the difference between opening and closing will come in P&L account as change in inventories. Except that everything is simple only. And consumables. Consumables they consider as a other expenses. That's it, pa. Remaining nothing is there in this question. Very simple illustration. Okay. You practice, I mean no need to practice also, just writing it, format and just copy pasting the items. There is nothing. These type of questions don't expect in examinations. They don't ask. Just it is there in the study material, just I am referring it. That's it. Come to scenario based question 7. See this question everybody. On 31st March 2011, sir, Bose and Sain Limited provides to you the following ledger balances after preparing P&L account. Sir, this is after P&L account prepared for the year ending 31st March 2011. So after preparation of P&L account, these are the balances available, sir. So they are asking what? You need to prepare balance sheet as per schedule 3. Okay. Now look at the credit balances. Equity share capital, fully paid shares of 10 each. Shareholders fund, share capital. General reserve, reserves and surplus. Loan from state financial corporation. But you see, don't come to conclusion. Secured by hypothecation of plant and machinery, repayable within 1 year. That means it is short term borrowings. Current maturities of long term borrowings. Here clearly given it is repayable within 1 year. See, but not entire amount. 10,50,000 is what? 2 lakhs is repayable within 1 year. That means remaining 8,50,000 long term borrowings. Unsecured loans, long term borrowings. Correct? So this 2 lakhs is a short term borrowing, sir. Remaining will be long term borrowings. So this one long term borrowings. Creditors for goods and expenses. Trade payables, which is payable within 6 months. P&L account, reserves and surplus. Provision for taxation, short term provisions. Now come to debit balances. Calls in arrears deducted from called up capital. Hello? Called up share capital. Land, PP. Building, PP. Plant and machinery, PP. Furniture, PP. Inventories, finished goods, raw material. Closing stock, nothing but. Hello? Inventories. Trade receivables, current assets, trade receivables. Advances, short term. Debit balance means asset, right? Short term loans and advances. Cash in hand, cash and cash equivalents. Balance with bank, cash and cash equivalent. Preliminary expenses, other expenses. Patent and trademarks, intangible assets. Intangible assets. Following additional information is also provided in respect of the above balances. Some additional information they have given, sir. What is the additional information they have given? See this. 4,20,000 fully paid equity shares are allotted for consideration for land and buildings. What is this? Shares issued for consideration other than cash. When shares are issued for consideration other than cash, we need to provide a note as per schedule 3. We have already discussed in some questions. So here we need to clearly write the shares are issued. 4,20,000 shares are issued for consideration other than cash. Cost of the building, 28 lakhs. Cost of plant and machinery, 49. Cost of furniture and fixtures, 4,37,500. See here cost given. But in the balance sheet what they have given? WDV. Correct? The difference is what? Depreciation. In one question we have done it. Next. Trade receivables for 3,80,000 are due for more than 6 months. So we need to disclose separately. Debtors, trade receivables outstanding for a period exceeding 6 months separately, remaining debtors separately. Notes to aging schedule like. Next, the amount of balance with bank includes 18,000 with bank, which is not a scheduled bank. The deposit of 5 lakhs are to be for a period of 9 months. Sir, amount of bank balance with scheduled bank or non-scheduled bank. We need to give a breakup. Unsecured loan includes 2 lakhs from bank, 1 lakh from related parties. So disclose separately. Give a breakup. Entire amount of preliminary expenses is to be written off by adjusting from opening balance of general reserve. So whatever the preliminary expenses is there, we need to adjust to opening balance of general reserve. Only remaining general reserve will be considered. That means our reserves and surplus will be affected. That means here preliminary expenses will be adjusted against the opening balance of general reserve. You are not required to give previous year figures. You are required to prepare balance sheet of the company as per schedule 3. Tell me how you are going to prepare. First you will start with the format. What is the equity and liabilities? First, shareholders fund. Share capital 1, note 1. Second, reserves and surplus, note 2. Next, money received against share warrants, there are not there. Next, share application money pending allotment, there are no. Next, non-current liabilities, long-term borrowings is there. Yes, what are those? Loan from state financial corporation is there, and also unsecured loan is there. Correct? Next, any deferred tax liabilities? No. Other long-term liabilities? No. Long-term provisions? No. Come to current liabilities. In current liabilities, short-term borrowings is there. Short-term borrowings is there. What is there in short-term borrowings? Yes, this is payable within next 1 year, 2 lakhs. Current maturities of long-term loan from state financial corporation, that will come in short-term borrowings. Next, trade payables, there. Next, other current liabilities is there? No. Short-term provisions is there? What is there in short-term provisions? Provision for taxation. Next, asset side, non-current assets, PP is there? Yes. Intangible assets is there? Yes. Non-current investments is there? No. No. Investments not there. Next, deferred tax assets? No. Long-term loans and advances? No. Other non-current assets? No. Current assets, first one, current investments, not there. Next, inventories is there. Trade receivables is there. Cash and cash equivalents is there. Other current assets, short-term loans and advances is there. There. And then other current assets not there. So first you write down the format. See, this is what. You see, this question is not new, sir. No new point. Everything is clearly given in the question itself. So see this. Bose and Sen, balance sheet as on 31st March 2011. Particulars, notes. So equity and liabilities, shareholders fund, share capital, reserves and surplus, note 1 and 2, sir. Non-current liabilities, we have long-term borrowings, note 3, sir. Current liabilities, we have trade payables, short-term borrowings, short-term provisions. Here presentation not happened properly. First we need to show short-term borrowings first. This is A. Then trade payables B. Then short-term provisions C. Hello? See, this is A. This is B. This is C. Short-term provisions. And asset side, you see non-current assets, PP, intangible assets. Current assets, inventories, trade receivables, cash and bank balances, short-term loans and advances. Now first, if I present one by one, share capital. What is the share capital given, sir? 70 lakhs given. Each share 10 rupees. That means how many shares? 7 lakhs. So 7 lakhs equity shares of 10 each. See this. 7 lakhs equity shares of 10 each. But the most important thing is, see, first presentation, equity share capital issued, subscribed and called up. Because calls in arrears is there. Calls in arrears is there, na? Hello? And now the note also, you see, out of the above, 4,20,000 shares are issued for consideration other than cash. As per schedule 3, if any shares are issued for consideration other than cash, we need to present separately. See here in the additional information, first point only they said 4,20,000 shares are issued for consideration other than cash. So therefore, we need to mention note as per schedule 3. And there is a calls in arrears also given, sir. You check calls in arrears is there. See this. 7,000. Sir, whenever calls in arrears given, sir, first you write issued, subscribed, called up. From that you reduce calls in arrears, then you will get the paid up share capital. 69,93,000. This will be written in balance sheet. Next, come to reserves and surplus. In reserves and surplus, sir, we have general reserve is there 15, 49, 100. Correct? P&L account is there 7 lakhs. Sir, from this 15, 49, 100, we need to adjust what? Preliminary expenses. How much is the preliminary expenses? 93,100. So from the general reserve 15, 49, 100, adjust preliminary expenses, you will get the balance. P&L account as usually 7 lakhs you take. No other adjustments. So 21 lakh 56,000. Very simple. Next to non-current liabilities, we have long-term borrowings. So long-term borrowings, what are the items we had, sir? Loan from State Financial Corporation 10 lakh 50 is there. In that 2 lakhs is payable in the next 12 months. That means what is the balance? 8 lakh 50. And unsecured loans 8 lakh 47. But in this 8 lakh 47 they have given a breakup. 2 lakhs from bank, 1 lakh from related parties. So therefore if you see the breakups here, long-term borrowings you see. Secured. Because in the question clearly said that loan from State Financial Corporation is secured. And schedule 3 says whenever any loan is secured, we need to mention nature of security. So see this. That's why secured by hypothecation of plant and machinery. I have written, we solved one question also. So see this. Loan from State Financial Corporation, 8 lakh 50 they have taken. From 10 lakh 50 you reduce 2 lakhs. Because this 2 lakhs is what which is payable in the next 12 months. Therefore it will come in short-term borrowing. See this. Short-term borrowing, current maturities of long-term debt loan. Repayable within 1 year. Important. So your long-term loan from State Financial Corporation 10 lakh 50, sir. In that 10 lakh 50, 2 lakhs is payable in the next 12 months. We'll go to short-term borrowings. 8 lakh 50,000 will be there as long-term borrowings. Unsecured, sir. Bank loan, loan from related parties. Others. Sir, total unsecured loan how much, sir? See this. Unsecured loan total 8 lakh 47. Correct? In this 8 lakh 47, unsecured loan includes 2 lakhs from bank, 1 lakh from related parties. So 8 lakh 47 minus 3 lakhs. That means other unsecured loans how much? This one 5,47,000. This is balancing figure. We know total 8,47,000. Loan from bank given in the question. Loan from related parties given. Remaining balancing figure. Hello? 16,97,000. Now trade payables. I think given in the question 14 lakhs. Trade payables. See this 14 lakhs directly given. Take it. Next. Short-term borrowings. First we need to write actually short-term borrowings. See here current liability is not properly presented. I will do it. What is the problem number? This is scenario based question 7 sir. In that please adjust current liabilities. So current liabilities first short-term borrowings. Correct? What will come in short-term borrowings? Loan from State Financial Corporation. How much? 2 lakhs. Hello? 2 lakhs you take. Any note given? Note given. Short-term borrowing. See this. Current maturity is 2 lakhs. And then next, trade payables. Trade payables how much, sir? Trade payables given. How much? 14 lakhs. And then short-term provisions. Short-term provisions means provision for taxation. How much, sir? 8,16,900. Actually, this order it should come, sir. Please change. 14 lakhs, 2 lakhs, 8,16,900. Actually, first 2 lakhs should come. 2 lakhs. This is the first priority because short-term borrowing should come first. Hello. In current liability, short-term borrowing should come first. Please understand. This is the first priority. This is A. This is B. This is C. This means short-term provisions is C. Okay, so total. Now asset side PP na. PP what items are there? Cost given na. Cost of building 28, plant and machinery 49, cost of furniture 4,37,500. These are cost. In balance sheet I need to show WDV. So in the trial balance after preparing P&L account means depreciation is automatically adjusted na. Hello? So after adjustment this is the thing. Land, buildings, plant and machinery, furniture and fixtures. So difference is nothing but depreciation. Show the cost. Show the WDV. WDV will come in balance sheet total. Difference is nothing but depreciation. But presentation you need to do like this. See this. Presentation how they are doing. Some students what they are doing, they are directly taking WDV. Wrong here. Learn presentation. See this. Property, plant, equipment. Land. Actually it was mixed. Land alone 14 lakhs. Next buildings 28 lakhs. Depreciation on building 7,50,000. How we got? Because 20,50,000 is given in trial balance. Check building. Hello. The cost is how much? 28. 28 lakhs cost has become 20,50,000 means current year depreciation 7,50,000. Same type, same manner I have done one question. Same thing. Plant and machinery. What is the cost? 49 lakhs. WDV 36 lakhs 775. Balancing figure is this. Furniture and fittings cost 4,37,500. WDV 3,50,000. So current year depreciation 87,500. Sir, these are all just a repetition of what we have solved. So these are all. You need to practice them. We don't waste our time on the same things repeating again and again. Because similar problems we already solved. You practice them when you have a time. Next, sir, once PP is over, intangible items. Sir, intangible assets, what are there in the question? Intangible assets, sir, debit side you see. Yeah, last one, patents and trademarks is there, 4 lakhs. So take them, 4 lakhs here. Next, current assets, inventories. So inventories we had what? So finished goods as well as raw material. Both of them, 14, 3,50,000. So 17,50,000, sir. Breakup also available. Trade receivables. Total trade receivables 14 lakhs. Trade receivables 14. But in the additional information they said that trade receivables outstanding for a period exceeding 3,80,000. Give a breakup. So note number 8 you go. Note number 8 they are telling. See this. Outstanding for a period exceeding 6 months. other debts. This is the balancing figure. Similarly, inventories, raw material, finished goods. Okay, and the last one is what, sir? Cash and cash equivalents, 9. So cash and cash equivalents, if you see, 19,39,000, give a breakup. Cash at bank with scheduled banks, 12,18,000, with others, 18,000. Cash in hand, 2 lakh. Other bank balances, deposits for a period of 9 months, 5 lakhs. See, actually in the additional information, they clearly mentioned, sir. See this. Actually, total cash in hand, 2,10,000. Cash at bank, 17,29,000. This 17,29,000, the amount of balance with bank include 18,000 with a bank which is not a scheduled bank. And deposit of 5 lakhs is for a period of 9 months. So therefore, what they have done is total 17,29,000, sir. See this. Total bank balance 17,29,000. Right? In this 17,29,000, 5 lakhs is what, sir? Bank deposits for a period of 9 months. They separated it. So what is the remaining? 12,29,000. This 12,29,000, how much is there with scheduled banks? 18,000. Remaining is how much is there with scheduled banks? 12,11,000. Obviously with others, 18,000. Hello? So this 5 lakhs which is there in the deposit, this is also bank balance, but they're presented separately. Please understand. Total 17,39,000 pa. They presented separately. A cash in hand, where they have presented? This one, right? 2,10,000. Correct? That's it, pa. Based on the information, you segregate, pa. How much is cash balance with the bank, with scheduled bank, with non-scheduled bank? How much is there in the form of deposits? How much is cash in hand? Like that. And then short-term loans and advances we got. How much is there in short-term loans and advances? Short-term loans and advances given by the company. Loans and advances, sir. 2,98,900. Take it, 2,98,900. So in this question, what is the new point? Nothing. Nothing, no new point according to me. For you, if any new point is there, nothing. Bank point easy only, na? You need to present separately whatever they have given. Just improvement. Preliminary expenses adjusted with general reserve. That's it, pa. Preliminary expenses adjusted with general reserve we need to do, so we have done it. That's it. So this is scenario based question 7, sir. One theoretical question is given in financial statements of company, sir. See this question. State under which head these accounts will be classified in balance sheet as per schedule 3. As per schedule 3, you need to classify where will you show them in balance sheet. First, share application money received in excess of issued share capital. Sir, share application money received in excess of issued share capital. Anything you received in excess. So for example, we issued a shares for 1 lakh shares, but public subscribed 1,05,000. That means 5,000 shares extra application money received must be refunded back. So therefore, share application money due for refund, where it will come? Other current liabilities. So it will be other current liabilities. See this, important, sir. Most of the students are not interpreting it properly. Anything you received in excess of issued share capital, company cannot allot, na? Hello? If company went for 1 lakh shares, public issue, only 1 lakh shares application money has to be, they have to consider it as share capital. Anything in excess definitely has to be refunded back. Next, share option outstanding account. I told you, share option outstanding account, where will you show? Reserves and surplus. Important, sir. I told you, at that time I told that point also. The moment you see outstanding, most of the students believe it is other current liability, which is wrong. Share option outstanding account will come in reserves and surplus. This one also we discussed. Unpaid maturity debentures and interest accrued thereon. Other current liabilities. You remember that? Unpaid maturity deposits and interest accrued thereon. Unpaid maturity debentures and interest accrued thereon will come in OCL. Other current liabilities. Important. Actually, this is also. Next, uncalled liability on shares and other partly paid investment. This also I told. Commitment. uncalled liability on shares and other partly paid investments. We need to see from company point of view. Company makes some investments. When company made some investment, na sir, so in respect of those investment, whenever the other party calls the amount, we need to pay. So those are uncalled liability on shares and other partly paid investments. So they are considered as what? Contingent liabilities and commitments. Sir, here also most of the students are wrongly interpreting this question. They are thinking this is calls in arrears. No sir, read carefully. This is uncalled liability on shares and other partly paid investments. That means these are the investments made by the company. Whenever you invest in any shares or debentures, you need to pay the amount when the other party calls. So whatever the amount still not paid because they are not called by the other party, they are called commitments. That's why contingent liabilities and commitments. In future, when you make investment, then it will become your asset. Till that time, it is considered as contingent liabilities and commitments. Commitments. Basically, it is what? Commitment. Next, calls unpaid. Calls unpaid means calls in arrears. Calls in arrears, what we will do? We will deduct from the called up capital. Correct? See, shareholders funds, share capital. Here you add deducted from called up capital. Deducted from called up capital. So from called up capital you deduct, sir, then you will get it. Last one, money received against share warrant. Where will you show? Shareholders fund. In shareholders fund, share capital, reserves and surplus, money received against share warrant. Separate item is there. So in this question, some good items are there. Please see this question carefully. So this is the one and only theory question we had, sir. Okay, sir. Next, from financial statements of company chapter, scenario based question 10, SR limited question. This question asked in recent examination also. Okay. See this question, everybody. On 31st March 2011, SR Limited provides the following ledger balances after preparing its P&L account for the year ending 31st March 2011. After preparing of trial balance, P&L account, this is the trial balance extract they have given, sir. Ledger accounts balances they have given. Debit to credit to. Equity share capital, fully paid shares of 50 each, 80 lakhs. Calls in arrears, 15,000. Tell me what to do. Calls in arrears, deducted from the called up capital. Then you will get the paid up capital, correct? Land, PPE. Buildings, PPE. Plant and machinery, PPE. Furniture and fixtures, PPE. Securities premium, reserves and surplus. General reserve, reserves and surplus. P&L account, reserves and surplus. Next, loan from public financial corporation secured by hypothecation of land. Long-term borrowings. Long-term borrowings. But we need to see whether any breakup given in respect of this. We need to see, sir. So generally loan from public financial corporation, long-term borrowings. Other long-term loans, long-term borrowings. Short-term borrowings, short-term borrowings in current liabilities. Inventories, finished goods, raw material, current assets, inventories. Trade receivables, current assets, trade receivables. Advances, short-term is there. Current assets, short-term loans and advances. Next, trade payables, current liabilities, trade payables. Provision for tax, short-term provisions. Unpaid dividend, other current liabilities. Very good. Other current liabilities. Cash in hand, cash and cash equivalents. Balance with banks, cash and cash equivalents. This is the trial balance they have given, sir. Look at the additional information. Following additional information was also provided in respect of the above balances. Additional information means these items are not yet adjusted. We need to adjust now. Okay. First point, 50,000 fully paid up equity shares are allotted as consideration for land. That means shares are issued for consideration other than cash. When shares are issued for consideration other than cash, what schedule 3 says? We need to disclose aggregate number, class of shares. We have done some questions also. Next, the cost of the assets given, sir. Building, plant and machinery, furniture and fixtures, cost given. Trial balance, WDV. Trial balance, what is appearing? WDV. The difference between cost and WDV is depreciation. So when you present in the balance sheet, cost less depreciation, WDV we will show. I think we have done this kind of questions. Next, trade receivables for 4,86,000 due for more than 6 months. Separate disclosures as per schedule 3. Debtors outstanding for a period exceeding 6 months. Next, balances with bank include 56,000. The Naya bank, which is not a scheduled bank. This also already came. Balance with banks, with the scheduled bank, other banks other than scheduled banks. We need to give a breakup like that in the notes to accounts. Next, loan from public financial corporation repayable after 3 years. So it's a long term. Next, the balance of 26,30,000 in the loan account with public financial corporation is inclusive of 1,34,000 for interest accrued but not due. The loan is secured by hypothecation of land. Sir, loan from state financial corporation, how much is there? 26,30,000. In this 26,30,000, 1,34,000 included. What is that? Interest accrued but not due. Where it will come? Other current liabilities. Already this point came. One question, we have done it. Loan from state financial corporation. So from this 26,30,000, 1,34,000 will be shown in OCL, other current liabilities, in current liabilities. Only remaining balance will be shown in what? Long-term borrowings. Next, other long-term loans unsecured includes loan taken from Nexus Bank 13,80,000, amount repayable within 1 year 4,80,000. Important, sir. Sir, can you tell me what is the total other long-term loan given in the trial balance? Total other long-term loan 22 lakhs. 22,50,000 given, sir. This is the breakup is giving. In this, loan taken from Nexus Bank is how much? 13,80,000. In this 13,80,000, how much is payable within 1 year? 4,80,000. Current maturities of long-term debt, where it will come? Current maturities of long-term borrowing, short-term borrowings. Short-term borrowings, very good. Short-term borrowings it will come. So in this 13,80,000, sir, 4,80,000 show in short-term borrowings. Remaining long-term borrowings. Hello? And loan taken from directors, 8,50,000. So can you tell me what is the balance? 22,50,000 minus 13,80,000 minus 18,50,000. 20,000 balance is there. Correct? Total other long-term loan 22,50,000. The breakup given, loan from Nexus Bank 13,80,000, loan taken from directors 8,50,000. What is the balance? 20,000. What is this? Others. Other loans. Like this we need to give a breakup in the notes to accounts. Okay. Next, bills receivable 1,60,000 maturing on 15th June 2011 has been discounted. Sir, we need to prepare financial statements for the year ending 31st March 2011. This is the year end for which we need to prepare the financial statements. Correct? Now you see here, there is one bill, sir, amount 1,60,000. When it is maturing, sir? 15 June 2011, next year. Has been discounted. That means on 31st March, bills discounted but not yet matured. So we discounted the bill with bank on maturity date. If the drawee honors the bill, we are not liable. If drawee doesn't honor, we need to pay the liability. Therefore, a liability may come, may not come. Right now, we can't say. So it is a contingent liability. Bills discounted but not yet matured is a contingent liability. See, on 31st March already bill we discounted it. Sir, bill discounted means first I will draw bill on you. For example, I supplied goods to you. You are my debtor. I draw a bill. You accepted. So it is bills receivable. That bill I discounted with the bank. On the due date, you need to honor the bill. If you don't honor, I need to honor. So a liability may come, may not come. Right now, contingent. So contingent liability. Contingent liability, will it come in financial statements? No, I told you, only notes to accounts. Next, short-term borrowings given, sir, includes loan from Naya Bank, 1,16,000, loan from directors, 48,000. What is the total short-term borrowings amount given? Look at the trial balance and tell me. 4,60,000. In this 4,60,000, breakup you see, 1,16,000, 48,000. What is the balance? 2,96,000. What is this? Others. Balancing figure, others. See, this breakup you should give in the examination while solving the question, notes to accounts. Next, transfer of 35,000 to general reserve. Transfer of 35,000 to general reserve has been proposed by the board of directors out of the profits for the year. So from the current year profits, we need to transfer 35,000 to general reserve. So from P&L we reduce 35. This 35,000 will add to general reserve. Correct? Next, inventories of finished goods includes loose tools costing 5 lakhs, which do not meet the definition of PPE as per A10. So loose tools, if they have not meet the definition of PPE, they will be classified as at inventory. So therefore, this 5 lakhs already included in finished goods. So they will be considered as inventory only. But we need to write separately. Total finished goods, how much? I think 10 lakhs given. Finished goods, how much given? So look at the trial balance. Finished goods, how much given? 45 lakhs. Correct? In this 45 lakhs, 5 lakhs is loose tools. Remaining 40 lakhs will show as a finished goods. You are required to prepare balance sheet under part 1 of schedule 3. You are not required to give any previous year figures. Sir, I want only what, sir? Balance sheet. No other thing is required. So tell me here, based on the information given, when I start preparing balance sheet, shareholders funds, share capital note 1, reserves and surplus note 2, next money received against share warrants not there, share application money pending allotment not there, then non-current liabilities, long-term borrowings is there, next deferred tax liabilities not there, other long-term liabilities not there, long-term provisions not there, next current liabilities, other long-term liabilities is there. What is that? Other long-term loans. Hey, that will be included as a part of long-term borrowings only. Don't see other means only other. That is other long-term liabilities means other than borrowings. Other than borrowings, then they will come there. Next, I think current liabilities. In current liabilities, we have short-term borrowings there, trade payables there, other current liabilities there, interest accrued but not due, short-term provisions, provision for tax is there. Now asset side you see, non-current assets, PPE there, intangible assets not there. Next, non-current investments not there, deferred tax assets not there, long-term loans and advances, any long-term loans and advances not there. There long-term not there. Other non-current assets also not there. Now come to current assets. Current assets, current investments not there. Inventories is there, trade receivables is there, cash and cash equivalent is there, short-term loans and advances is there. Other current assets not there. Sir, like this you need to analyze, sir, in examination also. You know, by this time you should know what items frequently will come. Share capital, reserves and surplus, long-term borrowings. In current liabilities, trade payables, what is that? Short-term provisions. Asset side, PPE will come definitely, and then non-current assets. Current assets definitely inventories, trade receivables, cash and cash equivalents. That's it. Short-term loans and advances. These are the items only frequently will come. Okay. So we'll do this question, sir. Let us start doing this because this is an examination question. We'll practice this. Come on, everybody. What is the question number? Can you tell me? SBQ 10. So what is the name of the company? SR Limited. Balance sheet as on 31st March 2011, right? Particulars, note number, amount. Amount normal rupees in lakhs. Normal only, ra? Yes. So first we'll start with what? Equity and liabilities. In equity and liabilities, first shareholders funds, correct? Shareholders funds. In shareholders funds, share capital, note 1. Next to reserves and surplus, note number 2. Next to non-current liabilities, we have long-term borrowings, note number 3. Next, current liabilities. In current liabilities, short-term borrowings is there. Next, trade payables is there. Next, other current liabilities is there. Next, short-term provisions also there. Short-term borrowings, note number 4. Trade payables I can write directly. Can you tell me trade payables amount? I think trade payables is 8 lakhs. 8 lakhs 13,000 trade payables. How much are trade payables? 8 lakhs 13,000. Next, OCL, other current liabilities. Interest accrued but not due. And then short term provisions, I think we have provision for tax, 6. So total. So therefore, one side is done, sir, equity and liabilities. Next, asset side. Part 2, assets. Asset side, first non-current assets are. In non-current assets, BP is there. That's it. We don't have any other non-current asset. Give 7. Next, current assets. In current assets, inventories is there. For this, give 8. Trade receivables is there. Give 9 because debtors outstanding for a period exceeding 6 months is there. So we need to show separately. So we will prepare notes to accounts. Next, sir, cash and cash equivalents. 10 you give. And then short term loans and advances. I think short term loans and advances there directly. How much, sir? 3 lakhs 75,000. Correct? Short term loans and advances. That's it, sir. I think total. Other current assets not there. So total 10 notes to accounts we need to prepare, sir. 10. So start notes to accounts, sir. So notes to accounts. First one, share capital. Sir, in this question, this company had only equity shares, correct? So first, equity share capital. Any authorized paid up capital is there? Not there. So directly you can write issued, subscribe. Will you write paid up or called up? Called up. Why? Because calls in arrears is there. Correct? Issued, subscribed and called up capital. How much given? 80 lakhs. Each share 50 rupees. That means how many shares? 1 lakh 60,000 shares. 1 lakh 60,000 equity shares of rupees 50 each. How much, sir? 80 lakhs. And also in the additional information, sir, 50,000 fully paid shares are allotted for consideration for land. That means we need to provide a note. Out of the above, how many? 50,000, right? 50,000 equity shares were issued for consideration other than cash. Sir, is this a normal point or a new point? Normal point already came. We know this. Out of the above, 50,000 equity shares are issued for consideration other than cash. So other than cash, we issued 50,000 shares out of this 1,60,000. So we have given a note. And from this, what we need to do? Calls in arrears you deduct. How much is calls in arrears? 15,000. Yes, deduct. So you will get how much? 79,85,000, right? 79,85,000. This is your capital. Update this in balance sheet, sir. 79,85,000. Okay. Now what is the second note, sir? Reserves and surplus. What are the reserves and surplus this company had, sir? I think general reserve is there. Securities premium is there. See this, securities premium, general reserve, P&L. 3 reserves are there. First take securities premium. How much is there? 15 lakhs. Right? 15 lakhs. Next general reserve is there. How much is there? 9 lakhs 41,000. 9 lakhs 41,000 general reserve is there, sir. But how much we are going to transfer, sir? Given in the additional information, board of directors decided to transfer some amount to general reserve. See this. Where? Point number 10. How much? 35,000. So add 35. So 9,41,000 plus 35. How much, sir? 9,76,000. Next to come to P&L account, sir. What is the P&L account balance given? P&L account balance is 5,80,000. Is this last year balance carry forward, or is this 5,80,000 includes current year also? Current year also, because in the beginning itself he said these balances are after preparing trial P&L account, right? So 5,80,000 P&L account. From this 5,80,000, how much we are transferring? Transfer to general reserve 35k. Deduct 5,65,000. Add everything. I think you will get total reserves and surplus. How much? 30, 20, 100. 30, 21,000. 30, 21, 100. 15 lakhs plus 9,76,000 plus 5,65,000. 30 lakhs 2,100. Correct. 5,80,000 minus 35. How much? 5,45,000 by the. Okay. 5,45,000. Hey, total correct? Please check it once. Correct only, no? Yes, 30 lakhs 21. Update this in balance sheet. 30 lakhs 21,000. Next to long-term borrowings. Long-term borrowings. See, I told you borrowings will be classified as what? Secured, unsecured. Here, long-term borrowings, we have two things. One is loan from public financial corporation, which is secured by hypothecation of land. So therefore secured, I will write in that loan from state financial corporation, SFC. What is the total amount, sir? 26 lakhs 30,000, right? In this, how much is the interest accrued but not due? That will go to other current liabilities, correct? Interest accrued but not due. How much? 1,34,000. This I will show it in other current liabilities, in current liabilities. Tell me, what is the balance left? So 26 lakhs 30 minus 1,34,000. 24 lakhs 96,000. Correct? This is secured. Hello? Now come to unsecured category. In unsecured, we have other long-term loans, correct? Other long-term loans total 22,50,000. Now see the breakup here. Other long-term loans which are unsecured, they have given First is loan taken from Nexus Bank. Sir, Nexus Bank, what is the total loan, sir? 13 lakh 80, correct? But in this 13 lakh 80, how much is due in the next 12 months? 4 lakh 80, which will go to short term borrowings. Hello? So from this 13 lakh 80, 4 lakh 80, you show it in short term borrowings. Here you need to show how much? 9 lakhs. Are you following? Important. Next, loan from directors. This is also there. Loan from directors. From directors, how much loan taken? 8,50,000. 8,50,000. What is the others? Others, sir. Others. Important. Others. Balancing figure. Others. Already here I have written 20,000. 20,000. How we got 20,000, sir? Take first total, sir. Total 22,50,000, sir. From this 22,50,000, loan from Nexus Bank 13,80,000 you remove. Next to directors loan you remove. Remaining balance is others. So this is important, please. This is how you need to present the things. This question is all about presentation. So secured, unsecured. Can you tell me total here? No, this one. Unsecured category. 17,70,000. Okay. So 17,70,000. Now tell me total. 42,66,000. So this I will show it in the balance sheet. 42,66. Correct? This is. So this is how you need to present. So 42,66,000. You present here 42,66,000. Next short term borrowings. Note 4, short term borrowings. In short term borrowings, what will come? Short term borrowings breakup given. If you want, you can check also. Loan from Naya Bank 1,16,000 secured. Loan from directors 48,000. And also now two things. One is loan from State Financial Corporation, in that interest accrued but not due will come here. And also that one. Loan from Nexus Bank repayable within next 12 months. Current maturities of long term debt. That one will also comes under short term borrowings. No. See, interest accrued but not due will go to other current liabilities. It will not come in short term borrowings. Yes. So in short term borrowings, what items will come? Say this. Loan from Naya Bank will come. Loan from Naya Bank. This is secured or unsecured? Secured. How much? Loan from Naya Bank 1,16,000 will come. One. Next to loan from directors. Hello? This is unsecured, right? Loan from directors, unsecured. How much? 48,000. And also current maturities of long term debt. What is that? Loan from Nexus Bank, right? From Nexus Bank, whatever the loan taken, in that loan, how much is payable in the next 12 months? 4,80,000. See, this is actually loan from Nexus Bank, current maturities. Current maturities of long term debt. Current maturities of long term debt, sir. Long term debt. So current maturities of long term debt is this. Okay. So this is the breakup. Important. So can you tell me the total? Others is also there, right? See, in the short term borrowings total 4,60,000, right? In that breakup is given for this. Remaining 2,96,000, right? So others. Balancing figure 2,96,000. Now you tell me the total. 1,16,000 plus 48,000 plus 4,80,000 plus 2,96,000. Total 9,40,000. Agreed? Hello? 9,40,000. You understand how it got it? They have given, sir. See, this one is given. This one is given. This is balancing figure. This one actually long term borrowings due in the next 12 months, which comes in short term borrowings. So 9 lakhs 40,000 you take in short term borrowings. Sir, you have to respond. Have you understood this? Next what? Note number 5. Other current liabilities. Right? OCL, other current liabilities, note number 4. In other current liabilities, interest accrued but not due. Interest accrued but not due. One item. That is loan from State Financial Corporation. 1,34,000. So 1,34,000. That is one thing. And also you see the trial balance. You have, I think, unpaid dividend, right? Unpaid dividend will also come in OCL. Unpaid dividend. How much? 70,000. So total it was 1,34,000 plus 70. 2,04,000. Any other item? Nothing. So 2,04,000, sir. So right here in OCL 2,04,000. Next, short-term provisions. Note number 6 is here. Short-term provisions. I think provision for tax. Provision for tax, sir. How much, sir? Provision for tax? 3,80,000. Right? 3,80,000 you write. Provision for tax. So 3,80,000 you write, sir. I think you add everything. So you will get the total. Kindly add total. Tell me how much came. One crore 66,69,000, right? 1 crore 66,69,000. Check everybody whether we got the correct or not. 1 crore 66,69. Now come to asset side. PP. In PP, land is there, buildings there. Land is non-depreciable asset, and then we have plant and machinery is there, and we have furniture and fixtures. Furniture and fixtures is there. So these are the items we had. Now look at one by one. Land, how much, sir? 25 lakhs. Land 25 lakhs. Directly you take, sir, 25 lakhs. Buildings, cost, tell me first. What is the cost of the building? 32 lakhs. 32 lakhs is the cost, sir. In the additional information, WDV 30. That means how much is the depreciation? 2 lakhs. Similarly, plant and machinery, cost 30 lakhs, sir. 30 lakhs cost. And what is the WDV given, sir? 24 lakhs. So what is the depreciation here? 6 lakhs. 6 lakhs is the depreciation. Next, to furniture and fixtures, cost 16 lakhs 50,000. WDV 13 lakhs. So depreciation 3 lakhs 50,000. Presentation is important. This is not a new point, already came. Now add everything, sir. All assets. WDVs you add. 25, 30, 24, 13. How much came? 92 lakhs, right? Hello? 92 lakhs. So update this in balance sheet. 92 lakhs. Ah. Sir, please make a total correction is there. You told wrong total, sir. Everybody, please do calculations wrong. Sorry, please do calculations right. You have told the wrong answer to me. What, sir? How much came total? 1 crore 76 lakhs 9,000. Correct? Ah? Make a total, yeah. Take your calculator, add everything. What is there? Next. What is note number 8? Inventories. I think inventories. In the question, if you see the inventory, sir, finished goods, raw material is there. Now, finished goods, 45 lakhs is there, sir. In this, how much is loose tools, sir? Loose tools, 5 lakhs. So, separate it. Because we will show this separately. That means finished goods is 40 lakhs, sir. Loose tools is also inventory because it is not satisfying PP definition. 5 lakhs, show separately, sir. And next one, sir, raw material. Raw material closing stock value, how much, sir? 13 lakhs. Add everything. 45 plus 13. 53, 58. Right? 58 lakhs inventories. So 58 lakhs inventory value, sir. So show here 58 lakhs. Next to trade receivables, right? Tell me trade receivables. Trade receivables outstanding for a period exceeding 6 months. Outstanding for a period exceeding 6 months. Show separately. Look at the additional information and tell me how much is the debtors outstanding for a period exceeding 6 months. 4 lakh 86,000. Given. See this third point. 4 lakh 86. Show separately. Actually, total trade receivables how much? 17 lakhs 50,000, right? In this 4 lakh 86,000 is outstanding for a period exceeding 6 months. That means what is the balance? 12 lakhs 64,000 is the balance. This will be others. Okay. This is how you need to present the things. So 17 lakhs 50,000 trade receivables. 17 lakhs 50,000. Now come to cash and cash equivalents. Note number 10. Cash and cash equivalents. Sir, when it comes to cash and cash equivalents, sir, cash in hand is there. How much is there? 70,000. Hello? Next, cash at bank. Cash at bank, sir. Total cash at bank is how much? 4 lakh 14,000. In this 4 lakh 14,000, if you observe carefully, how much amount is there with Naya Bank, which is not a scheduled bank? 56,000. So with non-scheduled bank, with scheduled bank, with the scheduled bank we got 56,000. That means out of 4 lakh 14,000, 56,000 is there with scheduled bank. What is the remaining? 3 lakh 58,000. It is there with non-scheduled bank. Just presentation. This point is also a repeated point. So total 4 lakh 14 plus 17. How much, sir? 4 lakhs 84,000. Right? 484,000. Update this 4 lakh 84,000 in the balance sheet. Now you tell me the total. 92 plus 58 plus 17.5 plus 4.84 plus 3.75. I think 1 crore 76 lakhs 9,000. Got it. 1 crore 76 lakhs 9,000, sir. Okay? Okay, sir? Sir, this type of questions they are testing in examination, sir. See, the thing you required is speed. Speed will come only by practice. Practice. If you do practice, speed will automatically come to you. Okay? So this is scenario based question 10. Similar type of questions are there in examination. I mean RTPs, MTPs examination. We'll discuss them when we go there. Okay sir, next SBQ 9 sir, scenario based question 9, ring limited sum. See this question. Ring limited was registered with a nominal capital of 10 lakhs divided into shares of 100 each. What is this sir? Authorized capital. The trial balance is extracted from the books on 31st March 2012 given. Trial balance given sir. See this trial balance everybody. Very interesting trial balance. So debit side items, credit side items given. Billings, PP. Machinery, PP. Closing stock, inventories, current assets. Loose tools, generally if nothing mentioned means we can consider it as inventory. Hello? If they satisfy the definition of PP, PP. Otherwise we can consider them as part of what? Inventory. So loose tools given. So we will consider them as a part of inventories. That is one thing sir. Next purchases given sir, 4,20,000. Purchases will come to P&L account. Purchases. Salaries, employee benefit expenses. Directors fees, other expenses. Directors fees we will pay to the board of directors for attending the board meeting. That is no way connected with employee benefits. Sitting fees like. So it will be other expenses. Rent, other expenses. Depreciation and amortization. Bad debts, other expenses. Investment, if it is non-current investment, non-current asset. If it is current investment, current asset. Interest accrued on investment. Interest accrued on, Jara use your brains and tell me. Interest accrued on investment. Interest accrued on investment. Investment is what? Basically asset. On that investment, interest accrued. That means interest was generated. Interest accrued on investment. At the end of the year, it is showing debit balance. Debit balance means receivable. So therefore, it is a other current asset. Interest accrued on investment. Next, debenture interest, finance cost. Advance tax. Short-term loans and advances. Advance tax is a current asset for us. It is kind of a short-term loans and advances. Important pa. Advance tax we are paying to the government. Right? So it comes under short-term loans and advances. Sundry expenses, other expenses. Debtors, trade receivables. Bank, cash and cash equivalents. Okay. Now can you tell me, debit side, do you find anything abnormal? Anything strange? Debit items? Tell me. Anything you find abnormal on the debit side items given? Interest accrued on investment, okay. Apart from that. Advance tax, apart from that. Interest accrued on investment to advance tax. Apart from these two. Okay, apart from that. Any other thing? See, generally, closing stock is given. Purchase is given. See this combination. Generally, this combination will come in trial balance. In trial balance, generally what they will give? Opening, purchases. Additional information they will give closing stock. You check all the problems till now. Whatever the problems we solved, wherever the stock given, closing stock is appearing as a part of additional information. But here in the trial balance itself they have given what? Closing stock. That means what? Tell me. If closing stock itself is appearing in the trial balance means what? Hey, come on here. In the trial balance, they have given closing stock. And you look at the additional information, first point, closing stock is more than opening stock by 1,60,000. Closing stock is more than opening stock by 1,60,000. What is the closing stock? 1,80,000, which is more than opening stock by 1,60,000. That means opening stock is 20,000. Opening 20, closing 1,80,000. That means closing is more than opening by 1,60,000. Hello. So therefore opening stock 20,000, closing stock 1,80,000. Purchases 4,20,000. Now my question is, in this question, in the trial balance, already closing stock is there. Then what is the impact? Already closing stock means this closing stock was already adjusted. Adjusted means what? See, generally we prepare trading account, right? Everybody. We will prepare what? Trading account. In trading account, first debit side, opening stock will show. Next, purchases we will show. Credit side, sales, forgot it. Next, closing stock we will show. Related to stock, correct now? Opening stock, purchases, closing stock. Now you see, in the trial balance, this closing stock is given means closing stock is already provided in the books. Already provided. See, how to get COGS, cost of goods sold? Opening plus purchases minus closing, right? So this COGS, in the trial balance, you know, they have given closing stock, purchases, opening stock not given, closing stock directly given. That means this purchases, whatever is appearing now, this is what? COGS, adjusted purchases. This one. How much is the COGS, sir? 4,20,000. Here what is opening stock? 20. Purchases, we don't know. Closing stock, 1,80,000. So if I want purchases, what I can do? Purchases is equal to 4,20,000 plus 1,80,000 minus 20. So how much? 4,20,000 plus 1,60,000. 5,80,000 is the purchases. So in P&L account, purchases we need to show 5,80,000. Purchases 5,80,000. And change in inventories of goods, change in inventories of the finished goods, how much? Opening and closing, 1,60,000. We will show opening and closing difference. Opening 20, closing 1,80,000. The difference is how much? 1,60,000. See, in this question, one of the main adjustment is this. Many of the students not observing this. See, in the trial balance, closing stock is already there. That means the effect of closing stock is already adjusted in the purchases. So these purchases are not direct purchases. These are adjusted purchases. Actually, while drafting the question itself, they have done some mistake. Here it should not be drafted like that. They should give these purchases as what? Adjusted purchases. But see, the moment you see closing stock in the trial balance, you can observe that this closing stock was already adjusted. So therefore, now I need to find out purchases. So that's why in the solution of this question, you see, you go to revenue from operations, you see, cost of purchases, how much they have taken? 5,80,000 they have taken. So this, see this. How much taken? 5,80,000. This one, 5,80,000. 1,60,000 they added to 4,20,000. Why they have added? What is this 1,60,000? The difference between opening and closing. Sir, COGS means opening plus purchases minus closing, sir. I want purchases. I want purchases. If I want purchases, what I will do? COGS plus closing stock minus opening stock. This is the formula you need to remember. COGS is equal to opening plus purchases minus closing. In the trial balance, this is available. COGS. Cost of goods sold is available. Because closing stock is given, purchases is given. Closing stock given means closing stock already provided in the trial balance, already provided in the books. Generally, by the time you are preparing trial balance, sir, closing stock valuation not done. That's why in the trial balance you don't see closing stock. But if it is given in trial balance, it is very unusual. If it is given means the purchases was already adjusted with this. Trading account is already adjusted means COGS. So this is COGS, cost of goods sold. In that I want what? Purchases. Original purchases. Because in P&L account I need to show purchases, cost of purchases. And also change in inventories. The difference between opening and closing. Opening 20, closing 1,80,000. The difference is how much, sir? Minus 1,60,000. So this is one of the important adjustments, sir. For example, sir, he has not given closing stock. It is opening stock is given. Then what you do, tell me? In the trial balance, opening stock purchases is available. Then that means this purchases is what? Normal purchases. Directly we can take purchases. And the difference between opening and closing, change in inventories will show. Since here this is the closing stock is already considered at the end of the year. That means it was already adjusted. So this is an adjusted purchase. We adjusted it. Hello. Okay. Next. This side you see sales. Sales means revenue from operations. Next, outstanding expenses. Outstanding expenses. Other current liability. Provision for doubtful debts opening 6,000. Provision for doubtful debts, what we do? We reduce from the debtors. Share capital, shareholders fund. General reserve, reserves and surplus. P&L account opening balance, reserves and surplus. Creditors, current liabilities. Provision for depreciation, building machinery. Reduce from the cost of the asset. Debentures, long-term borrowings. Interest on debentures. Interest on debentures. Come on, tell me. Interest on debentures accrued but not due. This is full. Interest on debentures accrued but not due. Other current liability. Other current liability. Sir, interest, see, important, sir. See, learn the concept. In the trial balance, look at the debit side balances. Debenture interest is there, na? How much is there? 56,000. This is what? This 56,000 is what? This is interest expense incurred during there. Therefore, it will go to P&L account. 56,000. Now you see, this side, credit side 28,000 is there. What is the meaning? Interest accrued, but you have not paid, or accrued but not due yet. That means this 28,000 is outstanding at the end of the year. That's why it go to other current liabilities. Already this 28,000 it is included in this here also. Debenture interest 56,000 included this 28 also. So this entire 56,000 interest expenses incurred will go to P&L account. In that expenses, how much is outstanding will go to balance sheet. Outstanding or accrued but not due will be shown in other current liabilities. That's why see, expenses will have a debit balance, liabilities will have a credit balance. Therefore, you need to understand, credit side interest accrued but not due means it's a liability. It is not an expense. This 28,000 is what? Liability. Which liability? Other current liability. Debenture interest means expense. It will have a debit balance. It will have a debit balance. Next you see, interest on investments. Tell me. Interest on investments means income, other income. In this interest on investments 24,000, how much is interest accrued at the end of the year? 4,000. That means, see, this is my interest income which will go to P&L account 24,000 as income, other income. In that 24,000 is accrued but not yet received. Therefore, it is my other current asset. Other current asset. How much I am earning? 24,000. So it will go to P&L. In this 24,000, how much at the end accrued? 4. That means it is not yet received. Interest earned but not yet received. So it is my asset. Balance receivable. Unclaimed dividend. Other current liability. That's it, pa. So very simple this one. Now you are required to prepare statement of P&L and balance sheet. Closing stock is more than opening stock by 1,60,000. Okay. Provide doubtful debts 4% on debtors. How much provision we need to maintain, sir? 4% on debtors. What is the debtors balance given? See the debtors balance, debit side you can see. Debtors 2,50,000. Everybody. You see 2,50,000 into 4%. 10,000. This is the closing provision I need to maintain. But already in the opening, how much provision is there? 6,000 is there. That means how much excess provision I need to create this year? 4,000. Only 4,000 I need to create. What is the entry? P&L to provision for doubtful debts. 4,000 will come in other expenses. Other expenses 4,000 will come. Because see, your opening provision 6,000, closing you need to maintain 4% provision, right? 10,000 you need to maintain. That means 4,000 current year you create provision. Current year provision is created from current year profits. So 4,000 will come in other expenses of P&L account. And in the balance sheet, debtors minus provision for doubtful debts. Total 10,000 you will reduce. And you will show the debtors balance. Next, make a provision for income tax 30%. Current year provision you create 30%. Depreciation expenses included. Depreciation of 16,000 on building and that of 24,000 on the machinery. Depreciation will come in P&L account. Directors declared a dividend of 25% on when? 2nd April. Any dividend declared after 31st March is not a liability. And transferred to general reserve 10%. This we will consider. How much they are transferring to general reserve? 10%. Reduced from the profits, added to the general reserve. Bills discounted but not yet matured 20,000. What is this, sir? Just now we discussed contingent liability. So we will ignore it. Any bills discounted at the end of the year but still maturity date not came, it's a contingent liability. So in this question, first balance sheet we will write. What items will come in balance sheet? Recollect. Shareholders funds, share capital, note 1. Reserves and surplus, note 2. Money received against share owners, not there. Share application money pending allotment, not there. Non-current liabilities, long-term borrowings is there. Yes, debentures is there, I think. Hello, debentures is there. Next, deferred tax liabilities, not there. Other long-term liabilities, not there. Long-term provisions, not there. Current assets, short-term borrowings is there. Any short-term borrowings? No. Next, trade payables, yes. Next, other current liabilities, yes. Other current liabilities, interest on debentures accrued but not due is there. Unclaimed dividend is also there. Two things are there. Next, short-term provision is there. Yes, provision for tax. Provision for tax. Provision for doubtful debts. No, provision for doubtful debts is not a provision. It is a provision created against asset. I told you. We need to reduce from only cost asset value. It should not be shown on the actual provisions. Hello. Now asset side, non-current assets, PP is there. I think PP only there. Any other asset like deferred tax assets, long-term loans and advances, other non-current assets, nothing. Next, current assets. In current assets, current investments is there, right? Investment is there. How much investment is there? 2,40,000. You can assume either non-current or current. Whatever you want, you can assume, sir. Accordingly, you will consider. Inventories is there. Trade receivables is there. Cash and cash equivalents is there. Other current assets also there in this question. Hello. Other current assets there na. Interest accrued on investment. Advance tax. Short-term loans and advances also there in loans and advances. Advance tax is there na. So these are the items. When it comes to P&L, sir, revenue from operations is there. Other income is there. Expenses side, cost of purchases is there. Change in inventories is there. Employee benefit expenses is there. Finance cost is there. Depreciation is there. Other expenses is there. Hello. You know, see here. First, when it comes to P&L account, sir, first go to P&L account. I will explain this question directly. So see this. First we will start. First format we will write. You know this balance sheet, then P&L. But first completion wise, which one we need to complete? P&L we need to complete. Revenue from operation, sales. Sales how much given, sir? 10 lakhs, 40. Take it. Next, other income. What is there in other income? Interest on investment is there. 24,000. Hello. Interest on investments 24,000 is there. Take it. Total 10 lakhs, 64,000. Expenses, first one I explained, cost of purchases. How you got cost of purchases? Purchases plus closing minus opening. 4,20,000 plus 1,80,000 minus 20. So purchases we got. Change in inventories I explained now. Opening closing difference is 1,60,000 minus 1,60,000. Next, employee benefit expenses. Salaries and wages. Sir, employee benefit expenses 1,20,000 is their salaries. Hello. So take it, 1,20,000 salaries. Next to finance cost, debenture interest is there. How much is the debenture interest, sir? 56,000 is there. Take it. You have to very careful. Students who does not have the basics, they will confuse. You should not confuse. P&L account contains incomes and expenses. If it is an expense, it will have a debit balance. In the trial balance, debenture interest is having a debit balance, so it will go to P&L account. It will go to P&L account. Suppose for example, you see interest on investments, 24,000 is having a credit balance. That means it go to P&L account as income. Income credit balance, expenses debit balance. When it comes to assets and liability, liability will have a credit balance, asset will have a debit balance. So you are preparing P&L account. When you prepare P&L account, your mind should think like expenses, incomes only will come. Accordingly, you need to take a call. Okay, depreciation and amortization, I think they have given in the question itself. See this additional information, 16,000, 24,000. Correct? 24 plus 16, how much? 40,000. They given in the question itself, depreciation. Remaining and all other expenses. Can you make a total and tell me other expenses? I will tell you. Take director's fees, 20,000. Rent, 52,000. And then bad debts, 12,000. And sundry expenses, 36,000. Plus provision for doubtful debts. Opening provision for doubtful debts, how much is there? 6. Closing, we need to maintain 10,000. That means how much provision? 4,000. I think total 1,24,000. See this, 1,24,000. Other expenses. Important here. So most of the students, other expenses, they are not doing correctly. Note number 8, you see. Rent, director's fees, bad debts, provision for doubtful debts. Learn how to create. We need to maintain 4% provision on debtors. 2,15,000 to 4%. 10,000 is our closing provision. We need to maintain. Closing provision to be maintained 4%. Already we have 6,000. That means 4,000 we need to create during the year. So if you create, what is the entry? P&L to provision. So that's why other expenses, sundry expenses. So 1,24,000. So total revenue minus total expenses, you will get profit. How much? 3 lakhs? 4,000. On that you need to create a tax provision 30%, 91,200. So you will get profit for the period 2,12,800, which will go to reserves and surplus in balance sheet. Correct? So once you complete the P&L account, sir, you got profits. Sir, important, sir, please understand. This profit you got, sir, 3,04,000. From this 3,04,000, see, provision for tax adjusted first. Then this balance will go to balance sheet, reserves and surplus. Now when it comes to balance sheet, sir, first shareholders fund, share capital, note number 1, 4 lakhs. How? Note number 1 is share capital. Any authorized capital given in the question? Take it. Issued, subscribed, fully paid. 4,000 equity shares of 100 each, 4 lakhs. Correct? Only 4 lakhs. So take it. Presentation you do according to us. Equity share capital, issued, subscribed and paid up capital. 4,000. No need to present issued, subscribed. You can present like one. Generally we do issued, subscribed and paid up share capital. 4,000 equity shares of 100 each, fully paid. Like that you present. In every problem we are doing. Next, reserves and surplus you see, sir. General reserve, how much is there, sir? 80,000. Plus current year they said how much we need to transfer. See this in the question clearly said 10%. 10% of this profit. This is the profit. 2,12,800 is there, na? On that 10%. Hello? So see this. 21,280. This is the general reserve closing balance. Now come to P&L account, opening balance already there. In the trial balance there 50,000. Current year profit 2,12,800. How much we transferred? 21,280. So P&L account closing balance 241,520. So total reserves and surplus 342,800. Very simple. Hello. Next, non-current liabilities, we have long-term borrowings, debentures, sir. How much, sir? 4 lakhs. Current liabilities, trade payables, they have directly given, I think. 1,84,000. Next, other current liabilities, what items will come? Interest accrued but not due, unclaimed dividend. See this, unclaimed dividend, interest accrued on debentures, outstanding expenses also there. Outstanding expenses there, that one also you need to take. Next, short-term provisions, you will get provision for tax. 91,200 in P&L account we created, na? That one. Next, asset side you see PP. PP you see buildings, less provision for tax. Equipment, less provision for tax. So total cost of the building you take, from that provision for depreciation you reduce. Hello? 5,80,000 buildings here. See, cost they have given 5,80,000, machinery 2 lakhs. Provision for depreciation given 1 lakh, 1,10,000. Everybody. Sir, some students will get a doubt. Sir, this provision for depreciation which is appearing in trial balance 1 lakh, 1,10,000. Whether this includes current year depreciation also? Not included or included? Generally in one sum, you remember that sum? Suspense account. So what we have done? Provision for depreciation, we add current year depreciation minus depreciation of the assets sold we done. That means current year depreciation we added, right? Here my question is, this depreciation you are seeing now, provision for depreciation, whether this includes current year depreciation also? Because we need to add current year depreciation, then only you will get the closing provision for depreciation. Included, not included? Read the additional information. See this. Depreciation expenses included depreciation of 16,000 on building and that of 24,000 on the machinery. So therefore, the point is, they clearly mentioned depreciation expenses included depreciation of 16,000 on building and that of 24,000 on the machinery. So in this provision for depreciation, whatever the provision is there, already current year depreciation is also adjusted. That is the assumption here, adjusted. Suppose in the other problems, if you read, they clearly given depreciation is to be provided. Depreciation is to be provided, like that. Then we will add current year depreciation to it. Correct? So in this question, depreciation was already adjusted. So that's why here when they are writing PP, see what they are doing. Buildings 5,80,000 minus provision for depreciation 4,80,000. Plant and machinery minus provision for depreciation 5,70,000 came. Next, investments. All the investments they assumed as what? Long term. So non-current investments. Now current assets inventories is there. Note number 6. In inventories what they have shown, see this, finished goods, loose tools separately shown. See this, loose tools also they have considered as what? Inventories. Next, trade receivables. Trade receivables also important. Total debtors how much? 2,50,000. From that provision for doubtfuls how much reduced? 10,000. Closing provision to be maintained. Hello? So 2,40,000. So trade receivables, cash and bank balance directly given. Short-term loans and advances. See this. Advance tax paid. Remember guys, advance tax paid is what? Short-term loans and advances in current assets. Other current assets we will have one item. What is it? Interest accrued on investments. Whatever the interest accrued on investment, so at the end of the year it will be receivable. So it is a other current assets. And bills discounted but not matured is a contingent liability. See this, there is a contingent liability for bills discounted but not yet matured amounting to 20,000. So very easy, and I mean this question is easy only, sir. Only thing is that stock item remaining and all easy only. What are the unique items here? Closing stock already given means it is adjusted purchases, so we find out the actual purchases. That's thing. Director's fees is considered as a part of other expenses. Interest accrued on investment is a other current asset at the end of the year. Advance tax is what? Short-term loans and advances is the current asset for us. And interest on debentures accrued but not, it is other current liability. Provision for doubtful debts. Opening provision 6,000, closing we need to maintain a provision of 4% on debtors, which is 10,000. So closing provision 10, opening 6. So 4,000 provision created during there. That 4,000 will debit to P&L account in other expenses. But when you are presenting in balance sheet, total debtors minus closing provision we need to reduce and show it in the balance sheet. That's it. This is one question, sir. Ring limited question. We complete it. Okay, sir. Now In the financial statements of company chapter, let us see the questions from MRP. MRP means model test papers, revision test papers and past examination papers. Additional questions for practice, we can say. See question number 1. This is the MTP question, sir. April 2022, October 2023. Very simple. You are required to prepare balance sheet as on 31st March 2020 as per Schedule 3 of the Companies Act 2013 from the following information of Meher Limited. So what is the thing they are asking, sir? They are asking us to prepare what? Balance sheet. What is the information they have given? See this. Term loans given. Term loans, where they will come? Long term borrowings. Trade payables. Current liabilities, trade payables. Correct? Cash and bank balances. Cash and cash equivalents. Staff advances. Advances given to staff. Nothing but. Staff advances means short term loans and advances. Current asset. Current asset. Short term loans and advances. Other advances given by company. Any other advances? Any other advances? Long term loans and advances, we can consider it. Other advances given by the company. Hello? Next, provision for taxation. Short term provisions. Securities premium. Reserves and surplus. Loose tools. Inventory. General reserve. Reserves and surplus. Investments. Non-current. Non-current investments. Sorry, non-current investments. Where? In non-current assets. Profit for the year. Reserves and surplus. Trade receivables. Current assets, trade receivables. Miscellaneous expenses. Miscellaneous expenses. See, additional information you see. Write off the amount of miscellaneous expenses in full amounting to 2,32,000. So this miscellaneous expenses we need to write off fully to the P&L account. So we will adjust this to P&L account. From P&L account, this 2,32,000 we will adjust. In one problem, you remember, I think SBQ 7. In that preliminary expenses we adjusted against general reserve. Because they are clearly said. Here, write off amount of miscellaneous expenses. Write off means generally we will write off to P&L account. So this 2,32,000 is adjusted against P&L. Okay. Next, loan from other parties. Either short term or long term. Assumption you can take. Provision for doubtful debts. Deducted from debtors. Stores. Inventory. Stores is also considered as what? Inventories. Finished goods. Inventories. Plant and machinery. PP. And then share capital consisting of 1,20,000 equity shares of 100 each fully paid. Shareholders funds, share capital, equity share capital. 40,000 10% redeemable preference shares of 100 each fully paid up. So both will come in share capital. One is equity, one is preference share capital. So they are asking balance sheet, sir. Simple, no? So if you start balance sheet, first equity and liability, shareholders funds. In shareholders fund, share capital. Then reserves and surplus. Money received against share warrants, not there. Share application money pending allotment, not there. Non-current liabilities, long-term borrowings is there. Hello? Long-term borrowings there, Yes. Term loans is there. Yes. Deferred tax liability is not there. Long-term loans and advances we can take other advances as long-term loans and advances given by the company. Next to long-term provisions not there. Then current liabilities we have short-term borrowings is there. Any short-term borrowings? Nothing. Loan from other parties is there. That I can consider it as what? Short-term borrowings or long-term borrowings. Assumptions, sir. Anything you can take. And then trade payables is there. Other current liabilities there are nothing. Next, short-term provisions. Provision for taxation is there. Asset side, non-current assets. PP is there. Yes, plant and machinery. Non-current investments also there. Deferred tax assets not there. And also other non-current assets, long-term loans and advances. See, these are advances given by the company. You can consider this. Long-term loans and advances. Oh, liabilities is advances taken. These are actually advances given. Assets, nothing but. Next, current assets. In current assets, inventories is there, trade receivables is there. Next, short term loans and advances is also there, staff advances. Other current assets, not there. That's it. See this. So equity and liabilities are share capital. Actually, you need to write here shareholders funds. They forgot it. Shareholders funds, share capital, reserves and surplus. Share capital total how much, sir? Equity 1,20,000 into 100. This one 40,000 into 100. Total 1 crore 60 lakhs. Equity plus preference. See this. Equity 1.2 crores, sir. Preference 40 lakhs. Total 1.6 crores. Next, reserves and surplus, you see. What are the reserves and surplus we had, sir? General reserve 62 lakhs. Securities premium 19 lakhs. P&L account 32 lakhs. And from P&L account we need to adjust miscellaneous expenses 2,32,000. So say this, securities premium, general reserve, P&L account opening balance 32 lakhs given. Miscellaneous expenditure adjusted to this P&L account. Say this, important. So we got 1 crore 10,68,000 reserves and surplus. Next, non-current liabilities, long-term borrowings. Term loans is there na? 40 lakhs. Take it. Next, come to current liabilities, trade payables. Trade payables is there. How much is there trade payables? 45 lakhs 80,000. Take it. Next, other current liabilities also there. What is there in other current liabilities? Loan from other parties. They have considered wrongly, sir. This 8 lakh. This see here in this question. Loan from other parties, they have considered other current liabilities, which is wrong, sir. Please change it. Wrong thing. This is a old question. It's wrong actually. Where it will come? Loan from other parties. Either it should come as a part of long term or short term. So I will assume this as what? Short term borrowings instead of other current liabilities. So you can also update here short term borrowings. Okay. Next, short term provisions. Provision for tax is there, 10,20,000. Next, asset side you come. Non-current assets, PP, property, plant, equipment. We have plant and machinery, 2 crore 14 lakhs. Take it. Non-current investments also there, 9 lakhs. Take it directly. Now come to current assets, sir. First, inventories is there, na, sir? Inventory, what items are there? See this. In inventories, we have loose tools 2 lakhs and also stores 16 lakhs, finished goods 30 lakhs. So 30 plus 16, 46, 46 plus 2, 48 lakhs inventory. Correct? Yes. Say this, 48. What is there in this 48, sir? Finished goods, stores, loose tools. Stores is also part of inventory, sir. Next, trade receivables. Trade receivables, how much is there, sir? 49 lakhs. And from that we need to reduce provision for doubtful debts 80,000. 49 lakhs minus 80,000. See this, 49 minus 80. 48 lakhs 20,000. Next, sir, cash and cash equivalents. Any change, sir? No. What is cash and cash equivalents given? 38 lakhs 40,000. Take it directly. 3840. Last one, short term loans and advances. See this, staff advances, how much given? 20, 2,20,000. Other advances given 14 lakhs 88,000. Total 17 lakhs 8,000. Both of them they have considered as a part of short term loans and advances. Staff advances as well as other advances. Alternatively, you can take it as long term loans and advances. Sir, here considered to be short term, assumption taken. So some students will come and ask me, sir, why you considered as a part of short term? Because assumption. I took it an assumption. Okay, considered to be short term. What, sir? Assumption they have taken, sir. If you want, you can take it in long term loans and advances also. Nothing wrong. But write an assumption in the examination that these are part of short term, long term loans and advances. That's it. So this is the question number 1, sir. This is the old MTP question. Nothing great, sir. Huh? Given, huh? No. He has written everything same. Authorized, issued, subscribed and called up. That means he is assuming that whatever issued, subscribed, called up is there, that itself is authorized. Even if you don't write this also, no problem. Just you write issued, subscribed and called up capital. Called up, you should write here paid up. You write. Okay. This is one question, sir. Question number 2, sir. This is MTP April 2023 question. From the following information, prepare extract of balance sheet of A Limited. They are asking only extract along with the notes making necessary compliance of schedule 3. Loan funds, sir, secured given, sir, 18 lakhs 12,000. Unsecured loans short term from bank 2 lakh 25, sir. Other information you see, sir, secured loans, term loans from banks from others, sir. This 18 lakh 12,000 breakup they have given. And current maturities of long term loan from bank 1 lakh 24,000, sir. Current maturities of long term loan from others 85, sir. Sir, any long term borrowings in that anything due to be settled in the next 12 months is a current maturities. It will be short term borrowings. So therefore in this 18 lakhs 12,000, this 2 1 lakh 24 plus 85, total 2 lakhs 9,000, correct? 1 lakh 24 plus 85, 2 lakhs 9,000. This 2 lakh 90,000 will be considered as what? Short term borrowings. See this. There was no interest accrued due at the end of the year. Current maturities of long term loan is how much? 2 lakh 9,000. Is included in the value of the secured loans of 18 lakhs 12,000. Now how you are going to present them in the financial statements? Very simple. So say this. Actually how we are going to present, sir? Tell me. In the, suppose if I start balance sheet, liabilities, equity and liability side, I will write non-current liabilities, correct? In non-current liabilities, I will take long-term borrowings, correct? For this long-term borrowings, I will prepare notes to accounts, correct? And you know, next I will take what? Current liabilities. In current liabilities, I will take what? Short-term borrowings. For this, I will prepare note number 2. Suppose if I prepare notes to accounts, first note I will prepare for what? Long term borrowings. In long term borrowings I have what, sir? Secured loans, correct? Secured loans. What is the total secured loans given? 18 lakhs 12,000. For that the breakup is given, sir. In the secured loans I have what? Term loans from banks, correct? So here I have term loan from banks. How much is the term loan from banks? 8 lakhs 95. See this, 8 lakhs 95. In this 8 lakhs 95,000, how much is current maturities? See this, in this current maturities of long term loan from bank is how much? 1 lakh 24,000. This will go to short term borrowings, correct? So this is current maturities of loan, bank loan. How much, sir? 1 lakh 80, 1 lakh 20, 1 lakh 24. Please deduct 1 lakh 24. 7 lakh 74,000 will be in long term borrowings. Now another one is there from others, correct? Term loans from banks, term loan from others. From others, how much is their term loans? 9 lakhs 17,000. In this 9,17,000, how much is the current maturities? Current maturities of term loan. How much? 85,000. It will go to short term borrowings. So it will be deducted from long term. How much? 8,32,000. 8,32,000. And also this company has what? Unsecured loan, but which is short term loan from bank. So it will not part of what? Long term borrowings. Hello? So therefore these two are the long term borrowings. Can you tell me the total? 7,71 plus 8,32. 16,03,000. So this I will show as a part of long term borrowing. See this. If I prepare the extract of balance sheet, sir, in that non-current liabilities, long-term borrowings, I will show 16,03,000. Important, sir. How I am presented? See this. Long-term borrowings, term loans secured from banks, from other parties. From banks, 8,95,000. From other parties, this. In this current maturities, how much I deducted? So I got 16,03,000. Here I have deducted individually. They deducted in total. Hello? Both are same only. 16,03,000 I will show in the balance sheet. This is in respect of what? Long term borrowings. Now come to short term borrowings, sir. Short term borrowings, what is there in the question, sir? See this. Unsecured loan is there. Short term from bank, how much is there? 2,25,000. So for this, if I prepare note number 2, short term borrowings, in that unsecured, what given? From bank, short term loan from bank, right? How much is there? Short term loan from bank, 2,25,000 plus in the long term borrowings, how much is the current maturities? Current maturities of long term borrowings, both from term loan from banks to from others, correct? Together, how much is the maturing? 2,09,000. That will also comes under short term borrowings. So add these two. How much, sir? 4,34,000. So 4,34,000 you will show here. That's it. So this is how the presentation will be done. 4,34,000. Sir, tell me, is this a difficult thing? Already this type of questions we solved, na, sir. Same the classification we have done here. So there is nothing new here. Already we have done the same thing, we presented again like this. So this is one question, sir. This is question number 2. Sir, you understand this question? So in the long term borrowings, how much is maturing in the next 12 months will comes under short term borrowings. Short term borrowings. Suppose, sir, suppose here in this question, instead, suppose they have given like this. Current maturities of long term loan from bank, instead they given like this. For example, interest accrued but not due. Tell me what you do. This 1,24,000, suppose they have given interest accrued but not due, which is included in the term loans from bank. What you do then? You understood the question first? This 1,24,000 is what? Current maturities of long term loan from bank. Instead, if they have given this 1,24,000 as interest accrued but not due, then what you do? Other current liabilities you will show. We have done one question, na? I think 2 questions we solved. Same thing. So this is one question, sir. Question number 2. MTP, April 2023 question. Sir, you understand this? Okay, sir. See question number 3, sir. This is RTP November 2022 question. RTP November 2022 question. Compared to this, I think old question this is. In this question, what they have given, sir? First they have given the balances. First inventory opening balance given, sir. Raw material, finished goods. Purchase of raw material given, which will go to P&L account. Of course, see, raw material opening stock is available, 30. Purchase of raw material is available. And also, I think raw material closing stock is available in the additional adjustments. So in case raw material, all details are available, we will show what? Consumption. Opening plus purchases minus closing. Finished goods, we will show what? Difference between opening and closing. So in this question, raw material, finished goods is there. Every detail given, sir. Opening given, purchases given, and also closing given, raw material and finished goods. So therefore, when you are preparing P&L account, sir, raw material consumption you will show, change in inventories of finished goods you show separately in this question. Manufacturing expenses, sir, other expenses in P&L account. Salaries and wages, employee benefits, general charges, other expenses, building, PP, plant and machinery, PP, furniture, PP, motor vehicles, PP, investments, current investments, current assets, non-current assets, trade receivables, current assets, trade receivables, cash in bank, cash and cash equivalents. This side you see sales, revenue from operations, interest, other income, credit balance is there, other income, P&L account, reserves and surplus, share capital, shareholders fund, share capital, secured loans, short term, long term. Short term means short term borrowings, long term means long term borrowings. Sir, these are credit balance, means liabilities. Next, fixed deposits, unsecured, short term, long term. What is this? Liability. Deposits taken. Hello. Deposits taken, short term borrowings, long term borrowings. Trade payables, current liabilities. From the above balance and following information, prepare company's statement of P&L as well as balance sheet. They are asking P&L as well as balance sheet. Outstanding expenses given, sir. Manufacturing expenses 67,500, salaries and wages 4,500. Tell me what you do. Manufacturing outstanding expenses, add it to the corresponding expenses and show it in other current liabilities in the balance sheet. Correct? So manufacturing expenses add 67,500, salaries and wages add 4,500. This outstanding will be comes in other current liabilities. So add to the corresponding expenses and in the balance sheet other current liabilities. Interest accrued on securities. Tell me, interest accrued on securities, other current liability, etc. See, this company is having investments here. See, this company is having investments. See this, interest accrued on securities. So it is interest accrued on securities at the end of the year is nothing but what? Other current asset. Other current assets. Next, general charges, prepaid expenses, deduct from the particular expenses. In the question, general charges is there. See this, 16,500. From the 16,500 you deduct it. And in the balance sheet asset side, which asset? No. Short-term loans and advances, because this is prepaid expenses, na? Short-term loans and advances. Prepaid means what? Expenses paid in advance. So which will come in short-term loans and advances. Short-term loans and advances. Next, depreciation 2% on building, machinery 10%, furniture 10%, motor 20%. So depreciation will come in P&L account. Current maturities of long-term loan. Current maturities of long-term loan. Current maturities of long-term loan, where it will come? Short-term borrowings. Next, taxation provision 40% of net profit. Short-term provisions, provision for tax. I think this is the what they have given, sir. Very simple question only, na? So first I will start with what? Balance sheet. First I will write equity, shareholders funds. In that share capital, reserves and surplus. Non-current liabilities I had long-term borrowings. Current liabilities I had short-term borrowings. Trade payables, other current liability, short-term provisions. Asset side you take non-current assets. I have PPE, non-current investments. Current assets you take current investments is there. Inventories is there, trade receivables is there, cash and cash equivalent is there. Short-term loans and advances, other current assets is also there. And if you look at the P&L account, revenue from operations is there. How much is the revenue from operations? 17 lakhs, 10,000 sales. Take it. Next, 3,900 is other income, interest. Hello? And 3,900 plus at the end of the year, see this, interest accrued on securities. I forgot to tell you. Interest accrued on securities means interest accrued. That means current year it is income and receivable. Therefore, it will be added to the corresponding income and at the end it is shown as what? Asset, other current asset. Since it is given in additional information, because we solved one question called ring limited question. In ring limited question, why we have not added? Because it is already there in the trial balance. It is already there in the trial balance means it was already included in the current year interest. Only accrued but not receivable. So that receivable amount is only considered as what? Asset. But here this 300 is there in additional information. That means it is not included in the corresponding income. So first you need to add, and also on the asset side you need to show other current asset, receivable. Hello. Next. So total income, expenses, cost of material consumed. Here cost of material consumed is what, sir? Raw material. Hello. See this raw material consumption. They given in the question raw material consumption. See this raw material consumption. Opening, purchases minus closing. Next, change in inventories of purchase of stock in trade given. Purchase is not given. Change in inventories of finished goods is given. Difference between opening and closing finished goods. Opening finished goods how much? 46,500. Closing 60. Total minus 13,500. Minus 13,500, sir. Here they put correct only. Minus 13,500. Employee benefit expenses, sir. Salaries and wages. How much is there? 40,200 plus outstanding 4,500. Add how much? 44,700. See this one. Finance cost not there in the question. Depreciation and amortization you provide, sir. Depreciation and amortization they given, sir. Building 2% create, machinery 10%, furniture 10%, motor vehicles 20%, sir. Hello. Depreciation you calculate. See this. Building 1,01,000 on the 2%. Plant and machinery 70,400 done 10%. Furniture 10,200 10%. Motor vehicles 20%. All the depreciation you add, take here. Last one, other expenses. So what items will come in other expenses? Other expenses, manufacturing expenses is one. General charges, but in general charges prepaid you need to deduct 16,500, and manufacturing expenses outstanding is there, right? 67,500. So therefore what you do is 2,70,000 plus 67,500, 3,37,500 plus general charges 16,500 minus how much is the prepaid? 2,490 deduct prepaid. So I think it is 3,51,510. Correct? See this 351,510. How we got 351,500, sir? See this one. Manufacturing expenses outstanding you add. General charges prepaid you deduct. Prepaid is deducted from the concern. Then you will get the profit 49,050. And they are saying that how much tax provision we need to create? 40%. It will be 19,620. This is provision for tax. Where it will go? Short term provisions. Now come to balance sheet, sir. Once you come to balance sheet first shareholders fund, share capital. Share capital how much given, sir? 3,15,000. Hello. So share capital 3,15,000 directly given in the question. Say this. No, actually notes to accounts not prepared for share capital, but we need to prepare it. Since details are not available, he has not prepared. Okay. Reserves and surplus, you see. Reserves and surplus carry forward P&L account balance is how much? 21. Plus current year we got now from P&L account. How much current year profit? 29,430. Add, you will get 50,430. Now come to long term borrowings. Sir, long term borrowings, we have a long term loan, long term secured loan. How much is there? 21,000. And also fixed deposit long term is there 3,300 and 24,300, sir. And in the additional information you see current maturities of long term loan is there. How much? 1,000. Deduct it. So 23,300 will be considered as long term borrowings. So long term borrowings you see secured loans. In that current maturities 1,000 is there, which will go to short term borrowings. See this 1,000 current maturities. Fixed deposits unsecured. Okay. Next, Short term borrowings. Short term borrowings we have what? Secured loan short term 4,500, fixed deposit 1,500. So 4,500 plus 1,500 plus current maturities 1,000. Total 7,000. 7,000. Say this 7,000 short term borrowings. Everything available in the question only. Just you need to arrange it properly. Next, trade payables given directly. Other current liabilities, what items are there? OCL. In other current liabilities, what will you show? Anything is there in other current liabilities? Yes, outstanding manufacturing expenses, outstanding salaries and wages. 67,500 plus 4,500. 72,000. Say this 72,000. These two. Other current liabilities. And next, sir, short term provision for taxation from P&L account 19,620. Now asset side you see, sir, PPE. In PPE we have building, plant and machinery, furniture, motor vehicles 4 minus depreciation. For example, building 1,01,000 minus depreciation. All these things you do. So see this, building 1,01,000, depreciation 2%. Plant and machinery 10% depreciation. So you will get 2,04,160. This will update here. Next, non-current investments directly given. Investments current to non-current. Next, current investments given. Inventories, sir. Inventories. Inventories. At the end, how much is the value of inventories we had, sir? Finished goods 46,500. Raw material 30,000. Total 76,500. And also any other item is there? Closing stock. I am taking opening stock, sorry. Closing stock means you have to take this one. 25,800 plus 60. Total 85,800. Okay. Next, trade receivables given 238,500. Cash and cash equivalents given 2,71,100. Short term loans and advances. Yeah, prepaid general charges is there now. How much? 2,490. Take it. See note number 8. Short term loans and advances. And last one, other current assets. Interest accrued. Is there now? Interest accrued on securities. 300. So in this question, actually this is a very good question, sir. In this question, if you observe carefully, good points are there. Outstanding expenses is there, prepaid expenses is there, and assets are there. Interest accrued on securities at the end of the year is there, 300. So if outstanding expenses given, in the additional information, add to the corresponding expenses, show in other current liability. If interest accrued on securities is given, in the additional information, add to the corresponding income in P&L account and show it as other current asset. And the prepaid expenses given, deduct from the particular expenses, show it on short term loans and advances. Short term loans and advances. Don't consider it as other current asset. Mostly prepaid expenses, people are considering it as other current asset. It is like a short term loans and advances. Hello? That's it. You practice this question once, sir. Very good question. And what is the question, sir? This is RTP. RTP November 2022. So we completed this question. Sir, question number 4 you see, sir. This is asked in May 2023. Now you tell me, sir, after reading this question, do you feel that this question already we covered or not? You see this question. They have given first balances, sir. Debentures, plant and machinery at cost, trade receivables, land, debenture interest, bank interest, sales, transfer fees, discount received, purchases, inventories, opening balance, and factory expenses, rent rates, taxes, insurance, repairs, sundry expenses, selling expenses, directors fees, interest on investments for the year 22-23, income nothing but provision for depreciation, miscellaneous receipts. Additional information you see, closing inventory given. Miscellaneous receipts represents what? Cash received from sale of the plant on 1/4/2022. Cost of the plant given, accumulated depreciation there given. Land is revalued, depreciation is to be provided on plant and machinery at 10% on cost. Make a provision for income tax at 25%. Board of Directors declared a dividend at 10% on equity shares when 4th April 2023. You are required to prepare a statement of P&L account they are asking, sir. Not balance sheet, only P&L account they are asking. I think if you observe this type of question, we solved a balance sheet. Illustration number 2. Illustration number 2. Here they given suspense account there. Here they given what? Miscellaneous receipts. Miscellaneous receipts indicates sale of plant. So therefore here suppose if I prepare P&L account, how will you prepare? First I will take revenue from operations. Revenue from operations is what here? Sales. See this. 47,22,600. And then other income. Other income what items will come? See this. Transfer fees, discount received, and also relating to this, see this. Interest on investments. 55,000. Hello. This one. And miscellaneous receipts you see, sir. See here we sold plant and machinery, right? What is the sale value? 142,800. Miscellaneous receipts represents cash received from sale of the plant. 142,800 is the sale value. And what is the cost? 1,65,750. Accumulated depreciation thereon 24,865. How much? 1,40,885. We sold it for 142,800. So profit on sale is how much? 1915. That will also comes under other income. 1915. If you want, you can check. See, revenue from operations, sales. Note number 1. 47,22,600. Next, other income you see. Transfer fees, discount, interest on investment, profit on sale of plant. How much profit they got? 1915. How they got profit? Sale value minus WDV of the asset. WDV of the asset means cost minus accumulated depreciation. Hello? This type we already done, sir. Next, you will get the total income. Then, expenses you see, sir. Expenses. If you see the expenses side, first one is what, sir? Cost of material consumption, not there. They have given what? Only opening inventory is given, closing inventory is given, and also purchases given. So therefore purchases we will take, difference between opening and closing we will take, change in inventories. So purchases 28,86,000, correct? Purchases, sir, 28,86,600. Change in inventories, the difference between opening and closing. See this. Opening is this, closing is this, 20,400. Next, sir, employee benefit expenses. Any employee benefit expenses? No. Next, finance cost. Any interest? No. Hello? Finance cost. No, there. There, I think. Finance cost, debenture interest 339,150, bank interest 13,260, both of them. So 352, 410. This one you see. 352, 410. See this. Interest, finance cost, interest on debentures, bank interest. 352, 410. Next, depreciation and amortization, sir. Sir, when it comes to depreciation and amortization, how much depreciation? See, look at the wordings. Depreciation is to be provided on plant and machinery. That means this provision for depreciation does not include current year depreciation. See, in the trial balance they have given, right? How much given? Provision for depreciation 5,96,700. 5,96,700 is there now. But in the additional information, see, depreciation is to be provided. On how much? 10% on cost. What is the cost of the plant and machinery, sir? See this, 37,43,400. But in the beginning itself, some cost of the plant and machinery sold, na? So 37,43,400 minus what is the cost of the plant we sold? 165,750. Hello. So 35,77,650 is the cost on that 10%. So 3,57,765 is the depreciation. Note number 5. See this. Depreciation. We sold at the beginning some cost of the machinery, deduct it. On the remaining cost, we provide depreciation 10%. Hey, you observed, Next, remaining and all other expenses. What items will come in other expenses? I will tell you. Factory expenses 258.60, rent rates taxes 65.25, repairs, sundry expenses, selling expenses, directors fees. I think these items. Add all these items. So see this. Factory expenses, rent rates, taxes, repairs, sundry expenses, selling expenses, directors fees. Total 6 lakhs 65,040. 040. Correct? See this. So total expenses. Total revenue minus expenses, you will get profit. 6 lakhs 1,850. And in the question they said how much provision we need to create? 25%. So 150, 463. So this is the profit for the period. So in this question they asked only P&L account. Sir, what is the interesting point you observed, sir? Depreciation, you might get confusion in exams. Depreciation, sir. Today we solved till now one of the question, depreciation already included. But here look at the wordings. What are the wordings they used? Depreciation provided. Therefore I provided the depreciation. I provided the depreciation during the year. Okay, anyways here balance sheet preparation is not required. Just P&L account preparation is required. You understand this, Previous year paper May 23 question, sir. Actually they will ask balance sheet, sir, but this time variety they asked P&L account. And when you are preparing P&L account, please be careful regarding this inventory, purchase of inventory, change in inventories. What information given in the question, accordingly you need to decide. And profit on sale of plant is an important item. That's it. And depreciation also. In the beginning itself, some cost of the plant and machinery sold. Only remaining cost we need to consider 10% depreciation. That's it, sir. This is question number 4. This question when they asked, sir, May 23 exams. Okay. Next question number 5, sir. This question is asked in September 2024 attempt. 14 marks question, sir. See, this question is exactly same, sir. In this question, if you observe, they are asking P&L as well as balance sheet. This question is exactly same, sir. Just a few additional points they tested. You write here, this is similar to illustration 2.6. You see illustration 2, same question. Illustration 2, you observe that questions are suspense account, provision for depreciation. Hello. Suspense account represents sale value, cost given, asset is sold at the beginning of the year. That question is there, na? Same question they're testing. So you solve illustration 2 and 6, you will get question number 5. But in question number 5, what is the extra point they are testing now? Out of all the additional information, see, first point, bonus issue. This is the extra point. So see this, I will explain this bonus treatment. First of all, they have given a trial balance on 31st March 2024, correct? What happened on 31st March, the company issued bonus shares to the shareholders on 1:2 basis. That is, 1 equity share issued as bonus for every 2 equity shares held. No entry relating to this has had been made. Actually, sir, in this company, rupees are given 1000, sir. So total 2 lakhs is there, equity share capital. Each one 10 rupees. That means total 20,000 equity shares. Correct? Hello? Total 20,000 equity shares. This is question number 5, sir. So number of equity shares 20,000, right? Now company want to give what? Bonus. In what ratio? 1:2. one equity share issued as bonus for every 2 shares. So number of bonus shares 20,000 divided by 2 into 1. So 10,000 shares will be given as bonus shares, right? Right? And total amount bonus share capital is how much? Share capital 10,000 into 10 rupees na each share face value. So total 1 lakh. So because of bonus issue, what happens? Tell me. Number of shares will increase. So therefore, when you are preparing balance sheet, share capital, already in the company 20,000 shares are there. Now because of bonus issue, another 10,000. So total 30,000 shares we will write. Issued, subscribed, paid up capital. And you also provide what? Note. You know, according to schedule 3, when shares, bonus shares are issued, we need to clearly mention the aggregate number class of shares. So therefore, you see, when you are solving this question, in the balance sheet, you see, equity share capital, first we will write authorized. I think in this question, authorized capital given, sir. Authorized capital given, say this. 35,000 equity shares of 10 each. So first I will present authorized. After that, issued, subscribed, paid up. See this, 20,000 equity shares of rupees 10 each fully paid. Add 10,000 bonus shares issued during the year. So 1 lakh. So total 3 lakhs. And here we need to provide what, sir? Note. Actually they forgot it, the note, sir, but according to schedule 3 we need to mention a note. So what is the note, sir? Out of the above 10,000 equity shares are issued as fully paid bonus shares. Okay, fully paid bonus shares. Like that you need to provide one note. Actually you need to write like this: 30,000 equity shares of 10 each fully paid, 3 lakhs. In that, below that you need to provide this note, but they have presented like this. But according to schedule 3, this is the correct presentation. So this is one effect, sir. What is the another effect, sir? Sir, whenever a company gives bonus shares, na, sir, here how much is the bonus given, sir? 1 lakh. Bonus is nothing but what, sir? Capitalization of profits. Whatever the profits you have, those profits you are capitalizing. That's why bonus issue is technically called capitalization of profits. Now, here company is issuing equity share capital, so your share capital is increases by 1 lakh. But no amount is collected, na? Bonus issue means freely we are issuing. We are not collecting any amount. Hello? Then what is the entry you will write? Share capital you will credit. Which account will debit? Bank amount is not collected. The Companies Act says whenever a company wants to give fully paid bonus shares, they can use free reserves, they can use securities premium, they can use CRR, capital redemption reserve. 3 reserves are available. So here what company can do? Company wants 1 lakh rupees. So in this company, what are the existing reserves? Check it. So in the general reserve is there na 90. P&L account is there na 48. Securities premium is there na 27. So you can use any one of them. You want to, how much? 1 lakh. Suppose I used securities premium. So securities premium account debit. How much? 27. Then I used general reserve. How much still I want, sir? 100 minus 27, 73. This is the balancing figure I will use from general reserve. In general reserve, how much is there? 90 is there. So I can use 73. So therefore, this is the entry. Securities premium account debit or general reserve account debit to bonus to shareholders. Then bonus to shareholders to share capital. So therefore, in this case, in reserves and surplus, what company will do is, see this. Securities premium 27 given minus amount utilized for bonus. So the net balance is nil. Similarly, general reserve 90 minus amount utilized for bonus 73. Still balance is how much? 70. Sir, you said we have to utilize securities premium general reserve. Can we use P&L also? Yes. I told now whenever a company going for bonus issue, we can use free reserves, securities premium or CRR. Here in this case, what are the free reserves available to the company? P&L account to general reserve. These two are free reserves. They can use from this 90/48. They can use, or they can use securities premium some amount. First in this question I used securities premium, then balance I used it from general reserve. Okay. So this is the effect, sir. Remaining Everything is same, sir. Same as illustration number 2. You know, in this question, land was revalued, na? Revalue the land at 2,45,000. Actually, land value is how much? 148. It was revalued to 245. That means revaluation surplus 97. Hello? See this. That's why they have taken here revaluation 97 they have taken. And also P&L account, you know, in the additional information they clearly mentioned that they have transferred some amount to general reserve. Yeah. Directors declare a dividend 10%. This we will not consider as a liability. And also transferred profit at 10% to general reserve. Now you know what is the total profit? P&L account balance 48. Profit for the period from P&L account 70.7. From that 10% will transfer to general reserve. And in general reserve we will add this. General reserve, this will be added. Correct? From P&L account when we transfer to general reserve balance will increase, P&L account balance will decrease. But here see, my main focus is only one point. What is that? Bonus. You understand the bonus treatment? So whenever a company issued bonus shares, what is the impact on balance sheet? First, share capital will increase and provide a note. Second, reserves and surplus will be decreased because that bonus is given from the either free reserves or securities premium or CRR. Here I used securities premium, general reserve. If you want, you can use P&L also. Nothing wrong. Remaining sum is exactly same, sir. So you please practice this question, sir. Question number 5. Please practice this question only after illustration 2 and 6. Illustration 2 you do, then come to question number 5. You will get it. Hello. This you need to practice. Everything is explained, already discussed, sir. So many, I think 2 or 3 problems I explained all these questions. The suspense account adjustment and all this. These are all very, very repeated adjustments. So you need to prepare both balance sheet as well as P&L, sir. That's it. This is question number 5. Next question number 6, sir. See question number 6. This is MTP May 25 question, sir. This is also repeated question, sir. Already this type of question we have solved. See in this question the amounts were bank balance, it will need to write here 487,500. This is 65,937, sir. So they have given the trial balance, sir, and additional information. Additional information, what is there? Authorized capital, rent, wages outstanding at the end, depreciation, closing stock value, provision, we need to maintain 5% on debtors, income tax provision 25%, 50,000 transferred to general reserve. Term loan from public sector bank is secured against hypothecation of plant and machinery. Installment of term loan falling due within 1 year 8,50,000. That means entire term loan from public sector bank is a long term borrowings. In that 8,50,000 falls due in the next 12 months. So that will be considered as what? Short term borrowings. Trade receivables 40,800 are outstanding for more than 6 months. So we need to present it separately. And also board of directors declared a dividend at 10% on paid up share capital when 5th April. It is not considered as a liability. So you are required to prepare balance sheet as well as statement of P&L account. Nothing new, sir. Nothing new. Everything already we know. This type of questions we solved earlier. So you see here purchases given, wages and salaries given, rent, rates and taxes, selling and distribution, directors fees, bad debts, interest on term loan, land, factory, building, plant and machinery, furniture and fitting, trade receivables, advance tax paid. Where it will come? Short term loans and advances, current asset. Opening stock given, bank balances, cash on hand. And this side sales, commission, equity share capital, general reserve, opening P&L, securities premium, term loan from public sector bank, trade payables, provision for depreciation given, provision for doubtful debts given, bills payable given. I think one question we solved, ring limited question, I think. In that provision for doubtful debts we maintained at 4%. Here they have given 5% on debtors. So their asking was to prepare balance sheet as well as P&L account. Hello. So first if you, suppose for example if you start preparing P&L account balance sheet, na sir, first you write the format. In the format, first of all, shareholders fund, share capital will come, reserves and surplus will come. Next, non-current liabilities, long-term borrowings will come. Term loan from public sector bank. Hello? Next, current liabilities. Any short term borrowings are there? No. Next, trade payables will come. Short term borrowings there are. Short term borrowings. Yeah, this one. This loan fall outstanding for next 1 year, 8,50,000. That will come in short term borrowing. Current maturities of long term borrowings. Yes. Next, trade payables will come. Then short term loans and other current liabilities. Yes, rent outstanding. See, this wages outstanding is there na. Other current liabilities. And then short term provision will also come. Why? Provision for income tax. Short term provisions. Now asset side, if you see, PP, non current assets, PP is there na. Land, factory, building, plant and machinery, furniture and fixtures. Intangible assets not there. Next, come to current assets. Current investments not there. Next, inventories is there. Trade receivables is there. Short cash and cash equivalents is there. Short term loans and advances there are. Yes, advance tax paid. Next, other current assets not there. This is balance sheet, sir. Same. So equity and liability, shareholders fund, share capital, reserves and surplus, non-current liabilities, long-term borrowings. Current liabilities, we have short-term borrowings, trade payables, other current liabilities, short-term provisions. Asset side, non-current assets, PPE. Current assets, inventories, trade receivables, cash and bank balances, short-term loans and advances. Now if I start